Namaste, and a very warm welcome to The Deep Dive. I'm James.
And I'm Jennifer.
And today, we're embarking on, well, a truly fascinating journey into the world of finance. This deep dive is especially for all of you bright minds preparing for the CFA exams, particularly if you're maybe feeling a bit new to this whole financial landscape.
That's absolutely right, James. Think of us as your friendly teachers, really. We're here to simplify those complex financial ideas.
Yeah.
We truly understand that finance, it can seem daunting sometimes. So many new words, new concepts. It might feel like a different language altogether.
It really can.
But we promise we'll break everything down step by step, and we'll use examples you might see in your everyday Indian life just to make it much more approachable.
Exactly. Our mission today is to demystify the very foundations, the basics of the financial system. We'll explore what it does, why it's so important for our economy, and how all the various pieces fit together.
And all of this is based on the excellent CFA study materials you'll be using.
That's right. We'll look at things like how money moves around, what different types of assets people invest in, and the crucial roles played by, well, various financial helpers in this big system.
So by the end of this deep dive, our goal is for you to have a really solid foundation. You should understand the main functions, be able to classify different assets and markets,
Right.
identify key financial instruments, and recognize the types of financial intermediaries that, make everything work.
And we'll also touch upon how investors take different positions in the market and how trades are actually ordered and finally settled.
So shall we begin our lesson step by patient step?
Sounds like a great plan. Let's unpack this right from the very beginning. When we talk about the financial system, what exactly are we referring to? I mean, for someone completely new, it can sound quite abstract, no?
That's a wonderful starting point. Okay, imagine our financial system as a vast network. Think of roads and bridges,
Okay.
but not for cars or people. These roads and bridges are for money, for property, and even for, believe it or not, risks.
Risks, too. Interesting.
Yes, its main job is to help all these things travel smoothly between different people, companies, even governments. It's all about getting resources, money, capital, where they are needed most, and precisely when they are needed.
Right, timing is key.
Exactly. Now, this vast network, it includes various mandis or markets, like our local vegetable market.
Yes.
Or a bustling stock exchange where shares are traded. And critically, it also includes various middlemen or helpers. We call them financial intermediaries.
Okay, intermediaries, helpers.
These intermediaries are super important because they facilitate the smooth transfer of different kinds of assets.
Such as?
Well, whether they are financial assets like shares or bonds, or real assets like a piece of land or a building.
Right, physical things.
Physical things, yes. And even the transfer of financial risks from one person or company to another.
So risk can be moved around too.
Precisely. Think of it like a very efficient train system, moving people and goods across the country.
Okay, I like that analogy.
The financial system similarly moves money and financial promises from where they are plentiful to where they are needed, making sure everything reaches its destination smoothly and on time.
That analogy of a train system is really helpful. It makes it sound much less intimidating. So if that's what the financial system is, why do people, businesses, even governments use it? What are the practical reasons?
Excellent question. The source material, your CFA material, highlights 6 main purposes for which people actively use this system. Shall we look at each one carefully?
Please, let's do that.
Okay. Purpose number 1, to save money for the future.
Okay, saving. That sounds familiar.
Yes, this is probably the most relatable purpose for everyone, isn't it? People often have money right now that they don't need immediately for, say, daily expenses.
Right, extra cash.
Exactly. Instead, they want to set it aside and have it available later on, perhaps for a big life goal.
Like what?
For example, saving for retirement, maybe for a child's higher education, or even for something as significant as a big family wedding that's coming up in a few years. Yes. Weddings. Big expense.
Very big. So when you put money into a fixed deposit, what we commonly call an FD in a bank,
FD.
or perhaps invest in a public provident fund, a PPF, you are essentially saving money for your future needs. You expect to get a little bit more money back later, don't you?
Yes, you hope so. The interest.
Exactly, the interest. It's a reward for not spending it now. It's about letting your money work for you over time.
So if someone is putting aside, say, a portion of their salary every month into a recurring deposit specifically for their sister's wedding next year. They're using the financial system for saving, right? For that future goal.
Exactly. That's a perfect example of saving for the future. Clear.
Right. Very clear. Okay, what's next?
Purpose number 2, to borrow money for current use.
Okay, the opposite of saving, borrowing.
On the flip side, yes. Sometimes individuals or companies or even governments need money right now, but they simply don't have it available immediately.
Happens all the time. It does.
Yeah.
In such situations, they can borrow. They promise to repay the money later, usually with some extra amount called interest.
Right. The cost of borrowing.
Precisely. For example, think of a small kirana shop owner, like the one in your neighborhood.
Okay, yeah.
Maybe he wants to expand his business, perhaps add new shelves or buy more stock, and needs funds today. He might approach a bank for a loan.
Right.
He expects to repay this loan from the sales he will make in the future. This allows him to grow his business now, rather than waiting years to save enough.
Ah, I see. It lets them act faster. So if a family takes a home loan to buy an apartment today, because they don't have all the cash up front, they are primarily borrowing, correct?
Precisely. That's a classic example of borrowing for a current need, a large purchase.
Makes sense. Okay, purpose number 3?
Purpose number 3, to raise equity capital.
Equity capital. Okay, what's that?
This is another very important way for companies to get money, but it's fundamentally different from borrowing. Instead of taking a loan and promising to repay it, a company sells a piece of ownership in its business.
Ownership. Like shares.
Exactly like shares. The people who buy these pieces, these shares, become part owners of the company.
Oh.
Imagine a family starting a new tech company, maybe a startup. Instead of going to a bank for a loan, they might ask relatives or friends to invest money and become partners in the business.
Right, like angel investors or something.
Could be. These partners then share in the future profits or losses if things don't go well. These partnerships are essentially like equity. They are investing for a share of the future success.
Okay, so they're not lenders, they're owners. So when a new startup company sells shares to investors to get money for its operations, they're not really borrowing, they are raising equity capital, which means they are bringing in new owners. Is that right?
Yes, that's absolutely spot on. They are exchanging ownership for immediate funds. It's a trade.
Got it. Different from a loan. What's purpose number 4?
Purpose number 4, to manage risks.
Managing risks. Okay, how does the financial system help with that?
Well, life is full of uncertainties, and so is the financial world now. Everyone faces financial risk, for example, prices of things changing unexpectedly.
Yeah, like petrol prices.
Exactly. Or the risk of an accident or unforeseen events. The financial system provides us with special tools and contracts to help reduce or hedge these risks.
Hedge. What does hedge mean here?
Hedge means to protect yourself against potential losses. Think of a farmer, for example. He worries that the price of his crops, say wheat, will fall sharply after harvest.
Right, that could ruin him.
It could. So he might enter into an agreement right now, today, to sell his produce at a fixed price in the future.
Ah, lock in the price now.
Precisely. This agreement helps reduce his worry about potential price drops, giving him some peace of mind. Similarly, when you buy car insurance,
Yes.
you are effectively managing the risk of accidental damage to your vehicle.
Yep.
You're transferring that risk to the insurance company.
Okay, that makes sense. So if a textile business is worried about cotton prices going up, maybe because of bad weather, and they sign a contract today to buy cotton at a fixed price in 3 months, they are managing their risk of higher costs, aren't they?
That's it. They're using the financial system to protect themselves from that price volatility, hedging their risk.
Okay, purpose number 5.
Purpose number 5, to exchange assets for immediate and future deliveries. This is often called spot market trading.
Spot market. Okay.
This purpose is quite straightforward, actually. It's simply about trading one asset for another, either right now, immediately, or in the very near future.
Like changing currency.
Exactly. When you travel abroad, say to the United States, and you need to exchange your Indian rupees for US dollars at the airport money changer, that's an immediate exchange. We call that a spot transaction.
Spot. Got it.
Or if you have an import-export business, you might constantly be exchanging currencies to pay for goods or receive payments right there on the spot.
All right, that would be crucial for them. So if a shopkeeper buys fresh vegetables from the local mandi for immediate sale in his shop, that's a spot market trade too, correct? Buying and selling right away.
Yes, indeed. A very common, everyday spot market transaction.
All right. And the last one, purpose number 6.
And finally, purpose number 6, to trade on information.
Trading on information, like insider trading? Is that what this is?
Good question, but no, not necessarily insider trading, which is usually illegal. This is about using publicly available information, but analyzing it very deeply.
Okay, tell me more.
Some people, whom we call information-motivated traders, spend a lot of time analyzing various pieces of information. They do this to try and predict future prices of assets and hopefully make a profit.
So they're doing research.
A lot of research. Their hope is to buy something at a low price and then sell it at a higher price, or sometimes even the other way around, sell high first and buy back low later. It's all based on their unique insights and detailed analysis.
Okay. Can you give an example?
Well, think of someone who spends hours studying cricket statistics, player forms, pitch conditions, past results, before making an investment or maybe even a bet on a match outcome.
Right, like in fantasy cricket leagues.
Exactly. They are using information to predict an outcome and hopefully profit from it. In the stock market, this is similar to a smart investor who does deep, thorough research on a company's financials, its industry, its management, future prospects, everything, before deciding to buy its shares.
So they're trying to find something the market hasn't fully appreciated yet?
Precisely. They're trying to gain an informational edge to profit.
Okay. So if an investor spends a lot of time analyzing a company's financial reports, visits its factories, speaks to its management, really digs deep before deciding to buy its shares,
Oh.
hoping to earn more than the usual market return, they are essentially engaging in information-motivated trading, correct?
Absolutely. They believe they know something based on their analysis that others might have missed.
Okay, so those are the 6 main purposes people use the financial system for.
Mhm.
Saving, borrowing, raising equity, managing risk, exchanging assets, and trading on information. That's a great foundation.
Mm-hmm.
But what about the functions that the financial system itself performs to help achieve all these purposes? It's like asking, what does this big machine, this system, actually do to facilitate all this?
Good question. It connects the purposes to the actual workings. The financial system primarily does 3 big overarching things.
Okay, what are they?
First, it simply facilitates the achievement of the 6 purposes we just discussed.
Okay. It makes them possible.
Exactly. It makes it easier, cheaper, and safer for people to save, to borrow, to raise capital, manage risk, exchange assets, and trade on information. Without a well-organized system, these activities would be incredibly difficult, time-consuming, and very expensive.
I can imagine. Trying to find someone to lend you money without a bank.
Almost impossible on a large scale, yes. So that's function 1, facilitation.
Okay. What's the second function?
Secondly, it helps in the discovery of rates of return.
Rates of return, like interest rates.
Yes, interest rates are a key example. What does this mean? Think of it like finding the right price for money as it moves through time.
The price of money.
In a way, yes. If you save money today, you expect a return on it, don't you?
Yes.
If you borrow money, you have to pay interest. The financial system helps to determine what we call the equilibrium interest rate.
Equilibrium, like a balance point.
Exactly. This is the price, the interest rate, at which the total amount of money people want to save or lend equals the total amount of money people want to borrow. It's that balancing point where supply meets demand for funds.
Okay. Can you give an Indian example?
Sure. Imagine it's Diwali time. Lots of people want to borrow money for shopping, for gifts, for celebrations, right?
Yes, definitely.
And maybe, at the same time, very few people are saving money. They're spending it. So, high demand for borrowing, low supply of savings. In this situation, what do you think will happen to interest rates?
They'd probably go up.
Yeah.
To attract more savers and maybe discourage some borrowers?
Precisely. Interest rates will likely go up to balance that demand and supply. Conversely, if everyone is saving a lot, maybe after a good harvest and very few are borrowing, interest rates might fall.
Okay.
This balancing act, finding that sweet spot, is the financial system at work, helping to determine that equilibrium interest rate. And this price helps allocate money efficiently.
That's a great way to put it. So finding this equilibrium interest rate seems really crucial. Could you elaborate a bit more on why that balancing act is so important for our economy?
Of course. It's important because it puts a fair price on using money over time. If the interest rate is too high, businesses might not borrow for productive investments, slowing down growth.
Right.
And if it's too low, people might not have enough incentive to save, reducing the pool of available funds. This equilibrium helps ensure a steady flow of funds, encouraging both saving and investment, which are absolutely vital for economic growth.
Okay, that clarifies it. It guides decisions. What's the third main function?
And thirdly, it ensures the efficient allocation of capital to the best uses.
Efficient allocation. Meaning money goes where it should.
Exactly. This function is incredibly important for any economy's overall prosperity. It means that the money collected from savers should flow towards the most productive projects and businesses, the ones likely to create the most value, and not be wasted on inefficient or excessively risky ones.
How does the system ensure that?
Well, in a well-functioning financial system, investors carefully choose where to put their money. They look for projects that promise the best returns relative to the risks involved. This comparison, this analysis, incentivizes companies with genuinely good ideas. Ideas that might create jobs, innovate new products, improve services to get the funding they need.
So good ideas attract money.
Ideally, yes.
Good.
But if investors have poor or incomplete information, maybe misleading reports or just lack of research, then good projects might not get funded at all, while bad or wasteful projects might mistakenly receive funding. This kind of misallocation of capital can seriously hurt the overall economy's growth potential.
Can you give an example?
Think of different businesses in a village, all asking for loans from a local bank or maybe a microfinance institution. A good financial system helps ensure that the loan goes to the most promising business, perhaps one that will create many jobs or produce something truly useful for the community, rather than a business that is likely to fail and waste those precious funds.
Right. So if investors somehow end up putting their money into, say, a new factory project that isn't actually very good, perhaps due to bad information or just hype, it means that capital is being wasted. It isn't going to better, more productive projects elsewhere, ultimately harming the economy.
Correct.
Exactly. That's a perfect summary of allocational inefficiency. It's a drag on progress.
What's truly fascinating here is that when all these functions work well together, when the system facilitates things, discovers the right rates, allocates capital efficiently, transaction costs are low, and scarce capital is used wisely, it ultimately leads to a wealthier, more prosperous economy for everyone.
Imagine how much easier and more productive life becomes if we can trust the financial market to connect the right people with the right resources. It's truly like having a smoothly oiled engine for our entire economy, isn't it?
Beautifully put. It really is the engine of growth. So now that we have a clear understanding of the why, the purposes and functions, let's talk about the what.
The building blocks.
Exactly. What are the different types of financial instruments or assets that people, companies, and governments actually trade in this vast system?
Right. The financial world has its own unique vocabulary for these different assets, doesn't it?
Yeah.
Like any specialized field, we can broadly classify them into several main categories.
Let's start with the big one, security.
Securities. Okay.
These are formal, tradable financial assets. Tradable means they can be easily bought and sold in organized markets. Within securities, we find several important subcategories.
All right. Where should we begin?
Let's start with debt instruments, often called fixed income securities.
Debt or fixed income? Okay, like loans.
Essentially, yes. These are basically promises to repay borrowed money. They usually come with predetermined payment schedules.
Like an EMI.
Similar idea,
Yeah.
but here it usually involves regular interest payments and then the return of the original borrowed amount, the principal, at a specified future date.
Okay. Example.
A government bond is a good example. It's like a promise from the government itself to pay you interest regularly, say every 6 months, and then return your principal amount after a certain number of years.
So the government is borrowing from me.
Exactly. Think of instruments like our very own Kisan Vikas Patra or maybe a company's fixed deposit. These are examples where you lend money and expect a fixed, predictable return. That's why it's called fixed income.
Got it. Fixed returns. Are there different types?
Oh, yes. Several types based mainly on how long the promise lasts.
Okay.
Bonds are typically your long-term debt instruments, promising payments over many years, usually for more than 10 years.
Long term.
Notes are similar, but for shorter periods, typically up to 10 years. Medium term, you could say.
Medium term.
Bills are the shortest term, usually under 1 year, like the Treasury bills issued by the government. They're essentially very short-term IOUs from the government.
Very short term. Okay.
Then you have certificates of deposit, CDs. These are receipts for money deposited in a bank for a fixed period at a fixed interest rate.
Like a special type of FD?
Kind of,
Yeah.
yes. And commercial paper, this is short-term, usually unsecured borrowing by large corporations for their immediate cash needs.
Okay, companies borrowing short-term.
Repurchase agreements, repos, these are very short-term borrowings, often just overnight. One party sells an asset and simultaneously agrees to buy it back later, maybe the next day, at a slightly higher price. The price difference is the interest.
Overnight borrowing. Wow.
Yes, very common between banks. And finally, a special type, convertible bonds. These can be converted into company stock under certain conditions. They offer a mix, a hybrid of debt and equity features.
Interesting. Debt that can become ownership. So, if a company issues a paper promising to pay me a fixed interest every year for 5 years and then return my original money.
Right.
That sounds like a fixed income security. Specifically a note, maybe?
Yes, precisely. Given the 5-year term, it would likely be classified as a note, definitely a fixed income security.
Great. What's the next type of security?
Next, we have equities.
Equities.
Shares, right?
Exactly. These represent ownership in companies. When you own equities, you become a part owner. There are a few types here, too.
Okay.
Common stock or shares. This is the most, well, common type. When you own these, you are a part owner. These owners have what are called residual rights.
Residual rights, what does that mean?
It means you get paid only after all other claims on the company, like debt holders or employees owed wages, are settled. If the company does well, you benefit greatly, but if it fails, you might get nothing. So last in line. Last in line for assets, yes, but you usually have voting rights, allowing you to have a say in company decisions, like electing directors.
Ah, okay. So I own a tiny piece? Exactly. When you buy shares of a big Indian company like Reliance or Infosys on the stock market, you are buying a tiny piece of that company. You hope the company performs well, so its shares increase in value, and you might also receive dividends.
Dividends, that's a share of the profits.
Yes, parts of the company's profits distributed to shareholders.
Okay. What other types of equity?
Preferred stock or shares. These have preferred rights compared to common shares.
Preferred how?
Especially when it comes to receiving dividends, they usually get paid dividends before common shareholders, and also claims on assets if the company is liquidated. But the trade-off is they often do not have voting rights.
So more safety, less control.
Often, yes. And for valuation purposes, if their dividends are stable and fixed, they are sometimes treated similarly to fixed income securities.
Interesting. Okay. Any others?
Warrants. These are issued by a corporation and give the holder the right, not the obligation, to buy the company's stock at a set price for a specified period. They are considered equities because exercising the warrant leads directly to stock ownership.
A right to buy shares later. Got it. So if I own shares of a large Indian public company, like TCS or HDFC Bank, what kind of asset do I hold?
That would be equity, specifically common stock. You hold a direct slice of ownership in that company.
Clear. Okay, what's the next category after debt and equity securities?
Then we have pooled investment vehicles.
Pooled, like swimming pool.
Pooling money.
Exactly like pooling money. These are fantastic instruments that pool money from many, many investors, small and large, to invest in a diversified portfolio of assets. They allow smaller investors to achieve diversification that might otherwise be impossible or too expensive.
Diversification meaning not putting all eggs in one basket.
Precisely. Spreading the risk. Let's look at the main types.
Okay.
Mutual funds. This is a very common one.
Yeah.
Here, investors buy units or shares in a fund that is managed by professional fund managers. These funds can be open-ended.
Open, meaning you can buy or sell units directly from the fund itself on any business day at a price called the net asset value, or NAV. The NAV is the total value of the fund's assets divided by the number of units.
Okay, buy from the fund.
Or they can be closed-ended. Here, the fund issues shares only once, when it starts. After that, you trade those shares with other investors on a stock exchange, much like regular company shares.
Trade with others, not the fund.
Yes. And interestingly, closed-end funds often trade at a price that is different from their NAV, sometimes higher, a premium, sometimes lower, a discount. That's a unique characteristic.
Why would that happen?
Market sentiment, demand and supply for those specific shares on the exchange. Now, a very common way for individuals in India to invest is through a systematic investment plan, an SIP in a mutual fund, investing a fixed amount regularly, say every month.
Yes, SIPs are very popular.
Very. It's a disciplined way to invest in a diversified portfolio of stocks or bonds.
Okay. What else comes under pooled investments?
Exchange-traded funds, ETFs, and exchange-traded notes, ETNs, these are quite similar to mutual funds, but with a key difference. They trade on stock exchanges throughout the day, just like individual stocks.
So, like closed-end funds, but maybe different.
Similar in trading, yes, but their prices usually stay very, very close to their NAV.
How do they manage that if closed-end funds don't always?
Because of special participants called authorized participants, or APs, these large institutions can create or redeem ETF shares directly with the fund itself in large blocks. This mechanism helps keep the market price aligned with the NAV through arbitrage.
Ah, okay, a special mechanism. Example.
For example, the Nifty 50 ETF tracks the Nifty 50 index of India. You can buy and sell units of this ETF throughout the day on the NSE, just as you would with a regular share of a company, and its price will closely follow the Nifty index value.
Got it. Very convenient.
Asset-backed securities, ABS. These are securities whose value and income payments come from a pool of underlying assets.
Pool again. What kind of assets?
Imagine a large number of home loans, or car loans, or even credit card debts, all bundled together. Mortgage-backed securities, MBS, are a prime example, where the underlying assets are residential mortgages.
So payments from homeowners flow to the investors.
Essentially, yes. These securities often have different tranches or classes. Each tranche has a different level of risk and return, catering to different investor appetites. Some tranches are safer, some are riskier, but offer higher potential returns.
Okay, slicing up the risk.
And hedge funds. These are investment funds primarily for wealthy and knowledgeable investors. They are often structured as limited partnerships. They tend to have unique, often performance-based compensation structures for their managers and may use leverage.
Leverage, borrowing to invest more.
Yes, borrowing money to increase their investment size and potentially amplify returns or losses. They often use complex strategies not available in regular mutual funds.
So more sophisticated, higher risk, perhaps.
Often, yes, and typically requiring a large minimum investment.
Okay, so what would you say is the main difference in how you typically buy or sell shares of an open-ended mutual fund versus an exchange-traded fund, ETF? It seems like a key practical difference.
That's an important point for new learners. With an open-ended mutual fund, you buy or sell directly from or to the fund company itself, usually just once a day, at the calculated net asset value, NAV, for that day.
Right, end-of-day price.
But with an ETF, you trade it on a stock exchange with other investors throughout the trading day at whatever the market price is at that moment, just like you would trade a share of Infosys or Reliance.
So real-time trading for ETFs.
Exactly. That real-time trading ability and typically lower expense ratios are big advantages of ETFs for many investors.
Understood. Okay, we've covered securities, debt, equity, pooled investments. What's next in terms of asset classes?
Moving on from securities, let's discuss currencies.
Currencies like rupees, dollars, euros.
Precisely. These are simply the money issued by national authorities, by governments, or central banks. Globally, there are approximately 180 currencies in use.
Wow, that many.
Yes. Some of the most important ones, like the US dollar and the euro, are known as reserve currencies.
Reserve currencies. Why reserve?
Because central banks around the world hold them in large quantities in their reserves for international trade, settling debts, and maintaining financial stability. Our own Indian rupee, the INR, the US dollar, USD, the euro EUR, these are all examples of currencies.
Okay, so if I need to pay for something in euros while visiting Europe, what kind of asset am I using there?
That's a straightforward one. You are using currency, exchanging one currency for another, perhaps.
Got it. Next asset class.
Next are commodities.
Commodities, like raw materials.
Exactly. These are raw materials or primary agricultural products that are traded often in large quantities and standardized forms.
What falls into this category?
This category includes precious metals like gold and silver.
Ah, gold. Very important in India.
Very important. Also, energy products such as oil and natural gas, industrial metals like copper and aluminum, and agricultural products like wheat, sugar, coffee, cotton. Even things like carbon credits are considered commodities today.
Carbon credits too. Interesting.
Yes. So gold is a very popular commodity here. Many families hold gold as a traditional investment, a store of value. Other examples familiar to us could be spices, crude oil, or agricultural produce like wheat and rice that are traded in large wholesale markets, or mandis.
Okay. So what category does gold fall under in the financial market then?
It definitely falls under commodities. It's a physical good, but traded widely.
Clear. And the last main asset class.
And finally, under assets, we have real assets.
Real assets, things
Yeah.
I can touch.
Exactly. These are tangible properties, something you can physically touch and feel.
Examples.
Examples include real estate like land, houses, commercial buildings, also things like airplanes, heavy machinery used in factories, or even stands of timber in a forest.
Okay, physical stuff. How are they different in the financial world?
Well, these assets are often unique. No two pieces of land are exactly alike, are they?
Sure.
They are often illiquid, meaning they are not easy to buy or sell quickly compared to, say, shares. And they can be expensive to manage, maintain, insure.
Right. Owning a building has costs.
Exactly. However, financial intermediaries often securitize them.
Securitize. Turn them into securities.
Yes, this means they convert them into tradable securities, like real estate investment trusts, or REITs.
Ah, REITs. I've heard of those.
Or master limited partnerships, MLPs. These allow investors to buy a share in a pool of real assets, like a portfolio of shopping malls or office buildings, without having to buy the whole building themselves. It makes real estate investment more accessible.
So I can own a piece of them all.
Through a REIT, yes. So buying a plot of land for your house or investing directly in a commercial building is an example of investing in a real asset.
Okay. So is a piece of agricultural land considered a real asset or a financial asset?
It is certainly considered a real asset. It's tangible, physical, rooted in the earth.
Got it. Real means physical. Okay. That covers the main asset types. What else is traded?
Excellent. Now that we have covered assets, let's talk about another extremely important category. Contracts.
Contracts. Like agreements.
Exactly. These are essentially formal agreements between traders to do something specific in the future.
To what?
Usually to buy or sell an asset at a later date. Generally, these contracts can be physical, meaning there's an actual exchange of goods or assets planned for the future.
Like the farmer selling wheat later.
Precisely. Or they can be cash settled, where only money changes hands based on a specific formula related to the price of the underlying asset. No physical exchange happens.
Okay, just money changes hands.
Most of these are what we call derivative contracts,
Derivatives. Why that name?
because their value derives from or depends on the price of an underlying asset like a stock, a bond, a commodity, or a currency. The contract itself doesn't have intrinsic value. Its value comes from something else.
Ah, derived value. Okay. What kinds of contracts are there?
Let's start with forward contracts.
Forwards.
Okay. This is a relatively simple agreement to trade an asset in the future, but at a price that is agreed upon today.
Like booking something in advance.
Exactly. Remember our farmer example from earlier? If he agrees today to sell his wheat harvest in 3 months to a flour mill at a price set today, say $2,000 per quintal, that's a forward contract.
Right. It protects both of them from price changes.
Yes, it helps both the farmer and the mill to reduce their risk of unexpected price fluctuations. However, forward contracts come with two main challenges.
Oh, what are they?
The first is counterparty risk.
Counterparty,
Yep.
the other person's in the deal.
Yes. This is the risk that the other party to the contract might not honor their agreement. Maybe they go bankrupt or simply refuse to pay or deliver. It's a risk of default.
Ah, that sounds risky. What's the second problem?
The second problem is liquidity. It's often very difficult to get out of a forward contract before its maturity date. Because it's a private agreement between two parties, you usually need the consent of the original other party to cancel or transfer it. It's not easily tradable.
So, counterparty risk is essentially the fear that the person on the other side of your agreement might just not show up or not pay up when the time comes. That seems like a pretty significant problem for financial transactions.
That's a very practical way to look at it. It truly is the risk of the other party failing to deliver on their promise. It undermines trust.
Okay, so forwards are simple, but have risks. What's next?
Next, we have futures contracts.
Futures. How are they different from forwards?
They are like standardized forward contracts, but with a very, very important difference. A clearinghouse guarantees the performance of all traders involved.
A clearinghouse. What's that?
It's a central organization that sits in the middle of every futures trade. It acts as the buyer to every seller and the seller to every buyer.
So it takes the place of the original counterparty.
Exactly. This structure completely eliminates counterparty risk, which was that big problem we discussed with forward contracts. The clearinghouse guarantees the trade will happen.
Wow, that's a huge difference.
It is. Futures contracts are also highly standardized, specific quantities, quality, delivery dates. And because of the clearinghouse's involvement in standardization, they are very liquid. They're easy to buy and sell on an exchange before maturity.
Can you give an analogy for the clearinghouse?
Think of the umpire in a cricket match.
Okay.
The umpire ensures everyone plays by the rules, makes decisions, and makes sure the game proceeds fairly, ensuring trust and smooth play, right?
Right.
A clearinghouse is very much like that umpire for financial contracts. It ensures everyone fulfills their promises, collecting margins and managing risk.
Margins, like a deposit.
Yes, you had to put up something called initial margin, which is like a security deposit when
Yeah.
you enter a futures contract. And you might face margin calls if your position loses value significantly, meaning you need to put up more money to maintain your security deposit. This protects the clearinghouse.
Okay, so it sounds like futures contracts are generally less risky than forward contracts for a typical trader, primarily because of that clearinghouse acting as a guarantee, right?
Absolutely. That guarantee is the crucial factor that makes futures much more widely traded and trusted, reducing the risk of default significantly.
Got it. Forwards, futures, what other contracts?
Moving on to swap contracts.
Swaps, like exchanging things.
Exactly. A swap is an agreement to exchange periodic cash flows in the future based on certain asset prices or interest rates.
Periodic cash flows, so multiple payments.
Yes, unlike a forward or future, which often settles at the end. For instance, in a very common type called an interest rate swap, one party might agree to pay a fixed interest rate on a notional amount while receiving a variable interest rate on the same amount from the other party at regular intervals, maybe every 6 months.
Why would they do that?
It helps them manage their interest rate exposure. Maybe one company has borrowed at a variable rate but prefers fixed payments, while another has the opposite situation. They can swap their interest payment types.
Oh, okay. Like trading payment streams. Can you give an Indian example?
Imagine you have a home loan with a fixed EMI, but you strongly believe interest rates are going to fall, and you wish you had a variable EMI to benefit from the drop. You could, theoretically, enter a swap contract with someone who wants the opposite. Perhaps they have a variable loan and are worried rates will rise, so they want the certainty of a fixed payment. You swap the characteristics of your interest payments.
Interesting. Are there other types of swaps?
Yes, there are various subtypes, such as commodity swaps, exchanging fixed versus variable prices for oil, for instance, currency swaps, exchanging principal and interest in different currencies, and equity swaps, exchanging returns based on a stock index.
Okay. What's the main difference between a forward contract and a swap contract in terms of payments then? Just to be sure I understand.
You've hit on the core difference. A forward contract typically involves one single payment or settlement at the end at maturity. A swap contract, however, involves multiple periodic payments or exchanges of cash flows over the life of the contract, often at regular intervals like every quarter or 6 months.
Multiple payments versus one. Got it. What's next?
Now, option contracts. This is a very interesting one.
Options. Giving you a choice.
Exactly. An option contract gives the holder, the person who buys it, the right, but crucially, not the obligation.
Right, not obligation.
Okay.
The right to either buy, this is called a call option, or sell, this is called a put option, an underlying instrument like a share or currency at a specific price, called the strike price, on or before a certain future date.
So you can choose whether to do it or not.
Precisely. You pay a small amount of money up front, called a premium, for acquiring this right, this choice. The person who sells or writes the option receives this premium, but then has the obligation to fulfill the contract if the buyer chooses to exercise their right.
Okay, the buyer pays for the choice, the seller takes the obligation. Can we have an Indian example?
Sure. A call option is like buying a ticket for a cricket match.
You pay the ticket price, the premium. You now have the right to see the match, buy the underlying asset. If you decide not to go, maybe it's raining, you only lose the ticket price you paid. You're not obligated to go.
Right, I just lose the cost of the ticket.
Now, a put option. It's like having a right to sell your old scooter to someone at a fixed price, say $10,000, within the next month. You paid a small premium for this right. If the market price for similar scooters drops to $8,000 during that month, you can exercise your right and sell yours for the higher fixed price of $10,000.
So it protects me if the price falls.
Exactly. But if the market price stays above $10,000, You wouldn't exercise your right to sell at 10,000, would you? You'd just let the option expire, and you'd only have lost the small premium you paid.
So it gives me flexibility. That, right, not obligation is the key thing.
Absolutely. It's what makes options so flexible and useful for managing risk or speculating.
So if you buy a call option, you don't have to buy the underlying asset, do you? You just have the option, the choice to do so if it benefits you.
Exactly. That flexibility is what makes options so appealing and sometimes complex for many investors.
Okay. Are there any other types of contracts we should know about?
Finally, we have other contracts like insurance contracts and credit default swaps.
Insurance is a contract.
Yes, fundamentally, insurance contracts. These pay a benefit if a specific defined event occurs. Think of your life insurance, car insurance, health insurance, or even home insurance. These help you manage unforeseen risks by transferring the potential financial loss to the insurance company in exchange for premium payments.
Right, we pay premiums.
Credit default swaps, CDS. This is a type of insurance contract, but specifically against a company or government defaulting on its bonds or loans.
Insurance on loans.
In effect, yes. Bondholders often buy CDS protection. If the company they lent money to fails to pay its debt, the seller of the CDS pays the bondholder, covering their loss. It became quite famous, or infamous, during the 2008 financial crisis.
Ah, okay. So how do insurance contracts in general help individuals or companies manage risk? It feels like they're paying money, but getting security in return.
That's it exactly. They transfer the risk of a potential, often large, financial loss to the insurance company. In exchange, they pay a relatively small, regular payment called a premium. It's a way to pool risk across many people and gain financial protection against unexpected disasters.
Pooling risk. Okay, that makes sense. Phew, that's a lot of building blocks, assets, and contracts.
It is. But understanding them is crucial.
So we have the financial system itself, its purposes and functions. We have the building blocks, the assets and contracts that are traded. Now, who are the crucial facilitators? Who helps make all this happen smoothly and connects buyers with sellers?
Ah, yes. That's where financial intermediaries come in.
The helpers we mentioned earlier.
Exactly. These are entities, companies, or institutions that stand between buyers and sellers, or savers and borrowers. They make transactions smoother, cheaper, and much more efficient for everyone involved.
How do they add value?
They add value in several ways. By reducing transaction costs like search costs, information costs, by providing much-needed liquidity, making it easier to buy and sell quickly, and even by creating new and innovative financial products by repackaging assets or risks.
Okay, so what are the main types of these intermediaries?
Let's look at the main types, starting with those that primarily connect the parties or facilitate trades.
Right.
First, we have brokers, exchanges, and alternative trading systems, ATSs.
Okay, brokers and exchanges. I know those words.
Brokers. These are essentially agents. They fill orders for their clients. The important point here is that they don't trade with you directly from their own account. They act on your behalf to find someone else willing to take the other side of your trade.
So they find a buyer if I want to sell, or a seller if I want to buy.
Precisely. Your local stockbroker, the firm that helps you buy and sell shares on the National Stock Exchange, NSE, or Bombay Stock Exchange, BSE, is a perfect example of a broker. They charge a small fee, a commission, for this service. Within brokers, we also have specialized types like block brokers who focus on handling very large orders, which are typically harder to fill without affecting market prices significantly.
Right, trading huge amounts needs special handling.
Investment banks. These are very important institutions, particularly in the primary market. They advise companies on raising capital, help them issue new securities, for example, managing an initial public offering, an IPO.
We talked about IPOs earlier.
Yes. They also facilitate big corporate actions like mergers and acquisitions. They are crucial for bringing new securities into the market and advising companies on major financial decisions.
Okay, advisors and facilitators for big deals.
Exchanges. These provide the actual platforms, the marketplaces, where traders can meet electronically or sometimes physically to arrange trades according to established rules. Historically, these were physical locations with lots of shouting.
Yeah, like in the movies.
Exactly. But nowadays, most are highly sophisticated electronic platforms. Exchanges also often have a regulatory role, setting rules for their members and the companies listed on them, ensuring fair and orderly trading. The NSE or the BSE in India are prime examples of exchanges.
Right. The main markets.
Alternative trading systems, ATSs, or electronic communications networks, ECNs. These are also trading venues, like exchanges, but generally they don't have the same level of regulatory authority over their members as traditional exchanges do. Some ATSs are known as dark pools.
Dark pools. That sounds mysterious.
It does, but it just means they do not publicly display the orders, like buy or sell quantities and prices placed on them before a trade happens. This is very useful for institutional investors placing very large trades.
Why is that useful?
Because if other traders saw a huge buy order, they might quickly raise their selling prices, making the trade more expensive for the large buyer. By hiding the order in a dark pool, they hope to execute it without moving the market price against them.
Ah, avoiding market impact. Clever. So if I want to buy just 10 shares of a company and I go to a firm that helps me place the order on the stock exchange, what role is that firm playing for me? Breaker, dealer, exchange.
That firm is definitely playing the role of a broker. They are acting as your agent to execute the trade on the exchange.
Okay, broker is agent. What about dealers then? How are they different?
Next, we have dealers. These intermediaries are different from brokers because they actually trade directly with their clients. They act as principals, not agents.
They trade with me.
They buy securities from sellers and sell securities to buyers, holding an inventory of securities themselves, much like a shopkeeper holds inventory of goods.
So they keep stock.
Yes. They provide what we call liquidity, the ability to buy or sell easily and quickly with low transaction costs because they stand ready to take the other side of your trade themselves.
How do they make money then if they're taking risk-holding inventory?
Dealers profit from the bid-ask spread. We mentioned this earlier. It's the difference between the price at which they are willing to buy a security, their bid price, and the slightly higher price at which they are willing to sell the same security, their ask price.
Ah, the buy low, sell high difference.
Exactly. Think of a money changer at the airport again. They will buy your US dollars at one rate, say 82 per dollar, that's their bid price, and they will sell you US dollars at a slightly higher rate, say 83 per dollar, that's their ask price. The UF difference is their spread, their profit margin for providing the service and taking the risk.
Okay, that's clear. But you mentioned a conflict of interest.
Yes, it's important to note that sometimes a large financial firm can act as both a broker, your agent finding the best price for you, and a dealer trading with you from their own inventory, potentially at a price beneficial to them. This can create a broker-dealer conflict of interest. They might be tempted to prioritize their own profit as a dealer over getting you the absolute best deal as your broker. Regulation tries to manage this conflict.
All right, that needs careful watching. Are there special dealers?
Yes, there are primary dealers. These are special dealers who are authorized to trade directly with central banks, like the Reserve Bank of India. They play a key role in government bond auctions and help the central bank implement monetary policy by buying or selling government securities.
Okay, special relationship with the central bank.
Yeah.
So just to recap the difference, a broker acts as an agent, finding another party for my trade, while a dealer trades directly with me from their own inventory, profiting from the spread. That difference is really key, isn't it?
Absolutely, James. Understanding that agent versus principal distinction is fundamental to understanding how different markets work.
Okay. Who else helps the system function?
Then there are arbitrageurs.
Arbitrageurs. They sound like they do arbitrage.
Exactly. These are smart, quick traders who find and profit from tiny price differences for the same or very similar instruments that exist simultaneously in different markets or in slightly different forms.
How do they profit?
They buy where the asset is cheap and simultaneously sell where it's expensive almost instantly to lock in that small, usually low-risk profit.
So they're like market detectives finding price mistakes.
You could say that. And by doing so, they actually help markets become more efficient. Their actions push prices back into alignment across different markets. They provide liquidity across markets.
Is pure arbitrage common?
Pure arbitrage, where you trade the exact same thing with zero risk, is quite rare and fleeting in highly efficient markets today because technology makes information flow so fast. Often, they use more complex replication strategies to manage risk when trading similar but not identical instruments, aiming to capture near arbitrage profits.
Can you give a simple example?
Imagine a vegetable vendor who notices tomatoes are selling at one local mandi for €20 per kilogram, while just across town at another mandi they're selling for 25 per kilogram. If he can quickly buy at 20 and sell at 25, covering his transport costs, that's a simple form of arbitrage. He's helping balance the prices between the two markets.
Okay, so by exploiting those temporary price differences, arbitrageurs effectively smooth out prices across different markets, making the overall market price more accurate and efficient, right? It's like they're the market's internal police, ensuring fair pricing everywhere.
That's a fantastic analogy, James. They certainly contribute significantly to price discovery and market efficiency.
Great. Who's next in our list of helpers?
Now, let's discuss a group. Securitizers, depository institutions, which are mainly banks, and insurance companies.
Okay, securitizers first. What do they do?
Securitizers. These entities take a pool of assets. Remember those asset-backed securities we talked about?
Yes, like pools of home loans.
Exactly. Securitizers are the ones who create these pools. They gather many similar assets like thousands of home loans or car loans, put them together, and then create new securities that represent ownership or claims on the cash flows from that pool.
So they package loans into bonds.
Essentially, yes. They create securities like mortgage-backed securities,
Yeah.
MBS. And as we mentioned, they often create different tranches, distinct classes of these new securities with varying levels of risk and return profiles, appealing to different types of investors.
Why do this?
The main reason is to make illiquid assets, like individual loans, which are hard to sell, much more liquid and tradable by turning them into standardized securities. It connects the loan originators with a wider pool of investors in the capital markets.
How is it done safely?
It's often done through a special purpose vehicle, SPV. This is a separate company set up specifically for this purpose. The original loans are transferred to the SPV, which then issues the securities. This legally separates the securities from the originator, protecting investors if the originator runs into financial trouble.
Okay, a safety mechanism. Now, banks.
Depository institutions, banks. These are the banks you interact with every day. They are foundational financial intermediaries. Their core function is to take deposits from savers, people like you and me putting money in savings or current accounts, and then lend that money out to borrowers, individuals taking home loans, businesses taking loans for expansion.
So they connect savers and borrowers directly.
Yes, your local bank branch takes your savings and uses that pool of money to give loans to businesses or individuals who need funds. They act as a critical intermediary, assessing credit risk, managing payments, and facilitating the flow of capital in the economy.
So a commercial bank acts as a crucial financial intermediary by taking deposits from savers and then lending that money to borrowers, effectively connecting the two sides of the financial system.
Precisely. They are perhaps the most visible and fundamental intermediary for most people.
And insurance companies. We mentioned them under contracts too.
Yes, insurance companies also act as intermediaries, but primarily in the market for risk. They help individuals and businesses manage various risks by selling insurance contracts or policies.
How does that make them an intermediary?
They collect premiums from many policyholders, taking in funds, like deposits in a way, and then they invest these premiums in financial markets, supplying funds. When a covered loss occurs for a policyholder, they pay out the claim, so they intermediate between those paying premiums and the financial markets where premiums are invested, and also between those who suffer losses and the pool of funds available to cover those losses. They also manage risk through pooling.
Pooling risk again.
Yes. They pool risks from many clients, which makes overall losses much more predictable for them using statistics and actuarial science. Of course, they also have to manage specific issues like fraud, false claims, moral hazard, people being less careful because they are insured, and adverse selection, where primarily high-risk individuals seek insurance, making it difficult to price policies fairly for everyone.
Right, those are challenges for insurers. So why is it usually less risky for an insurance company to insure many cars than just one? You mentioned diversification earlier.
That's the power of the law of large numbers in action, James. When an insurance company insures thousands or even millions of cars, the individual accidents, while random for one person, become statistically very predictable as a group. They can estimate the total number and cost of claims much more accurately when they have a large pool of policies. This makes the overall business less risky than being exposed to the unpredictable chance of just one car having a major accident. Diversification reduces the variability.
Okay, predictability through large numbers makes sense. Are there any other types of helpers?
Finally, we have the essential back-office functions provided by settlement and custodial services. These are the behind-the-scenes helpers that ensure everything is finalized correctly and safely after a trade is agreed upon.
The plumbing of the system.
An excellent way to put it.
Okay, who does this plumbing?
Clearinghouses. We mention these when discussing futures contracts. They are crucial institutions. They arrange for the final settlement of trades, making sure the buyer gets the securities and the seller gets the money. And especially in futures and options markets, they guarantee contract performance.
We guarantee again.
Yes. If one party defaults, the clearinghouse steps in to ensure the trade is completed, preventing a failure from spreading through the system. Think of a central authority that ensures all your UPI payments or credit card transactions are finally settled between the banks involved, so the money actually moves securely from your account to the merchant's account. That's the vital role of a clearinghouse for financial trades.
Building trust and preventing chaos?
Exactly.
And custodians.
Depositories and custodians. These entities hold securities safely on behalf of clients, preventing loss or theft. When you buy shares in India today, you don't usually get physical paper certificates anymore, do you?
No, it's all electronic.
Yeah.
Demat account.
Exactly. Those shares are held electronically in your demat account, which is maintained by a depository participant, linked to central depositories like NSDL or CSDL. This electronic holding and record-keeping is a custodial service. It ensures the safety, efficient transfer, and accurate record of your share ownership.
So they're like electronic safekeepers for our shares.
Precisely. They safeguard the assets.
So clearinghouses are truly important for maintaining trust in financial markets because they guarantee that trades will be settled even if one party defaults, building immense confidence, aren't they?
Absolutely. Without robust clearing and settlement systems and safe custody, modern financial markets simply couldn't function at the scale and speed they do. They are foundational pillars of trust.
Okay. We've covered the system, the assets, the contracts, the intermediaries. Now let's talk about how investors actually participate. When you buy something, you take a position. What exactly does that mean in finance? It sounds like a stance you take.
It is, in a way. A position is simply the quantity of a financial instrument you own or owe. It's your exposure to a particular asset, and it indicates whether you generally expect its value to go up or down.
Okay. So what are the types of positions?
First, the most common one, long positions.
Going home.
Yes. When you own an asset or a contract, you have a long position. You benefit if the price of that asset goes up.
So buying something hoping it increases in value.
Exactly. For example, if you buy a plot of land today, hoping its value will increase over time so you can sell it for a profit later, you have a long position in that land. You are betting on or expecting the price to rise, and you benefit if it does.
Okay. So if I buy shares of a company, am I taking a long position or a short position?
You are taking a long position, you own the shares, and you hope the share price will rise.
Simple enough. What about the opposite? Short positions.
Next is short positions. This can be a bit tricky to understand initially, but it's very important in finance.
Okay, I'm ready. Going short.
You create a short position when you sell an asset that you don't actually own.
Wait, how can you sell something you don't own?
Good question. You do it by borrowing the asset first. You sell the borrowed asset, hoping that its price will fall. Then, if the price does fall, you can buy it back at the cheaper price later in the market and return it to the person you borrowed it from. You profit from the price decline.
So borrow, sell high, buy back low, return.
That's the sequence. Let's use that Indian example again. Imagine you borrow your neighbor's basket of mangoes, promising to return an identical basket next week.
Okay, borrowing mangoes.
You immediately sell these borrowed mangoes in the market today for 100. You strongly believe mango prices will fall sharply in a few days because a big harvest is coming.
Okay, betting on a price drop.
A few days later, mango prices indeed fall, and you can buy an identical basket of mangoes from the market for only 80. You then return this 80 basket to your neighbor, as promised.
And I keep the difference.
Yes. You've just profited 20, the 100 you received, minus the era you spent buying them back. This is precisely how short selling works in the financial markets with shares or other securities.
Ah, okay. That example makes it clear. Are there risks?
Oh, absolutely. A critical risk with short positions is that the potential loss is theoretically unbounded.
Unbounded loss. How?
Because the price of an asset you've shorted can theoretically rise infinitely. If you shorted a share at 100, expecting it to fall, but instead it rises to 200, 300, or even higher, your losses keep mounting as you'll have to buy it back at that much higher price to return it. Unlike a long position where the most you can lose is what you invested if the price goes to zero, a short seller's loss potential is unlimited.
Wow. Okay. That's a serious risk.
Yeah.
So if you short sell shares, you are essentially betting that the share price will go down to make a profit. It's the opposite bet compared to a long position.
Precisely. It's a strategy for profiting from price declines, but it carries significant and unique risks.
Understood. Long means own and hope price goes up. Short means borrow, sell, and hope price goes down.
You've got it.
Now, here's where it gets particularly interesting. You mentioned leverage earlier, and it's something every CFA student needs to grasp. Leveraged positions and margin. This is where you use borrowed money to increase your investment size, hoping to magnify your returns.
Exactly. It's like using a lever to lift a heavy weight. A small effort can move a large object. Here, a small amount of your own money can control a larger investment.
So how does it work? Let's start with buying on margin.
Buying on margin means you borrow money from your broker to buy more securities than you could afford with just your own funds. The money you borrow for this purpose is called a margin loan.
So the broker lends me money to buy shares.
Yes. Your own money that you contribute to the investment is called trader's equity, or simply margin. There's usually an initial margin requirement. This is a minimum percentage of the total purchase price that you must pay yourself with your own money. The rest can be borrowed.
Okay, so I have to put some skin in the game.
Definitely. Now, the leverage ratio is a key concept here. It tells you how many times larger your total position is compared to your own equity investment in it.
How is it calculated?
It's simply the total value of the position divided by your equity investment. For example, if you buy 100,000 euro worth of shares and you put in euro 40,000 of your own money, your equity, and borrow 60,000,
Yes.
your leverage ratio is 100,000 euro 40,000 equals 2.5. This means for every euro of your own money, you are controlling 2.50 worth of the asset.
Okay, 2.5 times leverage. Why is this ratio important?
Because it directly amplifies both your potential gains and your potential losses.
Amplifies both ways.
But let's use that 2.5 leverage ratio example. If the stock you bought goes up by 10%,
Yes.
your return on your own equity is not just 10%, it's 2.5 times 10%, which means a 25% return on your 40,000 equity.
Yeah.
Leverage magnified your gain.
Wow, that sounds great.
But, and this is the very important part, if the stock falls by 10%.
Oh, dear.
You lose 2.5 times 10%, which means a 25% loss on your equity. So a 10% drop in the stock price wipes out 25% of your initial investment. Leverage magnifies losses just as powerfully.
Right. Double-edged sword indeed. The source material had an example too.
Yes, the CFA source material provides a detailed calculation. Imagine buying 1,000 shares at $20 per share for a total investment of $20,000. If your leverage ratio is 2.5, it means your initial equity is 40% of $20,000, which is $8,000. You borrow the remaining $12,000.
Okay, 8K on own money, 12K borrowed.
Now, if the stock price drops to $15 per share, the total value of your shares falls to $15,000. You've lost $5,000 on the stock price change. 1,000 shares, $5 drop per share.
Okay, a $5,000 loss.
But remember, you still owe the $12,000 you borrowed, plus interest maybe and commissions. Your equity, which started at $8,000, has now fallen by $5,000 to just $3,000. A 10% drop in stock price, $20 to $18 would be 10%, would cause a 25% loss in your equity. This $5 drop, 25% drop in stock price, caused a loss of $5,000 on your $8,000 equity. That's a huge 62.5% loss. The percentage loss on your equity is much, much higher than the percentage loss on the stock itself, all because of the leverage.
That really highlights the danger. So if my leverage ratio was, say, 4, and the stock I bought only went up by 5%, my actual percentage return on my own equity investment, ignoring costs, would be 4 times 5%, which is 20%, right?
Correct, James. That's exactly how it magnifies returns, but the risk magnifies equally.
Now, you mentioned brokers need protection. What about maintenance margin calls?
Right. To protect themselves from lending you money against an investment that might fall sharply in value, brokers impose a maintenance margin requirement.
Another margin. What's this one?
This is a minimum percentage of equity you must maintain in your margin account after the initial purchase, relative to the current market value of your securities. It's usually lower than the initial margin requirement, maybe 25% or 30%.
Okay, a minimum equity level I must keep. What if my equity falls below that?
If your equity falls below this maintenance level, usually because the price of your investment has dropped significantly, you will get a margin call.
A call from the broker.
Yes. It's a demand, a request from your broker for you to deposit more funds, cash or more securities, into your account immediately to bring your equity percentage back up to at least the maintenance margin level.
What if I can't or don't deposit more funds?
If you don't meet the margin call in a timely manner, The broker has the right to sell some or all of your securities in the account without necessarily asking you again to recover the amount they lent you. This is called a forced liquidation, and it can lock in your losses.
Wow, they can sell my shares.
Yes, it's part of the margin agreement you sign. It's to protect the broker from losing money on the loan they gave you.
Can we use an Indian analogy for a margin call?
Think of it like this. Imagine you take a loan from a bank, and you pledge your gold jewelry as security, as collateral.
Okay, loan against gold. Common thing.
If the market value of gold falls sharply, the value of your collateral drops. The bank might then call you and ask you to either put up more gold jewelry or pay back a portion of the loan to restore the original safety margin they required for their loan. This is exactly like a margin call in the financial markets. The broker wants to ensure their loan remains adequately secured.
That makes it very clear.
Yeah.
So the source also showed how to calculate the price at which this happens.
Yes, the CFA material shows the calculation for the margin call price.
Yeah.
Using the previous example, you bought stock at $20, initial margin was 40%, so your initial equity was $8 per share and you borrowed $12 per share. Let's say the maintenance margin is 25%.
Okay, 25% minimum equity.
A margin call occurs when your equity per share, which is current price P amount borrowed $12, divided by the current price P falls to 25%. So P $12, P equals 0.25. If you solve this equation for P,
Let's see. P12 equals 0.25P. So 0.75P equals 12. P equals 12.75. P equals 16.
exactly, the margin call price is $16. If the stock price drops to $16 or below, your equity, $16 or small dollars, is 25% or less of the market value. $416 equals 25%, and you'll get that call from your broker.
So the core reason brokers issue margin calls is to protect themselves from potential losses if my investment falls too much in value, ensuring their loan to me remains covered. It's a safety net for them, not for me.
Exactly. It's their mechanism for risk management when they lend money for margin trading. Remember, leverage is a powerful tool. It can greatly magnify your returns if the market moves in your favor, but it also, very importantly, magnifies your losses if the market moves against you. It is truly a double-edged sword that needs to be handled with extreme care and a full understanding of the risks.
Absolutely vital point.
Okay.
So let's say I've decided what I want to buy or sell, a share, a bond, whatever, and I've considered margin. How do I actually tell my broker or the exchange to make that happen? You mentioned issuing an order.
Yes, you communicate your trading intention through an order.
What information goes into an order?
All orders must specify, at a minimum, the specific instrument you want to trade, for example, which company's shares, the quantity, how many shares or units, and whether it's a buy or a sell order.
Okay, well, how much and buy or sell?
Exactly. But orders also come with various specific instructions that tell the broker how and when to execute the trade.
Before we get to instructions, you mentioned bid and ask prices earlier. Could you recap that?
Certainly. In most markets, especially for frequently traded securities, you'll see two prices quoted simultaneously. The bid price is the highest price that buyers in the market are currently willing to pay for that security.
Highest buyer price.
And the ask price, sometimes called the offer price, is the lowest price that sellers in the market are currently willing to accept for that same security.
Lowest seller price.
The difference between these two prices is the bid-ask spread. This spread represents an implicit cost of trading. Buyers typically have to pay the higher ask price, while sellers typically receive the lower bid price. The dealer or market maker profits from this spread.
So the smaller the spread, the better for traders.
Generally, yes. Markets with smaller or tighter bid-ask spreads are considered more liquid and cheaper to trade in. Remember the vegetable market example. One vendor bids 20 kilograms for your potatoes, another asks 25 kilograms to sell them to you. The or-5 gap is the spread. The smaller that gap, the better the market for you.
Got it. Bid is buy price, ask is sell price, spread is the difference. Now, what about those order instructions?
Let's look at the most common execution instructions. These tell the broker how to carry out the trade.
Okay.
First, we have market orders.
Market order. Sounds straightforward.
It is the simplest instruction. You tell your broker to buy or sell immediately at the best available price currently prevailing in the market. Whatever the best bid if selling or ask if buying is right now.
What are the pros and cons?
The main advantage is speed and certainty of execution. Your order will almost certainly get filled very quickly, assuming there's enough liquidity. However, the main disadvantage is price uncertainty. You don't know the exact price you'll get until the trade is done. Especially for large orders or in fast-moving markets or for thinly traded securities, the price you get might be slightly worse than the price you saw quoted just a moment before. You might pay a bit higher when buying or receive a bit lower when selling than expected. This is called slippage.
Slippage,
Hey,
okay. Like that Indian phrase.
exactly. Like going to a shop and saying, Baya jala hai de do. Sir, whatever the price is, just give it to me. You prioritize getting it now over haggling for the absolute best price. That's the spirit of a market order.
So if I place a market order to buy shares, I am guaranteed immediate execution if possible, but I'm not guaranteed a specific price, am I? The price could slip a bit.
That's precisely it, James. You get speed, but you give up price certainty.
Okay, what's the alternative if I want price certainty?
Then you use a limit order.
Limit order. Setting a limit.
Exactly. This instruction is more precise about price. It tells your broker to buy or sell only at a specific limit price, or better.
Or better. What does that mean?
For a buy limit order, you specify the maximum price you are willing to pay. Your order can only be filled at your limit price or lower, better for you.
Okay, won't pay more than X.
For a sell limit order, you specify the minimum price you are willing to accept. Your order can only be filled at your limit price or higher, better for you.
Okay, won't accept less than Y.
What are the pros and cons here? The main advantage is price control. You are guaranteed not to get a worse price than your limit if the order fills. However, the main disadvantage is execution uncertainty. Your order might not fill at all if the market price never reaches your specified limit price during the time your order is active. You might miss the trade entirely if you're too conservative with your limit.
So I might not get the shares if the price runs away from my limit.
Exactly. Using an Indian example again, if you say, Mainto RS500 says yara nahi dunga is share ke liye. I won't pay more than RS500 for this share. You are essentially setting a buy limit order at RS500. Your order will only execute if someone is willing to sell at RS500 or less.
Got it. Price control versus execution risk. What's a marketable limit order?
That's a limit order that is priced so aggressively that it will likely execute immediately, just like a market order. For example, placing a buy limit order at a price that is higher than the current lowest ask price, or a sell limit order lower than the current highest bid price. It will likely execute right away, but it still provides some price protection compared to a pure market order, preventing execution at a drastically worse price in a volatile moment.
Okay, a limit order acting like a market order, but with a safety net.
You could think of it that way. And terms like making a new market, setting the best bid or ask, making the market, posting both a bid and ask, or behind the market, limit price worse than current best bid ask, just describe where your limit order stands relative to the current best prices, its position in the queue or order book.
So if I place a limit order to sell my shares at euro 5 and the current market price best bid is 102, my order won't execute immediately, right? It will just sit there in the order book waiting for the price to rise to 105 or higher.
Correct. It will remain pending, waiting for the market to come to your price.
Okay. Market orders, limit orders, any other execution instructions? Like about size.
Yes. Orders can also have size conditions, which specify how the quantity should be handled.
Okay.
All or nothing AON orders. These orders instruct the broker to execute the trade only if the entire specified quantity can be traded in one single transaction. If the full amount isn't available at the limit price or better, then no part of the order is filled. It's all or nothing.
Useful maybe for large orders where a partial fill isn't desired.
Perhaps, though, they can be harder to fill.
Any others?
Minimum fill sizes. These specify a minimum amount that must be traded for the order to be executed at all. For example, fill at least 500 shares or cancel the order.
Okay, setting a minimum threshold. What about visibility? Can I hide my order? You mentioned dark pools.
Exactly. We have exposure instructions, which dictate how much of your order is visible to other traders in the market.
Right.
Hidden orders. As the name suggests, these orders are not displayed publicly in the order book. They are only visible to the broker or the exchange system processing them. They are very useful for large institutional investors who want to buy or sell significant quantities without signaling their intentions to the rest of the market, which could cause the price to move against them.
So they lurk unseen.
In a way, yes. They wait to be matched against incoming orders without revealing their presence beforehand.
What about partially hidden?
Display size iceberg orders. With these, only a small portion of the total order quantity is displayed publicly in the order book, while the larger, hidden portion remains undisclosed. Once the displayed portion is executed, another small portion might be displayed, and so on. It's like an iceberg, only the tip is visible, while the bulk is hidden below the surface. This allows large traders to participate in the market without revealing their full size immediately.
Clever name, iceberg order. So a very large institutional investor might prefer to use a hidden order or an iceberg order primarily to prevent other traders from seeing their large buy or sell interest and potentially moving the price against them before they can complete their trade.
Exactly, James. It's a strategic technique to minimize market impact costs associated with large trades.
Okay, that covers how the order is executed. What about when it's valid?
Good question. Besides execution instructions, orders also have validity instructions and clearing instructions. Let's look at validity instructions first. These tell the broker or exchange when the order can be filled or how long it remains active.
Okay, the lifespan of the order.
Day order. This is the most common type by default in many markets. It's only valid for the specific trading day on which it is submitted. If it isn't filled by the end of that trading day, it automatically expires and is canceled.
So I have to re-enter it tomorrow if I still want it.
Yes, exactly. What if I want it to last longer?
Good till canceled GTC orders. As the name suggests, these orders remain active day after day until they are either filled or you explicitly cancel them. However, it's important to note that many brokers might impose their own time limit on GTC orders, perhaps 30, 60, or 90 days, after which they might automatically expire if still unfilled to prevent very old, forgotten orders from causing issues. So canceled might mean by me or eventually by the broker.
Correct. Check your broker's policy.
Any others?
Immediate or cancel IOC orders. Sometimes called fill or kill, though there can be slight variations. The core idea is that the order must be filled immediately upon reaching the market, either entirely or in part. Any portion of the order that cannot be filled instantly is automatically canceled. There's no waiting.
So take what you can get right now, cancel the rest.
Yes. Useful if you want to execute as much as possible immediately without leaving an order pending.
Okay. What about trading at the end of the day?
Good on close, market on close MOC orders. These orders are specifically designed to be filled only at or very near the market's official closing price for the day. Mutual funds often use these because they need to value their portfolios based on closing prices, so executing trades at that price is convenient for them.
Matching the closing benchmark price.
Okay.
So if I place a day order to buy shares and it's not filled by the end of the trading day, what happens to it? It just vanishes.
Yes, it expires automatically at the market close. It's gone. You'd have to place a new order the next day if you still wanted to buy the shares.
Okay, understood. Now, you mentioned stop orders earlier as being unique. How do they work?
Yes, stop orders are quite different because they are dormant until a specific price level is reached. They become active only after a specified stop price is hit or passed.
Dormant until triggered. Okay, like a trap.
You could think of it that way. The most common use is the stop loss order.
Stop loss.
To limit losses.
Exactly. These are often used by investors to try and limit their potential losses on an existing position, either long or short.
How does it work for selling?
For a sell stop loss order, used if you own shares, i.e. have a long position, you set a stop price below the current market price. If the market price drops to or below your stop price, the stop order is triggered and immediately becomes a market order to sell.
Becomes a market order, not a limit order.
Typically, yes, a standard stop loss becomes a market order. The goal is to get out quickly once the price hits your pain point.
What about for a short position? For a buy stop order, which is often used to limit losses on a short position, you set a stop price above the current market price. If the market price rises to or above your stop price, the buy stop order is triggered and becomes a market order to buy, closing out your short position.
Okay, so it triggers an immediate market order once the price level is breached. But you said earlier market orders don't guarantee a price.
That is the extremely important note about stop loss orders. Triggering the stop order does not guarantee execution at the exact stop price. When the stop price is hit, it just converts your order into a market order. In a fast-moving market, especially during a sharp price decline, a gap down, the actual execution price might be significantly worse than your stop price.
So it might sell much lower than my stop price.
It could, yes. If the price drops very rapidly through your stop level, the best available price when your market order hits might be considerably lower.
Can we have an Indian example for this?
Sure. Imagine you own a share currently trading at 110. You want to limit your potential loss, so you place a sell stop loss order at €1. You're thinking, Agar ye share 100 ka niche gaya bektina. If this share goes below 100, sell it.
Okay, setting a floor at 100.
Now, suppose some bad news comes out overnight and the stock opens the next day at 95. Your stop order at 100 was triggered the moment the price hit or went below 100, which happened at the open. It became a market order. That market order might then execute at the best available price, which could be 95 or maybe even 94 euro 93 if the price is still falling rapidly. You didn't get out at 100.
So it's a tool to try to limit loss by triggering an exit, but not a guarantee of a specific exit price. That's crucial.
Absolutely crucial to understand the risk.
So the statement, a stop-loss sell order guarantees that your loss will not exceed a certain amount. Is this statement true or false?
Based on what we just discussed, that statement is definitely false. It only activates the sell order when the stop price is hit, but the actual execution price, and therefore the actual loss, might be worse than anticipated due to market conditions.
Very important distinction. Okay, any other instructions? You mentioned clearing.
Lastly, yes, there are clearing instructions. These are usually simpler and handled by the broker based on the nature of the trade. They basically tell the brokers and the clearing system how to arrange the final settlement of the trade. For example, specifying whether it's a long sale, meaning you actually own the shares you're selling, or a short sale, meaning you are borrowing shares to sell them, which requires specific handling like locating shares to borrow.
So instructions for the final paperwork and delivery.
Essentially, yes, making sure the settlement happens correctly based on the type of trade.
Okay. We've covered orders quite thoroughly. Now, we've spoken a lot about buying and selling, assets, intermediaries. But where do these activities actually take place? We need to understand the different market structures where all these trades are arranged and executed.
Absolutely. The structure of the market itself influences how trades happen, how prices are formed, and how efficient the market is. The most fundamental distinction for CFA students to grasp is between primary and secondary markets. We touched on this briefly, but let's solidify it.
Primary and secondary. Okay.
Primary markets are where issuers, these are the companies or governments needing capital first, sell their brand new securities directly to investors to raise that capital. This is where fresh money flows to the issuer directly from the investors.
The first sale. New money for the company.
Exactly. Think of an initial public offering, IPO. This is a classic primary market event. It's the very first time a private company offers its stock shares to the general public, becoming a publicly traded company. When a new company, perhaps like Zomato or Nika recently in India, first lists its shares on the stock exchange and sells them to the public for the very first time, that's an IPO. That transaction happens in the primary market.
Right. The company gets the cash from the IPO buyers.
A seasoned offering, also called a follow-on offering. This occurs when a company that is already publicly traded decides to sell additional new shares to the public to raise more capital. Still primary market as the company gets the money.
Okay, more shares from an existing public company.
These offerings can be structured in different ways. For example, in an underwritten offering, an investment bank, or a group of them, typically buys the entire issue of securities from the company at a negotiated price and then resells them to the public. The investment bank takes on the risk. If they can't sell all the shares, they're stuck with them.
So the bank guarantees the sale for the company.
Yes, they underwrite the risk. In a best effort offering, the investment bank acts only as a broker or agent. They try their best to sell the shares for the company, but don't guarantee that all shares will be sold. The company bears the risk if the offering isn't fully subscribed.
Less risk for the bank, more for the company.
Correct. Now, it's important to note a potential conflict of interest for investment banks in underwritten offerings. They have two sets of clients: the issuing company, who wants the highest possible price for its shares, and the investors who want to buy at a lower price.
Ah, caught in the middle.
Yes. To ensure the issue sells well and to reward their investor clients, investment banks sometimes price IPOs slightly below their estimated true market value. This often leads to a price jump or pop on the first day of trading in the secondary market. Good for the first buyers, but means the company might have left some money on the table.
Right, the IPO pop.
Okay.
Are there other ways companies sell in the primary market?
Yes. Other methods include private placements. Here, securities are sold directly to a small, select group of qualified institutional investors, like insurance companies or pension funds, or very wealthy individuals rather than to the general public. These are usually quicker and cheaper than public offerings, but the securities are typically less liquid, harder to resell.
Sold to a few big players directly.
Shelf registration. This allows large, established companies to complete the regulatory paperwork for a potential future offering in advance and then put the registration on the shelf. They can then sell shares incrementally over time directly into the secondary market when market conditions are favorable or when they need capital without having to go through a full, separate registration process each time. Very flexible.
Like getting permission ready in advance.
Dividend reinvestment plans, DRPs or DRIPs. These allow existing shareholders to automatically reinvest their cash dividends into buying additional shares of the company, often commission-free and sometimes even at a slight discount to the market price. It's a primary market transaction because the company issues new shares for this.
Convenient way for shareholders to buy more.
And rights offering. Here, a company gives its existing shareholders the right, remember options, give rights, to buy new shares, usually at a fixed price below the current market price in proportion to their current shareholding. This allows existing shareholders to maintain their percentage ownership in the company, avoid dilution, if they choose to exercise their rights and buy the new shares.
Giving existing owners the first chance to buy new shares. Okay, so when a very famous new technology company sells its shares to the general public for the very first time, it's happening in the primary market, specifically an IPO, where the company gets the money directly from those first buyers. Is that right?
That's absolutely correct, James. That's the defining characteristic of a primary market transaction. The issuer receives the funds.
Okay, so what happens after the IPO? Where do shares trade then?
Now we come to the secondary markets. This is where the vast majority of trading activity happens on a daily basis. This is where investors trade already issued securities among themselves.
Among investors. So the company isn't involved anymore.
Exactly. The crucial point here is that no new funds flow back to the original issuer, the company or government, from these secondary market transactions. It's just investors exchanging ownership of existing shares or bonds with each other. One investor sells, another buys.
Why are secondary markets so important then if the company doesn't get money?
They are incredibly important, especially for the primary markets. Think about it. Would you be willing to buy shares in an IPO, primary market, if you knew you could never sell them easily later?
Probably not. I'd want an exit option.
Precisely. Secondary markets provide that essential liquidity, the ability to buy or sell existing securities quickly and easily. Because investors know they can likely sell their securities later in a liquid secondary market, they are more willing to buy them in the primary market in the first place.
It gives confidence to primary market investors.
Yes. And this liquidity, this ease of resale, generally means investors will pay a higher price for securities in the primary market, which translates directly to a lower cost of capital for the companies or governments issuing them. A vibrant secondary market makes raising capital in the primary market cheaper and easier.
Okay, that connection is vital. So after Zomato's IPO, when I buy or sell Zomato shares from another investor on the stock exchange, say the NSE, that's a secondary market transaction. The money goes between me and the other investor, not to Zomato itself.
Perfectly stated. That's the secondary market in action.
So primary is the first sale from issuer to investor. Secondary is trading between investors.
Got it. Now, within these markets, how are the trades actually arranged? You mentioned different market structures or execution mechanisms.
Yes, how orders are brought together and trades are executed can vary significantly. There are three main types of market structures.
Okay, three types. What's the first?
First, quote-driven markets, which are often called dealer markets.
Dealer markets.
Yeah.
Run by dealers. Exactly. In these markets, customers trade directly with dealers, or market makers, who actively quote prices at which they are willing to buy, the bid price, and sell, the ask price, a particular security. They provide the liquidity by standing ready to trade from their own inventory.
Where do we see these markets?
Most bonds, currencies, like the foreign exchange market, and many spot commodities trade in quote-driven markets. These markets are often over-the-counter OTC markets.
OTC. What does that mean?
Over-the-counter means trades are typically done directly between two parties. For example, you and a dealer, or two dealers, often over computer networks or phone, rather than on a centralized, formal exchange floor or electronic order book. It's a more decentralized structure.
Okay, trading directly with dealers, often OTC. So in a, quote, driven market, who typically provides the prices at which customers trade?
It's the dealers. They are quoting the bid and ask prices, making the market.
Got it. What's the second type of market structure?
Next, we have order-driven markets.
Order-driven, so driven by the orders themselves.
Precisely. In these markets, trades are arranged by rules, usually implemented by an exchange or an electronic system, that match buy orders directly with sell orders without relying on dealers to act as intermediaries in every trade.
How are the orders matched?
There are specific order matching rules. Usually, orders are ranked first by price priority. The buy order with the highest price gets priority, and the sell order with the lowest price gets priority. If there are multiple orders at the same best price, then time precedence usually applies. The order that arrived first gets filled first.
Price first, then time. Makes sense. What about hidden orders?
Good point. Displayed orders often get priority over hidden orders at the same price level, encouraging transparency.
Okay. And how is the actual trade price determined in these markets?
There are different trade pricing rules used in order-driven markets. The uniform pricing rule. This is common in call markets. We'll discuss those in a moment. All trades for a particular security during a specific trading session happen at a single unified price that best matches supply and demand.
One price for all trades in that session.
The discriminatory pricing rule. This is common in continuous trading markets. Here, the price of a trade is typically determined by the limit price of the standing order that is being filled. For example, if your incoming market buy order matches with a standing limit sell order at 100.50, your trade happens at 100.50.
Trade happens at the price of the order already waiting.
And the derivative pricing rule. Here, the trade price is derived from the price of the same asset in another market. This is often used by crossing networks, which are systems that match buy and sell orders internally, often at the midpoint of the bid, and ask prices quoted in the main exchange market.
Okay, price based on another market's price. Now, you mentioned call markets versus continuous markets.
Yes, that's an important distinction within order-driven markets, call markets. In these markets, trades occur only at specific, scheduled times, usually once or twice a day, or maybe just at the market open and close. All orders submitted between the calls accumulate, and then at the scheduled call time, the system finds a single price, using the uniform pricing rule, that maximizes the volume of shares traded.
Trading only happens at set times.
Yes, they can be very liquid during the call because all interested buyers and sellers are present simultaneously, but they are completely illiquid between calls. Think of it like an auction that happens only at fixed times. Some stock exchanges use call auctions to open or close the market.
Okay, and continuous.
Continuous trading markets. This is what most people think of for major stock exchanges like the NSE or NYSE. Trades can be arranged and executed anytime the market is open, whenever a buy order matches a sell order according to the matching rules, usually discriminatory pricing.
So trading happens throughout the day.
Yes, continuously.
What is the main advantage of a call market for trading then? It seems less convenient than continuous trading.
Its main advantage is that it concentrates all liquidity, all the buy and sell interest at one specific point in time. This makes it easier to find a match, especially for less frequently traded securities or very large orders, and can lead to a single fair price discovery during that call period. It aggregates interest effectively.
Okay. Concentrating liquidity. Got it. So we have quote-driven, order-driven. Was the third type.
And finally, brokered markets.
Brokered. Run by brokers.
Yes. In these markets, brokers act as agents who actively search for a counterparty for their client's order, especially when the instrument being traded is somehow unique, illiquid, or non-standardized.
Why use brokers here instead of dealers or an order book?
Because dealers typically won't want to hold inventory of such unique or risky assets. And an order-driven system might not work well if the asset is too unique or trades too infrequently. Think of trading very large blocks of stock, where a broker might discreetly find a buyer or seller, or complex real estate transactions, or even things like rare art or ships.
Things that need a specialist matchmaker.
Exactly. The broker uses their network and expertise to find the other side of the trade for their client.
So, if I want to sell a very rare, expensive painting, I would most likely use a brokered market, where a specialist art broker would use their contacts to connect me to potential buyers, right?
Exactly. For unique, illiquid assets where finding a counterparty requires search and negotiation, brokered markets are the most suitable structure.
Okay, quote-driven dealers, order-driven matching rules, brokered search. That covers the main structures. One last thing here. You mentioned transparency earlier.
Yes, market information systems and transparency are key aspects of any market structure.
What kinds of transparency are there?
We usually distinguish between pre-trade transparent markets. These markets publish real-time data on current quotes, bids and asks, and sometimes even the depth of the order book. quantities available at different price levels. You can see the potential trading interest before you trade.
See before you leap.
Post-trade transparent markets. These markets publish information about trades that have already occurred, typically the price and size of each trade soon after execution. You can see what prices others have actually traded at.
See what happened afterwards.
What's the value of this transparency? Transparency generally helps traders make better informed decisions and manage their trading costs more effectively. If you can see the current bids and asks, you have a better idea of a fair price. If you can see recent trades, you get a sense of market activity and direction.
So transparency is good.
Generally, yes, for most investors and for overall market efficiency. However, as we discussed with dark pools, some market participants, particularly dealers or those executing very large orders, might sometimes prefer less transparent markets. Why? Because opacity can give them an information advantage, potentially allowing them to achieve wider bid-ask spreads or execute large trades with less market impact. But for the market as a whole, transparency usually leads to fairer prices and lower transaction costs.
Okay, transparency is generally beneficial. Phew, we built up quite a picture now. The system, the parts, the helpers, the trading.
Indeed. And if all these pieces, the purposes, functions, assets, intermediaries, trading mechanisms, transparency, work together seamlessly, efficiently, and fairly, we get what we call a well-functioning financial system.
The ideal state.
Yes. And this is incredibly important for an economy's overall prosperity and growth.
What are the hallmarks, the characteristics of such a well-functioning system?
A well-functioning system typically exhibits several key characteristics. 1. Complete markets. This means that all the necessary financial instruments and markets exist for people and businesses to solve their various financial and risk management problems effectively. Whatever their legitimate needs, saving for retirement, borrowing for a house, hedging currency risk, ensuring against crop failure, there should be appropriate tools available. The system offers a full menu of options.
So no gaps in the toolkit.
Ideally, yes. 2. Operationally efficient markets. In these markets, transaction costs are very low and trades can be arranged easily, quickly, and reliably. We often use the term liquid to describe such markets. Low commissions, narrow bid-ask spreads, and minimal price impact from trades are all signs of operational efficiency. It should be cheap and easy to transact.
Smooth operations, low friction.
3. Informationally efficient markets. This is a fascinating and very important concept in finance. It means that the current market prices of assets quickly and accurately reflect all available, relevant information about their fundamental value.
All information is in the price.
To a large degree, yes, in an efficient market. This implies that prices move primarily because of new information or real changes in the underlying value of the asset, not just because of random buying and selling by uninformed traders. It means it's very difficult to consistently beat the market by finding mispriced assets based only on publicly available information.
How do markets become informationally efficient?
Well-informed, diligent traders, like those information-motivated traders we discussed, play a big role. When they conduct their research and act on it by buying undervalued assets or selling overvalued ones, they quickly push prices towards what they believe is the true fundamental value. Their actions help incorporate information into prices rapidly.
So competition among smart investors makes prices accurate.
That's a key driver, yes.
Okay, so if a country's financial markets have very high transaction costs, like big commissions and wide spreads, and it's hard to buy or sell securities quickly without moving the price, would you say it's an operationally efficient market?
Definitely not. High transaction costs and low liquidity are the opposite of operational efficiency. That market would be considered operationally inefficient.
Got it. And what are the overall benefits if a system has all these positive characteristics?
The benefits are enormous for the entire economy. A well-functioning system allows capital to be allocated to its most productive uses. That's allocational efficiency. Again, money flows to the best ideas. It facilitates efficient risk sharing, allowing those who are best able to bear risk to do so, while others can hedge or insure against risks they don't want. And importantly, it creates trust, enabling strangers to confidently contract and transact with each other over long distances and time periods. All of this leads to greater investment, innovation, economic growth, and ultimately higher standards of living and wealth for society as a whole.
It really sounds like the bedrock of a modern economy.
It truly is.
So who ensures all these wonderful things happen and continue to happen? Who makes sure the markets are complete, efficient, and fair? Who is the guardian of the financial system?
That brings us to the crucial role of market regulation.
Regulation. Rules and oversight.
Yes. Regulation is essential to ensure the financial system achieves its potential benefits and avoids potential pitfalls like fraud, instability, or unfairness.
What are the main goals, the objectives of market regulation?
Regulators typically aim to achieve several key objectives. 1. To control fraud. A primary goal is to protect customers and investors from dishonest practices, theft, and misrepresentation. In complex financial markets where information is often asymmetric, one party knows more than the other, regulation is key to preventing unacceptable losses due to fraud.
Protecting the public from being cheated.
2. To control agency problems. We mentioned this earlier with brokers-dealers. Regulation aims to ensure that financial agents, like brokers, investment managers, financial advisors, act in their clients' best interests, their fiduciary duty, especially when clients are less informed or sophisticated. This is why organizations like the CFA Institute emphasize ethical standards so strongly in your curriculum.
Making sure the helpers act helpfully.
3. To promote fairness. Regulators strive to create a level playing field for all market participants, ensuring that everyone has access to opportunities and information, relatively speaking. A prime example is prohibiting insider trading based on material, non-public information. This builds trust and encourages broader participation.
Preventing unfair advantages.
4. To set mutually beneficial standards. Regulation often involves setting common standards that benefit the entire industry and its users. For example, standardized accounting rules like IFRS, International Financial Reporting Standards, or US GAAP, allow investors and analysts to reliably compare companies across different countries or industries, making investment decisions easier and more informed. Common settlement procedures also increase efficiency.
Golden rules of the game.
5. To prevent undercapitalized financial firms from exploiting investors or causing instability. Regulators require banks, brokers, and other financial firms to maintain minimum levels of capital, their own money at risk. This ensures they have a buffer to absorb unexpected losses, can honor their commitments, and incentivizes their owners not to take excessive risks with other people's money. It promotes financial stability.
Making sure firms are strong enough to operate safely.
6. To ensure long-term liabilities are funded, particularly for entities like insurance companies and pension funds that have long-term promises to clients. Regulators ensure they maintain adequate reserves and sound investment strategies to be able to pay out future claims and benefits reliably. This protects policyholders and retirees.
Protecting long-term promises. Okay, so James, why is regulating insider trading specifically so important for market fairness? What's the core idea there?
It's crucial because it prevents people with privileged, non-public information from profiting unfairly at the expense of the rest of the market. If insiders could freely trade on secrets, ordinary investors would feel the game is rigged against them. They would lose trust and likely withdraw from the market. Regulating insider trading helps maintain confidence that the market offers a reasonably level playing field, encouraging broader participation and making the market more liquid and efficient overall. It's about trust and perceived fairness.
Trust seems to be a recurring theme here.
It is absolutely fundamental. Now, who actually does this regulating?
Good question. Who are the regulators?
Regulators can be government agencies like SEBI, Securities and Exchange Board of India in India, or the SEC, Securities and Exchange Commission in the U.S., or they can be self-regulating organizations, SROs.
Self-regulating, like the industry policing itself.
Yes, SROs are organizations formed by market practitioners themselves, like stock exchanges or clearinghouses, that set and enforce rules for their own members, subject to government oversight. They often have detailed knowledge of market practices.
Okay, government bodies and industry bodies working together. So the overarching goal of all this regulation is to create safer, more trustworthy, and ultimately more efficient markets for everyone involved.
Precisely. It's a balancing act. Regulation shouldn't stifle innovation or efficiency, but it must provide the necessary safeguards. Without proper, effective regulation, people might lose trust, withdraw their savings, good projects might struggle to get funding, and the whole economy could suffer. Regulation provides the framework of trust needed for the financial engine to run smoothly.
And that brings us, I think, toward the end of our deep dive into the essentials of financial markets for you CFA students.
It does seem like we've covered a lot of ground, haven't we?
We certainly have. We've covered everything from the basic functions and purposes of the financial system to the different types of assets like stocks and bonds, the various contracts like futures and options, the crucial roles of intermediaries like brokers and dealers, how investors take long and short positions using margin, the different types of orders, market structures, and finally, the vital role of transparency and regulation.
It's a vast and interconnected world, isn't it? But we really hope that by breaking it down step by step with examples, it feels a bit less daunting now.
Remember, everyone, this is just the beginning of your journey into finance. Each of these topics, assets, derivatives, market structures, regulation, can be explored in much, much greater detail as you progress in your CFE studies.
hmm The key is to build a strong foundation first. And we sincerely hope this deep dive has helped you connect these seemingly complex ideas to your everyday understanding, much like connecting the dots to see the bigger picture.
As you reflect on what we've discussed today, maybe think about what stood out most to you. Perhaps it was the hidden cost of the bid-ask spread, or how a clearinghouse acts like that umpire ensuring trust in trading, or even the immense power and the significant danger of using leverage.
Try to think about how these concepts apply in the real world. Maybe to the financial headlines you read in the newspapers, or perhaps the investments your own family might make or consider making.
If we connect this all back to the bigger picture, a well-functioning financial system, as we said, it's not just about making money for a few people. It's really about enabling progress, facilitating innovation, helping businesses grow, helping people achieve their life goals, and ultimately building a stronger, more prosperous economy for everyone in society.
Absolutely. And looking forward, it raises an important question, perhaps something for you to think about on your own. How do you think technology, things like online trading apps on your phone, artificial intelligence being used in investment decisions, the rise of digital currencies and blockchains, how might these powerful forces further change how these traditional market functions and structures operate in the future? What new opportunities or maybe even new challenges and risks might they bring to this whole system we've discussed?
That's a great thought to end on. Thank you all so much for joining us on the deep dive. We wish you all the very best in your CFA studies. Keep exploring, keep asking questions, keep learning, and remember, building a strong foundation leads to strong and lasting understanding.
Danyawad, thank you for listening, and we look forward to our next lesson together. Welcome, everyone, to another deep dive here at the Deep Dive.
Hello.
I'm James, and joining me today is Jennifer.
Great to be here.
And we are embarking on a truly, truly essential journey today.
Absolutely. Foundational stuff.
We're going to unpack a topic that is, well, it's absolutely fundamental for anyone stepping into the world of finance, especially perhaps for our aspiring CFA candidates who might be feeling just a bit overwhelmed by all the new terms and concepts.
It can feel like a lot at first.
Think of this as laying the bedrock, you know? Building the ground floor for your entire financial understanding.
That's absolutely right. Imagine you're building a strong multi-story house. For your family's future, maybe?
Okay.
You wouldn't start by building the roof, would you? No.
Right.
You begin with a solid foundation.
Makes sense.
And we've received a stack of excellent material on this topic, security market indexes. Our mission today is simple. Break it down brick by brick. So you not only understand what these indexes are, but also why they are so crucial in the investment world, and very importantly, how they actually work behind the scenes.
Right, the mechanics.
Exactly. We promise to go slow, use clear, simple language, and we'll give you plenty of examples from our everyday lives, right here in India, to help make everything click into place.
So, whether you're trying to get your head around the market for your upcoming CFA exams, or maybe you're just curious about how we measure the health, the direction of our economy and investment opportunities, this deep dive is really custom tailored for you. Get ready for some, hopefully, some truly illuminating insights, some aha moments.
Let's hope so.
Okay, let's start right at the very beginning then. Imagine, just for a moment, you want to know how well the Indian stock market is doing today. Right now.
Okay.
Would you really go and check the price of every single share listed on the Bombay Stock Exchange? Or the National Stock Exchange?
My goodness, no. Thousands of them.
Exactly. That would be like, well, it'd be like trying to understand an entire cricket match by meticulously tracking every single run scored.
By every single batsman.
Every single ball bowled, every single wicket taken.
Across multiple matches even.
Yes. Just to know if Team India is winning overall, it would take forever. You'd be exhausted before you even grasped the big picture.
Precisely. You've hit the nail on the head. That's exactly where a security market index comes in.
Okay.
An index is like,
yeah.
Well, it's like a single simple number, or you could call it a consolidated measure. And it tells us really quickly at a glance how a specific market, or maybe a particular part of a market, or even just a defined group of investments is performing
So it simplifies
It
things.
does. It's designed specifically to summarize vast amounts of information into one easily understandable figure. This helps investors quickly gauge market sentiment, track performance over time, and even compare different segments of the economy. Instead of drowning in thousands of individual stock prices, you get a clear, concise snapshot.
Right, like a summary statistic.
Exactly. Let's push that cricket analogy a bit further. Think of the scoreboard in a cricket match.
Okay, big screen at the stadium.
Right. You see the total runs of a team, say 250 for 5 wickets.
Yep.
Now, you don't need to know every single run scored by every single batsman to understand if the team is doing well or if they're, you know, struggling a bit.
True. You just look at the total.
That total score, or maybe even a specific player's strike rate, that acts as an index of their performance. It simplifies all that complex dynamic data into something digestible, a key metric.
Ah, okay, I see.
In the financial world, an index does exactly this. It gives you a quick, representative overview of a larger, more complex whole.
That's a perfect way to put it. And what's really fascinating, isn't it, is how relatively new these financial indexes are.
Considering how long markets have been around.
Right. Financial markets are centuries old. Investors in London could get individual security prices way back in 1698. But it took almost 200 years for someone to actually come up with a simple aggregate indicator, a summary number.
So who did it first?
Well, the very first one, it was called the Dow Jones Average. It appeared in the U.S. in 1884.
Dow Jones. Rings a bell.
Yes. Introduced by publishers Charles H. Dow and Edward D. Jones. And initially, it was tiny, just 9 railroad companies and 2 industrial companies.
Very specific.
Very. That eventually evolved into what we now know as the Dow Jones Transportation Average. But then later, in 1896, Dow and Jones were convinced that industrial companies would be the great speculative market of the future.
Looking ahead.
They were. So they introduced a second, even more famous index, the Dow Jones Industrial Average, the DJIA.
The one we hear about all the time.
That's the one. It started with an initial value of just 40.94, believe it or not.
40.94.
Yes, and it included just 12 industrial stocks. From those really humble beginnings, now we have thousands and thousands of indexes worldwide.
Measuring everything imaginable.
Pretty much. Specific sectors, entire global markets. They've become absolutely indispensable tools for investors everywhere.
So just to recap quickly then, at its very core, a security market index is essentially an indicator or a measure of something.
Okay.
It represents a given security market, maybe a specific market segment, or perhaps an entire asset class.
Right.
And these indexes, they're typically constructed as hypothetical portfolios, like pretend portfolios.
Hypothetical, meaning you don't actually buy the stocks.
Well, the index provider doesn't
Yeah.
necessarily. It's a calculation. They create a theoretical portfolio of marketable securities. And the value of this index, this number, it's calculated regularly, often in real time, using the actual or sometimes estimated market prices of the individual securities within it.
The ones that make up the index.
Exactly. We call those the constituent securities.
Constituent securities. Got it.
Now, just to check understanding, can you think of any other index from our daily life here? Something that gives us a quick summary of something complex.
Something like, oh, like the air quality index, maybe? AQI.
Perfect example.
We hear about it all the time in the cities. You don't need to know the exact concentration of every pollutant, right?
Not at all.
Just one number tells you if the air is good, bad, or, really unhealthy today.
Exactly. Or think about the Consumer Price Index, the CPI, that we hear about in the news regarding inflation.
Yes, inflation numbers.
It tells us about the overall change in prices for a whole basket of goods and services that people buy, not just the price of, say, onions or petrol.
Right. It averages it out.
It does.
Yeah.
All these are indexes that simplify complexity, making big pictures easier to grasp.
Okay, that makes sense. Now, when we talk about how an index performs over time, you mentioned calculations. There seem to be 2 crucial ways to look at it. And you said understanding the difference is key.
It really is. Very important for any investor, especially long-term ones.
So what are they?
They are price return and total return.
Price return and total return.
Correct. Many new investors, perhaps even those just starting their CFA journey, might sort of gloss over this distinction.
Easy to do, I imagine.
It is, but it's incredibly important for understanding true performance.
Okay, let's break them down. First one, price return.
Yes, price return index. This is the simpler of the two.
Okay.
It's like looking at the price of a share and only caring if its price went up or down just due to market movements. Nothing else.
just the capital appreciation then.
Exactly. It reflects solely the changes in the prices of the individual shares, the constituent securities within that index. So if, say, the S&P BSE Sensex Price Return Index goes from 60,000 points to 60,600 points, it means the prices of the shares included in the Sensex have collectively gone up by 1%. That's it. It ignores any other forms of income those shares might have generated.
Like dividends.
Precisely. It's a straightforward measure of capital appreciation, only how much the value of your initial investment has grown simply from those price changes.
Okay. Seems simple enough. So what's the other one? Total return.
Right. And here's where we get the complete picture. This is the one that really matters, especially for long-term investors. The total return index.
Complete picture. How
Yeah.
so?
Well, the total return index considers not only those changes in the share prices, but also, crucially, the reinvestment of any income received from those shares.
Reinvestment. You mean like plowing the profits back in?
Exactly. This income could be in the form of dividends from stocks, or perhaps interest payments if we're talking about bonds. It gives you a much more comprehensive and frankly more accurate picture of your investment's true performance.
Why? Because it includes everything.
Because it accounts for all the ways your investment can generate wealth price changes and income, and the growth on that reinvested income.
Ah, the compounding effect.
You got it. Let's use a proper Indian example. Imagine you run a small kirana shop, a local grocery store.
Okay. Selling biscuits, soaps, rice.
Exactly. Now, if you only count how much the value of your existing stock, the goods on your shelves, has changed in price. Maybe the price of rice went up. That's like tracking price return. You're just looking at whether your inventory value went up or down based on market prices.
Okay. Just the stock value.
But what if you also include the profits you made from selling those goods? Your daily sales revenue minus your costs.
Ah, the actual earnings.
Yes, and then this is the key part. You reinvest that profit back into your shop by buying even more stock to sell.
Buying more inventory with the profits.
Correct. That entire process is like tracking your total return, you see. The total return will always show you a bigger, truer picture of your shop's earnings over time.
Why always?
Because it includes all the income generated and the powerful effect of putting that income back to work, essentially compounding your gains. Your larger inventory can now generate even more profit.
That compounding effect, it really is the quiet powerhouse of long-term investing, isn't it?
It absolutely is. And here's a crucial point about the two index types. At the very beginning, when an index is created, both its price return and total return versions start at the exact same value.
Okay, they're equal initially.
Yes. But as time passes, the total return index will always grow larger than the price return index. Always.
Because of that reinvested income.
Precisely because it includes all the dividends or interest income that has been reinvested. And crucially, those reinvested earnings themselves start earning returns. It snowballs.
Can you give a quick number example?
Sure. Imagine an index starts at 1,000.
Right.
In the first period, let's say its price return is 5%, and it also yields an additional 1.5% from income, like dividends.
Okay.
The total return for that period is 5% plus 1.5%, which is 6.5%.
Right.
So the price return index value would become 1,000. 1 plus 0.05 equals 1,050.
Makes sense.
But the total return index value would become 1,000. 1 plus 0.065 equals 1,065.
Ah, higher already.
Exactly. And if this continues over many periods, that gap between 1,050 and 1,065 just keeps widening, and it widens exponentially because of the power of compounding. The reinvested 1.5% starts earning returns too.
So just to really nail this down, price return equals capital gains only. Total return and capital gains plus income plus the growth on that reinvested income.
Perfectly summarized. This geometric linking of returns over multiple periods means the total return index can grow significantly, often vastly more, over long periods.
So the biggest takeaway here for you listening, especially if you're an aspiring investor, is this. If you're tracking your long-term wealth, if you're trying to understand your true investment growth.
Always look at the total return index.
Always. A price return index alone, it kind of hides the magic of compounding, doesn't it?
It does. It gives you an incomplete and frankly potentially misleading picture of your actual earnings over time.
Right. So quick check then. If you invest in a company's shares and it pays you regular dividends, which type of return, price return, or total return will give you a more complete, more accurate picture of your investment's performance over the long run? And why?
Think about what you're truly getting back from that investment. Is it just the price change or is there more?
Okay, so we know what indexes are, and we know the crucial difference between price and total return.
Foundational concepts covered.
Now, let's dive into the really interesting part. How are these things actually built? And how are they managed?
It's quite a process. It's actually quite similar in many ways to building and managing a highly specialized investment portfolio for a very specific goal.
Like a custom plan.
Exactly.
Right.
Think of it like a master chef planning a very special multi-course meal for a very discerning gathering. Maybe a big wedding feast.
Okay, I like that. A wedding feast.
They can't just throw anything into the pot, can they?
Oh, no.
They need to make very deliberate, careful choices at every single step.
From the menu planning to the final presentation.
Precisely. And this next point is absolutely critical because it underpins the entire integrity and usefulness of any index.
Okay, what is it?
Index providers, these are the expert organizations, the chefs, who create and maintain these vital market indicators. They have to make 5 key decisions, just like our master chef curating that feast menu.
5 key decisions. Let's hear them.
1. What market do they want the index to represent? This is like deciding, is the feast going to be authentic North Indian, maybe a modern South Indian fusion, or perhaps an array of dishes from across the globe? The target audience and the culinary goal dictate everything. Okay, define the scope first. Makes sense. What's 2? 2. Which specific shares or securities should be included? Which specific vegetables, which spices, which meats, which lentils go into each dish? Each ingredient's quality and suitability are paramount. You can't just use anything.
Right. Selecting the components. Number 3.
3. How much weight or importance should each security have in the index? How much turmeric versus how much chili powder? How much paneer versus how much potato? Each ingredient's quantity matters hugely, and it impacts the overall flavor profile, the final taste.
Weighting. Okay.
Crucial. 4.
4. When should they adjust the weights of these securities? This is what we call rebalancing. You know, if a spice is proving too strong, or maybe a vegetable is slightly undercooked, the chef might adjust it slightly during the cooking process to ensure perfect harmony in the final dish. Fine-tuning along the way. Rebalancing. Got it. And the last one. Number 5.
5. And when should they re-examine the whole list of securities, potentially swapping some out entirely? This is called reconstitution. Sometimes a main ingredient might need to be swapped out. Maybe it's not fresh anymore, maybe it's unavailable, maybe it just no longer fits the overall culinary theme of the feast.
Replacing ingredients. Reconstitution. Okay, those 5 seem comprehensive.
They cover the life cycle of an index. Let's start unpacking those first 2 critical decisions then. Target market and security selection.
Right, defining the scope and picking the players.
Exactly. The target market is the very first and arguably the most crucial decision. It precisely defines the investment universe the index intends to measure. What part of the vast financial world are we trying to capture?
So it could be broad or narrow.
Very broad, yes. Like an index trying to represent all shares listed in India. Or it could be incredibly specific. For instance, an index tracking only technology companies listed in Mumbai with a market capitalization above a certain threshold, say 500 crore rupees.
Wow, that's specific.
It can be. The target market can be based on the type of asset shares, bonds, maybe something else. It could be based on a geographic region, Asia, Europe, or specific countries like Japan or South Africa.
Or even smaller categories.
Oh, yes. Or even other characteristics like the economic sector a company operates in, like banking or pharma, or its size, large cap, mid cap, small cap,
Yeah.
or even its investment style, like value or growth stocks.
So many possibilities.
For example, an index provider might specifically decide to create an index representing large cap Indian pharmaceutical stocks. That's a very, very tightly defined target market. Clear objective.
Okay, so once they've defined that target market, what's next? Selecting the actual securities.
Exactly. Step 2, security selection. Choosing the actual individual shares or bonds that will make up the index.
How do they do that? Just pick their favorites?
Haha, no, not usually.
Mm-hmm.
Some well-known indexes, like the S&P 500 in the US or the FTSE 100 in the UK, they have a fixed number of companies, and often that number is right there in the name.
S&P 500 has 500 companies. FTSE 100 has 100.
Broadly, yes. That's the target. Others, like Japan's 2PX, that's the Tokyo Stock Price Index, might include all the largest stocks that meet certain predefined criteria.
So the number can change.
Yes, the actual number of securities in TOPIX can fluctuate over time as companies meet or fail to meet the criteria. To be included in TOPIX, for example, stocks have to meet specific objective hurdles. Things like having a minimum number of shares outstanding, a certain number of shareholders, and a minimum market capitalization.
So rules-based.
Often, yes. If a stock no longer meets these objective criteria, it gets removed at the next review.
But is it always purely rules-based?
That's an important distinction. Sometimes these selection decisions are made purely by objective mechanical rules. A computer algorithm could decide based on clear numerical cutoffs or predefined criteria. Very systematic.
Okay.
But sometimes, and this is true for our own S&P BSE, Sensex here in India, or even the S&P 500 in the US, there's a dedicated selection committee involved.
Human judgment comes in.
Yes. This committee makes more subjective judgments about which companies best represent the market segment the index aims to capture. They balance the strict rules with a degree of market insight and qualitative assessment.
Interesting. A blend of objective and subjective.
You can be. Now let's try a quick exercise for you listening. Imagine you wanted to create a simple index, just for fun, for small independent retail businesses in your local Mumbai neighborhood.
Okay, like the local shops.
Exactly. What would be your target market definition? And what kind of security selection rules might you use to decide which specific shops to include in your neighborhood index? How would you define small or independent? Think about the criteria you'd set.
That requires some thought. Okay, moving on from selection. You mentioned the third key decision was weighting.
Yes. Index weighting. This is a very crucial decision because it profoundly impacts how the index behaves and what it actually represents.
How so?
Weighting determines how much influence each company's share each constituent security has on the index's overall value calculation.
Like how much power each player has on the team's score.
A good analogy. And there are several different methods for assigning these weights, each with its own distinct pros and cons. Like choosing different base ingredients for our feast. Each brings a different texture and flavor to the final index.
Okay, what's the first method?
The first one we'll discuss is price weighting. Historically, this is the simplest method. It's actually the one Charles Dow used way back when he constructed the original Dow Jones Industrial Average.
The oldest one.
Seems like it. And the logic is very straightforward. The higher a security's price per share, the more weight it gets in the index. Simple as that.
So a high-priced stock moves the index more.
Yes. You can almost imagine the index portfolio just holding one single share of each constituent security. So if one company's share price is, say, 1,000, and another's is only 100, the 1,000 share will have 10 times the influence on the index's movement compared to the 100 share. It's weighted simply by its price per share, regardless of the company's overall size or number of shares.
Okay. Can you give an Indian example for that?
Sure. Think about our fruit vendor again, selling apples, bananas, oranges.
Right.
If he were to calculate the average price of his fruit basket by simply adding up the price per piece of each type of fruit and then dividing by the number of fruit types,
Okay.
the more expensive fruits would naturally pull that average higher, wouldn't they?
Yeah, mathematically.
So if apples are much more expensive, say 200 apart per piece, compared to bananas at maybe 50 per piece, then apples will automatically have a higher weight in his total fruit basket value calculation, even if he actually sells fewer apples by quantity.
Ah, I see. So if apple prices jump, his average jumps more than if banana prices jump.
Exactly. The price gives them more influence in this specific calculation method.
Now, you mentioned something earlier about stock splits affecting these.
Yes, absolutely. A unique and very important property of price-weighted indexes, something you should definitely make a note of, is how they handle stock splits.
What's a stock split again?
A stock split is when a company decides to increase the number of its outstanding shares. They issue more shares to existing shareholders, maybe 2 for every one they hold. And critically, the share price halves proportionally at the same time.
So the total value doesn't change.
Exactly. If you had one share worth 100 and it splits 2 for 1, you now have 2 shares, but each is worth 50. Your total holding value is still 100. The company's overall market value hasn't changed just because of the split.
Okay. So what's the issue for a price-weighted index?
The issue is that the price per share suddenly drops, right? The 100 share becomes a 50 share.
Ah. And since the index is weighted by price?
Sure, precisely. The index value would suddenly plummet just because of this split, even though the underlying value of the company hasn't actually changed. That would be misleading.
So how do they fix that?
To prevent this artificial drop, the index provider must adjust a special number called the divisor.
The divisor.
Yes. When the index is calculated, you sum the prices of all the constituent stocks and divide by this divisor. After a stock split lowers one of the prices, they adjust the divisor downwards as well, so that the final index value remains the same immediately before and after the split. It's a mathematical adjustment to maintain continuity.
Okay, that sounds a bit complicated to manage.
It adds a layer of complexity, yes. So let's summarize price weighting. The primary advantage is its simplicity. Historically, it was easy to calculate.
Right, just add prices and divide.
But the main disadvantage is that it results in somewhat arbitrary weights. Higher-priced stocks have a disproportionately bigger impact, which doesn't necessarily reflect the company's overall importance or actual size in the broader market.
And those stock splits cause problems.
They do. They cause these arbitrary changes in weights and necessitate those adjustments to the divisor, which can introduce complexity and arguably makes the index less representative of the true market structure.
Okay, so not perfect. What's the next weighting method?
Next up, we have equal weighting. And as the name clearly suggests, this method is quite different.
Equal, so everyone gets the same slice.
Exactly. In this method, each security is given the exact same weight in the index, at least at the beginning of each measurement period, usually when it's rebalanced.
So if there are 100 stocks.
Each one starts with a 1% weight. The index provider conceptually allocates an equal amount of the index's total notional value to each security.
Okay. How about an Indian example for equal weighting?
Think of a parent giving pocket money to their children.
Okay.
If they have, say, 5 children and they decide everyone gets the same amount, they give each child exactly 1/5 or 20% of the total pocket money available.
Regardless of age or anything else.
Exactly.
Yeah.
Regardless of age, needs, school performance, everyone gets an equal share. So if the total pocket money available is 500, each of the 5 children gets 100.
Simple fairness.
In that sense, yes. Similarly, in an equal-weighted index, if the total index value represented, say, 10,000, and there were 5 stocks in it, each stock would initially represent 2,000 of that value. Equal footing at the start.
What's the advantage of doing it this way?
Well, like price weighting, its main advantage is also its simplicity and perhaps its intuitive sense of fairness. Every company, big or small, starts off with the same level of importance in the index calculation.
Okay, but are there disadvantages? It sounds almost too simple.
There are a couple of significant ones, yes. First, think about the market itself. Some companies are huge, right? Massive market values. Others are tiny.
True.
In an equal-weighted index, those securities that constitute the largest fraction of the actual target market value are naturally underrepresented compared to their real market size.
Because they only get the same small percentage as everyone else.
Exactly. And conversely, securities that constitute only a tiny fraction of the target market value are overrepresented. A small company, in terms of its actual market value, gets the same initial importance as a giant multinational.
Which might not reflect their actual influence on the economy or the market.
Correct. It might not accurately reflect their size or influence. Second, and this is a really critical operational point, think about what happens after you set those equal weights. Stock prices constantly change, don't they?
All the time.
So as prices fluctuate, those weights quickly become unequal. If one stock's price surges by 50% and another's drops by 20%, their initial 20% weights, in our 5-stock example, will no longer be equal at all.
So it drifts away from being equal weighted.
It drifts immediately.
Right.
This requires very frequent adjustments, what we call rebalancing, usually done every quarter. The index provider has to actively sell the winners that grew too large, buy the losers that shrank just to bring the weights back to equal.
And that trading costs money.
It does. This constant rebalancing means more trading activity within funds that track such indexes, leading to higher transaction costs and potentially higher capital gains taxes for the investors in those funds. So, simplicity in concept, but potentially costly in practice.
Okay. Price weighting has issues. Equal weighting has issues. What's the most common method then, especially for the big indexes we hear about?
Right. Most commonly, especially for the large, broad market indexes that track entire countries or regions, we see market capitalization weighting. This is also widely known as value weighting.
Market capitalization or value weighting. Okay.
This is arguably the most widely used method globally. Why? Because it naturally reflects the actual proportion of a company's value in the overall market. It tends to mirror how typical broad market investment portfolios are already constructed.
So how does it work? What determines the weight?
Here, the weight of each security in the index is determined directly by its market capitalization.
Market capitalization. Remind me what that is exactly.
Sure. It's simple, really.
Yeah.
Market capitalization, or market cap, is just the total current market value of all of a company's shares that are outstanding.
All its shares combined.
Yes, you calculate it by multiplying the total number of shares a company has issued by its current market price per share.
Number of shares times share price. Got it.
So, for example, a company with 1 million shares outstanding, and each share is currently trading at 100.
Has a market cap of 100 million.
Exactly. Now, in a market cap weighted index, the higher a company's market cap, the greater its weight, and therefore the greater its influence on the index's overall movement. Bigger companies matter more.
Okay. Can we have an Indian example for this one too?
Definitely. Imagine a large, diverse group of businesses, all within a big family conglomerate here in India.
Okay, like a Tata or a Reliance Group structure.
Something like that.
Yeah.
Now, within that group, you might have a massive textile mill that has millions of shares issued and perhaps a high share price. It's a huge business.
Right.
And maybe in the same group, there's also a small artisanal pottery workshop. It has far fewer shares issued and maybe a lower share price. It's a much smaller part of the overall group's value.
Clear difference in scale.
Absolutely. Now, in a market cap weighted index that included both, the textile mill would automatically have a much, much larger influence on the index's performance than the little pottery workshop.
Why? Just because it's bigger overall.
Precisely because its total market capitalization, its overall market value is much larger. It represents a bigger part of the overall market's value that the index is trying to track. This method attempts to reflect the real-world scale and economic significance of companies within the market.
Okay, that seems logical. Is there a refinement to this?
Yes, there is. A more refined and, in fact, very widely adopted version today is called Float Adjusted Market Capitalization Weighting.
Float adjusted. What does float mean here?
Good question. Market float refers to the shares that are actually readily available for public trading on the open market.
As opposed to shares that are locked up.
Exactly. This sophisticated approach considers only those shares available for public trading. It specifically excludes shares held by controlling shareholders, like the founding family, shares held by other companies, cross-holdings, or shares held by governments. Essentially, it excludes large blocks of shares that aren't readily available for the investing public to buy or sell.
Why exclude those?
Because it provides an even more accurate picture of what's actually accessible to typical investors in the market. It reflects the supply of shares truly available for investment.
Makes sense.
And today, most major market capitalization weighted indexes, including many big global ones and our own key Indian indexes like Nifty 50 and Sensex, are float adjusted. It's become the standard.
So what's the main advantage of market cap weighting, whether float adjusted or not?
Its primary advantage is its inherent market representativeness. It naturally reflects the actual proportion of a company's value within the overall target market. Companies that are larger in market value have a greater impact on the index's performance, just as they would on a typical investor's broadly diversified portfolio. It's seen as a natural reflection of the market's collective valuation judgment.
Okay. Sounds like the winner. But are there any disadvantages? Nothing's perfect, right?
You're right. There is a widely discussed disadvantage, and it's a critical point for aspiring finance professionals to understand.
Okay, let's hear it.
Think about how it works. Companies whose share prices have risen a lot, their market cap goes up, right?
Naturally. Price times shares outstanding.
So they automatically get a higher weight in the index. Conversely, companies whose share prices have fallen, their market cap shrinks, and they automatically get a lower weight.
Okay, so what's the problem with that?
The potential problem is that this can lead the index to overweight companies whose prices have perhaps run up too much. Maybe they're becoming overvalued, and it could underweight companies whose prices have fallen. Perhaps they're temporarily out of favor, but might actually be undervalued.
Ah, so it reinforces trends, buys more of what's gone up, less of what's gone down.
Exactly. It inherently creates a kind of momentum effect. Stocks that have performed well in the past continue to have a larger influence on the index's future performance.
And the risk is?
Critics argue this means the index can become over-concentrated in companies or sectors that might be experiencing a speculative bubble. And at the same time, it might underweight those companies or sectors that are out of favor, but potentially offer better long-term value. It's not necessarily forward-looking, it reflects current market popularity.
Interesting point. So is there a way to weight stocks that avoids this momentum effect?
Yes, that leads us to the final major weighting method, fundamental weighting.
Fundamental weighting. Okay, how does this try to solve the problem?
This method attempts to address that potential shortcoming of market cap weighting, particularly its momentum effect and potential concentration in hot stocks. It does this by using measures of a company's size or value that are independent of its share price to determine its weight in the index,
Independent of the share price, like what?
like the company's underlying economic footprint or substance. These fundamental measures can include things like the company's book value, essentially its assets minus liabilities from the balance sheet, its cash flow, how much cash the business is generating, its revenues or sales, its earnings or profits, the dividends it pays out to shareholders, or even something as simple as the number of employees it has.
So you weight companies based on their actual business size or profitability, not just their stock market value.
Precisely. The idea is to base the weight on economic size or fundamental value, not just the potentially volatile market price.
How does that work in practice? Give me an example.
Okay, let's say an index provider decides to create an index weighted by earnings. Companies with higher total earnings will simply get a greater weight in the index, regardless of their share price or market cap.
So profitability drives the weight.
Yes. Or imagine an index weighted by dividends. Companies that pay out larger total amounts of dividends get a higher weight.
What effect does this have compared to market cap weighting?
It often gives the index a characteristic called a value tilt.
Value tilt, meaning it favors value stocks.
Generally, yes, because companies with higher earnings or book value relative to their market price, which are often characteristics of value stocks, tend to get a greater weight than they would in a market cap index.
Okay.
It also tends to have what's called a contrarian effect.
Contrarian, meaning it goes against the cloud.
In a way, unlike market cap weighting, which buys more of what's gone up, fundamental weighting often systematically shifts weights away from stocks that have become relatively expensive, where prices outrun fundamentals, and towards those that have become relatively cheaper, where prices lagged fundamentals. It's automatically rebalancing towards fundamental value, not market momentum.
That sounds like a very clever way to potentially avoid chasing bubbles and maybe capture value opportunities.
That's the argument proponents make, yes. It decouples index weight from stock price level.
Okay, quick check on this then. Let's say a well-known company's share price goes up significantly, maybe by 50% in a year. But its actual underlying earnings, its profits, they remain relatively flat during that same period.
Right. Price up, fundamentals stable.
How would its weight likely change in a market capitalization weighted index versus a fundamentally weighted index, say one based on earnings?
Think about what drives the weight in each case. Price versus fundamentals. What would happen?
Okay. Lots to think about with weighting. So we've covered defining the market, selecting securities, and weighting them. What about managing the index over time? You mentioned rebalancing and reconstitution.
Exactly. Building an index, as we've seen, involves many deliberate choices. But once it's built, it's not a static thing you just leave alone. It needs ongoing management to stay relevant, accurate, and true to its purpose.
Like maintaining a garden. You can't just plant it and walk away.
Perfect analogy. Just like a professional cricket team needs regular practice, reviewing individual player performance, maybe making strategic changes in players, or the batting order. Indexes also need continuous management.
And the two main processes are?
Rebalancing and reconstitution. People often confuse them, but they are distinct.
Okay, let's clarify. Rebalancing first.
Yes. Rebalancing simply means adjusting the weights of the securities already in the index to keep them consistent with the chosen weighting method.
Bringing things back into line.
Precisely. Remember our equal-weighted index example, where every company initially got, say, 20% weight?
Yes.
We discussed how, over time, if one company's share price zooms up and another's drops, their actual weights will naturally drift away from that initial 20%.
Right. They become unequal.
So to maintain the integrity of the equal-weighted label and methodology, the index provider needs to rebalance. This is usually done on a regular schedule, often quarterly or maybe semi-annually.
And what does rebalancing actually involve? Buying and selling.
Yes, absolutely. The process involves systematically selling some of the securities that performed well and whose weights have consequently grown too large. Selling them brings their weight back down to the target 20%.
Selling the winners.
And simultaneously buying more of those securities that underperformed and whose weights have shrunk. Buying more brings their weight back up to the target 20%.
Buying the losers, relatively speaking.
Relatively, yes. This process, of course, creates turnover within the index. Turnover just means there's actual buying and selling of the constituent securities by the many funds that are trying to track that index.
And turnover has consequences.
It does. Turnover generates transaction costs, brokerage fees, bid-ask spreads, and potentially triggers capital gains taxes if profitable positions are sold. These costs ultimately get borne by the investors in the funds tracking the index. So high rebalancing frequency can mean higher hidden costs.
Do all index types need frequent rebalancing?
Interestingly, no. Price-weighted indexes, for instance, don't need rebalancing in the same way. Their weights are directly tied to share prices, so they kind of self-adjust as prices move, although they need divisor adjustments for splits.
What about market cap weighted?
Market capitalization-weighted indexes also largely rebalance themselves naturally. As companies' price goes up, its market cap increases, and its weight in the index automatically increases proportionally. No active trading is needed just because price has changed.
So they only need adjustments sometimes.
Yes, they typically only need adjustments for significant corporate actions, like if a company merges with another, gets acquired, issues a huge amount of new stock, or unfortunately goes bankrupt and is liquidated. These events change the shares outstanding or the company's existence, requiring the index provider to step in, but not just for day-to-day price changes.
Okay. Let's try a relatable scenario for rebalancing. Imagine you initially invest an equal amount, say 1,000, in each of your favorite Indian sweets. Maybe gulab jamun, jalebi, and laddu.
Delicious portfolio.
Indeed. Now, after a month, you find that gulab jamun has become incredibly popular and its price has doubled, so your holding is worth 2,000. But jalebi became less popular, its price halved, and your holding is only worth 500. Laddu stayed the same at 1,000. Your total portfolio is now 3,500.
Right, the weights have drifted far from the initial one-third each.
Exactly. What would rebalancing your sweet portfolio mean if you wanted to get back to having an equal investment value in each of the 3 sweets? What would you have to buy and sell?
Think about bringing those values back to roughly 1,167 each, which is 3,500 divided by 3.
Okay, that's rebalancing. What about the other process, reconstitution? You said it was a bigger change.
Yes, much more fundamental. Reconstitution is the process of actually changing which specific securities are included in the index. It's not just about adjusting the weights of the current members, it's about deciding who is in the club and who is out.
Changing the team members, not just their positions.
Exactly like that. Think back to our national cricket team analogy. Before a big tournament, the selectors review the entire player roster.
Right. Who's in form, who's not.
Precisely. They look at who is performing well, who isn't, who might be injured or retired, and crucially, who might be a new rising talent that should be added to the squad.
Replacing players.
Yes. The index providers do essentially the same thing, typically on a regular schedule, maybe annually or semi-annually. They reapply their initial criteria for security selection, the rules they set up back in step 2.
To see who still qualifies.
Exactly. They use these criteria to decide which companies to keep in the index, which ones to remove because they no longer fit the criteria, and which new companies should be added because they now qualify. Companies that no longer meet the original selection rules get replaced.
Why does this happen? Why do companies stop fitting?
Well, companies change constantly, don't they?
Yeah.
A company might unfortunately go bankrupt, or it might get acquired by another company and cease to exist as an independent entity.
Okay.
Or on the positive side, a company might grow so big that it no longer fits the criteria for, say, a small cap index it was originally part of. It might graduate to the mid cap or large cap index.
So it keeps the index relevant.
That's the whole point. Reconstitution ensures the index continues to accurately represent its defined target market and remains true to its stated purpose. It's how indexes stay relevant and reflective of the current, evolving market landscape, not stuck in the past.
Does reconstitution affect stock prices? You hinted at this earlier.
Oh, absolutely. Dramatically sometimes. The process of reconstitution can have a huge impact on the prices of the shares involved, often leading to significant market activity and even speculation before the changes are officially made.
How so? People anticipate the changes.
Yes. For instance, when a company is widely expected to be added to a popular, widely tracked index, like the Nifty 50 or the S&P 500, its stock price can shoot up significantly in the weeks or months leading up to the official inclusion date. Why? Because thousands of index funds and ETFs that track that index must buy that stock once it's added.
They're forced buyers.
Essentially, yes. And other savvy investors, knowing this forced buying is coming, will often buy the stock in anticipation, hoping to profit from the price increase. This creates a surge in demand even before the index funds start buying.
Can you give an example of that?
There was a really striking historical example with a company called Uranium Energy Corporation, UEC, back in 2009. Its stock value increased by more than 300% in just a single quarter.
300%. Why?
Primarily because investors strongly believed it was going to be added to the Russell 2000 index, which is a very widely followed index of small-cap U.S. stocks.
And was it added?
Yes. When the index provider, Russell, listed UEC as a preliminary addition, the stock continued to be bid up even higher, ultimately rising nearly 400% for that quarter.
Wow. That clearly shows the immense market power these index decisions have.
It does. Just the decision by an index provider to add or remove a company can create temporary but significant buying or selling pressure, impacting prices purely due to the mechanics of index tracking, not necessarily due to new information about the company's fundamentals.
Okay, so final check on this section. If a well-known company that is currently included in our S&P BSE Sensex unfortunately goes bankrupt, its operations cease, its stock stops trading.
A sad situation, but it happens.
What management process will the index provider need to undertake to ensure the Sensex remains an accurate representation of the top Indian companies? Will it primarily be rebalancing or reconstitution, and why?
Think about whether the company's weight just needs adjusting or if its membership in the index itself is the issue.
Right. Okay, we've dug deep into the how indexes are built and managed. Now let's shift focus a bit. Why do we even have them? What are their actual uses? You said they're more than just seeing if the market went up or down.
Oh, much more. Indexes serve a whole variety of incredibly important and quite sophisticated purposes in the financial world. Think of them as a versatile, almost indispensable tool in any serious investor's or analyst's toolbox.
Okay, tool number one. What was their original purpose?
Well, initially, as we discussed with Dow Jones, they were really just simple gauges of market sentiment. They acted as basic barometers, reflecting the collective mood, the confidence or nervousness of investors.
Like a market mood ring.
Something like that. The Dow Jones Industrial Average, for example, has such a long history that it's still quoted everywhere in the media, newspapers, TV news, largely serving this broad purpose of indicating daily market direction and sentiment.
But you mentioned it only has 30 stocks.
Exactly, and that's an important caveat. While it's useful for a quick sentiment check, it's crucial to remember it only contains 30 very large, mature U.S. industrial and now other sector stocks, so it might not accurately reflect the mood or overall attitude of the entire market, which includes thousands of other U.S. stocks of all sizes and types. It's more of a snapshot of large-cap sentiment rather than a comprehensive market picture.
Okay, so beyond just sentiment, what else? You mentioned risk.
Yes, a very important use. Indexes are absolutely crucial as proxies for measuring and modeling returns, systematic risk, and risk-adjusted performance.
Proxies, meaning they stand in for the whole market.
Exactly. For those of you delving into advanced finance topics, you'll definitely encounter sophisticated models like the Capital Asset Pricing Model, or CAPM. Heard of it?
Vaguely. It involves data, right?
It does. CAPM defines beta as the measure of a security's systematic risk. That's the market risk you cannot get rid of just by diversifying your portfolio relative to the entire market.
Okay.
Now, in these complex financial models, you need a representation of the entire market portfolio. Since owning every single asset in the world is impossible, brand market indexes are widely used as practical proxies for this theoretical market portfolio.
Like using Nifty 50 or Sensex as a proxy for the Indian market.
Precisely. Or the Tokyo Price Index in TOPIX, Japan, or the S&P 500 in the United States are often used as proxies for the market portfolio in their respective countries when calculating betas or evaluating performance.
And this helps investors understand risk.
Yes. It helps investors understand the systematic risk, the beta, of an individual stock or an entire portfolio. It also allows them to measure risk-adjusted performance. That tells you not just how much return an investment made, but how well it performed relative to the level of market risk it took on. Did it deliver returns higher than expected for its level of beta?
Okay, so if my portfolio has a beta of 0.95 compared to the Nifty 50.
It means your portfolio is estimated to have 95% of the systematic risk of the Nifty 50 index. You'd expect it to move very closely with the market, perhaps slightly less volatile on average.
Got it. What's another use? You mentioned asset allocation.
Yes, indexes act as vital proxies for asset classes in asset allocation models. This is fundamental to portfolio construction.
Asset allocation, that's deciding how much goes into stocks, bonds, gold, etc.
Exactly. When you or your financial advisor decide how to divide your investment money across different broad types of assets, shares, bonds, maybe real estate, gold, or other alternative investments, you need historical data.
Data on how each asset type has behaved in the past.
Correct. You need to know how these different asset classes have performed historically, not just in terms of average return, but also their volatility risk, and how they tend to move in relation to each other, their correlations.
And indexes provide this data.
They do. Indexes provide readily available long-term historical data series for various asset classes. This historical performance information is crucial for building diversified portfolios that are tailored to an investor's specific financial goals, time horizon, and tolerance for risk.
So without indexes.
Without indexes, it would be incredibly difficult to systematically model, compare, and understand the long-term behavior and correlations of these broad asset categories. Strategic asset allocation, the cornerstone of portfolio management, would be a much, much harder task.
Okay. That sounds critical. What else are indexes used for? You mentioned fund managers.
Ah, yes, this is a huge application, particularly relevant for anyone aspiring to work in asset management or become a financial advisor. Indexes serve as crucial benchmarks for actively managed portfolios.
Benchmarks, like a measuring stick.
Exactly like a measuring stick. Investors, whether they are individuals like you and me or large institutions like pension funds, frequently use indexes to evaluate how well their hired fund managers are actually doing.
Comparing the manager's results to the index's results.
Precisely. It's like comparing a student's exam score to the class average, or maybe to the score of the top student in the class. The index acts as a standard, a baseline, against which the manager's skill and, importantly, their ability to generate alpha, that's excess return above what the benchmark delivered, are measured. Did the manager add value through their active decisions?
But you stressed earlier, choosing the right benchmark is vital.
Absolutely. Critically important. You must choose the right benchmark for the comparison to be meaningful.
Can you give that example again?
Sure. If your fund manager's stated strategy is to invest specifically in small-cap Indian companies,
Okay. Niche strategy.
then you absolutely should compare their performance to an index specifically designed to track small-cap Indian companies, not to the broad Nifty 50 or the Sensex, which are dominated by large-cap stocks.
Why is that so important? What if you use the Nifty 50 anyway?
Using the wrong benchmark can lead to completely inaccurate and potentially very misleading conclusions about the manager's actual skill or lack thereof.
How?
Well, imagine a period where small-cap stocks, in general, are doing much better than large-cap stocks. Your small-cap manager might actually be doing a poor job within the small-cap universe. Maybe they're underperforming the small-cap index?
Okay. Lagging their peers.
Yes, but because small-caps overall are booming, they might still happen to outperform the large-cap dominated Nifty 50 index for that period.
Ah, so if you only compared them to the Nifty 50.
You might mistakenly think, wow, my manager's doing a great job. They beat the Nifty. But in reality, they failed to add value within their chosen specialization. They actually lost value compared to simply buying a small-cap index fund.
That's a huge difference in interpretation.
It is. This is why professionals, like CFA charter holders, spend considerable time ensuring proper benchmark selection. It has to be appropriate for the manager's mandate. Apples must be compared to apples.
Okay, that's clear. One more use you mentioned, model portfolios.
Yes, finally, indexes serve as the fundamental model portfolios for various investment products that have become incredibly popular.
Products based on indexes.
Exactly. Indexes are the very basis, the blueprint, for hugely popular and accessible investment products like index funds and exchange-traded funds, ETF.
Index funds and ETFs, we hear about those a lot.
You do. These products are specifically designed to passively track or replicate the performance of a specific underlying index. They aim to deliver the return of the index, minus some small fees.
How do they replicate it?
They're built to hold the exact same constituent securities, the same shares or bonds in the exact same proportions, weights, as the index they are designed to track. They essentially try to mirror the index's portfolio.
Can you give an Indian example here?
Absolutely. Many investors here in India, especially those starting out or those who prefer a low-cost, hands-off approach, choose to simply buy, say, a Nifty 50 index fund.
Why is that popular?
Because its objective is simply to replicate the performance of the Nifty 50 index. By buying just one fund, they get broad market exposure to the 50 largest, most liquid Indian companies, without having to research, select, and manage individual stocks themselves.
So it's diversified and simple.
And typically very low cost compared to actively managed funds. ETFs are similar in principle. They also track indexes, but they have the added feature of trading like individual shares on the stock exchange throughout the trading day. This offers more flexibility for those who want to trade intraday.
And the growth of these passive funds has influenced indexes.
Immensely. The explosive popularity and growth of these passive investment products have even led index providers to create brand new, sometimes very narrowly defined indexes specifically designed to serve as the basis for new ETFs. They cater to very specific investment themes, sectors, or strategies that investors are interested in.
Fascinating how it feeds back. Okay, final check question for this section then. Thinking about all these uses, why is choosing the right benchmark index so profoundly important when you're trying to evaluate the performance of an active portfolio manager? What are the risks of getting it wrong?
Consider the implications of making a comparison that isn't truly fair or relevant. What conclusions might you wrongly draw?
All right. Now, as we approach the final segment of our deep dive today, let's embark on what you called a grand tour. A look at the sheer variety of index types that exist.
Yes, let's explore the landscape. Just like we have a truly dizzying array of different spices, cuisines, and dishes across our diverse Indian kitchens.
North Indian, South Indian, Gujarati, Bengali, so many.
Exactly. Similarly, in the financial world, we have a wide variety of indexes, each one meticulously designed, like a specific recipe, to capture a particular part of the market, a specific asset class, or a distinct investment style.
And understanding these different flavors is key.
It's key to knowing which index, which spice, to use for which specific purpose. You wouldn't use garam masala when the recipe calls for sambar powder, right?
Definitely not. Okay, where do we start this tour? Equities.
Let's start with equity indexes for shares. These are generally the most common type you'll encounter day to day.
Okay. What kinds are there within equities?
First, we have the really big ones, broad market indexes. As their name clearly suggests, these aim to represent almost the entire stock market of a particular country, or sometimes even a region.
The whole market, or close to it.
Very close. They typically include securities representing more than 90%, sometimes even 98 or 99%, of the selected market's total market capitalization. They give you that very wide, holistic view of the market's health and overall direction.
Any examples?
Sure. In China, there's the Shanghai Stock Exchange Composite Index, SSE. It's a market capitalization-weighted index of all shares trading on the Shanghai Stock Exchange. In the United States, a famous one is the Wilshire 5000 Total Market Index, which, despite the name, now holds several thousand stocks and aims to represent the entire U.S. equity market. Another one is the Russell 3000, covering about 98% of the U.S. equity market by market cap.
So very comprehensive. What if you want to look beyond one country?
Then you need multi-market indexes. These are specifically designed to represent multiple security markets, often combining indexes from different countries or even entire regions.
Like a global view.
Exactly. They might represent multiple national markets bundled together, or entire geographic regions like Asia-Pacific or Europe. Or they might group countries based on their level of economic development, developed markets, emerging markets, frontier markets. Some even try to capture the entire world's stock markets.
Why would investors use these?
For global investors who want to diversify their investments beyond just their home country and who don't want to bias their portfolio too heavily towards any single nation, these multi-market indexes are incredibly important. They offer a consolidated view of global trends and allow for global benchmarking.
Any famous providers of these global indexes?
Yes, MSCI Morgan Stanley Capital International is a very well-known global index provider. They offer many sophisticated multi-market indexes.
How do they categorize markets?
They classify markets along two main dimensions. First, by the level of economic development. Developed markets like US, Japan, UK, emerging markets like India, China, Brazil, and frontier markets, smaller, less developed markets.
And the second dimension?
By broad geographic regions. The Americas, Europe combined with Africa, and Asia combined with the Pacific. So you can get indexes like MSCI Emerging Markets Asia or MSCI World.
Where does India fit in?
India is currently classified as an emerging market within MSCI's global framework.
Interesting. You also mentioned some weight countries differently.
Yes, this is quite fascinating. While most multi-market indexes weight countries based on their relative stock market capitalizations, some actually weight countries by their gross domestic product and their GDP.
By the size of their economy, not their stock market.
Correct. MSCI actually introduced this concept back in 1987. At that time, the Japanese stock market had boomed so much that Japan made up a huge 60% of the market cap weighted MSCI EAE index. That's Europe, Australasia, Far East.
60% just from Japan.
Yes. To provide an alternative perspective, MSCI created a GDP-weighted version, which effectively halved Japan's allocation, giving more weight to countries with large economies but perhaps smaller stock markets relative to Japan at that time.
So fundamental weighting at the country level.
Exactly. It creates a very different perspective on global market performance, shifting emphasis based on economic output rather than just stock market size.
Okay. Broad markets, multi-markets. What about focusing on specific industries?
Yes, that brings us to sector indexes. These track specific economic sectors like technology, healthcare, energy, banking, consumer goods, you name it. They can be created on a national level, like India and IT, a regional level, or even a global level.
Why track specific sectors?
They help investors and analysts understand how different parts of the economy are performing, which sectors are leading the market, which are lagging. For example, during a technology boom, you'd likely see a technology sector index significantly outperform, say, a utility sector index.
Are these sector indexes related to broad market indexes?
Usually, yes.
Yeah.
They're often organized as families, where the aggregation of all the different sector indexes within that family, when weighted appropriately, should theoretically equal the broad market index they are derived from. It's like cutting the whole market pie into sector slices.
Can you give an Indian example?
Sure. We have several sector indexes here. For instance, there's the Nifty IT Index, which tracks the major Indian information technology companies. There's a Nifty Bank Index, a Nifty Pharma Index, and so on.
And how are these useful?
They are invaluable for performance analysis. They help investors and analysts figure out if a particular fund manager's success or failure comes from their skill in wisely choosing good individual stocks within a sector, what we call stock selection skill, or if it comes more from correctly allocating the fund's money to the sectors that happen to be performing strongly overall, what we call sector allocation skill. Sector indexes help disentangle those two effects.
Performance attribution. Okay. What's the last type within equities? You mentioned style.
Yes, style indexes. These are very popular too. They group companies based on distinct characteristics, usually related to either their size or their investment style.
Size we mentioned. Large, mid, small.
Exactly. Size is typically measured by market capitalization. This leads to categories like large cap indexes for the biggest companies, mid cap indexes for medium-sized companies, and small cap indexes for smaller companies.
Are the definitions standard? What makes a company large cap?
That's a good point. There's no single universally agreed upon definition for the exact market cap cutoff between large cap, mid cap, and small cap. Different index providers often use slightly different thresholds or percentile ranks, so you need to check the specific index methodology.
Okay. And the other dimension was investment style.
Right. Investment style broadly categorizes companies, most commonly into value or growth.
Value versus growth, what's the difference again?
Generally speaking, value stocks are often companies that appear relatively undervalued by the market compared to their underlying fundamentals. They might have low price to earnings, PE ratios, low price to book PB ratios, or perhaps high dividend yields. They are often mature companies with stable, predictable earnings.
Okay. And growth stocks.
Growth stocks, on the other hand, are typically companies whose earnings and revenues are expected to grow much more rapidly than the overall market. They often reinvest most of their profits back into the business to fuel that growth, rather than paying out large dividends. Consequently, they often trade at high PE ratios because investors have high expectations for their future growth. Think potentially younger, faster expanding companies.
Can you combine size and style?
Oh, absolutely. These style categories are frequently combined with size categories. So you can have indexes specifically for small cap value stocks, smaller companies that appear undervalued, or large cap growth stocks, large companies expected to grow rapidly, and all the combinations in between. Large cap value, small cap growth, mid cap value, mid cap growth.
So quite granular. Do stocks stay in one style box forever?
No, definitely not. Company characteristics change over time. A growth stock might mature and become more of a value stock. A small company might grow into a mid-cap. Because of this, stocks frequently migrate between these different size and style categories, especially when the indexes are reconstituted.
Does that have implications?
Yes, it generally leads to higher turnover, more buying and selling, within style indexes compared to broad market indexes, as stocks get reclassified and moved between the different style boxes. This constant repositioning is important for investors tracking these indexes to understand, as it can impact costs.
Okay, quick check then. If you, as an investor, strongly believe that smaller companies have more potential to grow faster than large established companies,
hmm A common investment thesis.
and you are specifically looking for stocks that might be currently undervalued or overlooked by the wider market,
Right. Growth potential plus value characteristics.
which specific style index combination would you be most interested in tracking and perhaps even investing in? Think size and style together.
What label would capture that best?
Okay, we've covered a lot on equity indexes. What about the other major traditional asset class? Bonds, fixed income.
Right. Let's move on to fixed income indexes. These are for bonds, things like government bonds, gilts, or bonds issued by companies, corporate bonds.
Are they similar to equity indexes?
In concept, yes, they track the performance of a defined market segment, but they come with their own unique and quite significant set of challenges compared to equity indexes.
Challenges. Why? What's different about the bond market?
Primarily, the fixed income market is vastly different from the equity market in terms of its structure, the sheer number of securities, and importantly, its liquidity.
Okay, tell me more about these challenges. What's the first one?
First, the sheer volume of fixed income securities is just enormous. There are a huge number of individual bonds out there, far more distinct bond issues than there are listed company shares.
Really? Why so many?
Because governments, central, state, local, government agencies, and countless corporations all issue a wide variety of bonds with different maturities, different coupon rates, different features. It just creates a massive universe of debt securities. And index tracking, say, the broad U.S. bond market, might include tens of thousands of different individual securities.
Wow, tens of thousands. Compared to maybe 500 in the S&P 500, that's a big difference. What's the second challenge?
Second, and this is a major practical hurdle for index providers, liquidity. Many bonds, especially corporate bonds issued by smaller companies or older government bonds, simply don't trade very often. Some might not trade for days or even weeks at a time.
So it's hard to know their current price.
Exactly.
Yeah.
If something doesn't trade, how do you know it's true? Current market price. It makes it incredibly hard to get accurate, reliable, up-to-the-minute prices for every single bond that's supposed to be in the index.
So what do the index providers do? Just guess.
Not exactly guess, but they often have to estimate prices. They might use prices from similar bonds that are trading actively, or they might use complex mathematical valuation models based on interest rates and credit spreads. But this introduces a layer of estimation or matrix pricing, which isn't quite the same as having a real traded market price like you usually get for stocks.
Okay, estimation adds uncertainty. What's the third challenge?
Third, flowing directly from these first 2 points, the huge number of securities and the difficulty in pricing many of them, it's often much more costly and practically difficult to exactly replicate a broad bond index compared to replicating a broad stock index.
Harder for index funds or ETFs to match the bond index?
Yes. Imagine an index fund trying to buy and hold, say, 20,000 different bonds, many of which are hard to find and price. It's often impractical. So bond index funds often use sampling techniques, where they hold a representative subset of the bonds in the index, trying to match its key characteristics like duration, credit quality, sector exposure, without holding every single bond.
And bonds mature, right? Does that add complexity?
Absolutely. Unlike stocks, which can exist indefinitely, bonds have finite maturity dates. They constantly mature and need to be replaced in the index with newly issued bonds. This creates constant, unavoidable turnover within bond indexes as old bonds expire and new ones are issued, adding another layer of management complexity and transaction costs.
So despite these challenges, bond indexes are still important.
Oh, incredibly important, because bonds are a massive and vital part of the global financial system and investor portfolios. So despite the difficulties, providers create and maintain many fixed income indexes.
How are bonds categorized for these indexes?
Bonds can be categorized in many different ways to create different types of indexes, allowing investors to track specific segments of the debt market. Common categorizations include: by the type of issuer. Is it issued by the central government, sovereign bonds, a government agency, a state or municipality, or a corporation? By their maturity. Are they short-term, maturing in, say, 1 to 3 years? Intermediate term, maybe 3–10 years, or long-term, 10+ years. By their credit quality. This reflects how likely the issuer is perceived to be to pay back the money. You have high-quality investment-grade bonds, like AAA, AA, BBB ratings, considered very safe, and lower-quality, riskier high-yield or junk bonds, BB rating or below, which offer higher interest rates to compensate for the higher risk of default, or even by the currency the bond is denominated in, or specific features like inflation linking.
So you can get quite specific bond indexes too.
Yes. For example, the Bloomberg Barclays U.S. Aggregate Bond Index is a very famous, widely used benchmark. It's a broad market bond index in the U.S., encompassing thousands of U.S. investment-grade fixed-income securities across various government and corporate categories. But you can also find indexes just for U.S. high-yield corporate bonds, or just for Eurozone government bonds, and so on.
Can you give an Indian context for fixed income?
Sure. Think about something regular you pay, like your electricity bill or your mobile phone bill every month. That's typically a fixed payment you owe, right?
Usually, yes.
Bonds work similarly, but often in reverse. They typically promise to give the investor fixed interest payments, often called coupons, at regular intervals, like every 6 months or annually, plus the principal back at maturity. It's like receiving a steady income stream. So a fixed income index would track a whole basket of these kinds of fixed payment instruments, maybe government securities, GSECs, or corporate bonds issued by Indian companies. It provides a summary of how that segment of the debt market is performing based on changes in bond prices, which move inversely to interest rates and the interest they pay. It gives you a pulse on the debt market and interest rate trends.
Okay. So, considering all those unique characteristics, the huge number, the pricing difficulties, the constant maturities, why might it generally be harder and probably more expensive to create, maintain, and especially for a fund manager to replicate an index for bonds compared to an index for stocks?
Think about the sheer operational complexity involved in tracking thousands of often illiquid securities versus maybe a few hundred actively traded stocks. What are the practical differences?
Right. Equities, fixed income, what's left? You mentioned alternatives.
Yes. Lastly, let's explore indexes for alternative investments. This is a broad category for things that fall outside the traditional buckets of stocks and bonds. We're talking about things like commodities, real estate, and hedge funds.
Why are these getting more attention?
Because as investors increasingly seek diversification beyond just stocks and bonds and look for new sources of returns that might behave differently, these alternative asset classes have become more important. And so naturally, indexes have been developed to try and track their performance too, although often with even greater challenges.
Okay, let's start with commodity indexes. What do they track?
These indexes track the prices of underlying physical commodities. Think raw materials like gold, silver, crude oil, natural gas, or agricultural products such as rice, wheat, corn, soybeans, coffee, sugar, or even livestock.
How do they track these? Do they actually hold barrels of oil or sacks of rice?
Haha, no, that would be highly impractical. Imagine the storage costs and logistics. Instead, commodity indexes typically gain exposure to these commodity prices by using futures contracts.
Futures contracts, what are those briefly?
A futures contract is basically an agreement to buy or sell a specific commodity at a predetermined price on a specific date in the future. Commodity indexes usually hold a portfolio of these futures contracts representing various commodities.
Okay. Now, you mentioned earlier that commodity indexes tracking the same commodities can have very different returns. Why is that?
Yes, this is a really unique and crucial point about commodity indexes that you absolutely must grasp. Even if two different indexes track the exact same basket of underlying physical commodities, their reported returns can differ significantly
Why?
because they often use very different weighting methods. Think about it. What's the market capitalization of a barrel of oil or a ton of wheat? It doesn't exist in the same way as for a company stock.
Right. No shares outstanding times price.
Exactly. So index providers have to come up with their own schemes for deciding how much weight to give each commodity in the index. And these schemes can vary wildly.
How do they decide the weights then?
Some indexes, like the older Thomson Reuters Score Commodity CRB Index, might simply equal weight a fixed number of commodities. Others, like the very influential S&P GSCI, Goldman Sachs Commodity Index, use a combination of measures like trading liquidity and world production values. This production weighting often gives a much larger weight to energy commodities like crude oil and natural gas because they dominate global production value.
So, different weighting philosophies lead to different exposures.
Hugely different exposures and consequently very different risk and return profiles for different commodity indexes, even if they contain similar underlying commodities. Unlike broad equity or fixed income indexes targeting the same markets, which tend to have reasonably similar risk-return profiles, commodity indexes can behave very differently from each other. You absolutely need to know how a specific commodity index is weighted to understand its biases and what drives its performance. Is it dominated by energy, or is it more balanced across agriculture, metals, etc.?
Okay, weighting is key. You also mentioned something about futures contracts causing returns to differ from the actual commodity price.
Yes, another critical distinction for commodity indexes. Their returns can often be quite different from simply tracking the price change of the actual physical commodity, the spot price. This is because of how futures contracts work.
How so?
Futures contracts have specific expiry dates, and index holding futures can't hold them until expiry, as that would mean taking physical delivery of the oil or wheat. So before a contract expires, the index provider must sell it and buy a new contract that matures further in the future. This process is called rolling over the contracts.
Okay, constantly replacing expiring contracts with new ones.
Yes, and this seemingly simple process involves several factors that impact the index's return, beyond just the spot price movement. One, you earn interest on the cash collateral you post to hold the futures, the risk-free rate. Two, the price changes of the futures contracts themselves. Three, and crucially, something called roll yield.
Roll yield, what's that?
Roll yield arises from the difference in price between the expiring contract you're selling and the new, longer-dated contract you're buying during that rollover process. If the futures market is in contango, meaning contracts for later delivery are more expensive than near-term contracts, then when you roll over, you're selling cheaper and buying dearer. This results in a negative roll yield, acting as a drag on your return.
Selling low, buying high.
Bad, exactly. Conversely, if the market is in backwardation, meaning later contracts are cheaper than near-term ones, often happens if there's a current shortage, then you're selling dearer and buying cheaper. This generates a positive roll yield, boosting your return.
Selling high, buying low. Good.
Right. This subtle but potentially very significant factor, the roll yield, determined by the shape of the futures price curve, means commodity index returns aren't just about the physical commodities price change. They're also significantly impacted by the cost or benefit of continually rolling those futures contracts forward.
Can we have an Indian example to clarify this spot versus futures return idea?
Sure. Imagine you're tracking the price of a sack of rice you buy from your local mandi or market. That's the actual physical spot commodity price.
Okay. Today's price for immediate delivery.
Right. But now imagine someone is tracking a rice futures contract listed on an exchange. The return they get from holding and rolling that futures contract might be slightly different from just the change in the spot price of rice.
Why?
Because the futures contract price already implicitly includes factors like the cost of storing the rice until the future delivery date, the interest rate you could earn on your money instead, opportunity cost, and market expectations about future supply and demand. These cost of carry elements, reflected whether the futures curve is in contango or backwardation, directly impact the roll yield and thus the overall return you get from the futures-based index, making it potentially differ from the simple spot price return.
Okay, that's complex but important. What's next in alternatives after commodities? Real estate.
Yes, let's look at real estate indexes. Now, tracking the value of all physical property directly is very difficult. Properties are unique. They don't trade often. Valuations are subjective.
Hard to make an index of houses on my street.
Exactly. So many real estate indexes instead track publicly traded companies called real estate investment trusts, or REITs.
REITs? What are they again?
REITs are companies whose primary business is owning, operating, or financing income-producing real estate. Think companies that own large shopping malls, office buildings, apartment complexes, warehouses, hospitals, etc.
And these REIT companies trade on stock exchanges.
Yes, that's the key. REITs are structured as companies whose shares trade on major stock exchanges, just like shares of, say, Infosys or Reliance.
Ah, so you can make an index of REIT stock prices.
Precisely. Because REIT shares trade continuously during market hours, their prices are readily available, and they are much more liquid than trying to trade the underlying physical properties directly. So index providers create indexes based on the stock prices of these publicly traded REITs.
Any examples?
Yes. A well-known global family of REIT indexes is provided by FTSE Pranerate. These indexes aim to represent global trends in publicly traded real estate stocks, offering investors a way to gain exposure to the real estate asset class through the stock market without the hassles of direct property ownership.
Okay. So REIT indexes track listed real estate companies, not physical property values directly.
That's the main approach for liquid, tradable real estate indexes, yes.
All right. Last category of alternatives, Hedge funds. These sound mysterious.
They can seem that way. Hedge funds are private investment pools, typically open only to sophisticated or wealthy investors. They often use complex strategies involving leverage, short selling, derivatives, and investing across a wide range of assets, aiming for positive returns regardless of market direction.
So how do you make an index for them if they're private?
That's the challenge. Index providers try to create hedge fund indexes that reflect the returns of these funds. Several research organizations and data vendors maintain large databases where hedge funds voluntarily report their performance data.
Voluntarily. Not required.
Generally, no. Unlike mutual funds in many countries, hedge funds are often not required to report their performance publicly to regulators. They choose whether or not to report to these commercial databases.
What do the index providers do with this voluntary data?
They compile the data from the funds in their database and construct indexes. Most of these database-driven hedge fund indexes are equal-weighted across the funds included, and they generally aim to represent the performance of funds within their specific database, often categorized by the fund's investment strategy, like long-short equity, global macro, event-driven, etc.
But you mentioned a big challenge here, because it's voluntary.
Yes, this voluntary reporting nature creates several critical issues that you absolutely must be aware of if you ever look at hedge fund index performance. These issues can significantly impact the reliability and representativeness of these indexes.
Okay, what's the first issue?
1. The constituents determine the index, not the other way around. Think about that. For a stock index like the S&P, the index provider sets the rules, and companies are included or excluded based on those rules. For hedge fund indexes built from databases, the funds themselves choose whether or not to report their data and thus be included. The index is simply made up of whoever decided to report. This can lead to self-selection bias. Maybe only the funds doing well or those seeking publicity choose to report.
So the index might not represent all hedge funds, just the ones reporting.
Exactly. That's a major potential bias. Second issue, there's often surprisingly little overlap in the actual underlying funds included in different hedge fund indexes, even if those indexes claim to track the same broad global hedge fund industry or the same specific strategy. Different database providers have different funds reporting to them.
So two different global hedge fund indexes could give very different results.
Very different, yes, because they might be based on substantially different sets of underlying funds. This makes comparing performance across different hedge fund index providers quite difficult.
Okay. What's the third major issue? You mentioned survivorship.
Yes, a very significant potential bias. Survivorship bias. What does this mean? Think about what happens to hedge funds that perform poorly.
They might lose investors, or even shut down.
Exactly. And if a fund is performing badly, or if it shuts down entirely, it's quite likely to stop reporting its returns to the database. It effectively drops out of the index calculation.
So the index only includes the funds that survived.
Precisely. The index calculation ends up being based only on the funds that survived and continue reporting. The poor performers disappear from the history. This can make the index's historical performance look artificially better than the performance of the overall hedge fund industry actually was, because it systematically excludes the failures over time.
So the reported returns are likely biased upwards.
Most researchers believe hedge fund index returns are biased upward due to survivorship bias. They likely overstate the typical performance achieved by the average hedge fund. Related to this is also backfill bias or instant history bias.
Backfill bias.
This happens when a hedge fund decides to start reporting to a database. Often the database provider will add not only its future performance, but also its past performance into the historical index data. But funds are more likely to start reporting only after they've had a period of good performance. So adding this good past performance backfills the index history with successful funds, again making the historical index returns look stronger than reality.
Wow. Survivorship bias and backfill bias. Sounds like you need to take hedge fund index returns with a big grain of salt.
A very large grain of salt.
Yeah.
You need to be extremely aware of these potential biases when interpreting hedge fund index data. They are likely not fully representative of the entire universe and probably paint a rosier picture than reality.
Okay, final check question for this tour, though. Given these unique characteristics, voluntary reporting, self-selection, survivorship bias, backfill bias, why might two different hedge fund indexes, even if they both claim to track, say, the same global macro investment strategy, give you very different ideas about how that specific strategy actually performed over the last year? What are the key factors contributing to this likely discrepancy?
Think about the underlying data quality and representativeness issues we just discussed.
Wow, that really was quite the journey, wasn't it? Through the dynamic, sometimes complex, but absolutely vital world of security market indexes.
It certainly was a comprehensive tour,
We started right at the beginning with simple definitions. What is an index?
like that cricket scoreboard analogy.
Exactly. Then we explored how these vital tools are actually built and manage those 5 key decisions, especially around weighting methods
Price, equal, market cap, fundamental.
and the ongoing processes of rebalancing and reconstitution, keeping the index fit for purpose.
The maintenance is crucial.
Then we shifted to understanding there are many, many crucial uses in finance, not just gauges of sentiment.
But vital proxies for risk modeling,
Yeah.
essential tools for asset allocation,
Critical benchmarks for evaluating active managers, if chosen correctly.
and the fundamental blueprints for index funds and ETFs.
And finally, we took that grand tour through the diverse types available across different asset classes, equities with all their flavors,
Broad market, multi-market, sector, style,
then the unique challenges of fixed income indexes,
that massive universe and the pricing issues.
and finished with the complex, sometimes murky world of indexes for alternative investments like commodities, REITs, and especially hedge funds with all their biases.
Indeed, Ed. And if there's one key takeaway from all this, James, I think it's this. To genuinely benefit from using security market indexes, whether you're an investor, an analyst, a student, you simply must understand how they are constructed and managed. You need to look under the hood.
Because the details matter hugely.
They matter profoundly. An index that is perfectly constructed and perfectly suitable for one purpose, say, benchmarking a globally diversified equity fund, might be completely inappropriate and misleading if used for another purpose, like trying to track the performance of just small-cap value stocks in one specific region or comparing it to a hedge fund.
The devil, as they say, is truly in the details of the index methodology.
Absolutely. Weighting, rebalancing frequency, reconstitution rules, constituent selection, these details define what the index actually measures and how it behaves.
So what does this all mean for you, our bright, aspiring CFA students listening today, and indeed anyone curious about finance?
What's the bottom line?
It means that in the vast, often confusing, ever-changing ocean of financial information, indexes are your indispensable compass. They really are. They simplify those complex market movements into digestible numbers, offering direction, comparison, and clarity.
A vital navigation tool.
But just like any compass, it's only truly useful if you know how to read it properly. You need to understand its calibration, how it was built, and you need to be aware of any potential magnetic deviations. Those biases or limitations, like the survivorship bias in hedge fund indexes or the momentum effect in market cap weighting.
You need to know how the index is weighted, price, equal, market cap, fundamental,
Yeah.
how frequently it's rebalanced, creating turnover, and how its constituents are periodically reconstituted, impacting prices. Because all these details profoundly impact the story that the index number tells you. Assuming all indexes are the same or using the wrong one can lead you far astray.
Well said. And that leads us perhaps to a final thought to leave you with, a question to ponder as you continue on your financial learning journey.
Okay, let's hear it.
As technology advances so rapidly, think about AI, blockchain, maybe even commercial space travel, and as new types of investments become more accessible, perhaps more mainstream, maybe complex digital assets, tokens representing fractional ownership of anything, or even entirely new economic sectors we can barely conceive of today.
The financial world is constantly evolving.
Do you think entirely new types of indexes will emerge to track these novel assets and economic activities, things we can't even fully imagine today?
A fascinating question. It seems likely, doesn't it?
And if so, what completely new challenges might index providers face in constructing, managing, and ensuring the reliability and representativeness of those future indexes? Think about data collection for assets that might exist only digitally. Think about valuation methodologies for things with no historical precedent. Think about defining the constituents or the market in a rapidly decentralizing or virtualizing financial landscape. What new problems will the index chefs of the future need to solve?
That's a great question to mull over. It highlights that even something seemingly established like market indexes is constantly adapting and facing new frontiers. Keep thinking, keep learning, and definitely keep asking those kinds of insightful questions.
Exactly. Well, thank you all so much for joining us on this quite detailed deep dive into security market indexes. We hope it provided a strong foundation. Until next time, keep your curiosity alive and your financial mind sharp.
Thank you for listening.
Dhanyavad and goodbye. Welcome to the deep dive. Today, we're plunging headfirst into a concept that sits really at the very core of financial markets, market efficiency.
That's right.
Our mission today is to uncover just how quickly and how completely market prices absorb new information. And crucially, what that means for you as an investor or, someone simply looking to understand the mechanics behind global finance.
Exactly. We've gathered a fascinating stack of sources for this deep dive.
Yeah.
It's a mix of foundational theories and, well, some surprising real-world observations too.
Right.
Our goal is to extract the most important insights, give you that kind of shortcut to being well-informed, and maybe explore the unexpected corners of this topic. So let's untangle this fascinating idea together.
Okay. Our journey will take us through the fundamental definition of market efficiency, then the powerful forces that drive it, the different levels, at which it can exist, and then we'll dive into some of the more intriguing observations, the anomalies that seem to challenge everything we thought we knew.
Yes, those are fascinating.
And finally, we'll explore how human psychology plays a role, for better or for worse. So, are you ready to embark on this financial adventure? Let's unpack this. #tag, what exactly is market efficiency?
Okay, so to kick us off, let's start with the foundational question. What do we actually mean by an informationally efficient market?
Good starting point.
At its heart, an efficient market is one where asset prices reflect new information quickly and rationally.
Quickly and rationally.
Yes.
Yeah.
This implies that prices inherently incorporate all past and present information that is relevant to that asset's value.
So everything known is already in the price.
Pretty much. The moment new information emerges, whether it's a company's earnings report, an interest rate decision, or even, say, a geopolitical event, the market price adjusts almost instantaneously to integrate that new knowledge.
That's the crucial point, isn't it? The speed of reaction.
Absolutely.
When we talk about quickly, we're talking, well, in modern high-speed trading environments, it can be microseconds.
Tiny fractions of a second.
Think of it like this. If you're a professional foreign exchange trader and you hear about an unexpected shift in a country's economic policy, you'd expect the currency pair you're trading to react, literally, within milliseconds.
Instantly.
If prices were slow to adjust, if there was a noticeable lag, that would create immediate, virtually risk-free profit opportunities for traders,
Free money almost.
which would then be exploited and closed down almost as quickly as they appeared. The very act of exploiting those delays makes the market more efficient. It's self-correcting, in a way.
And that brings us to a key nuance. Prices react primarily to the unexpected component of information.
The surprise factor.
Exactly. If everyone already anticipates, say, that a tech giant's quarterly earnings will be strong, that expectation is often already priced in, as they say. It's baked into the stock price before the official announcement.
Right, the market's already expecting it.
It's the surprise the earnings coming in significantly higher or lower than forecasts, or maybe a completely unforeseen strategic move that triggers the really dramatic price shifts.
We saw this play out vividly with the example of that speculative grade bond issuer in our sources.
Yes, that was a good case study.
The market was already buzzing with rumors that the company might default on an upcoming interest payment before any official announcement. You'd see the bond price start to reflect some of that concern, maybe drift lower.
A bit of worry creeping in.
But the true, full price adjustment, the absolute confirmation of default, only occurred after the official news broke that their critical loan negotiations had failed.
That was the final nail, wasn't it?
That was the truly unexpected piece of information that cemented the market's view and caused the definitive price movement. Before that, there was still, a sliver of hope, a bit of uncertainty, keeping the price from fully collapsing. The market waits for that unexpected confirmation.
This leads us naturally to two fundamental concepts in finance: market value and intrinsic value. It's absolutely vital to understand the distinction.
Okay, let's break these down.
Market value is straightforward. It's simply the price at which an asset, let's say a share of a company, can be bought or sold right now on a public exchange. It's the prevailing price, fluctuating second by second based on the dynamic interplay of supply and demand. Like the price of, say, tomatoes you see displayed at your local Kirana shop today. It changes.
Got it. The current ticker price, essentially. But then there's intrinsic value, sometimes also called fundamental value. This is a much deeper concept.
Yes, it is.
It's an estimate of the asset's true worth derived from analyzing all its future benefits and risks for a company's share. This would involve deeply scrutinizing its future earnings potential, its expected dividends, its operational risks, the competitive landscape, the broader economic outlook. It's a lot.
It really is. The challenge, of course, is that it's always an estimate because we can never know the future with perfect certainty. Think of it like maybe your grandfather saying a piece of land has an intrinsic value based on its history and future potential, even if its current market price is different due to temporary factors.
That's a good analogy. It requires comprehensive research and making informed projections about future cash flows. Hard work.
The profound implication, then, is this.
Hmm.
In a highly efficient market, the market value and the intrinsic value should be very, very close. Ideally, almost identical.
Okay.
If they diverge significantly, if the market price is noticeably lower than an asset's estimated intrinsic value, making it appear undervalued, or vice versa if it seems overvalued, that signals an opportunity for investors to profit. But in an efficient market, such opportunities are fleeting. They don't last long.
And this brings us to a crucial fork in the road for investment philosophy. Active versus passive investment strategies.
Get a big debate in finance.
If a market truly operates at a high level of efficiency, consistently beating the market, that is, earning returns significantly higher than the market's overall return after accounting for risk becomes incredibly difficult, maybe impossible over the long run.
That's why a passive strategy often gains traction in efficient markets. With a passive approach, you simply buy a broad market portfolio, like an index fund that tracks a major stock market index, maybe the Nifty 50 or the Sensex, and you just hold it over the long term.
You're not trying to be clever, just ride the market.
Exactly. You're not trying to pick winning stocks or time the market. You're simply aiming to capture the market's overall return. Think of it like taking the local train. It's a reliable, low-cost way to get towards your destination.
Compared to
An active strategy. This is when investors try to find assets that are mispriced, where market value is different from their estimate of intrinsic value, and buy the undervalued ones or sell the overvalued ones to earn superior returns. That's more like hiring a private car, trying to find shortcuts to reach your destination faster. It might work, but it's more expensive and uncertain.
So the implication.
The implication is, in an efficient market, a passive strategy is generally preferred because the costs associated with active investing, extensive research, analytical teams, frequent trading leading to higher transaction fees are often too high to justify.
It's hard to make back those costs.
Precisely. The argument is, why pay all those costs to try and find mispricings that the market has likely already corrected? The efficiency makes it hard.
Right. The ultimate insight for your investment strategy is this. In an efficient market, the cost of trying to outsmart everyone else usually outweighs any potential gains. That's why simply tracking the market with a low-cost index fund often delivers superior long-term results compared to expensive active management.
That's a powerful argument.
So let's pause here. A quick check for understanding. If you believe a company's shares are trading in an efficient market and you've meticulously calculated their intrinsic value, what would you expect to see when you look at the market price?
Think about that for a moment. What should the relationship be?
In theory, the market price and your carefully estimated intrinsic value should be almost identical.
Right. Ideally, yes.
If your estimate is moderately different, the most likely conclusion is that your estimate might be slightly off. Perhaps you've overlooked a subtle risk, or maybe the market isn't perfectly efficient, leaving only a very small, short-lived opportunity that would likely be erased by trading costs anyway.
It really highlights why this efficiency debate is so central to how we approach investing. #, what makes a market more or less efficient?
Okay, so we've defined efficiency. Now let's turn our attention to the driving forces. What factors genuinely contribute to making a market more or less efficient? Because remember, no market exists in a state of absolute perfection or absolute chaos. They exist on a spectrum.
That's a very important point. It's not black and white. The first, and perhaps most intuitive factor, is the number of market participants.
More eyes on the market.
Exactly. Imagine the difference between a small, local market in a town versus a bustling city mandi. In the small town market, if one shopkeeper gets some inside scoop on vegetable prices, it might take a while for others to catch on.
Information travels slower.
But in a big city mandi with thousands of buyers and sellers, any near price information spreads and gets incorporated almost instantly. Same in financial markets. The more investors, analysts, and trading desks actively scrutinizing a market, the quicker information is processed, disseminated, and reflected in prices.
More competition to find and use information.
Precisely. Our sources give a great illustration. A small cap company's stock might initially react slowly to unexpectedly good news because only a handful of analysts even cover it.
Not many people are watching it.
Right. But once its growth potential becomes widely known, more analysts jump in, more institutional investors take notice, and suddenly that stock's price reacts much faster to subsequent news. This increased scrutiny, this collective intelligence, dramatically enhances efficiency.
So barriers to entry would hurt efficiency?
Definitely. Conversely, if a market restricts participation, for instance, if certain types of foreign investors are barred from trading, it naturally limits the number of informed participants, reducing overall efficiency. Fewer viewpoints, slower reactions.
Okay, makes sense. What's next?
Moving on, we have information availability and financial disclosure. For prices to reflect information quickly and accurately, that information must be readily accessible and transparent to everyone.
Like getting your electricity bill. You know what you're paying for because the details are clearly disclosed.
That's a good analogy. In financial markets, robust financial news media and strict disclosure rules are vital. Major stock exchanges like the Bombay Stock Exchange or National Stock Exchange here in India are quite efficient because information is released frequently, and many analysts cover the listed companies. Transparency is key.
Absolutely. Regulations like the SEC's Regulation FD, or Fair Disclosure in the U.S., are designed precisely for this.
Can you explain that one briefly?
Sure. It basically says if a company shares important non-public information with a select few investment professionals, they must also disclose it to the wider public at the same time. No special whispers to favorites.
Leveling the playing field.
Exactly. It fosters trust and encourages broad participation. On the flip side, the issue of illegal insider trading directly undermines this principle.
Trading on secrets.
Yes. This is when individuals trade on material, non-public information, critical information that could affect a company's value but isn't yet known to the public. Governments around the world, like SEBI here in India, have strict laws and heavy penalties against this.
Why is that so important for efficiency?
Because it creates an unfair advantage. If some can always profit from secret knowledge, ordinary investors lose faith, they might pull out, and the market becomes less efficient because fewer people are willing to participate and contribute to the collective processing of information. Fairness matters for efficiency.
Very true. Okay, the third critical factor involves limits to trading, often tied to the concept of arbitrage.
Arbitrage sounds complicated.
It's actually a simple idea. Imagine noticing that the same brand of rice is selling for, say, Rs 500 per bag in one market, but only Rs 450 in another nearby market.
I'd buy cheap and sell high.
Exactly. You would immediately buy from the cheaper market and sell in the expensive one to make a riskless profit, right? Arbitrageurs are traders who do this constantly in financial markets. If an asset is priced differently in two markets or in two different forms, they'll instantly buy low and sell high until the prices converge.
So they force prices to be consistent.
Correct. Their actions make the market more efficient by eliminating these discrepancies.
So anything that creates impediments to arbitrage directly reduces market efficiency.
Precisely. If it's difficult or costly to execute trades quickly, if there's a lack of price transparency, or if regulatory hurdles exist, it becomes harder for these arbitrageurs to perform their market-correcting function.
Okay. And what about short selling? That comes up a lot.
Yes. Short selling is a trading strategy where you borrow shares you don't own, sell them on the market, hoping the price will fall.
Betting against the stock.
In essence, yes. Then you buy them back at the lower price later to return to the lender, and you profit from the difference, minus fees and interest.
How does that help efficiency?
This mechanism is crucial because it allows investors to express a belief that a security is overvalued. It puts downward pressure on inflated prices. While some regulators worry it could exacerbate downward movements during market stress.
It can cause panic sometimes.
It can be controversial. But theoretically, short selling is a vital tool for driving prices toward their intrinsic value and enhancing overall efficiency. It provides the sell-side pressure when things get too optimistic.
Got it. So participants, information, arbitrage, what's the last factor?
Finally, we arrive at transaction costs and information acquisition costs. Every time you buy or sell a financial asset, you incur costs. Brokerage fees, exchange fees, taxes.
The unavoidable friction.
Exactly. An efficient market is efficient within the bounds of these costs. If a potential mispricing exists, but the profit you could make from exploiting it is smaller than the transaction costs of buying and selling, then that inefficiency simply isn't actionable for profit.
So it might exist, but you can't actually benefit from it.
Correct. The market, in practical terms, is still efficient because the discrepancy cannot be profitably exploited.
And then there are the information acquisition costs. Gathering, processing, and analyzing financial information is expensive and time-consuming. Think of the tuition fees you are paying for your CFA coaching, or the massive research departments at investment banks, the subscriptions for financial data.
It costs money to get smart.
Right. The traditional efficient market hypothesis sometimes struggled with this. If prices already reflect all information, why would anyone bother incurring these significant costs to acquire information?
A bit of a paradox.
Yeah. The modern view, however, suggests there must be some return to information acquisition. Otherwise, no one would research, and the market would quickly become less efficient as new information wouldn't be quickly incorporated.
So the search for profit makes the market efficient.
It's a fascinating dynamic. The effort to find mispricings, which is costly, is what helps make markets efficient in the first place.
So to summarize this section, a market is only truly considered inefficient if a price discrepancy is large enough to leave an investor with a net profit after accounting for all these real-world costs, both the cost of trading and the cost of acquiring the information.
The profit has to be bigger than the hassle.
Exactly. If the potential gain is less than these combined costs, it's not a true exploitable inefficiency. It raises the question, doesn't it? If a government were to suddenly open up its stock market to all foreign investors, removing restrictions, what would be the most likely immediate effect on that market's efficiency and why?
Okay, let's think. More players.
More capital, more viewpoints.
It seems like such a move would almost certainly increase market efficiency
Why?
because it dramatically expands the pool of market participants, bringing in more capital, more diverse analytical perspectives, and intensifying arbitrage activity. All of this leads to information being processed more quickly and thoroughly, ensuring prices reflect that information more accurately.
Spot on. More eyes, faster adjustments. Hashtag, the three forms of market efficiency.
Building on our understanding of what efficiency is and what drives it, let's explore a framework developed by the renowned economist Eugene Fama. He classified market efficiency into three forms, each defined by the type of information reflected in asset prices.
Ah, yes. Fama's three forms. Very important. It's like a progression, a ladder of efficiency, each step encompassing more information.
Can you lay them out for us?
Right. We can visualize this as a hierarchy of information. At the foundational level, we have weak form efficiency. Here, prices reflect only past market data. This means historical prices, trading volumes, and any technical patterns derived from them are already incorporated into current prices.
Just the history of the price itself.
Exactly. Then, moving up, semi-strong form efficiency. This is a more comprehensive level. Prices reflect past market data, AD all public information. This includes financial statements, company announcements, news articles, economic forecasts, anything openly available.
So past data plus anything the public knows.
Correct. And finally, the top level, strong form efficiency. This is the highest, most stringent level. Prices reflect past market data, public information, A&D, private insider information. This is knowledge known only to a select few, not yet public.
Wow, that's a very high bar. Includes secrets, too.
It is. And when researchers test these forms of efficiency, they're typically looking for something called abnormal returns.
You mentioned those earlier, returns higher than expected for the risk.
Precisely. Returns that are consistently higher than what an investor should expect given the level of risk they've taken. And critically, in a truly efficient market, after accounting for all risks, these abnormal returns simply should not exist.
They shouldn't be possible, consistently.
Right. Their consistent presence, or absence, is the ultimate litmus test for whether a market is truly efficient at a particular level.
Okay, let's start with the base level then. Weak form of market efficiency.
All right, in a market that's weak form efficient, all historical price and trading volume data are already fully incorporated into current prices.
So looking at charts won't help predict the future.
Essentially, yes. What this effectively means is that you cannot predict future price movements by simply analyzing past price patterns or trends. It's like trying to perfectly predict tomorrow's weather simply by looking at yesterday's temperature or last week's wind patterns. That historical data is already baked into today's atmospheric conditions, so it offers no consistent edge for tomorrow.
This has profound implications for a popular investment discipline, technical analysis.
Definitely. Technical analysis involves scrutinizing historical price charts, volume data, and various indicators to identify recurring patterns, think head and shoulders formations or double tops and bottoms, with the goal of predicting future price movements.
Chart reading, basically.
Yes. Many technicians or chartists believe that market psychology creates these patterns and that history tends to repeat itself.
But if weak form efficiency holds,
However, if markets are genuinely weak form efficient, then technical analysis by itself cannot consistently generate abnormal profits after accounting for transaction costs.
why not?
The reasoning is straightforward. If a truly profitable historical pattern existed, market participants would quickly spot it, exploit it, and in doing so, they would eliminate the pattern itself before anyone could consistently profit.
Like finding a secret shortcut during Delhi rush hour traffic.
Exactly. It works beautifully for a day, maybe, but once everyone knows about it, that shortcut quickly becomes just as jammed as the main road, and its advantage vanishes. The market learns.
So what does the evidence tell us? Is technical analysis pointless?
Well, most academic research on developed markets consistently suggests they are indeed weak form efficient. This means that consistently beating the market using only past price data is incredibly challenging, if not impossible, for the average investor.
So for major markets, probably not a path to riches.
Likely not consistently. However, there's some mixed evidence regarding developing markets, where information might not flow as freely or trading costs might be higher, suggesting that some technical strategies might still offer temporary, fleeting opportunities there. But the consistent message for developed markets is clear.
Okay, moving up the ladder. The semi-strong form of market efficiency.
Right? This is a more stringent condition. In a semi-strong efficient market, prices reflect all publicly known and available information.
So everything in the weak form plus all public news and data.
Exactly. This encompasses a vast array of data. A company's financial statements, earnings announcements, dividend declarations, new product launches, management changes, industry trends, broad economic forecasts, essentially anything that is openly accessible to the public. Crucially, if a market is semi-strong efficient, it inherently means it's also weak form efficient, as public information naturally includes historical market data.
The ramifications for fundamental analysis are particularly significant here, aren't they?
Very significant. Fundamental analysis involves a deep dive into publicly available information, balance sheets, income statements, industry reports, economic indicators to estimate a security's intrinsic value.
The true worth we talked about earlier?
Yes. Now, if markets are indeed semi-strong efficient, then the prices you see on the trading screen already reflect all this publicly available information.
So my hard work reading reports might not give me an edge.
It means that simply analyzing public reports in isolation won't give you a consistent edge to earn abnormal returns. The key insight is that while fundamental analysis is still vital for the market to function, someone has to do the analysis for prices to be right. Simply gathering and processing publicly available data won't make you consistently wealthy because everyone else is doing the same thing. The information is already in the price.
How do researchers test this?
They often employ what are called event studies. Imagine a major pharmaceutical company announces surprisingly positive results from a new drug trial. Big news.
Stock price should jump.
In a semi-strong efficient market, you would expect the stock price to jump immediately upon the announcement and then quickly stabilize at the new level reflecting the news.
What if it drifts up slowly afterwards?
If the price were to slowly drift upwards for days after the announcement, it would suggest an inefficiency, a delayed reaction. But an immediate sharp adjustment followed by stabilization is entirely consistent with semi-strong efficiency.
A perfect example from our sources is Tesla's stock back in 2018.
Ah, the infamous tweet.
When its CEO tweeted about potentially taking the company private, the stock price reacted almost instantly to that public statement, adjusting sharply.
Huge move, very fast.
It didn't necessarily reach the proposed take-private price because there was still significant uncertainty surrounding the actual deal, but the immediate dramatic price movement demonstrated how quickly the market processed that public news.
And then it reacted just as fast when the plan was dropped.
Exactly. And when news later broke that he wasn't taking it private, the price adjusted just as rapidly again. This swift incorporation of public information is a hallmark of semi-strong efficiency. Most studies confirm that developed securities markets largely exhibit this form of efficiency.
And developing markets.
Again, for developing markets, as we mentioned, the evidence remains somewhat mixed, indicating potentially more opportunities for active managers due to slower information flow or less analysis.
Okay, finally, we reach the summit. The strong form of market efficiency.
The highest level, remind us again.
This is the highest, most demanding level of efficiency. In a strong form efficient market, security prices fully reflect all information, and this is key, public and private.
Even insider information.
Yes, this means that even someone possessing insider information, such as a company executive knowing about an impending merger before it's publicly announced, or a government official privy to unreleased policy changes, would be unable to earn abnormal returns.
That sounds almost impossible. The information would have to leak or be figured out instantly.
The implication here is quite radical. If a market were truly strong-form efficient, laws against insider trading would, theoretically, be completely unnecessary,
Why?
because the market price would already reflect that private, privileged information even before it became public. The advantage would be gone.
But is that how it works in reality?
Well, the evidence is quite conclusive on this point. Most research overwhelmingly demonstrates that securities markets are not strong-form efficient.
Okay, so that highest level is mostly theoretical.
Largely, yes. Studies consistently find that abnormal profits can be earned when non-public information is used. This is precisely why insider trading is illegal and heavily prosecuted in virtually every developed economy. It's an unfair advantage, and its very existence proves that private information does hold value before it becomes public, meaning markets are not strong-form efficient.
That makes sense. So the question for you, listening, if a company's shares react immediately and sharply to their earnings announcement, which form of market efficiency is this most consistent with, and what does it tell us?
Think about the type of information. Earnings announcements are public, and the reaction is immediate. This scenario is most consistent with semi-strong form efficiency.
Right, because prices are quickly reflecting new publicly available information, like earnings announcements. It's a strong indicator that the market is efficient in processing and incorporating public data into prices without any significant delay.
It doesn't say anything about private information, though, just public. Hashtag tag tag, do markets always behave efficiently? The anomalies.
Now, this is where our deep dive gets truly intriguing. While the general consensus points towards developed markets being largely semi-strong efficient, researchers have also unearthed some fascinating apparent market inefficiencies, what we refer to as anomalies.
The puzzles of the market.
Mhm.
What are anomalies exactly? They are patterns or observations in market behavior that, on the surface, seem to contradict the predictions of efficient markets.
They don't fit the theory neatly.
Exactly. They are anomalous because they appear to offer consistent abnormal returns that cannot be readily explained by the arrival of new, unexpected information, or by simply taking on greater risk. They're like puzzling deviations from the expected, a wrinkle in the fabric of market efficiency.
Before we delve into specific examples, it's vital to highlight a significant caveat: the risk of data mining, also known as data snooping.
Oh, this is so important. You have to be careful.
Imagine you have decades of comprehensive financial data. If you run hundreds, even thousands of different statistical tests and look for every conceivable pattern simply by pure chance, you're bound to find some correlation that appears to have worked historically.
If you torture the data long enough, it will confess to anything.
Exactly. For example, you might discover that a specific industry's stocks tend to perform unusually well every time the temperature in, say, Mumbai hits 30 degrees on a Tuesday. While that might seem like a strategy that worked in the past.
It's probably just noise. Coincidence.
Right, it doesn't mean it will continue to work in the future. Many purported anomalies might simply be statistical flukes resulting from looking too hard at vast amounts of historical data rather than true exploitable inefficiencies. Keep that skepticism in mind.
Definitely. With that important warning in mind, let's explore some of these compelling anomalies. We can broadly categorize them. First, we have time series anomalies.
Patterns over time.
Yes, patterns observed over time, often linked to calendar periods or recent price movement.
Within these, we find calendar anomalies. The most famous of these is the January effect.
Yes, I've heard of this one. Small stocks doing well in January.
That's the one. Throughout the 1980s, researchers observed a peculiar phenomenon. Stock returns, especially for smaller companies, were consistently and significantly higher in January, often concentrated in the first 5 trading days of the month. This pattern didn't seem directly connected to any specific new public information.
So why would it happen?
Explanations put forward included tax loss selling, where investors sell losing stocks in December to realize tax benefits, thereby depressing prices, then buy them back in January, pushing prices up.
Okay, that makes some sense.
Another idea was window dressing, where fund managers might sell off riskier stocks before year-end to make their portfolios look safer for client reports, only to buy them back in January.
Making the books look good for the end of the year.
Right. While these explanations account for some of the effect, they don't fully explain its persistence. Interestingly, recent evidence suggests that the January effect has become much less pronounced or has even disappeared, particularly after accounting for risk.
Maybe because too many people tried to exploit it.
That's the thinking. As we discussed, arbitrage tends to eliminate these patterns once they're known.
Then there are other calendar effects, which are equally curious. We've seen observations like the day of the week effect, where Mondays have historically shown negative average returns, while other weekdays tend to be positive.
Monday blues for the market.
Apparently. The weekend effect suggests lower returns on weekends than weekdays, and the holiday effect indicates higher returns leading into market holidays. There's also the turn-of-the-month effect, which shows higher returns around month-end and the very beginning of a new month.
Have these lasted?
Like the January effect, many of these calendar-based anomalies have significantly diminished over time, largely because once these patterns became widely known, investors tried to exploit them. And that very arbitrage activity eroded the profitability of the pattern itself.
Okay, what about anomalies related to price movements?
Next up are momentum and overreaction anomalies, which sometimes appear contradictory. The overreaction effect suggests that investors can at times overreact to unexpectedly good or bad news, causing prices to become temporarily inflated or excessively depressed.
Getting too excited or too pessimistic?
Exactly. Studies found that if you bought loser stocks, those that had performed poorly over the preceding 3 to 5 years, and sold winner stocks, the losers would then significantly outperform the winners over the subsequent period, suggesting a long-term price reversal. Prices swing too far and then correct back.
Interesting. But you said it contradicts momentum.
Yes. In stark contrast, the momentum effect implies that stocks which have performed well in the short term, typically over the last 3 to 12 months, tend to continue performing well in the immediate future. Winners keep winning.
That seems to directly contradict weak form efficiency if you can profit just from past prices.
It does seem to. Interestingly, evidence for the momentum effect is quite strong and persistent globally, even more so than some other anomalies.
So is momentum real or not?
Well, some researchers argue that momentum isn't necessarily an inefficiency, but rather reflects a slow, gradual adjustment of prices to new information or changing growth expectations. So it might be a rational phenomenon, albeit one that defies simplistic explanations. The debate continues.
Okay. Moving beyond time-based patterns, we have cross-sectional anomalies.
Yes, these focus on differences observed across various companies at a point in time, rather than over time. The size effect is one prominent example.
Small companies beating big ones.
That's the idea.
Yeah.
The observation that shares of small-cap companies, those with a relatively small market capitalization or total value of their outstanding shares, have historically tended to outperform large-cap companies on a risk-adjusted basis.
Yeah.
This was a particularly strong finding in the 1980s.
If now.
However, like many anomalies, the size effect has been less apparent in more recent decades. Some argue it was a statistical anomaly that disappeared once discovered and exploited, or that it simply reflected unmeasured risks specific to smaller companies.
Right. What's another big cross-sectional one?
A particularly well-known cross-sectional anomaly is the value effect. This is the consistent observation that value stocks have outperformed growth stocks over long periods.
Define those again for us.
Sure. Value stocks are typically defined as companies with low price-to-earnings (PE) ratios, low market-to-book (MB) ratios, and high dividend yields, essentially. Companies that appear cheap relative to their underlying fundamentals. Growth stocks, on the other hand, are companies with high PE, high MB, and often low or no dividends, valued primarily for their high future growth expectations. They look expensive, but are expected to grow fast.
And the value stocks do better.
Historically, yes, over long periods. The value effect poses a significant challenge to semi-strong efficiency because the information used to classify these stocks, PE ratios, book values, dividends, is all publicly available.
So why should cheap stocks consistently beat expensive ones if the market is efficient?
Great question. A compelling counterargument, often put forward by economists like Fama and French with their three-factor model, suggests that value stocks might simply be inherently riskier than growth stocks. Maybe they are companies in more cyclical industries or with higher distress risk.
So it's not free lunch, it's just higher risk.
That's the argument. Once you account for this additional systematic risk using more sophisticated asset pricing models, the anomaly might actually disappear, implying that investors are simply being compensated for taking on more risk, rather than exploiting an inefficiency.
Okay, that makes sense too. What other oddities are there?
Finally, let's touch upon some other anomalies that defy easy categorization. A peculiar one is the phenomenon of closed-end investment fund discounts.
What's a closed-end fund again?
A closed-end fund issues a fixed number of shares at its inception, and these shares then trade on stock exchanges like any other stock. Theoretically, the market price of these shares should be equal to their net asset value, NAV, per share,
Which is?
which is simply the total value of their underlying investments minus any liabilities divided by the number of shares outstanding, the value of the stuff inside the fund.
Okay, so the price should match the value of the holdings per share.
Exactly.
Yeah.
Yet, surprisingly, these funds often trade at a persistent discount to their NAV, typically in the range of 4–10% on average.
It's like buying a basket of fruits for less than the sum of the value of the individual fruits inside it.
That's a perfect analogy. Explanations range from management fees and potential future tax liabilities on unrealized gains within the fund to liquidity issues. However, none fully explain the consistent discount.
Can't you just buy the fund and force it to liquidate to get the full value?
Trying to profit from this by buying all shares and liquidating the fund is usually impossible due to prohibitively high transaction costs and legal hurdles, so the discount persists.
Fascinating. What else?
Another observation is earnings surprise and the post-earnings announcement drift. While prices generally react quickly to earnings announcements, as we discussed for semi-strong efficiency.
Right, immediate jump.
For some studies show that if a company delivers surprisingly positive earnings, its stock might continue to perform well, slowly drifting upwards after the initial sharp jump.
A slow burn after the news. That sounds like inefficiency.
It does suggest a slower than expected price adjustment. However, here too, evidence suggests that once you rigorously control for transaction costs and the risks involved, these apparent abnormal returns might well disappear. Maybe the drift is just compensation for taking on the risk associated with that earnings surprise.
Always back to costs and risk. Okay, what about IPOs?
Then we have initial public offerings, IPOs. When a company first lists its shares on a public exchange, the initial offering price is often set too low, a phenomenon known as underpricing.
So the first buyers get a bargain.
Often, yes. This leads to a dramatic jump in the share price on the very first day of trading, allowing initial buyers to make quick profits. It's like when tickets for a hugely popular movie are sold at a lower price initially, and then on the first day, demand pushes the price much higher in the resale market.
But what about investors buying later?
Well, investors who buy shares after the initial offering on the open market typically do not earn abnormal profits. In fact, IPOs often underperform the broader market in the long run after their initial pop.
So a quick burst of excitement, then disappointment.
It suggests an initial burst of over-optimism, perhaps, followed by a more sober reality check.
Okay, one last anomaly type.
And finally, some studies indicate a predictability of returns based on prior information, where stock returns seem correlated with prior economic factors like interest rates or inflation levels.
Can you use that to predict the market?
Well, this isn't necessarily evidence of market inefficiency, as these are fundamental economic factors that can logically influence asset valuations. It might just be risk premiums changing. Furthermore, these relationships are often inconsistent over time, making it exceedingly difficult to develop a consistently profitable trading strategy from them. They might work for a while, then stop.
So the big takeaway from all these anomalies is this. While they are undeniably fascinating and spark endless academic debate, actually making consistent risk-adjusted profits from them in the real world is incredibly difficult after accounting for all costs and risks.
The market fights back.
Many researchers believe these anomalies are often just statistical artifacts remember the data mining, or that they disappear once they become widely known and people try to exploit them. It's a powerful argument for the persistent efficiency of markets, even with these intriguing quirks.
It suggests the market is pretty good at learning and adapting. Hashtag human behavior in markets behavioral finance. This brings us to a compelling and relatively newer field that attempts to explain why markets sometimes behave in seemingly irrational ways. Behavioral finance.
Okay, moving beyond pure numbers and looking at people.
Exactly. Traditional finance models, which form the bedrock of much of what we've discussed so far, often assume that all investors are perfectly rational, always acting to maximize their financial gain, processing information perfectly and without bias. Mr. Spock investors, basically.
Isn't always realistic.
Not always. Behavioral finance introduces the messy, unpredictable element of human psychology into the equation. It studies how people actually make decisions, individually and collectively, and how various cognitive biases, our inherent mental shortcuts and blind spots, might influence investment decisions and consequently market prices. It acknowledges that humans are, well, human.
With emotions and biases and all that.
Precisely. The connection to the anomalies we just discussed is profound. Many behavioral biases have been proposed as potential explanations for why these market anomalies might exist and persist.
Like maybe overreaction is due to panic.
Exactly. Some observed market overreactions or underreactions could be linked directly to how people psychologically process and react to new information, driven by fear or greed or other emotions.
Okay, let's explore some key behavioral biases that are frequently discussed in this field. What's a big one?
First, loss aversion. Traditional finance suggests investors simply dislike risk. Behavioral finance takes this a step further, arguing that the pain of experiencing a financial loss, say losing Rs 10,000, is often psychologically far more intense than the satisfaction derived from an equivalent gain of Rs 10,000.
Losing hurts more than winning feels good.
That's the essence of it. It's like a lopsided emotional scale. This inherent aversion to losses can lead investors to hold on to losing investments for too long, irrationally hoping they'll recover the get-evenitis, or to sell winning investments too early to lock in a gain, even if doing so isn't optimal from a rational perspective.
Fear of loss makes us do strange things.
It can. Some argue this bias can contribute to market overreactions or delayed price adjustments.
Okay, what else?
Then we have herding. This occurs when investors, consciously or unconsciously, disregard their own independent research or private information, and simply choose to do what a large number of other investors are doing.
Following the crowd.
Exactly. Imagine seeing a sudden surge of people rushing to buy tickets for a particular movie, not because you've read reviews or know it's good, but simply because you see everyone else queuing up and you assume it must be good, or you just don't want to miss out.
FOMO, fear of missing out.
Precisely. This clustered trading behavior can amplify price movements, leading to under or overreactions to information, sometimes pushing prices far beyond what underlying fundamentals might suggest, creating bubbles or crashes.
Closely related is overconfidence, right?
Yes. This bias manifests when investors overestimate their own ability to process and interpret information or their ability to control outcomes. I know better than the market.
A dangerous thought.
It can be. An overconfident investor might believe they know more than they actually do, leading them to trade too frequently, generating high transaction costs, or to not diversify their portfolio enough, believing their chosen stocks are infallible. If a significant number of investors are overconfident, it can certainly lead to temporary mispricings in the market.
Okay. You also mentioned information cascades.
Yes, a specific form of herding is an information cascade. This happens when initial actions by a few ostensibly informed individuals influence subsequent individuals, who then imitate those actions without necessarily having their own independent, validating information.
Like a chain reaction.
Exactly. Think of it like deciding which food stall to go to at a busy market. One or two people join a queue at one stall, then a few more follow seeing the queue, and soon a long line forms, even if the food isn't extraordinary. People assume those at the front of the queue know something they don't, and they just follow along.
So people stop thinking for themselves.
In a cascade, yes. In financial markets, this can lead to prices that are incorrect relative to underlying fundamentals or to slower than expected adjustments to information as participants rely on the actions of others rather than processing the original news themselves.
Beyond these, there are several other fascinating behavioral biases.
Yes, quite a few. Like representativeness. This is our tendency to assess new information based on how similar it is to a familiar situation or stereotype, rather than on its actual statistical probability.
Like assuming a new tech stock will be the next Google just because it's in tech.
Exactly. Assuming it will perform exactly like the last successful tech stock, based purely on superficial similarities, without digging into the distinct business models or risks.
What about mental accounting?
This involves treating different pools of money differently. Even though money is fungible, meaning Rs 100 is Rs 100, regardless of where it came from or what it's for.
Like having separate buckets for money?
Precisely. For example, diligently saving money for a specific goal, like saving for a wedding in a very safe, low-risk account, while simultaneously taking high risks with other investments, perhaps your play money. A rational approach might integrate these based on overall risk tolerance, but we mentally compartmentalize.
Interesting. And conservatism.
This bias describes our tendency to be slow in reacting to new information. clinging to our old views or forecasts, even when presented with evidence that contradicts them.
Stubbornness, almost.
You could say that. Imagine a long-standing Kirana shop owner being slow to adopt digital payments because they are comfortable with cash, even when digital is clearly more efficient and preferred by customers. It's sticking to old ways despite new information.
Okay, one more. Narrow framing.
This is the tendency to focus on issues in isolation, without considering the broader context or looking at the big picture.
Tunnel vision.
Sort of. For an investor, it might mean obsessing over the daily fluctuations of a single stock in their portfolio, losing sleep over small dips without considering its overall impact on their diversified long-term investment strategy or their total wealth, focusing too narrowly on one part.
So the fundamental insight from behavioral finance is that humans are, by their very nature, imperfect decision makers. Our cognitive biases can and do influence individual investment decisions.
Absolutely. And this offers compelling potential explanations for some of the market anomalies we observe.
However, a significant debate continues. Even if individual investors are not always perfectly rational, does the market as a whole still remain efficient?
That's the million-dollar question, isn't it?
The argument for efficiency often rests on the idea that smart, rational investors, the arbitrageurs, will quickly step in to correct any mispricings caused by others' irrationality, thereby restoring equilibrium. The smart money cleans up the mess.
So the market might be efficient, even if the people in it aren't always.
This is truly the ongoing tension between traditional efficient market theory and the insights from behavioral finance. Behavioral finance provides us with invaluable tools to understand why people might make certain investment decisions, the psychological drivers.
But it doesn't automatically mean you can make money off those drivers.
Exactly. It doesn't necessarily mean you can consistently profit from those behaviors in an efficient market after accounting for all the associated costs and risks. The market, as a collective mechanism, might still be remarkably efficient, even if some individuals within it are not.
A complex interplay.
So, consider this final check question. If you observe many investors buying a particular stock, not due to any new public information, but simply because they see a few prominent investors making the purchase, what behavioral bias might be at play here?
Following the leaders.
It sounds very much like herding or potentially an information cascade.
Yes, people are following the actions of others, implicitly assuming those others have superior information, rather than conducting their own independent analysis or reacting to direct news. #hashtag outro.
Well, we've certainly covered a tremendous amount of ground today, and our deep dive into market efficiency, a really core concept.
Absolutely. We've established that an efficient market is one where prices reflect information quickly and rationally, and we precisely define the difference between market value, the current price, and intrinsic value, the true estimated worth.
We then rigorously explored the critical factors that contribute to market efficiency. The sheer number of market participants and the depth of analyst coverage, the crucial role of transparent information availability and robust disclosure rules, and the powerful forces of arbitrage constrained by trading costs.
All those drivers. And of course, we meticulously dissected the three forms of market efficiency: weak, semi-strong, and strong, and their direct implications for popular investment approaches like technical and fundamental analysis. What works where?
And let's not forget those truly intriguing anomalies, those apparent deviations from efficiency, like the January effect, the size effect, or the persistent momentum effect, while endlessly fascinating for research.
They are fun to study.
We underscored just how challenging it is to reliably profit from them in practical terms, often due to the friction of transaction costs, the ever-present risk of data snooping, or simply because their profitability diminishes once they become widely recognized and exploited.
The market learns.
Finally, we peered into the compelling world of behavioral finance, gaining insights into how fundamental human psychological biases, from loss aversion and herding to overconfidence and narrow framing, can influence investor decisions and potentially contribute to some of the observed market patterns.
It's a powerful reminder that while markets are complex systems, they're ultimately composed of human beings with all our inherent imperfections.
For you, as someone navigating the complexities of finance, especially for your CFA studies, understanding market efficiency is absolutely fundamental.
Crucial.
It shapes your fundamental investment philosophy, guiding decisions on whether to pursue an active or passive investment strategy, and empowering you to critically evaluate investment advice. It tells you unequivocally that consistently beating the market in developed, transparent markets is an extraordinarily difficult endeavor once all costs and risks are meticulously accounted for.
Absolutely. So as you continue your own journey, here's a thought to really ponder. If markets are, for the most part, highly efficient, does that imply that all the arduous work investors and analysts undertake tirelessly poring over financial statements, scrutinizing news, building complex models to find undervalued stocks is ultimately pointless?
That's a deep question.
Or could it be that their very effort, their relentless competition to identify and exploit every fleeting mispricing is precisely what contributes to the market's efficiency, making it a kind of self-fulfilling prophecy? Does the hard work create the efficiency?
A truly profound question to leave you with. We encourage you to keep dissecting these ideas, keep asking those deep questions, and keep exploring. This is how you build truly robust understanding.
Indeed. Until our next deep dive, take care and keep learning. Goodbye, students.
Goodbye, everyone, and best of luck with your studies. Namaste, and a very warm welcome, my dear students, to the Deep Dive. It's truly wonderful to have you joining us today.
Yes, welcome everyone.
We're about to embark on, well, a really important and fascinating journey into the world of finance.
That's right.
And for many of you, this might be your very first step, your very first introduction to understanding how money truly works in, big businesses.
And that's perfectly all right. Don't worry at all.
Absolutely. We think of us as your friendly guides. We're here to make sure every single concept clicks into place. We'll go step by step.
With lots of patience and lots of relatable examples from our everyday Indian life.
Exactly. So let's start with our big topic for today, equity securities.
Equity securities.
Now, what exactly are these equity securities? It sounds a bit technical, doesn't it?
It can, initially.
But simply put, they represent ownership claims on a company's net assets. Think of it like this, students. When you own equity, you literally own a piece, a small part of that company.
You become a part owner. You share in its successes, its growth.
And even its challenges, yes.
Yes.
Imagine your family decides to start a small Kirana shop. The neighborhood provision store in your local market.
Ah, yes, a familiar sight.
If you contribute some money, maybe from your savings, to help set up that shop perhaps for buying the first lot of goods or maybe a new fridge.
Initial capital?
You immediately become an owner, don't you? Your contribution, your share in the shop's ownership, that's very, very similar to owning equity in a larger company, one listed on the stock market.
You've put your money in, and now you have a claim on its assets, its future earnings.
Precisely. This whole asset class, equity, is absolutely fundamental. It's central to investment analysis, portfolio management.
It's a huge, huge part of how people, individuals like you and me, and large institutions invest their money all over the world.
It really is.
And it is absolutely crucial for our aspiring CFA students, especially those of you just starting, maybe with no finance background at all, to understand equity securities for several very important reasons. Firstly, deciding how much of a client's money, or even your own money, to put into equities. Well, that decision significantly impacts the overall risk and the potential return of the entire investment portfolio.
Ah, that balance.
Exactly. It's like balancing spices in your mother's cooking, isn't it?
Yeah.
It's chili or too little salt, and the whole dish changes flavor.
Good analogy, yes.
Secondly, you'll discover that different types of equity securities, they give different kinds of ownership rights, different levels of control, different claims.
Okay, so not all equity is the same.
Not at all. And these varying rights, in turn, directly affect their individual risk and return profiles. A share that gives you more control, maybe more predictable income, might behave very differently in the market compared to one offering less certainty, but maybe, just maybe, higher growth potential.
I see.
And finally, these subtle variations in features, they are directly reflected in market prices. So understanding them thoroughly helps us value these investments correctly.
Right, to see if the price is fair.
Exactly. Is it priced fairly? Too high? Or maybe it's a hidden gem, undervalued. So today, our aim is to build a strong foundation by answering some key questions.
Like, right.
What is the fundamental difference between common shares and preference shares? What exactly are these private equities we hear about? How can you, sitting in India, invest in companies abroad? And importantly, what are the risks involved and what are the potential rewards?
Excellent points. So, my dear students, based on what we just discussed, if you contribute money and own a piece of a company, what does that fundamentally make you in relation to that company? Just take a moment to think.
Pause.
Yes.
You're an ant.
Yes, that's absolutely correct. You are an owner of that company.
Yep.
Very well done. You truly have a stake, a share in its future.
Now let's zoom out a bit, dear students. Let's look at the truly immense importance of equity securities on a global scale.
The bigger picture.
Yes, the bigger picture. We are talking about markets that are truly massive.
Yeah.
Huge in size, vast in scope.
How massive?
Well, to help us grasp this scale, we can look at something called market capitalization. It sounds fancy, but it's simple, really.
Okay.
Market capitalization, or market cap, basically tells us the total value of all the shares of all the companies listed on a particular stock exchange. It's a very, very big number, representing a vast pool of wealth.
Can you give an example?
Sure. Imagine you are in a big city like Mumbai or Delhi, and you try to calculate the total value of all the houses, all the flats in that entire city.
Wow, that would be a huge number.
Exactly. That huge sum gives you a very real sense of how much wealth is tied up in real estate there, doesn't it? Market cap is similar for stocks. It shows how much investors collectively value all the companies listed on that exchange.
Okay, got it.
Now, our sources highlight something fascinating. The U.S. market, for instance, contributed about 51% more than half to global equity market capitalization back in 2017.
Half the world's stock value. Wow.
Yes. Now, compare that to its contribution to global GDP. That's the total value of all goods and services produced globally. The U.S. GDP contribution was only around 25% in the same year.
So 51% of stock value, but only 25% of economic output. That's a big difference.
It is a significant difference, isn't it? It suggests a very high value placed on U.S. equities by investors globally, perhaps an overrepresentation compared to its direct economic output.
That's indeed a fascinating insight. And if we look at Exhibit 1 from our sources, we see other big economies like China contributing a substantial 15% to global GDP.
A huge economy, yes.
But only 3% to global equity market capitalization. That contrast with the U.S. figures is quite stark, isn't it?
Very stark.
What this implies, my students, is a crucial point for anyone thinking about finance. As markets outside the U.S., particularly dynamic emerging markets like China, and of course our own India,
Yes, India too.
as these economies continue to develop and mature, their market capitalization levels might grow significantly. They might move closer to their actual contributions to global GDP.
That makes sense. Growth potential.
Exactly. This isn't just about numbers. It means understanding global equity markets is becoming more and more important. The opportunities, the dynamics, they're expanding far beyond just one or two dominant markets. It's becoming a truly global playing field. So, thinking about what we just discussed regarding these developing markets, why do you think it is truly important for us here in India to study equity securities from a global perspective? What's the big takeaway? Pause.
Any thoughts? Why look beyond our borders?
That's an insightful answer. You're absolutely right. It's precisely because the global financial landscape is changing so rapidly.
Things move fast these days.
They do. And there are growing opportunities, new dynamics, new market forces to understand that extend far beyond just our home country's borders. The world is getting smaller, more interconnected, and so are our financial markets.
Very true. Let's also briefly look at how equity markets have historically performed compared to other types of investments. This is quite revealing.
Okay, performance comparison.
Yes. Our sources clearly show that. Over the very long run, we're talking about a huge period from 1900 all the way up to 2017.
Over a century.
Indeed. Over that long stretch, equity securities have generally offered higher real returns compared to government bonds and government bills. And remember, real returns means the returns after accounting for inflation. So it's the actual increase in your buying power.
So equities beat bonds and bills after inflation historically.
Generally, yes, over the long term. This has been a very consistent trend across global markets. Think of it like a very long cricket match, a test match, not a quick T20 game.
Ah, cricket. Always helps.
Equities are like the batsmen who take more calculated risks, don't they? They aim to hit more boundaries, maybe take quick singles, score more runs.
The risk takers, yes.
As a result, they tend to accumulate significantly higher scores, representing higher returns over that long innings. They might have some ups and downs, maybe get out cheaply sometimes, but over the full 5 days, they often end up with a much higher total score.
Makes sense. And bonds.
Government bonds and bills, on the other hand, are like those very conservative, very reliable fielders. Excellent at saving runs, stopping boundaries, preserving the team's total.
Steady eddies?
Exactly. They are very reliable. They might help preserve your capital, keep pace with inflation like a good fielder protects runs, but they don't score big themselves. They offer stability, safety, but not that explosive growth potential you see with equities.
So safety versus growth potential.
Precisely. And this historical data aligns perfectly with a fundamental concept in finance, one you must always remember. Higher risk, higher return.
The golden rule.
You could say that. Equities are inherently riskier than government bonds and bills because their future returns are less certain. Therefore, to compensate investors like you for taking on that additional risk, they offer higher expected returns over time.
But there's a catch.
Yes, there is. This higher potential return also means they tend to be more volatile. They experience bigger swings in value, both up and down. More risk, more potential reward, but also more bumps along the road.
Yes, and Exhibit 15 from our sources truly brings this point home vividly. It's an incredibly powerful illustration of how wealth can be created over time.
It really is striking.
Imagine this, my students. An investment of just one single US dollar in US equities back in 1900. Now imagine all the dividends received were consistently reinvested, meaning any profits paid out were immediately used to buy more shares.
Compounding in action.
Exactly. That $1 would have grown to a staggering US $402 in real terms by 2016.
$1 to over $1,400, incredible.
Almost unbelievable wealth creation over a century. But here's the crucial part. Without reinvesting those dividends, if you just took the cash payouts,
What happens then?
that same initial US $1 would only have grown to a mere US 11.9 cents. Just $11.90.
Wow, what a difference.
It highlights the absolute magic, the transformative power of compounding. Reinvesting makes all the difference.
Often called the eighth wonder of the world, isn't it?
It is, and for very good reason. Think of it simply. Reinvesting dividends is like using the bonus talk time, or maybe the cash back you earn on your mobile recharge.
Ah, yes, we all get those.
If you use that bonus talk time to get even more talk time, or use the cash back to pay part of your next bill, those small extras start to add up, don't they?
They do, slowly but surely.
Those extra bits, if used smartly, can help you save more or do more over time, leading to a much bigger benefit than if you just spent them immediately. It's the snowball effect. Your earnings start earning more for you, creating this powerful cycle of growth.
A virtuous cycle.
So my bright students, let's check again. Can you recall why, historically speaking, equity securities generally offer higher returns compared to government bonds and bills? What's the core reason? Pause.
What compensates for the ups and downs?
Excellent, you've got it. It's because equities carry higher risk compared to government bonds and bills. Investors need to be adequately compensated for taking on that extra uncertainty. And that compensation comes in the form of higher potential returns over the long run. Well understood. Now, let's dive into the heart of different types of equity, because believe me, not all shares are created equal. It's important to know the differences.
Very important distinctions, yes.
Companies primarily finance themselves. They raise money by issuing either debt or equity securities. We've already established that equity represents ownership in a company.
Right, owning a piece.
Debt, on the other hand, is quite different. It's simply like taking a loan, borrowing money.
An obligation to repay.
Exactly. Let me give you a very relatable example from our daily lives. If your family needs money for a big occasion, let's say a wedding.
Ah, a common scenario.
If.
Big expenses.
Indeed. You typically have a couple of options, right? One option is you can ask all family members to pool their money together, each contributing their own share from their savings.
Family contribution.
That's very much like equity. There's no fixed obligation to pay them back a specific amount by a specific date or to pay them a fixed return every month. It's their collective stake in the family's well-being. Maybe they share in the joy of the wedding.
More informal, based on trust.
The other option is that you can take a loan from a bank, and that, my students, is precisely like debt.
The formal route.
With a bank loan, you are contractually obligated to repay the exact amount you borrowed, the principal, and to pay interest regularly, usually every month, until the loan is fully repaid. There's a legal agreement, a contract, that must be followed.
Very clear terms and conditions.
So, when a company issues debt, it has that clear contractual obligation. Repay the amount, pay the interest. But when a company issues equity securities, it is not contractually obligated to repay the amount it receives from shareholders.
No fixed repayment date for equity.
Nor is it obligated to make periodic payments like dividends to shareholders. Instead, shareholders, as owners, have what's called a residual claim on the company's assets.
Residual meaning what's left over.
Exactly. They only get whatever is left after all liabilities, like debt, have been fully paid off. Because of this residual claim, equity shareholders are truly considered the owners of the company.
The ultimate risk bearers, but also the ultimate owners.
Precisely. And as owners, investors in equity securities expect the company's management to act in their best interest, primarily by making good operating and strategic decisions that will ultimately increase the value of their shares. That's maximizing shareholder wealth.
Right. So the two main types of equity securities we need to understand are common shares, sometimes called ordinary shares, or common stock and preference shares, also known as preferred stock.
Common and preference. Okay.
Let's begin our detailed discussion with common shares. These are by far the most dominant, the most widely traded type of equity security you'll find in the market today. Most of the shares you hear about are common shares.
Okay, the common type.
Yes. When you own common shares, you truly get a direct share in the company's operating performance. If the company does well, profits grow, your shares usually go up in value. That's your capital gain.
Potential for growth.
You also get to participate in the governance, the running of the company, through important voting rights. This means you have a say in crucial decisions, typically by electing the board of directors.
A voice in the company.
And finally, you have that residual claim on the company's net assets, if it ever liquidates. If the company closes down, sells everything, pays its debts, you, as a common shareholder, get your share of what's left over.
Last in line, but still a claim.
Exactly. Now, companies may choose to pay cash dividends to common shareholders' distributions of their profits. However, it's very important to remember this. They are not contractually obligated to do so.
So dividends aren't guaranteed for common shares.
Not at all. It's entirely at the discretion of the company's board of directors. Depends on their profits, their financial health, their future plans for investment. Many factors.
I see. Voting rights. This sounds important. It really makes common shareholders owners with a voice, doesn't it?
It does. It's a key feature.
Common shareholders get a say in major decisions, like electing the board of directors who oversee the company's management, or maybe approving significant actions like big mergers or acquisitions.
Crucial decisions for the company's future.
But how do these votes actually work in practice? You mentioned there are different ways shareholders can vote.
Yes, there are a few common methods.
Okay. The first and most common method is called statutory voting.
Statutory voting.
Right. With statutory voting, each share you own gets one vote for each director position being elected. So imagine you own 100 shares and there are 5 directors being elected to the board.
Okay, 100 shares, 5 directors.
You can cast 100 votes for candidate A, 100 votes for candidate B, 100 for C, 100 for D, and 100 for E. You have to distribute your votes evenly among the different positions. You can't put all your 500 potential votes onto just one person.
One share, one vote per position. Clear.
Then there's cumulative voting. This one is a bit different, and it's often designed to give a bit more power to smaller shareholders to make their votes count more.
Helping the little guy.
In a way, yes. Here, shareholders can pool their total voting rights and cast them all for a single candidate if they want, or they can spread them across candidates as they wish. Your total votes are calculated differently.
How so?
You multiply the number of shares you own by the total number of directors being elected. So in our example, if you have 100 shares and 5 directors are being elected,
100 times 5.
gives you 500 total votes. You could then use all 500 votes for just one candidate you really want to see elected, maybe candidate C, or you could give 250 to C and 250 to D or any other combination you like.
So you can concentrate your voting power.
Exactly. Let's make this even clearer with an example. Imagine your residence association and your colony or apartment complex is electing 4 committee members for the year.
Okay, a society election.
With statutory voting, if you have, say, 100 voting units based on your flat size, you would give 100 votes to Mr. Sharma, 100 to Mrs. Gupta, 100 to Mr. Reddy, and 100 to Mrs. Khan, distributed equally. But with cumulative voting, you can take all your 400 voting units, 100 units by 4 members, and give them all to just one candidate, perhaps someone you really believe in, like Mrs. Gupta, to significantly boost her chances of getting elected.
I see. That really could make a difference for minority shareholders.
It genuinely helps smaller shareholders get representation on the board, which might otherwise be difficult if large shareholders dominate under statutory voting.
A more democratic system, in a way.
So, my students, quick check. If you had a small number of shares but really wanted to ensure your preferred candidate gets elected to the board, which type of voting system do you think would be more beneficial for you? Statutory or cumulative? Think about concentrating your power. Pause.
Which one lets you put all your votes in one basket?
That's absolutely right. Cumulative voting gives you more power to concentrate your votes on a specific candidate, significantly increasing their chances. Very perceptive.
Building on this idea of voting power and control, we also have something called dual share arrangements or dual class shares.
Dual shares, meaning 2 types of common shares.
Exactly. Our source mentions examples like Viacom and Ford Motor Company. In these structures, companies issue different classes of common shares,
Hmm.
typically labeled Class A and Class B shares.
Okay.
And these classes come with very different voting rights, or sometimes even different claims during liquidation if the company closes down.
So same company, different share powers.
Precisely. For instance, at Viacom, the Class A shares have the voting rights, but the Class B shares are non-voting. What's interesting, though, is that there are far, far more Class B shares outstanding than Class A shares.
So most shares have no vote. Why do that?
This arrangement allows founding families, or perhaps certain groups of initial investors, to maintain significant control over the company, even if they don't own the absolute majority of all outstanding shares. They hold the Class A shares, the ones with the votes.
Ah, so it's a control mechanism.
Yes. At Ford, for example, the Class B shares are predominantly owned by the Ford family, and these shares carry a substantial 40% of the total voting rights, even though the public Class A shares represent the remaining 60%.
So the family keeps significant influence even without owning 50%?
Exactly. But wait, there's more. The Ford Class B shareholders also get preferential treatment during liquidation. They are entitled to receive an extra $1 per share from any distributed assets before Class A shareholders get anything else beyond their initial par value.
Wow, so better voting and better liquidation rights for the family shares.
In that specific case, yes. Think of this like a traditional Indian family business, perhaps passed down through generations.
Yeah, okay.
The elder family members, who might have started and built the business, could hold special Class B shares. These shares might give them more decision-making power in family meetings, or maybe a bigger share of the profits if the business ever closes down, even if outsiders who might be like Class A shareholders technically own a larger total number of shares overall.
It's a way to ensure continuity of control or benefit for specific, often founding groups.
That's a good way to put it.
Yeah.
So a quick thought for you students. In a dual share arrangement, does simply owning more shares always guarantee you more voting power in a company? What have we learned? Pause.
More shares equals more votes. Always.
No, you're spot on. Not always. As we saw with Viacom and Ford, it depends entirely on the specific class of shares you own and the unique rights attached to that particular class. It's a very important nuance to remember.
Okay, so that covers common shares quite well. Now let's shift our focus to the other main type, preference shares.
Yes, preferred stock.
These are quite unique, my students, because they're a fascinating blend. They have characteristics of both debt and common shares. You can think of them as a sort of hybrid financial instrument.
A mix of features.
Exactly. Here's why they're special. Preference shares rank above common shares regarding both dividend payments and the distribution of assets if the company ever liquidates.
Above common shares. That's important.
It's very important. It means if the company decides to pay dividends, preference shareholders get paid before common shareholders get anything. And if the company ever closes down and liquidates its assets, preference shareholders also get paid back their investment before common shareholders receive anything. This gives them a higher claim, more security in a way.
So they have priority.
Yes, priority. Their dividends are usually fixed, much like the interest on a loan or debt. And generally, these fixed dividends are higher than what common shareholders might receive if common shareholders receive any dividends at all.
Fixed income, like debt interest.
However, and this is a crucial distinction, students, unlike debt interest, these preference dividends are not contractual obligations. The company doesn't have to pay them.
Ah, so not guaranteed like interest.
Correct. If the company is facing financial difficulties, it can choose to skip the preference dividend payment without technically defaulting, like it would on a loan.
More flexibility for the company than debt.
Yes. Also, preference shares typically have no voting rights, similar to a bondholder or a lender, usually don't get a say in how the company is run.
No vote, generally.
They can be perpetual, meaning there's no fixed maturity date. Much like common shares, they can just exist indefinitely. And, interestingly, they can also come with special features that make them callable or putable.
Callable and putable. What do those mean?
Let me explain these terms with a relatable example.
Huh.
Imagine you've rented a house.
Okay, renting a house.
Callable preference shares are like your landlord having the right to ask you to vacate your rented house, maybe with a few months' notice, even if your lease agreement isn't fully over. They can call back their shares from you, usually at a predetermined price.
So the company can buy them back.
Yes.
Yeah.
Usually if interest rates fall or the company's situation improves, they might want to get rid of this higher dividend-paying share. On the other hand, putable preference shares are, like you as the tenant, having the right to break your lease early and put back the house to the landlord if you want to leave.
So the investor can sell them back to the company.
Exactly. You can sell your shares back to the company at a predetermined price if you wish. This specific feature offers the investor a bit of a safety net, a guaranteed exit price under certain conditions.
Interesting options. Callable benefits the company. Putable benefits the investor.
Generally speaking, yes.
That's a very clear analogy.
Yeah.
And preference shares can be even more nuanced, especially regarding how those dividends are treated if the company misses a payment. Dividends could be cumulative or non-cumulative.
Cumulative or non-cumulative. Okay, what's the difference?
This feature impacts whether skipped dividends are permanently lost or if they actually accrue, meaning they add up and must be paid later.
So it's about missed payments.
Precisely. With cumulative preference shares, if the company decides to skip a dividend payment in one period, or even multiple periods, maybe because profits were low, that unpaid dividend accrues. It gets added to a running total of what the company owes the preference shareholders. And here's the key. All those unpaid accrued dividends must be paid in full to the preference shareholders before any dividends whatsoever can be paid to the common shareholders.
So preference shareholders get all their back payments first.
Yes, it's like getting in line and waiting for all past dues to be cleared first before anyone behind you in the line gets anything. For instance, think of this like a special annual bonus at your workplace.
Okay, an annual bonus.
If the company skips paying your bonus one year because of, say, financial reasons, with a cumulative feature, they still owe it to you. It adds up to your account. They must pay all past due bonuses to you before they can pay any current bonuses to other employees or even the owners. This feature provides a significant level of security for the preference shareholders regarding their income stream.
That sounds much safer for the investor.
It is. In contrast, non-cumulative preference shares have no such provision. If a dividend is not paid in a certain period, it's permanently forfeited, gone forever. You lose that payment, it doesn't accumulate.
So if they skip it, you just don't get it.
Correct. However, it's important to note, even with non-cumulative shares, the common shareholders still cannot be paid any dividends until the current period's preferred dividends are paid. So while you don't get back past skipped payments, you still maintain priority for current payments over the common shareholders.
Still ahead of common, but no catching up on missed payments.
Exactly. So a quick question for you students. If a company fails to pay dividends on non-cumulative preference shares, do those unpaid dividends accumulate and have to be paid later? Pause.
Non-cumulative. Does it build up?
No, they do not. They're forfeited permanently. That's a crucial distinction to remember, especially when comparing risk.
Very good. Building on that, we also have participating and non-participating preference shares. This distinction is all about whether preference shareholders get to share in the company's extra success beyond just receiving their fixed dividend.
Sharing in the upside.
Exactly. Participating preference shares entitle shareholders to their standard fixed dividend PLUS and additional dividend if the company's profits exceed a certain pre-specified level. It's like getting a bonus payment on top of your regular fixed payment if the company does really, really well.
Oh, interesting.
They can also sometimes have a provision that gives them an extra distribution upon liquidation beyond just their par value, which is their stated or face value. So if the company sold for a huge profit, they might get more than just their initial investment back.
So they participate in extra profits.
Precisely. Imagine you invest in a small sweet shop, a mithai shop. If you have participating preference shares in that shop, you get your fixed payment every month, reliably. But if the shop sells sweets way beyond its target during, say, the Diwali season and makes a lot of extra profit,
A bumper season.
then you get a special bonus share of that extra profit. It's an incentive for you as an investor, allowing you to share in the company's upside potential along with the common shareholders, to some extent.
That sounds attractive. What about non-participating?
On the other hand, non-participating preference shares simply give the shareholder the fixed dividend payment and just the par value upon liquidation, and nothing more from any additional profits. No extra bonuses, no extra share of assets if the company does exceptionally well. They are simpler, more predictable, but offer less upside potential.
Just the fixed return.
Yes. So, students, if you're an investor who wants the chance to earn more than just a fixed dividend from a company that performs exceptionally well, which type of preference share would you prefer to invest in? Participating or non-participating? Pause.
Which one gives you a share of the extra success?
Precisely. You definitely want participating preference shares because they offer that valuable extra participation in the company's success. Well reasoned.
And lastly, under preference shares, we have convertible preference shares. These are quite popular, especially in financing for newer, perhaps riskier companies.
Convertible, meaning they can change into something else?
Exactly. They allow shareholders to convert their preference shares into a specified number of common shares, usually at a predetermined conversion ratio or price, which is set when the shares are first issued.
Okay, so you can switch from preference to common. Why do that?
Well, these shares offer several advantages for investors. Firstly, investors typically earn a higher fixed dividend from these preference shares compared to what they might get from the company's common shares, especially if it's a young, growing company that reinvests all its profits and pays no common dividends.
Better income initially.
Secondly, they get an exciting opportunity to share in the company's future profits and growth if they choose to convert their shares into common shares. This is particularly attractive if the company performs very well and its common stock value increases significantly.
Potential for capital gains later.
Thirdly, they can truly benefit from a significant rise in the common share price through this conversion option. If the common shares skyrocket in value, they can convert and capture that impressive growth. And finally, their price is generally less volatile than common shares because of those stable, predictable dividend payments. This offers a bit of a safety net against market fluctuations, especially in the early, uncertain stages of a company.
So it's like the best of both worlds. Stable income plus potential growth.
In a way, yes. Let's use an analogy. Imagine this is like getting a ticket for a comfortable, perhaps slower, AC bus journey. It's reliable, you know what you're getting, a steady ride with fixed comfort.
Okay, the preference part.
But the bus ticket has a special option written on it. If a new high-speed bullet train starts running on the same route, and you think it will get you to your destination much faster and maybe open up more opportunities of profit,
The common stock taking off.
you have the flexibility to convert your bus ticket into a train ticket. You have the power to switch to the potentially more lucrative, faster option if the company's performance justifies it.
I like that analogy. Clear.
Convertible preference shares are often used by riskier, perhaps unseasoned companies, meaning newer companies, without a long track record to raise crucial capital, especially in venture capital or private equity deals,
Why them specifically?
because it offers investors a safety net with a fixed dividend, providing some stable income and downside protection, but also offers significant upside potential if the company becomes successful and maybe goes public later through an initial public offering, IPO, causing its common shares to become highly valued.
Attracts investors to risky ventures.
Precisely. It balances risk and reward.
Yeah.
So, my students, why might an investor find convertible preference shares more attractive than common shares, particularly when considering a risky young company? What's the dual benefit we discussed?
Think about safety and growth.
You've got it. You're absolutely right. They offer a higher, more stable dividend payment, providing a measure of security, while still giving the chance to benefit significantly if the company's common shares rise dramatically in value later. It's a clever balance of safety and exciting potential upside. Excellent. Tag 4. Private versus public equity securities.
So far, my students, we've mostly discussed equity that is traded on public exchanges. You know, shares you can buy and sell relatively easily on stock markets like our own National Stock Exchange, NSE, or the Bombay Stock Exchange, BSE here in India.
Shares of well-known listed companies.
Exactly. But there's another very significant category of equity which operates quite differently called private equity.
Private, meaning not publicly traded.
Correct. The key difference here is fundamental. Private equity securities are issued primarily to institutional investors like big pension funds or insurance companies, or sometimes to very wealthy individuals through non-public offerings.
Not available to the general public on an exchange.
Right. These are often called private placements because the deal is arranged privately, not offered broadly. And because they aren't listed on public exchanges, there's no active secondary market where you can simply buy or sell them instantly with a click of your mouse or a tap on your phone.
No continuous trading, no readily available price quote.
Exactly. They don't have a constantly updated price flashing on a screen like the shares of, say, Infosys or HDFC Bank. Think of it like this. Shares of a big, well-known company like Reliance Industries or TCS that you can easily buy and sell on the NSE or BSE anytime the market is open, that's public equity.
Easily accessible liquid.
But if you invest money directly into your cousin's new growing startup cafe business that isn't listed anywhere and you own a part of it,
Investing in a friend's venture.
that's private equity. It's much, much harder to sell your stake in that cafe quickly, isn't it? You'd have to find someone specific who wants to buy it, then you'd have to negotiate a price, and then complete all the paperwork for the transfer.
A much slower, more negotiated process.
Illiquid. Highly illiquid is the right term. This also means private equity investments don't have readily market-determined prices like public shares do. And any trade usually requires direct negotiation between the buyer and seller. Also, getting detailed, audited financial statements for private companies can be challenging. They aren't required by regulatory bodies like SEBI to publish them regularly for public consumption, unlike their public counterparts.
Less transparency, generally speaking.
That lack of transparency and illiquidity can be significant challenges for investors.
Exactly, host speaker. Our sources highlight 3 primary types of private equity investments that you should be aware of. These are broad categories.
Okay, 3 types.
First, there's venture capital, often shortened to VC. This provides crucial seed capital. That's the very initial funding to get an idea off the ground or early stage financing, or sometimes what's known as mezzanine financing, which comes a bit later. This funding goes to companies that are in their very early stages of development or those that need capital to expand rapidly.
So funding for brand new ideas and startups.
Yes. These VC funds come from various sources. It could be angel investors, often wealthy individuals, sometimes family and friends, or dedicated private equity funds that specialize in venture capital.
Who are these VCs funding?
For example, if a brilliant young engineer, maybe straight out of IIT, has an amazing idea for a new software app, or perhaps a group of agriculture graduates has a groundbreaking idea for sustainable farming, but they need money to develop the prototype, build the team, and bring it to market.
The initial hurdle.
Venture capitalists are like the angel investors who step in to provide that initial, crucial funding. They take a big risk, mind you, because many startups fail. But they do it hoping for a very big reward if the company becomes hugely successful, maybe the next Flipkart or Zomato.
High risk, high potential reward.
Second type, leveraged buyouts, or LBOs. This is a fascinating and often complex type of transaction you might read about in the financial news.
Leveraged buyout? Sounds like borrowing is involved.
A lot of borrowing. It happens when a group of investors, this group often includes the company's existing management team, and in that specific case is called a management buyout, or MBO uses a very large amount of borrowed money, debt, to buy all the outstanding common shares of a publicly traded company.
Buying the whole company using mostly loans.
Yes, essentially. Once purchased, the company then goes private, meaning its shares are delisted and no longer trade on a public exchange.
Taking it off the stock market, why?
Companies that are good candidates for LBOs often have certain characteristics. Maybe they have undervalued assets that the buyers believe can be sold off to help pay down the large amount of debt they took on. Or perhaps the company consistently generates high, stable cash flows that can be reliably used to make the interest and principal payments on that debt.
So using the company's own assets or cash flow to pay for its purchase.
In large part, yes. The ultimate objective of an LBO is often to restructure and improve the acquired company, make it more efficient, perhaps cut costs, improve operations, and then, after a few years, take it public again, usually through a new initial public offering, IPO, hopefully at a much higher valuation, making a substantial profit for the LBO investors.
So buy it cheap with debt, fix it up, sell it high.
That's the general idea, yes. Imagine a well-known, perhaps slightly old-fashioned, biscuit factory that is currently publicly listed. Maybe its shares are undervalued, or it's not performing up to its full potential due to some inefficiencies.
Okay, an underperforming company.
A group of savvy investors might see potential. They take out a huge loan, buy all its shares, take it private. Then they might streamline its operations, maybe launch some new modern biscuit brands, improve its distribution network. After improving it, they relist it on the stock market at a much higher price, paying back the debt and making a large profit. It's about unlocking hidden value.
A high-stakes strategy.
It can be. And the third type is private investment in public equity, often called a PIPE.
PIPE. Private investment in public equity. How does that work?
This is a specific scenario where a company is already public, listed on an exchange, but it needs capital quickly, perhaps more quickly than a traditional public offering would allow.
An urgent need for funds.
Yes. So instead of going through a lengthy public fundraising process, the company sells a large ownership stake directly to a private investor or a group of private investors. This often happens at a significant discount to the current public market price. as an incentive for the private investor to provide the capital quickly and in a large chunk.
Why would a public company do this?
This strategy is typically employed when a company needs funds urgently for, say, a major expansion project, or maybe to manage a high level of debt that's coming due. Or perhaps if it's experiencing a rapid deterioration in its operations and needs a cash injection quickly to survive or turn things around.
A lifeline sometimes.
It can be.
Yeah.
For instance, imagine a listed real estate company that suddenly needs, say, 500 crore rupees to finish a big housing project or to pay off an urgent bank loan. A large private investment firm might quickly inject that huge sum by buying a large block of shares directly from the company, often at a slightly discounted price compared to the market. It's much faster than trying to sell those shares slowly on the open market or arranging a full public offering.
A quick, direct injection of cash from a large investor.
Exactly. So, students, let's recap those three types. Which type of private equity investment typically involves a company going from being publicly traded to privately owned, and usually involves using a lot of borrowed money to achieve this?
Pause. Public to private, lots of debt. Which one was that?
That's right, you've grasped it. It's a leveraged buyout, LBO. Well done.
Private equity has seen truly considerable growth globally over the past 3 decades, my students. It's certainly no longer a small niche area of finance. It's become quite mainstream.
A major force in global capital markets now.
Absolutely. The number of companies under private equity ownership has also grown significantly. Our sources say from fewer than 2,000 companies in the mid-1990s to over 20,000 globally by early 2017.
A tenfold increase. That's remarkable growth.
It really is. And interestingly, the average holding period for these private equity investments has also increased quite a bit. It used to be around 3 to 5 years back in the 1980s and 90s.
A relatively quick turnaround then.
Yes, but now it's approximately 10 years on average. This longer holding period is very key, I think.
Why is that important?
It allows private equity investors to be more patient. They can take the time to properly address any underlying operational issues within the company, implement long-term strategic changes, and truly focus on sustainable long-term value creation, rather than just aiming for quick financial engineering or flips.
More focus on fundamental business improvement.
Exactly. And this brings us to a crucial point about the difference in focus between public and private companies. Public companies, those listed on stock exchanges, often face immense pressure to meet short-term results.
The tyranny of the quarterly report.
You could call it that. They have to report quarterly earnings targets to market analysts and investors, and there's constant scrutiny on their day-to-day share price performance. This intense short-term pressure can sometimes distract management from making decisions that are truly best for the company's long-term sustainable growth. They might delay a crucial R&D project because it hurts this quarter's profits, even if it's vital for the future.
Short-term gain prioritized over long-term health.
Let's use another cricket analogy. We seem to like those.
They work well.
A public company is like a cricket team that feels it must win every single T20 match that's like their quarterly results to keep its fans, the analysts, and the sponsors happy and confident. Constant pressure for immediate performance.
High pressure, yes.
But a private company, because it's not under that constant glare of public scrutiny and daily share price movements, is more like a team that can focus on building strong players for the future, developing a solid strategy for winning a long 5-match Test Series championship. They can make decisions with a much longer time horizon in mind, fostering deeper, more sustainable growth, without worrying about every single day's or week's performance metric.
A very different mindset. Precisely, host speaker. By going private, through an LBO, for instance, management can genuinely focus on the long term. They can also eliminate many of the significant costs associated with being a public company.
Costs of being public, like...
They can be substantial. Costs for regulatory filings with bodies like SEBI here or the SEC in the U.S., maintaining dedicated investor relations departments to constantly communicate with shareholders and the media, holding those frequent quarterly analyst conference calls. These can be quite significant financial and time burdens.
So going private saves money and allows long-term focus. Sounds good.
It has advantages. However, it's also important to acknowledge the other side. Public equity markets are much, much larger and offer far more opportunities to raise significant amounts of capital from a broad base of investors. You can potentially raise billions through an IPO, which is harder privately.
Access to huge capital pools.
Yes. And the capital raised in public markets is actively traded, providing crucial liquidity, that ease of buying and selling to investors, which they value highly. Also, that public scrutiny, despite the pressure it creates, does incentivize companies to be more transparent in their corporate governance practices and how they compensate their executives.
The pressure keeps them honest, maybe?
To some extent, yes. Some studies even suggest that private equity firms might sometimes score lower on certain corporate governance effectiveness metrics precisely because they lack this constant public oversight and the associated pressure for transparency.
Yeah.
So it's definitely a trade-off. Public versus private has distinct advantages and disadvantages on both sides.
No single perfect structure.
Not really. It depends on the situation. So my students, can you tell me one key advantage of a private company compared to a public company, specifically in terms of its management's strategic focus? What can they prioritize? Pause.
What kind of focus does being private allow?
Yes, you've hit the nail on the head. A private company's management can often focus much more on long-term value creation and achieving strategic objectives rather than being constantly driven by short-term quarterly results. That's a very important distinction to keep in mind. #Tay5. Investing in non-domestic equity securities.
In today's incredibly interconnected world, my students, investing in companies outside your home country, what we call non-domestic equity securities, has become significantly easier than ever before. It wasn't always like this.
Technology has made a huge difference.
It really has. The internet, advanced electronic trading platforms, they've truly broken down many of the traditional barriers that once made global investing seem very complex, very expensive, and largely inaccessible for ordinary investors.
Opening up global markets.
So why would an investor sitting here in India want to invest globally? Why look at companies in the US or Europe or Japan?
Diversification is a key reason.
Exactly. It's a powerful and smart strategy. It allows investors to diversify their portfolios and potentially improve their overall risk and return characteristics. How? Well, by adding assets from different countries, different economies, you introduce investments that don't always move in the same direction as your local assets, like the Indian market.
Not putting all your eggs in one basket.
Precisely. If the Indian market is having a tough time, maybe experiencing a slowdown, your international investments might be doing well. Perhaps the U.S. economy is booming. This helps to balance things out, smooth out the ride, and provide stability to your overall portfolio.
Reduces dependency on just one market's performance.
It's like, well, let's use our favorite sweets example again. It's like not putting all your delicious ladoos in just one single box from one single shop.
Okay, diversifying your sweets.
If your local sweet shop is having a bad day, maybe sales are down, or there's a problem with their ingredients, your precious ladoos are much safer if you also have some stored safely from another popular sweet shop, maybe one in a different city or even a different country. You spread your risk, right? And you might even discover new, delicious varieties or opportunities you didn't know existed.
A tasty way to think about diversification. While it's certainly easier to invest globally now, it's not entirely without hurdles. There are still some barriers, primarily what our sources call foreign restrictions imposed by various countries.
Restrictions by governments? Why?
These restrictions are usually put in place for, broadly speaking, three main reasons. First, to limit the control foreign investors can exert on domestic companies. Governments often want to ensure that strategic national industries, maybe defense or key infrastructure companies, remain largely under domestic control and influence. They might cap the percentage a foreign entity can own.
Protecting national interests.
Second, sometimes it's to give domestic investors better opportunities to own shares in foreign companies operating within their own country. This allows local citizens to participate in and benefit from the success of international businesses that choose to set up operations locally.
Sharing the benefits.
And third, governments sometimes restrict the easy movement of money in and out of their country to reduce the volatility of capital flows. They want to prevent sudden, large outflows of capital, which can severely destabilize their economy and currency.
Avoiding crises.
Exactly. Remember the Asian financial crisis back in 1997-98? Huge, rapid outflows of foreign capital severely hit emerging markets like Thailand, Indonesia, and South Korea. Many governments responded by imposing restrictions on capital movement to protect their economies from such destabilizing shocks.
So controls can be defensive measures.
They can be. However, it's also important to note that many studies show that reducing these restrictions, opening up markets more, can actually improve long-term equity market performance. It attracts more capital, increases liquidity, and fosters competition. And thankfully, the trend globally is towards liberalization. More and more countries are allowing higher levels of foreign ownership today, recognizing the benefits of global economic integration.
So the barriers are generally coming down.
Generally, yes.
And over the past 2 decades, my students, we've observed three big interconnected trends emerging in international financial markets, driven by this globalization and technology.
What are those trends?
First, an increasing number of companies are choosing to issue their shares directly in markets outside their home country, an Indian company listing in New York, for example. Second, the number of companies whose shares trade actively in multiple markets around the world has also grown significantly. And third, flowing from that, more companies are becoming dual listed.
Dual listed, meaning listed on two exchanges simultaneously.
Yes, exactly. Their shares are simultaneously issued and traded in two or more different markets, perhaps their home market, and a major international market like London or New York.
Why would a company do that? What are the benefits?
This trend has particularly benefited companies in emerging markets like here in India. For them, it means they are no longer solely reliant on or constrained by the capital available or the liquidity conditions in their domestic market alone.
Tapping into larger pools of capital abroad.
Precisely. They can now raise capital in developed countries, which often have much deeper pools of capital, higher liquidity, meaning it's easier for investors to buy and sell shares quickly, and they generally have stricter financial reporting requirements and accounting standards.
Which builds investor confidence.
Absolutely. Being listed internationally offers several other benefits too. It can significantly increase investor awareness about the company's products, services, and brand, not just at home, but globally. It enhances the liquidity of the company's shares, making them more attractive to a wider global pool of institutional and retail investors. And importantly, it often boosts corporate transparency,
How so?
because the company is now subject to the scrutiny of a broader range of analysts, investors, and regulators in different countries, and it needs to meet potentially multiple sets of filing requirements. This increased scrutiny encourages better governance and disclosure.
So more visibility, more liquidity, better transparency. Sounds good.
It generally is, yes. So my intelligence students, can you name one significant benefit for an emerging market company if its shares are dual listed on an international exchange? Think about what it gains access to. Pause.
What becomes easier for the company if it lists abroad?
That's a very good answer. You've understood it well. Such a company can gain access to more capital from a wider pool of investors and significantly increase the liquidity of its shares, making them much more easily tradable for everyone. Excellent.
So the next logical question is, how can you, as an investor sitting here in India, actually invest in these non-domestic equities, these shares of companies based abroad?
Yes, the practical steps.
There are a few main and popular methods. First, there's direct investing.
Buying shares directly on a foreign stock exchange.
Yes, the most straightforward way, conceptually. You open an account with a broker that specifically offers international trading facilities. However, this comes with its own set of complexities you need to be aware of.
Like what?
Well, you have to deal with foreign currencies, both for buying the shares and for receiving any dividends paid. This means you're exposed to foreign exchange. Risk, the value of your investment can change just because the exchange rate moves.
Currency fluctuation.
Yes. You also need to understand and comply with potentially different trading rules, clearing procedures, settlement regulations, and even different accounting standards used by the foreign company, which might vary significantly from Indian standards. It can also mean less transparency if you're investing in less developed foreign markets, and potentially more volatility.
So direct investing needs more homework.
It certainly does. A second and very popular and often more convenient method is using depository receipts, often just called DRs.
Depository receipts, DRs. Okay.
These are especially useful for accessing shares of foreign companies that don't have a direct listing here in India. A DR is essentially a security that trades just like an ordinary share on your local exchange, like the NSE or BSE, but it actually represents an economic interest in a foreign company.
So it trades here but represents a share elsewhere. How does that work?
Let's say you want to invest in a big Japanese electronics company, maybe Sony or Panasonic. Instead of you having to open an account in Japan, deal with yen, and buy shares directly on the Tokyo Stock Exchange.
Which sounds complicated.
What happens is this. A large international bank, often called the depository bank, buys a large block of shares of that Japanese company in Japan. Then, that bank holds those shares in custody and issues receipts against them. These receipts are then listed and traded on your local stock exchange here in India, in Indian rupees.
Ah, so the bank holds the foreign shares and issues a local certificate.
Exactly. You buy the DR in rupees, you trade it in rupees, and if the company pays dividends, the bank collects the dividends in yen, converts them to rupees, minus some fees, and passes them on to you, the DR holder.
Much simpler for the local investor.
Much simpler. Think of it like this. If you want to invest in that big Japanese electronics company, but don't want the hassle of dealing with Japanese yen or their specific stock exchange rules and timings, you can simply buy its depository receipt listed in India.
Like a proxy.
Exactly. It's like buying a proxy ticket for a popular foreign movie at your local PVR or INOX cinema without needing to actually travel all the way to Japan to watch the movie there.
Hmm.
It gives you the economic exposure to the foreign company without all the logistical headaches.
Got it. And the DR price.
The price of the DR is affected by the price of the underlying shares in the foreign market, of course, but also by the exchange rate between the rupee and the foreign currency, like the yen, and by supply and demand conditions in the local Indian market for that DR. The depository bank acts as a custodian for the shares, handles all the dividend payments, manages things like stock splits or bonus issues, and acts as the transfer agent.
Okay, that makes sense. Now, I remember reading that DRs can be sponsored or unsponsored. What's the difference there? It sounds important.
It is quite important, yes, because it affects your rights as an investor.
How so?
In a sponsored DR, the foreign company itself, the Japanese electronics company in our example, is directly involved in issuing these receipts. They initiate the process, they choose the depository bank, and they sign an agreement with the bank.
So the foreign company wants this to happen.
Yes. Because the foreign company is involved and has agreements in place, investors who buy sponsored DRs usually have the same rights as the direct common share owners of that foreign company. This typically includes the right to vote on company matters, usually through the depository bank, and the right to receive dividends directly. Sponsored DRs, especially those listed on major exchanges like the New York Stock Exchange, generally have more extensive reporting requirements and are subject to stricter regulation, providing more transparency. Our source mentions Alibaba's sponsored ADR program as a prominent example of this.
Okay, sponsored means the company is involved and you get voting rights.
Generally, yes. Think of it like a big international hotel chain, say Marriott or Hyatt, directly setting up its franchise hotel in your city. They are actively involved, they ensure all their brand standards and services are replicated properly, and you, as a customer staying there, have all the benefits and expectations as if you were staying at their main hotel in another country. You get the full official experience.
Good analogy. So what about unsponsored?
With an unsponsored DR, the foreign company has no involvement whatsoever. The depository bank, perhaps seeing demand from local investors, simply goes into the foreign company's domestic market on its own initiative, buys its shares on the open market, and then issues receipts against those shares through local brokerage firms here.
So the foreign company isn't even asked?
Correct. They have no formal agreement with the bank for this DR program. In this case, because the foreign company isn't involved, the depository bank usually retains the voting rights for those underlying shares, not the individual investors who buy the unsponsored DRs.
Ah, so if I buy an unsponsored DR, I don't get to vote.
Typically, no. The bank holds the vote.
Yeah.
You get the economic exposure, the price changes and dividends, but usually not the governance rights like voting. Unsponsored DRs also tend to have fewer reporting requirements.
That's a very important difference. So a quick check question for you, my bright students. If you invest in an unsponsored depository receipt, who typically holds the voting rights to the underlying shares, is it you or someone else?
Who keeps the vote when the company isn't involved?
Yes, you're absolutely right. It's the depository bank that retains those voting rights in an unsponsored program. Very good. You're picking up these details well.
Now, within the world of DRs, there are two main types you should be familiar with based on where they are issued and traded.
Okay, two main types of DRs.
First, Global Depository Receipts, or GDRs. These are issued outside the company's home country and, importantly, outside the United States. The depository bank that issues GDRs is typically located in the major financial centers where these shares are traded, like London or Luxembourg or Singapore.
So GDRs are for trading outside the U.S. and the home country.
Exactly. A key advantage often cited for GDRs is that they may not be subject to some of the foreign ownership restrictions or capital flow controls that might be imposed by the issuing company's home country because they are created and traded outside that country's direct jurisdiction. Most GDRs traditionally have been denominated in US dollars, although we're seeing an increasing number denominated in euro and British pound sterling as well. It's important to note, while GDRs cannot be publicly listed on US exchanges, they can still sometimes be privately placed with large institutional investors in the United States under specific rules.
Okay, GDRs are global, mostly non-US. What's the other type?
The other major type is American Depository Receipts, or ADRs. These are specifically U.S. dollar-denominated securities that trade just like common shares on U.S. exchanges like the NYSE or NASDAQ.
So ADRs are specifically for the US market.
Precisely. ADRs are actually the oldest type of depository receipts, first created way back in 1927, and they are currently the most commonly traded type of DR globally. They were specifically designed to make it easier for foreign companies to tap into the vast pool of capital available from U.S. investors, and to make it easier for U.S. investors to invest in foreign companies without dealing with foreign currencies or exchanges.
So ADR is a US version of a DR.
You can think of it that way. An important point to grasp is that an ADR is essentially a form of a GDR. It's issued outside the home country. But not all GDRs are ADRs because, as we said, GDRs in general cannot be publicly traded in the U.S. Only ADRs can. You might also hear the term American Depository Share, ADS. That usually refers to the underlying foreign share that the ADR certificate represents, often used interchangeably.
Okay, ADRs are US-listed DRs. Are there different kinds of ADRs?
Yes. Our sources note that there are different levels of ADRs, primarily based on the level of SEC, Securities and Exchange Commission, registration and reporting the foreign company undertakes. Level 1 ADRs, for example, trade over-the-counter, not major exchanges, and have the least stringent requirements. Levels 2 and 2 ADRs can trade on major U.S. exchanges like the NYSE and NASDAQ. Level 3 ADRs actually allow the foreign company to raise new capital in the U.S. market through the ADR offering. But these require full SEC registration and compliance, meaning the highest degree of transparency and scrutiny equivalent to a U.S. company. There's also a Rule 144A category for ADRs that are privately placed with large, qualified institutional investors and don't require full SEC registration.
Wow, different levels of compliance and trading access.
Exactly. Let's use another analogy. Think of it like a travel visa again, but this time for your foreign shares wanting to enter the U.S. market. An ADR is like a specific U.S. visa that allows those foreign shares to be traded and function within the U.S. financial system. A GDR is perhaps like a more general Schengen visa that lets your shares travel to many countries outside the U.S. The different ADR levels, 1, 3.44a, are like different tiers of U.S. visas. Some allow more activities, like Level 3 allowing capital raising, similar to a work visa, but require much more paperwork and compliance, while others are simpler, like Level 1, maybe akin to a basic tourist visa, with fewer privileges but easier entry.
That visa analogy helps clarify the different levels. Are there any other ways to invest internationally besides direct investing in DRs?
Yes, a couple more worth mentioning briefly. There are global registered shares, or GRSs.
DRSs, how are they different?
These are quite interesting. They are essentially the company's actual common shares, but they are registered and can be traded on different stock exchanges worldwide in the local currency of that exchange. The key difference is the seamlessness. The same underlying share purchased on, say, the Swiss exchange in Swiss francs can be easily sold on the Tokyo exchange for Japanese yen without the investor having to worry about complex currency conversions or dealing with separate receipts. It represents direct ownership, just traded globally. Companies like the former Daimler Chrysler and UBS AG have used GRSs.
So one share, multiple exchanges, direct ownership. More flexible than DRs, perhaps.
Potentially, yes, in terms of trading across markets seamlessly. And finally, there are Basket of Listed Depository Receipts, or BLDRs.
BLDRs, that sounds like builder.
It does. But it stands for Basket of Listed Depository Receipts. This is essentially an exchange-traded fund, an ETF.
Like our nifty ETFs here.
Exactly. An ETF, as you know, is a fund that holds a basket of securities designed to track a specific index, like Nifty 50 or the Sensex. But the ETF itself trades like a single share on the stock exchange throughout the day.
So a BLDR is an ETF of?
It's specifically an ETF whose underlying portfolio consists of depository receipts. It's designed to track a particular index composed of DRs, often from a specific region or sector.
So I can buy one share of a BLDR and get exposure to many foreign companies via their DRs.
Precisely. For example, if you want to invest broadly in, say, Asian technology companies, but don't want to pick individual stocks or DRs, you could buy a BLDR that tracks an index of 50 major Asian tech ADRs. It's like buying a convenient combo pack or a dolly meal of different foreign company investments rather than ordering each dish separately. It gives you broad diversification within that theme with a single, easily traded investment.
That sounds very convenient for diversification. Okay, lots of ways to invest globally. So my bright students, let's do a final check on this section. If you are a U.S. investor and you want to invest in a foreign company that is already listed on a U.S. exchange, like the NYSE, and denominated in U.S. dollars, what specific type of security would you typically look for? Pause.
Listed in the U.S. in U.S. dollars.
Mm-hmm.
Which DR was that?
That's right. You would look for an American Depository Receipt, ADR. You're really getting the hang of this. Fantastic. Hashtag tag 6. Risk and return characteristics of equity securities.
Okay, now let's shift our focus slightly and connect some of these ideas. We need to understand how the specific type of equity security fundamentally affects its risk and its potential return. This relationship between risk and return is perhaps the most central concept in all of finance.
Risk and return, the core trade-off.
Exactly. The total return you earn from holding an equity security primarily comes from two main sources. First, the price change, which is also known as capital gain or capital appreciation. Second, any dividend income the company might pay out.
Price change and dividends.
Let's break that down simply. If you buy a share for, say, €, and then sell it later for 60, that 10 difference, 60 euros, your price change or capital gain. Now, if during the time you held that share, the company also paid you euro as a dividend,
A payout from profits.
then your total return from that investment would be the €10 price gain plus the €2 dividend, making it 12 in total.
Okay, simple enough.
The formula for calculating the percentage total return is also quite straightforward. Total return, selling price, purchase price plus dividends, purchase price. So in our example, it would be €60.50 plus €2, which is €12.50 or 24%.
Got it. What about companies that don't pay dividends?
Good question. For non-dividend paying stocks, and these are often younger, fast-growing companies that prefer to reinvest all their profits back into the business to fuel further growth, the return for the shareholder comes purely from price appreciation, from the capital gain when they eventually sell the share.
All return comes from the price going up.
Yes. But remember, for investors who purchase foreign shares, either directly or through depository receipts, there's potentially a third crucial source of return or loss that we touched upon earlier.
Ah, the currency effect.
Exactly. Foreign exchange gains or losses. Let's revisit that with an example. Suppose a U.S. investor buys ADRs of an Indian company listed in New York. If, during their holding period, the Indian rupee appreciates or strengthens against the U.S. dollar,
The rupee gets stronger.
that U.S. investor actually earns an additional return when they eventually sell the ADRs and convert the proceeds back to U.S. dollars. Why? Because each rupee represented by their ADR is now worth more in dollar terms.
So a strong rupee helps the U.S. investor in an Indian ADR.
Correct. But the opposite is also true. If the Indian rupee depreciates or weakens against the U.S. dollar during their holding period,
The rupee gets weaker?
then their total return when converted back to U.S. dollars will actually be lower than the return generated by the underlying Indian share price movement alone. The currency movement subtracts from their return.
Works both ways. Adds another layer of uncertainty.
It certainly does. Think of it like planning your budget for a foreign holiday. If the local currency of the country you're visiting suddenly strengthens against the rupee after you've already exchanged your money, your rupees by less, it feels like a loss for your spending money. But flip it around. If you hold investments denominated in that foreign currency and that currency strengthens against the rupee, the value of those investments, when you convert them back to rupees, actually increases. Currency movements are a key part of international investing returns.
Definitely something to watch out for.
So a quick check question for you students on this currency impact. If you invest in a foreign company, say a U.S. company from India, and your home currency, the rupee, strengthens compared to the foreign currency, U.S. dollar, will your total return from that investment when converted back to rupees generally be higher or lower? Pause.
Rupee strengthens, dollar weakens. Good or bad for your U.S. investment return in rupees?
It will be lower. You're thinking clearly. When your home currency strengthens, it means the foreign currency buys fewer units of your home currency, so the returns earned in that foreign currency translate back into fewer rupees. Very good.
Now, it's absolutely vital, my dear students, to keep hammering home the compounding effect of reinvested dividends. We mentioned the numbers earlier, but it bears repeating because it's so powerful.
The foundation of long-term wealth building.
Truly, our sources highlight this dramatically. Over long periods, total returns are overwhelmingly influenced by the decision to reinvest those dividends. It's not just a small boost, it's the main engine of growth for many long-term equity portfolios. As we saw in that Exhibit 15 example, From 1900 to 2016, that single U.S. $1 invested in U.S. equities grew to U.S. $1,402 with dividends reinvested.
An astonishing figure.
But without reinvesting, if you just spent the dividends as they came in, it grew to only U.S. 11.1199 cents.
The difference is just immense, more than 100 times larger with reinvestment.
It clearly shows how utterly crucial reinvesting is for truly building significant wealth over decades. Let's simplify this further. Imagine you plant a small mango seed.
Okay, a mango seed.
It grows into a small tree and gives you a few mangoes each year. If you just eat those mangoes, you enjoy them, but that's it. But what if you take the seeds from those mangoes and plant them?
Ah, you get more mango trees.
Exactly. Over time, you don't just have one tree, you have an orchard. Each new tree produces more mangoes, which contain more seeds, leading to even more trees. That's the essence of compounding with reinvested dividends. Those small dividend payments continuously put back to work buying more shares, more trees, don't just add up. They multiply and snowball into a much, much larger total investment over time. Each share you own works to buy you more shares.
A beautiful analogy for compounding.
Now let's turn our attention from returns to the other side of the coin, risk.
Yes, equally important.
The risk of any security, whether it's equity or debt, is fundamentally based on the uncertainty of its future cash flows. Think about it logically. If you're very unsure about how much money a company will make in the future, or whether it will be able to pay you any dividends, or even if it will survive, well, then your investment in that company is naturally riskier, isn't it?
More uncertainty equals more risk.
Precisely. The more uncertain those future cash flows are, the greater the perceived risk. And consequently, the more variable or volatile the security's price is likely to be in the market as investors react to new information and changing expectations. So, for equity, risk is essentially the uncertainty surrounding its expected total return.
And how is this risk measured?
It is often measured statistically by the standard deviation of its expected total return. Standard deviation, in simple terms, tells us how much the actual returns are likely to deviate or spread out from the average expected return. A higher standard deviation means a wider spread of possible outcomes, indicating higher risk and greater volatility.
So higher standard deviation, higher risk. Okay. Building on that understanding of risk, we also need to compare the relative risk of the different types of equity securities we've discussed. Common versus preference shares.
Which one is generally riskier?
Generally speaking, preference shares are considered less risky than common shares for three main reasons. These are important distinctions for you to remember.
Okay, 3 reasons preference shares are safer.
1. Known and fixed dividends. As we discussed, dividends on most preference shares are known and fixed, or have a fixed formula. This significantly reduces the uncertainty about future cash flows for preference shareholders, making their expected returns more predictable compared to common shares, where dividends are discretionary and can vary wildly or be non-existent.
More predictable income stream.
2. Payment priority. Remember, preference shareholders get paid their dividends and any other distributions like liquidation proceeds before common shareholders receive anything. They are higher up in the payment queue, giving them a stronger prior claim on the company's earnings and assets.
First dibs on payments.
3. Fixed liquidation amount. The amount preference shareholders are entitled to receive if the company is liquidated is usually known and fixed, typically the par value or face value of their shares. While payment isn't absolutely guaranteed if the company faces severe financial distress and simply runs out of assets after paying debt holders, they still have a fixed claim amount that ranks senior to or ahead of the common shareholders.
A more defined claim in bankruptcy.
Exactly. Now compare that to common shares. With common shares, a much larger portion of the total expected return typically depends on future price appreciation, which is inherently uncertain and depends on market sentiment and company performance. Future dividends for common shares are also uncertain and entirely at the discretion of the company's board. And in the unfortunate event of liquidation, common shareholders are the residual claimants. They get whatever is left, if anything, only after all creditors, like banks and bondholders, and all preference shareholders have been paid in full.
So common shareholders face more uncertainty all around.
They do. So because there is significantly lower uncertainty surrounding the total return for preference shares compared to common shares, preference shares generally have lower risk. And following our fundamental principle,
Lower risk means?
lower risk generally implies a lower expected return compared to common shares. Investors accept a lower potential return on preference shares in exchange for that greater certainty and priority. It's that classic risk-return trade-off in action again.
That makes perfect sense.
So My students, let's solidify this point. If a company were to be liquidated, meaning it's selling off all its assets and closing down permanently, who generally gets paid back their investment first? Preference shareholders or common shareholders? Pause.
Who has the higher priority in liquidation?
Yes, you're correct.
Yeah.
Preference shareholders come before common shareholders in the pecking order during liquidation. That's a very important seniority to remember.
And finally, my students, it's not just about common versus preference. Even within those categories, the specific features attached to the shares can significantly affect their risk profile.
Ah, the callable and putable features again.
Exactly, and cumulative versus non-cumulative, too. Let's quickly recap their risk implications. Putable, common, or preference shares, remember, where the investor has the right to sell back to the company. These are less risky for investors than callable or non-callable ones.
Why less risky?
Because the investor holds the option. They have the right to sell the shares back to the issuer at a predetermined price. This predetermined put price acts as a floor, a minimum value for their investment under certain conditions, which significantly reduces the downside risk and future cash flow uncertainty. Because they offer the safety net to the investor, putable shares often pay slightly lower dividends or yields the company is compensated for giving away this valuable option.
Investor option reduces investor risk.
Callable, common, or preference shares where the company has the right to buy back the shares. These are, conversely, riskier for investors than non-callable ones.
Why riskier for the investor?
Because the issuer, the company, holds the option. They can choose to redeem or call back the shares from the investor at a predetermined price. This is usually done if interest rates fall or the company wants to refinance at a lower cost. For the investor, this call feature effectively limits their potential future upside return. If the share price or value rises significantly above that call price, the company might just call the shares back, preventing the investor from fully benefiting from that rise. To compensate investors for taking on this call risk, callable shares typically have to offer higher dividends or yields compared to similar non-callable shares.
Company option increases investor risk, so higher yield is needed. Makes sense.
And cumulative preference shares, remember, where missed dividends add up. These are clearly less risky for investors than non-cumulative ones.
Because you eventually get paid missed dividends?
Exactly. The cumulative feature provides a strong assurance that any unpaid dividends accrue and must be paid in full before common shareholders can receive any dividend payments at all. This provides a much stronger claim for the preference shareholder regarding their expected income stream, significantly reducing their dividend payment uncertainty compared to non-cumulative shares.
So putable and cumulative features reduce investor risk, while callable features increase investor risk.
That's a great summary. However, it's important to remember that for all preference shares, regardless of these features, the primary underlying risk remains the uncertainty of those future dividend payments actually being made. Even with cumulative features, if the company faces severe financial distress or goes bankrupt, there's no absolute ironclad guarantee of payment. This uncertainty ultimately depends heavily on the issuing company's ability to consistently generate sufficient cash flows and net income year after year. So as an investor, you must always look carefully at the fundamental financial health and stability of the company itself beyond just the attractive features of the preference share.
Okay, let's shift our focus now slightly to how equity, this ownership stake, actually contributes to a company's overall value and how we measure that value.
Value creation, the ultimate goal.
Precisely. Companies issue equity on primary markets. Remember, that's when they sell new shares directly to investors, like in an IPO, primarily to raise vital capital. This capital is the lifeblood, the fuel for any business.
What do they use this capital for?
Oh, a variety of critical purposes. To finance their day-to-day revenue-generating activities, to acquire long-lived assets like factories, machinery, or technology, to fund large capital expansion projects, to invest in crucial research and development, R&D for future products, to enter new product lines or geographic markets, or even sometimes to acquire other companies to grow faster or gain market share.
Fueling growth and operations.
Yes. And sometimes it's simply to ensure the company can continue to operate smoothly as a going concern, perhaps meeting regulatory capital requirements like banks need to, or satisfying debt covenants promises made to lenders to avoid defaulting on their loans.
So for stability, too.
Absolutely. Now, the ultimate goal of the company's management, at least from a shareholder's perspective, should be twofold. First, to steadily increase the book value of the company, and second, to maximize the market value of its equity.
Book value and market value. We heard these terms before. Let's clarify them again.
Good idea. The book value of equity is essentially an accounting measure. It's the difference between a company's total assets and its total liabilities, as meticulously recorded on its balance sheet, that key financial statement showing assets, liabilities, and equity at a specific point in time. Book value increases primarily when the company earns net income, profit, and then retains that net income, reinvesting it back into the business instead of distributing it all as dividends to shareholders.
So book value, assets, liabilities from the accounting records.
Exactly. For example, let's go back to our small Kirana shop. The total value of all its goods on the shelves, its cash register, maybe delivery scooter, and its furniture. Those are its assets. Now, subtract any loans it has taken from suppliers, or maybe a small bank loan. Those are its liabilities. The remaining amount is its book value, according to its simple books.
Okay.
Now, if the shop makes a profit at the end of the month, and the owner wisely decides to reinvest that profit back into the business, say, by buying more stock to fill the shelves, or maybe upgrading to a bigger, better refrigerator, instead of taking all the profit out for personal use,
Reinvesting the profits.
then the shop's book value increases. Management, through its decisions affecting net income and how much of that income is retained within the business versus paid out, directly influences this book value figure.
Okay, so book value is historical, based on accounting. What about market value?
Market value is a very different concept, my students. It's forward-looking and based on investor perceptions. Market value reflects the collective expectations and sentiments of all investors, everyone participating in the stock market, about the amount, timing, and uncertainty or risk of the company's future cash flows.
Future expectations, not past records.
Exactly. It's not just about what's recorded on the balance sheet today based on historical costs. It's about what investors think the company will earn, how much cash it will generate, and how reliably it will deliver that cash in the future. Because of this difference in perspective, historical accounting versus future expectations, rarely will book value and market value be exactly equal.
Usually market value is higher.
Often, especially for successful growing companies with strong future prospects, the market value will be much, much higher than the book value. Investors are willing to pay a premium over the accounting value because they anticipate future growth. However, even if management successfully increases the company's book value by retaining earnings, it may not automatically reflect in a higher market value if investors don't believe that increase will generally translate into higher or more certain future cash flows. Maybe they think the company is reinvesting in low-return projects.
So market sentiment matters hugely.
Absolutely. Let's revisit our Kirana shop. The shop might have a book value of, say, 5 lakh rupees, based purely on its assets minus liabilities in its account books. But if people in the market, potential buyers, local investors believe that this shop is in a great location, has a wonderful owner, and is poised to grow very fast, perhaps opening new branches across the city, and they expect it to earn huge profits in the future.
High future potential.
They might be willing to pay 10 lakh rupees, or even more, for it today. That 10 lakh rupees is its market value. It's the market's collective assessment of its future potential, not just its current accounting value.
Big difference. Okay. So how do investors judge if management is doing a good job using the equity capital to create this value?
A key measure investors use to assess management's effectiveness in precisely that generating profit from the capital shareholders have entrusted to them is the return on equity, or ROE.
ROE, return on equity.
Yes, ROE is a critically important financial ratio, one you will definitely encounter very often in your studies and in any financial analysis. It measures the net income available to common shareholders for every unit of equity capital that they have invested in the company.
Profit generated per rupee of equity?
In essence, yes. It tells us how efficiently the company's management is using the shareholders' money to generate profits. It's calculated as net income available to ordinary shareholders, average total book value of equity. We use average equity because net income is earned over a period, while equity is a point-in-time figure.
Okay, net income divided by average equity.
Our sources provide examples using large pharmaceutical companies like Pfizer, Novartis AG, and GlaxoSmithKline, GSK. Let's look at GSK again. Its ROE, as mentioned, almost tripled from 12.9% in 2016 to a remarkable 38.2% in 2017.
Huge jump. What does 38.2% mean practically?
It means that in 2017, for every $1 or rupee or pound of equity capital invested by its shareholders on average during the year, GlaxoSmithKline generated about 4.29 or 38.2 cents in profit specifically available to those common shareholders. This impressive increase was partly because their net income almost doubled during that period, but interestingly also because their average shareholders' equity, the denominator in the ROE calculation, actually decreased significantly during that time, perhaps due to share buybacks or restructuring.
So higher profit on a smaller equity base really boosts ROE.
Exactly. It implies they became much more efficient in utilizing a smaller base of equity capital to generate substantial profits.
So, my students, quick check. What does a company's return on equity, ROE, primarily measure? Think about management and shareholders' money. Pause.
What efficiency does it show?
Correct. It measures how effectively management uses the shareholders' capital that has been provided to them to generate profits. It's a key indicator of profitability and efficiency from the equity investor's perspective.
Now, a very important follow-up question, my students.
Mhm.
Is an increasing ROE always a good sign? Should we just cheer whenever ROE goes up?
It sounds good, but is it always?
The short answer, as our sources wisely indicate, is it depends. This is where your critical thinking, your analytical skills as aspiring finance professionals truly come into play. You can't just look at one number in isolation.
Why might a rising ROE be misleading?
Well, for instance, ROE can mathematically increase even if the company's net income, the numerator, decreases, as long as the shareholders' equity, the denominator, decreases at an even faster rate. Logically, falling profits are generally not a positive sign for the business, even if the ratio looks better.
The denominator effect.
Or, and this is a common scenario we need to watch out for, ROE can increase significantly if a company takes on a lot more debt and then uses the money raised from that debt to repurchase its own shares, a share buyback. While this reduces the amount of equity, the denominator, and can make the ROE per share look much better, it also dramatically increases the company's financial leverage, its debt level relative to its equity. This makes the remaining equity inherently riskier.
More debt equals more risk, even if ROE looks good.
Exactly. So it's really, really important to look beyond just the single ROE number and diligently examine the underlying sources of the changes. Is the ROE increasing because profits are genuinely growing strongly? Or is it due to accounting quirks, or perhaps due to taking on excessive risk through more debt?
Dig deeper than the headline number.
Always.
Yeah.
Let's use our sweet shop example again. If you're a sweet shop owner suddenly gets a huge loan from the bank and uses that borrowed money to buy back shares from some of the existing small partners.
Reducing the equity base.
Yes. Their ROE might look incredibly good on paper because the equity base, the denominator, is now much smaller relative to the profits. But now the business is carrying a lot more debt, it has higher interest payments to make, and it's fundamentally riskier. If sales dip unexpectedly, perhaps due to a bad monsoon season affecting festivals, paying back that large bank loan could become a real problem, threatening the entire business. So you see, we need to look beyond just the ratio and truly understand the whole financial story behind it.
Context is crucial.
Okay.
Is there another ratio that compares value measures?
Yes. Another extremely useful ratio that investors and analysts frequently use, especially in conjunction with ROE, is the price-to-book (PB) ratio, sometimes simply called the market-to-book ratio.
Price to book. Comparing market price to book value.
Exactly. This ratio provides a strong indication of the market's perception of investors' collective expectations about a company's future investment opportunities and its ability to generate future cash flows from those investments. It's calculated simply as market price per share, book value of equity per share. Market price divided by book value on a per-share basis.
Correct. Now, if the PB ratio is high, significantly greater than 1.0, it generally means that investors view the company's future prospects very favorably. They believe the company has excellent growth opportunities, perhaps due to strong brands, innovative technology, or a great management team, that are not yet fully captured by its historical accounting book value. They are willing to pay a premium over the book value for that expected future growth.
PB1 means market expects good things.
Generally, yes. Looking back at our pharmaceutical examples from the source, GlaxoSmithKline had a PB ratio of a very high 19.16 in 2017. This was significantly higher than Pfizer's 2.98 or Novartis's 2.84 around the same time.
19 versus 3, that's a huge difference. It is. This strongly suggests that investors, at that point in time, collectively believe GlaxoSmithKline had substantially higher future growth potential and better investment opportunities compared to either Pfizer or Novartis. They were willing to pay almost 19 times its accounting book value per share, anticipating strong future performance, whereas they were only willing to pay around 3 times book value for the other two.
Market confidence was much higher in GSK's future then.
It appears so, based on this ratio. However, a crucial caveat, my students, very important. It's generally meaningful to compare PB ratios only among companies within the same industry,
Why only within the same industry?
because different industries naturally have different business models, different asset structures, and vastly different growth outlooks. A fast-growing software technology company, for instance, might inherently have a much higher average PD ratio than a mature, capital-intensive, heavy equipment manufacturing company. The tech company's value might lie more in intangible assets like code and intellectual property, which aren't always fully reflected in book value, while the manufacturer's value is more tied to physical assets. Comparing their PB ratios directly would be misleading, like comparing apples and oranges. Always ensure you're comparing similar companies within the same sector for the ratio to be truly informative.
Compare apples to apples, not apples to oranges. Got it.
So if a company has a price-to-book ratio significantly greater than 1, what does that generally indicate about investors' expectations for that company's future?
Pause. High PB means the market thinks the future looks.
It indicates that investors believe the company has strong future growth opportunities and are willing to pay a premium price today for that expected future potential. Excellent understanding. You're connecting these concepts very well.
Finally, let's briefly touch upon a deeper concept of value. Intrinsic value. This is a profound idea championed by legendary investors like Warren Buffett, probably the most famous and successful investor in the world, the CEO of Berkshire Hathaway.
The Oracle of Omaha. His wisdom is always valuable.
Indeed, he explains the critical difference between book value, which we just discussed as the accounting measure, and intrinsic value.
What is intrinsic value, according to Buffett?
Buffett defines intrinsic value, in his words, as the discounted value of the cash that can be taken out of a business during its remaining life. It's essentially trying to figure out what the business is truly worth today, based on all the cash it's expected to generate for its owners from now until it ceases to exist, adjusted for the time value of money, meaning cash received later is worth less than cash received today.
So it's based on future cash generation discounted back.
Exactly. He emphasizes that it's inherently a subjective estimate because it depends heavily on your predictions of those future cash flows, which are obviously uncertain, and also on the interest rates or discount rates you use to bring those future cash flows back to their present value. Two analysts looking at the same company could come up with different intrinsic value estimates based on their differing assumptions.
Not a precise number found in the accounts.
Yeah.
An estimate.
Yes, an estimate arrived at through careful analysis. Think of a young, extremely talented but currently unknown cricket player, maybe playing in the Ranji Trophy or even lower level.
A promising youngster.
Their current book value, how much they are paid today, their current contract value might be quite low. But an astute talent scout, someone with a keen eye for potential, like a discerning value investor looking at a company, might see their intrinsic value. They might see the hidden potential for this player to become a future superstar for India, to earn crores of rupees from IPL contracts and endorsements, and to lead their team to major victories. That perceived future potential is their intrinsic value, a highly subjective estimate based on talent and future prospects, not just their current low earnings.
Seeing the future potential beyond the current stats.
Precisely. Buffett emphasizes that despite this fuzziness, despite intrinsic value being hard to nail down to an exact number, it is all important, and in his view, the only logical way to truly evaluate investments and businesses. It's about looking past the current noise and accounting figures to understand the long-term, underlying earning power and cash-generating ability of the business. That's the ultimate measure of worth for a long-term investor. #8, cost of equity and investors' required rates of return.
Okay. Moving towards the final pieces of our foundation today. When companies raise capital, whether it's through borrowing money, issuing debt, or selling ownership stakes, issuing equity, there's always a cost associated with that capital, my students. Just like anything else in business, or life really, money isn't free.
The cost of raising funds.
Yes. And companies naturally try to raise the capital they need as efficiently as possible, meaning they try to minimize these costs. Why? Because the lower their cost of capital, the lower the hurdle rate for new investments, and the higher their overall profitability and competitive advantage.
Makes sense. Lower costs are always better.
Now, the cost of debt is relatively straightforward to estimate. It's essentially the interest rate, the coupon rate, that the company contractually promises to pay to its lenders, the people who buy its bonds, or the banks that give it loans. It's a fixed, known payment obligation that is clearly defined in a legal loan agreement or bond indenture.
The interest payment is the cost. Clear.
For example, if your friend lends you, say, 1 lakh rupees to start or expand your small business, and you both formally agree in writing that you will pay them 5% interest per year on that loan until it's repaid, then that 5% is your clearly defined cost of debt for that particular loan. It's fixed, it's clear, and you have a legal obligation to pay it. Generally, all the bondholders or lenders for a specific debt issuance receive the same periodic interest rate, so their required rate of return is the same as the company's cost for that debt. Relatively easy to quantify.
Okay, cost of debt is the interest rate. What about the cost of equity? Is it the dividend?
That's where it gets more challenging. The cost of equity is significantly harder to estimate accurately. Why? Because as we've discussed, the company is not contractually obligated to make specific payments to its equity shareholders.
Right, no guaranteed dividends or repayment.
Exactly. Investors, of course, do require a return on the funds they provide when they buy equity. They wouldn't invest otherwise. This is called their minimum required rate of return on equity. For debt investors, that required return is simply the interest rate they charge. But for equity investors, their required rate of return is based on those uncertain and unknown future cash flows, like potential dividends someday or hopes for future stock price appreciation.
Based on expectations and risk.
Precisely. Because these future cash flows are not guaranteed, the required rate of return must be estimated, and it can actually differ quite significantly across different investors based on their individual expectations about the company's future, their personal tolerance for risk, and the other investment opportunities available to them.
So different investors might demand different returns from the same stock.
Conceptually, yes. As a result, the company's true cost of equity, what it implicitly pays in terms of expected return to attract and retain equity investors, might be different from each individual investor's minimum required rate of return. However, in practice, because companies always aim to raise capital at the lowest possible overall cost to them, the company's estimated cost of equity is often used as a proxy or a stand-in measure for the market's average minimum required rate of return from its equity investors.
Okay, the company's cost is an estimate of what investors demand on average.
Yes, and there's a market mechanism that helps align these. If investors, as a group, start demanding a higher rate of return from a company's stock than what its current price implies, perhaps because the company becomes riskier or other investments become more attractive, they will simply start selling their shares.
Selling pressure.
Exactly. This selling pressure will cause the share price to decline. Now think about it. As the price declines, the expected future returns, dividends plus capital gains, relative to that lower purchase price effectively increase. So the cost of equity from the investor's perspective increases until it meets that higher required rate of return demanded by the market. It's a natural adjustment process that balances the supply of shares with the demand for expected returns.
Market forces push the price until the expected return matches the required return. Clever.
It is indeed. So, my eager students, let's quickly recap this tricky point. Why is the cost of equity generally harder to estimate accurately than the cost of debt? What's the fundamental difference in the company's obligation? Pause.
Debt payments versus equity payments. What's the key difference?
That's perfectly articulated. It's because companies are not contractually obligated to pay fixed returns or specific dividends to their equity shareholders, unlike the fixed interest payments they absolutely must make to their debt holders. That fundamental uncertainty about future payouts makes the cost of equity much more challenging to estimate precisely. Very good grasp of a key concept.
So we have a cost of debt and a cost of equity. What does the company do with these costs?
These costs, the cost of debt, usually considered after factoring in the tax deductibility of interest payments, so it's the after-tax cost of debt, and the estimated cost of equity are absolutely crucial inputs for calculating a company's overall weighted average cost of capital, commonly known as WACC.
WACC, weighted average cost of capital. Sounds important.
It is vitally important, especially in the context of the capital budgeting process within a company.
Capital budgeting, what's that?
Capital budgeting is the disciplined decision-making process that companies use to evaluate potential long-term investments or large projects. Should we build this new factory? Should we launch this new product line? Should we acquire that competitor? These are capital budgeting decisions.
Big strategic investment choices.
Yes. And the WACC plays a central role here. The WACC represents the blended average minimum required rate of return that the company must earn on its overall asset base, or specifically on its new long-term investments, to satisfy all the providers of its capital, both its debt holders and its equity shareholders, weighted by how much capital comes from each source.
So WACC is the minimum return needed to keep all financiers happy.
That's an excellent way to put it. It's the company's overall hurdle rate. If a potential project or investment is expected to generate a return that is less than the company's WACC, it essentially means that project won't be profitable enough to cover the costs of financing it, both debt and equity costs. Therefore, companies wisely use WACC as a benchmark. They choose to invest in those potential long-term projects that have expected returns greater than their WACC. Those are the projects expected to create value for shareholders.
Reject projects below WACC, accept projects above WACC.
That's the fundamental rule of capital budgeting using WACC, yes. For example, imagine a local dhaba owner, a small roadside eatery owner is thinking about opening a new branch in another part of town.
Expanding the dhaba business. Good for him.
Let's say he has some money from his own personal savings that he'll invest. That's like his equity contribution. And he also plans to take a small loan from a local bank to cover the rest of the setup costs. That's the debt. The WACC for this new dhaba branch would be a blend of the return he expects on his own savings, his opportunity cost, and the interest rate the bank charges him on the loan. This WACC percentage is like the minimum profit percentage that the new branch must generate each year just to cover the cost of both his own savings and the bank loan interest, keeping both himself as the equity owner and the bank as the debt provider happy.
The minimum acceptable profit rate.
Exactly. If the dhaba owner estimates, after careful planning, that the new branch is likely to earn a return higher than this minimum required WACC, then it's considered a financially viable and value-creating investment, and he should probably go ahead with it. If the expected return is lower than the WACC, opening the new branch would actually destroy value, and he should reconsider. It's how businesses make rational investment decisions. ###9.
Well, my dear students, we've covered a lot of ground today. We truly hope this deep dive into equity securities has provided you with a clear, patient, and solid foundational understanding of these truly fundamental financial instruments.
Yes. Hopefully it wasn't too overwhelming. We tried to break it down.
We certainly did. We've explored what equities are those ownership claims. We looked at their immense importance in global markets. We carefully distinguished between common shares with their voting rights and preference shares with their priority and fixed dividends.
We also peeked into the fascinating and sometimes complex world of private equity versus public equity, understanding LBOs and venture capital.
And we discussed the various practical ways you can invest in non-domestic companies using things like ADRs and GDRs right from here in India.
And crucially, we explore the interconnected concepts of risk and return, how different features affect risk, how equity contributes to company value through metrics like ROE and price to book.
And finally, how companies think about the cost of raising equity capital and use WACC for making investment decisions. Phew, quite a journey.
It was indeed. Remember, students, equity securities play a truly foundational and ever-growing role in investment analysis and portfolio management globally. Their importance continues to increase, driven by the constant need for capital in both developed and emerging economies, and greatly facilitated by technological innovation and the rapid electronic exchange of information we see today.
Absolutely. Understanding their unique return characteristics, their specific risks, and how they contribute to company value is truly crucial for any aspiring finance professional like yourselves and, frankly, for any informed investor trying to navigate today's dynamic financial markets.
Couldn't agree more.
As you move forward in your CFA studies and indeed in your careers, always remember that theory is best understood and truly mastered through practical application by relating it to the real world and by constantly asking probing questions. Don't just memorize, try to understand why.
Curiosity is key.
So as we wrap up today's session, here's a final provocative thought for you to ponder, something to mull over as you continue your journey in finance.
Something to think about.
Considering the clear historical outperformance of equities over bonds and bills over the very long term, and the incredible, almost magical power of compounding growth through reinvested dividends that we discussed, how might this long-term perspective specifically influence a young investor starting out in India today? Especially given our current dynamic economic landscape, the rise of digital India, and the explosion of local investment platforms like Zero to Grow, Upstocks, which make investing so much easier and more accessible than ever before. What unique opportunities and perhaps what new challenges or risks might this young Indian investor face in this modern era that were simply not present or not as significant for investors even a few decades ago?
That's a wonderful and very relevant question to contemplate, host speaker. A lot has changed, offering both great potential and new complexities for today's young Indian investors. keep thinking about these practical implications, students. How does this global knowledge apply right here, right now? We are very confident that you will continue to build a strong and lasting foundation for your future in finance.
We are indeed. Until our next deep dive, keep learning, keep questioning, and keep growing. Namaste. Namaste, everyone. Keep up the excellent work. Hello, everyone, and a very warm welcome to the deep dive.
Welcome.
Today, we're embarking on a really crucial journey, a core pillar of your CFA studies, understanding company analysis.
That's right. It's fundamental.
And we know many of you might be just beginning your finance journey, perhaps without a formal background in accounting or business.
Yes, and if that's you, please don't worry at all.
Think of us as your guides, We'll be patient, we'll explain everything clearly, taking our time.
And we'll use simple, everyday examples that you can easily relate to.
Yeah.
Our goal is for every concept to really, truly stick.
Absolutely.
We're here to help you sort of unravel the secrets, you could say, of how financial experts scrutinize a company to decide if it's a wise investment. It's a bit like learning a brand new language,
It is.
where numbers and strategies tell a company's entire story.
Our mission today is to uncover the key elements of a thorough company research report.
And then, crucially, understand how analysts determine a company's unique business model.
This module, my dear students, is fundamental. It's about building your financial foundation.
So buckle up.
We've gathered some truly fascinating material from your company analysis, past and present module,
We'll carefully break down the most important nuggets.
ensuring you walk away feeling well-informed, confident, and ready to tackle those challenging CFA questions.
Let's begin our exploration.
All right, so we've set the stage for our deep dive.
Yes,
But where do analysts even begin their research? It starts with the blueprint, doesn't it?
exactly. The company research report itself.
Right.
Imagine for a moment that you're planning to buy something significant for your family. Maybe a brand new car.
Okay.
You wouldn't just pick any car off the street, would you?
No, definitely not.
You'd spend a good deal of time researching, reading reviews, comparing features, maybe looking at safety ratings.
You do your homework.
A company research report is, well, it's a lot like that, but for businesses you might want to invest in. It's a comprehensive document. It helps investors make smarter, more informed decisions about a company's securities, like its shares in the stock market.
So it's not just a quick look.
No,
Okay.
it provides a full, deep picture.
Indeed. These comprehensive reports are diligently prepared by financial analysts.
Yes, no doubt.
They begin by examining a company's past performance, what it has achieved over many years.
What's a track record?
Exactly. Then they meticulously analyze its current situation, paying careful attention to the industry it operates in and the competitors it faces.
Very important context.
Finally, armed with all this robust information, they attempt to predict its future.
The tricky part.
Yes, including potential earnings and cash flows. Based on this thorough analysis, they provide an investment recommendation.
Right, advising whether to buy, hold, or sell its shares.
And very often they'll even provide a target price they believe the share should reach.
So it's really a holistic package.
It is.
Now, there are generally two main types of these company research reports. Each serves a slightly different purpose and targets a specific audience.
Right.
First, we have initial reports. These are often known as initiating coverage reports.
Initiating coverage, okay.
Think of these like a foundational textbook for a subject you're completely new to.
Like starting from chapter 1.
Exactly. They are prepared when an analyst first starts covering a particular company.
So, for newcomers.
Yes, their primary audience is indeed those who know little or nothing about that specific company or its industry. These reports are incredibly comprehensive, you see, to provide a complete understanding right from scratch.
Makes sense. So, what kind of things are in these big reports?
Well, what key elements would you typically find? They always include the analyst's investment recommendation that buy, hold, or sell.
And the target prices.
And the target prices they expect the stock to reach, yes. There's also a clear summary of the main reasons supporting this recommendation.
The why.
The why. Crucially, they dive deep into the company's business model and strategy.
Ah, the business model. We'll come back to that.
We will. And they often include helpful charts that break down revenues or profits by product lines or perhaps geographical regions.
So you can see where the money comes from.
Precisely. Visualize it. An extensive industry overview is also provided, covering the industry's size, its growth rate, market share trends within it, and overall profitability.
The whole playground.
The whole playground.
Yeah.
They perform a thorough competitive analysis, frequently using frameworks like Porter's Five Forces analysis.
Right. Porter's five forces. That helps understand competition, supplier power.
Buyer power, threat of new entrants, substitutes, all of that.
Okay.
Additionally, external industry influences are examined through a PESTLE analysis.
PESTLE. Political, economic.
Social, technological, legal, and environmental factors. Things outside the company and industry that could have an impact.
Got it. External factors.
This is followed by an evaluation of the company's specific competitive position within that industry.
Where do they stand?
Exactly. And of course, there's thorough financial analysis, historical numbers, forecasted financial statements, detailed financial models,
The number crunching part.
heavy lifting.
Phew.
Valuation estimates are provided, explaining how the company's value was determined.
How they got to that target price.
Yes. More recently, environmental, social, and governance, ESG, considerations are evaluated. How does the company impact society, the environment?
ESG is becoming very important.
It is. And finally, a comprehensive list of material downside and upside risks. Investors need to know potential challenges and opportunities.
Full disclosure.
Now, our source specifically highlights that Porter's Five Forces analysis and a PESTLE analysis are very common in these initial reports,
Why is that?
precisely because they address broad long-term factors that tend to evolve much slower than, say, quarterly financial results.
Ah, okay. They set the scene for the long term.
That's right.
Now, here's a little thought for you listening. If a research report prominently features both a Porter's Five Forces analysis and a PESTLE analysis, what kind of report is it most likely to be? Take just a moment to think about that. Short pause. You might have guessed it. It's most likely an initial report.
Makes sense.
These deep dives into industry structure and external influences are typically done when an analyst first begins covering a company. They provide that broad foundational understanding that doesn't need updating every week or month.
It's part of setting the baseline for all future analysis.
Right.
Now, on the other hand, we have subsequent reports.
Okay, the second type.
These are much shorter, more like a news update or a quick brief.
Ah, like an update bulletin.
Exactly. They are designed for people who are already familiar with the company.
Okay, not for beginners.
No. They need to be informed about recent changes, like new financial results or maybe a big company announcement. They don't rehash the basics. They focus on what's new and relevant right now.
So what's in these shorter reports then?
Well, the elements are more concise, focused on updates. They'll always feature the analyst's names, specific identifiers for the company and its stock,
The basics?
and the updated investment recommendation. Is it still a buy, hold, or sell? Or has it changed?
And the prices?
Current and target prices will be listed. Crucially, there's a summary of any changes to the recommendation, with clear explanations for why those changes were made.
The justification again.
Yes, the core of these reports is the analysis of new information, like comparing quarterly actual financial results against what analysts were expecting.
Actual versus expected.
Exactly. Analysts then provide their interpretation of this new information and any adjustments they're making to their future forecasts.
So, updating the model.
Updating the model. You'll also find updated historical and forecasted financial statements, revised valuation estimates based on the new info, and an update of any risk factors mentioned before, highlighting how those risks might have changed or evolved.
So, for example, if a big tech company just announced its quarterly results, sales, profits, future outlook, an analyst would quickly put out one of these shorter subsequent reports.
That's right.
It would update investors on how those results compare to expectations, explain any changes to the outlook, and maybe adjust the recommendation or target price.
It's all about providing timely, focused updates to an already informed audience.
Without making them reread everything they already know from the initial report.
Precisely.
Okay. So, let's check understanding again. What is the main purpose of a subsequent research report compared to an initial one? Think about the audience and the trigger for the report. Short pause.
Well, the core purpose is really to update investors who are already familiar with the company.
Right.
Based on significant new information like those quarterly results or maybe a change in the analyst's recommendation. It's about keeping them current.
Keeping them in the loop.
Exactly.
Now, let's move to what you mentioned earlier, the very first and most crucial step in any company analysis, understanding its business model.
Yes, the foundation.
Think of a business model like the detailed plan a small shopkeeper, maybe your local Kirana shop owner, has for how his shop runs.
Okay, Kirana shop. I like that.
It summarizes exactly how the company makes money, how it serves its customers, and how it operates day to day.
Just like that shopkeeper needs a clear plan to succeed, a large company also has a well-defined business model guiding its operations.
And an analyst must understand that first.
Absolutely. For an analyst, determining the business model is paramount. It immediately helps them understand the key drivers of a company's financial results.
Right. What makes it tick?
And what areas need further, deeper investigation. It essentially answers some fundamental questions, giving us a blueprint of its operations.
So what are these fundamental questions?
Okay, first, what is the firm selling?
What's the product?
Yes, what specific products or services does it offer? Like our Kirana shop selling dolls, rice, biscuits, soaps, maybe cold drinks.
Staples and treats?
For a large company, it could be anything from software to electronics to financial advice.
Okay. Question 1. What does it sell?
Second, to whom does the company sell?
Who are the customers?
Exactly. Are they individuals, like shoppers in a mall?
Yeah.
Other businesses, like B2B sales? Or specific groups like governments?
And our Kirana shop?
Our Kirana shop primarily caters to families living right there in the neighborhood.
Local community.
Yeah.
Okay. Question 2. Who does it sell to?
Third, how does the company reach customers and deliver products?
The how. Sales channels.
Yes. What are its sales channels?
Yeah.
Physical stores, online website, direct sales force. This also includes how they get customers in the first place, their acquisition strategy, and how they actually deliver the product or service.
And for the Kirana shop example?
Might be door-to-door delivery in the locality or just customers walking into the shop.
Simple enough. Okay. Question 3. How does it reach and deliver?
Fourth, how are products or services priced and paid for?
Pricing strategy and payment terms.
Right. Are they charging a standard price? Offering discounts for bulk buys? Using subscriptions? And how do people pay cash, credit, online?
Our Kirana shop might charge the MRP, the maximum retail price, for packaged goods.
But maybe give small discounts on staples like rice if you buy a lot, right?
Could be. Okay. Question 4. How is it priced and paid for?
And finally, fifth, what does the company buy and rely on to operate effectively?
Key resources and dependencies.
Yes. What are its key resources? Who are its main suppliers? Are there important partner relationships? What essential inputs does it need to function?
For the Kirana shop, this might be buying supplies from a big wholesaler.
Or relying on steady electricity for the fridge.
Or maybe having a delivery boy.
Exactly. Okay, question 5. What does it need to operate?
So 5 key questions to map out the business model. Where do analysts get the answers?
Good question. They gather information from various sources. We can group these into 4 categories based on where the info comes from.
Okay, 4 types of sources.
First, issuer sources. This is information straight from the company itself, especially if it's a public company.
Directly from the horse's mouth.
Pretty much. This includes essential documents like regulatory filings, annual reports, quarterly reports. These are mandatory.
Must-reads for analysts.
Definitely. They also carefully listen to earnings conference calls, attend investor presentations, read press releases, and talk directly to company management or investor relations people.
Direct interaction.
Yes. And even visiting company websites or experiencing their products as a customer can give insights.
Like asking the Kirana shop owner directly about his business.
Exactly. What he sells, to whom, how he manages things.
Okay, issuer sources first. What's second?
Second are public third-party sources. This is information that's freely available to anyone.
Free info. Like what?
Things like industry white papers from research firms, economic or industry data from government agencies, general news outlets, industry-specific news sites, even relevant social media discussions sometimes.
So like reading a newspaper report about the general grocery market in the city.
Precisely.
Yeah.
Gives you broader context beyond just one shop.
Okay. Public third-party sources. Third,
proprietary third-party sources. This is paid-for information, usually from specialized platforms or consultancies.
the expensive stuff.
Often, yes. Think of widely used financial data terminals like Bloomberg and FactSet, huge databases, analyst reports.
The tools of the trade.
Absolutely. There are also industry-specific consultancies, maybe Rystad for energy, Gartner for IT. They sell highly detailed specialized reports and data.
Like deep market research you pay for.
Exactly. Giving you deeper insights not available to everyone.
Okay. Proprietary third party. And the fourth source.
Fourth is proprietary primary research. This is research, the analyst commissions or conducts directly themselves.
Ah, they do their own digging.
Yes. This could involve conducting surveys with customers, having direct conversations with industry experts to get unique perspectives, or doing detailed product comparisons.
Like personally asking customers what they like about a certain biscuit brand at the Kirana shop.
Perfect example. Or visiting different shops to compare prices in stock.
Understanding the ground reality.
Exactly.
So, understanding the business model using these questions and sources is the essential first step.
It directs all the analysis that follows, helps identify those core drivers of financial performance.
Okay, let's make this concrete. Let's look at an example.
Yes, let's apply this framework.
All right, let's take a fictional company we'll call Warehouse Club, Inc.
Oh.
This company is described as a leading discount retailer. We'll use our business model framework, drawing from information compiled by an analyst named Elaine Guillen.
Let's break it down using those 5 questions.
First, what is Warehouse Club selling?
That's on the shelves.
They sell a broad range of consumer goods, about 4,000 different items. This includes packaged food and beverages, that's 40% of their net sales in year 2x19.
A big chunk.
Fresh foods at 13%, non-food merchandise like appliances and electronics at 28%, and ancillary product services like petrol stations and pharmacies at 19%.
Quite diverse.
Now, a crucial point. Customers must hold a membership card to even enter and shop.
Ah, the membership model.
And that card costs $60 per household annually. They also sell over 15% of their net sales as private label goods, which they say have higher profitability.
Okay, so goods plus a mandatory membership fee. Understood. Next question.
To whom do they sell?
Who are the members?
Primarily consumer households that are members, typically living within 10 kilometers of a store.
Local shoppers.
These customers are described as value conscious. They're willing to give up extensive selection to get lower unit prices on bulk size goods.
Okay, bulk buyers looking for value.
And they also need to be able to afford that $60 annual membership fee.
So a certain demographic maybe. Okay, next.
How do they reach customers and deliver products?
Sales channels.
They sell products and services both inside and around their physical stores. Members can shop right there or use their buy online, pick up in store service.
Click and collect.
They do minimal advertising, mostly promotional mail and renewal reminders. They primarily rely on word of mouth and the sheer physical presence of their stores to attract interest.
Low advertising spend. Interesting.
Memberships can be purchased online, by phone, or in the stores themselves.
Okay, straightforward. How about pricing?
How are products and services priced and paid for?
The money part.
2 main revenue streams.
Yeah.
Net sales from good services and those membership fees.
Right.
They set merchandise prices deliberately to maintain a remarkably low gross margin. For example, it was about 11.03% in 2x19,
Very low margin.
which means their markup on costs is only about 12.39%. This clearly shows their low-cost price leadership strategy.
Aggressive pricing.
The annual membership fee is $60 paid up front. Historically, it's increased by $5 every 5 years or so. The last increase was 3 years ago.
Likable fee increases.
This annual fee effectively raises the overall price for members, but critically, it enables Warehouse Club to charge significantly lower prices on the actual merchandise compared to competitors.
Ah, so the fee subsidizes the low prices.
Exactly. Creates that compelling value proposition. Okay, last question.
What do they buy and rely on to operate effectively?
Key inputs and partners.
They rely on merchandise from a wide range of manufacturers, including contract manufacturers for their private label goods.
Suppliers are key.
Very key.
Hmm.
Also, human capital, their employees, fixed assets like land, buildings, IT systems.
Sure.
And they rely on credit debit card payment networks.
Standard retail dependencies.
Key partners are definitely the merchandise manufacturers, especially for those private label products. Warehouse Club is apparently very strict on cost and quality.
Makes sense for a low-cost model.
Those relationships are critical for maintaining their strategy.
So, putting it all together for Warehouse Club.
Well, the real genius, I think, of their model is how those seemingly thin merchandise margins are subsidized by that predictable high-margin membership fee.
It enables the whole thing.
It creates a powerful virtuous cycle. Low prices attract more members. More members drive more sales volume. More volume gives them negotiating power with suppliers
Which lets them keep costs low.
and maintain the low prices. This whole structure allows them to be profitable despite those thin margins on goods. The membership fee is the linchpin.
It holds it all together. Okay, quick check then. How do the membership fees at Warehouse Club contribute to its overall profitability given those thin margins on goods? What's the main point? Short pause.
They provide that steady, recurring, predictable revenue source
Right.
that allows the company to be profitable even while offering those super low prices on merchandise. They're absolutely vital.
And they also foster loyalty, you mentioned.
Yes, customer loyalty, and interestingly, they can help reduce inventory theft, which also boosts the bottom line.
Okay, very clear on Warehouse Club. Let's briefly touch upon another example just to see a different model.
Yes, diversity is important. Let's look at an e-commerce company, Eliso Marketplace Ltd.
The Lisa Marketplace. Okay.
First, Eliso strongly emphasizes a superior customer experience. That's their focus.
How so?
They offer things like next day or even faster delivery. Over 93% of orders in 2X19 delivered within 24 hours.
Wow, that's fast.
They provide free shipping on orders over $25, which they claim is an industry-leading low threshold. And importantly, no membership fee is required.
Different from Warehouse Club.
Very different. They also boast a vast selection, including fresh groceries, and a truly frictionless returns process. Apparently, you just tap a button, leave the item outside, and get a refund once it's picked up.
Making it easy for the customer.
Exactly. Customer delight seems to be a core part of their model to attract and keep customers.
Okay, customer experience first. What else?
Yes. Second, their fulfillment network is key to their speed and efficiency.
The logistics.
They've built a vertically integrated system focused on urban markets in the U.S. They control every step from purchase to delivery confirmation.
Owning the process.
Yes, they directly employ over 65,000 people just for fulfillment and delivery, minimizing reliance on third-party carriers like FedEx or UPS.
Why do that?
This level of control aims for speed, efficiency, and waste reduction, especially important for perishables like fresh foods.
Control equals quality and speed. Makes sense. Third point.
Third, they have a merchant services segment. This is interesting.
What's that?
They allow third-party merchants to sell products on the Eliso Marketplace platform.
Ah, like Amazon Marketplace.
Similar idea.
Ah.
And these merchants can utilize Eliso's own fulfillment network if they want. Eliso earns sales commissions and service revenues from these merchants.
So they make money from other sellers too.
Yes, and importantly, this revenue is recorded on a net basis. Eliso acts as an agent. They don't take control of the inventory themselves.
Okay, agency model.
And this creates a powerful two-sided network effect.
Explain that.
Well, the more customers use the platform, the more attractive it becomes for merchants to join, right?
Sure, more buyers.
And in turn, the more merchants offer products, the more attractive the platform becomes for customers. More choice.
Ah, it feeds itself. More customers attract more merchants. More merchants attract more customers.
Exactly. Increasing the platform's overall value and stickiness for everyone.
Clever. Anything else for Eliso?
And finally, a key metric for them is gross merchandise value, GMV.
GMV, what's that?
It includes the value of all products sold on their marketplace, both the ones sold by Eliso directly and those sold by their third-party merchants.
The total value flowing through the platform.
Precisely. In 2X19, their total GMV was $8,605 million, and fresh food and grocery alone accounted for 55% of that.
Big in groceries, then.
Very big.
Okay, so thinking about Eliso's merchant services segment, what stands out about how it operates, especially who are its customers in that segment, and how does it make money from them? It's quite different from Warehouse Club. Short pause.
Well, for that merchant services part, Eliso's customer base is actually the third-party merchants themselves.
Right, not the end consumer buying the goods.
No. Eliso earns commissions and service fees from these merchants for facilitating their sales and often for using Eliso's fulfillment network.
It's a platform fee, essentially.
Exactly. A very different revenue model than just selling goods directly like a traditional retailer. It's an agent-based or platform model.
Okay, that clarifies the business model concept nicely with those examples.
Good. It's the essential starting point.
So now that we understand how to figure out the business model, let's move to how a company actually earns its money.
Yes, revenue analysis.
Yeah.
Absolutely critical for predicting future performance.
How should we think about this? Any analogies?
Definitely. Think of it like looking at a cricket scoreboard.
Okay, Crow.
You see the total runs a team has scored, say 250 runs. That's the total revenue.
Right.
But to truly understand the game, you need to know how those runs were scored. Were they mostly singles and twos, showing steady play, or lots of fours and sixes, maybe riskier shots, or perhaps a lot of extras, like wides and no balls from the bowlers?
Ah, understanding the components of the score.
Exactly. Just knowing the total isn't enough.
Yeah.
You need to understand the individual contributions to drivers to truly grasp the game, or in our case, the company's revenue generation.
Precisely. So in finance, we look at these revenue
So
drivers.
causative factors.
Yes, the factors that explain both the level of revenue a company earns and any changes in that revenue over time.
And there are two main approaches analysts use to analyze these drivers.
Okay, two approaches,
A bottom-up approach and a top-down approach.
bottom up and top down. Let's start with bottom up.
The bottom-up approach is like looking at each player's individual score in that cricket match.
Okay, granular detail.
You break down total revenues into their granular components or drivers. For instance, you might analyze sales volume, how many units sold, and the average price per unit,
Quantity times price.
the classic. Or you might disaggregate revenues by specific product lines, different business segments, or even by geographical regions.
Like how much revenue came from phones versus tablets, or India versus the US?
Exactly. This detailed view helps understand the mechanics, the nuts and bolts of revenue generation.
Okay, that's bottom up. What about top down?
The top-down approach is more like looking at the total market for cricket matches played across the country and then seeing what share your specific team captured of that entire market.
The big picture view.
Right. Here, you express a company's revenues as a function of broader drivers. This could include its market share within a given industry.
What percentage of the pie do they have?
Exactly. Or overall size of the addressable market. How big is that pie in the first place?
Yeah.
Or even macroeconomic factors like GDP growth.
Things outside the company's direct control.
Often, yes. For example, if you're analyzing a car manufacturer, you might look at the total number of cars sold in a country that year and then see what percentage of that total your company sold
Gives you a sense of their relative position.
and how they're doing compared to the overall market trend.
Okay, let's apply this. Let's revisit Warehouse Club and use the bottom-up approach for their revenue using Elaine's data.
All right. Their net sales, remember, are mostly from selling merchandise and services in their stores.
Right.
So logical bottom-up drivers would be the average number of stores open during the year
How many locations?
and the net sales generated per average store.
How much does each store sell?
Exactly. Now, looking at the data from year 2x10 to 2x19, Warehouse Club's net sales in 2x19 were $28,377 million. That was a remarkable 96% higher than in 2x10, when it was $14,488 million. Huge growth.
Nearly doubled in about 9 years.
This significant growth was driven by almost equal contributions from both factors we mentioned.
Stores and sales per store.
Yes. The average number of stores increased by 39% from 106 stores in 2x10 to 147 in 2x19.
Okay, solid expansion.
And net sales per average store increased by a substantial 40%, from $138 million per store to $193 million per store.
Wow, so existing stores became much more productive too.
Exactly. This consistent growth across both drivers is a very positive sign for forecasting their future potential.
Okay, that covers net sales. What about the membership fees? Bottom-up drivers there.
For membership fee revenues, the drivers are quite straightforward. The annual price of membership
The $60 fee.
and the average number of members.
Price times quantity again.
Basically, yes. Interestingly, membership growth has actually been a larger driver of revenue growth than price increases.
More people joining.
Yes. The number of members grew by 70%, from 2x10, about 5.9 million average members, to 2x19, over 10 million average members.
Big jump in numbers.
While the price only increased by 20% over that same period, from $50 to $60.
So volume was more important than price hikes for fee revenue.
It seems so. Now, an important check analysts perform here is what we call a cannibalization check.
Cannibalization, like eating yourself.
Sort of. It's to see if opening new stores is eating into or taking away sales and members from existing nearby stores.
Ah, stealing your own customers.
Right. You want new stores to add new customers, not just shift existing ones. So by calculating the average members per store, analysts at Warehouse Club could check this.
And what did they find?
They found that this metric actually grew by 19% from 2x10, about 57,000 members per store, to 2x19, over 68,000 members per store.
So each store, on average, had more members over time.
Yes. This is a very positive sign. It indicates there was no significant cannibalization.
Good news for them?
And it shows that new store openings are not the only driver of membership growth. Existing stores were also attracting more members on their own.
Excellent. Okay, let's recap that. For Warehouse Club, what were the two main bottom-up drivers for their impressive net sales growth over that period? Short pause.
The two main drivers were the average number of stores open
More stores,
and the net sales generated per average store.
more sales from each store.
Right. Both contributed significantly to their overall revenue increase, showing effective store expansion and growing customer spending.
Got it. Now, related to pricing, you mentioned Warehouse Club has low margins but uses a fee. Let's talk more about this idea of pricing power.
Ah, yes, pricing power. A very crucial concept. It refers to a company's ability to set prices for its products or services,
How much they charge.
and also other economic terms with its customers, like payment schedules or contract lengths,
Okay.
without materially affecting its sales volumes. Can they raise prices without losing too many customers?
How much control do they have?
Exactly. How much control over price before customers walk away?
So some companies have low pricing power.
Yes. In highly competitive markets, where firms sell nearly identical products, think basic commodities like oil or wheat, or generic medicines after a patent expires, or even fresh vegetables in a crowded market.
Where everyone sells the same thing.
Right. In those cases, companies are generally price takers. The price is largely dictated by market supply and demand.
They have to accept the market price.
Pretty much. If a firm prices its product even slightly above the market price, they'll likely lose sales, as customers can easily buy the exact same thing elsewhere for less.
And pricing below market.
This reduces your own profits and can even lead to damaging price wars where everyone loses.
Right.
So in the long run, returns on capital in such competitive markets often just approximate the cost of capital. Competition drives prices down towards costs.
Hard to make big profits then.
It is. However, a genuinely low-cost producer can still earn above-average returns if their low-cost position is sustainable and hard for competitors to copy.
If they have a real cost advantage.
Yes.
Okay, so that's low pricing power price takers. What about high pricing power?
On the other hand, in less competitive markets, think structures like monopolistic competition, many sellers, but differentiated products, or oligopoly, a few dominant sellers, or even a near monopoly.
Where there's less direct competition.
Right. Firms tend to have a higher degree of pricing power. They act more as price setters.
Why? What gives them this power?
Usually due to factors like product differentiation. Their product is unique or has a strong brand reputation people trust.
Like Apple iPhones, maybe.
Could be an example. Or high barriers to entry for new competitors. It's hard or expensive for others to start competing.
Like building a whole new car factory.
Exactly. Or a lack of economical substitutes. There aren't good alternatives for customers. High switching costs for customers. It's difficult or costly for them to change suppliers. Or simply strong customer loyalty.
People stick with what they know and like.
Right. Examples could include branded consumer goods, like a specific premium coffee brand, patented pharmaceuticals where no one else can make that drug, or specialized software solutions that businesses rely on.
So these companies can raise prices more easily.
They generally can raise prices or change terms without seeing a significant drop in sales volumes. They have more flexibility.
How do analysts figure out if a company has this power? Just look at prices.
Not just prices. A key way analysts evaluate pricing power is by comparing a firm's prices with its costs, essentially, looking at its profit margins.
Ah, price minus cost.
Right. If a company keeps raising prices, but its costs are rising even faster, its profitability will decline, which actually signals a lack of real pricing power. They can't pass costs on effectively.
So what's a good sign then?
An important sign of sustained pricing power is rising profitability over time.
Margins going up.
Yes. This shows the company can retain the economic benefits for its investors. It means competitors or substitutes are not driving down prices faster than the company can manage its costs or increase its value.
Any examples?
Our source mentions Nestlé SA, the global food and beverage company. Brands like Nespresso, Maggi.
Well-known brands.
Exactly. From 2011 to 2021, Nestlé apparently consistently demonstrated pricing power. They increased prices, while also increasing sales volumes and improving their operating profitability.
Wow. Higher prices, more sales, and better margins. That's strong.
That's a clear sign of pricing power. They could pass on costs and capture value.
Okay, very clear in pricing power. Now let's switch back to Warehouse Club, but this time using the top-down approach for their revenue.
All right, zooming out to the big picture market view.
First, market size. How big is the pond they're swimming in?
Analysts used total U.S. national retail sales, but they excluded automobiles and parts, since Warehouse Club doesn't sell those.
Makes sense. Focus on relevant retail.
In year 2 x19, the estimated market size was huge, $5,472 billion. calculated from a monthly average of $456 billion.
A massive market. Okay, what about their share?
Next, market share. Analysts expressed warehouse clubs' revenues as a percentage of this total market. This helps assess their relevance, their footprint within that huge retail landscape.
And what did they find? Are they a big player?
What they found was that Warehouse Club had a relatively small market share, only about 0.70% in 2X19.
Less than 1%. Seems small.
It does, however, and this is the important part, this was a growing share. It was up from 0.48% back in 2X10.
Ah, so they're gaining ground, even if it's still small overall.
Exactly. This indicates that their unique value proposition, bulk goods, low prices, membership model, is resonating with consumers and allowing them to gain ground, even in a very large and competitive market.
So they're carving out their niche, effectively.
It seems so. The overall market growth itself was positive but slow, around 3.4% annually. The Warehouse Club was growing its share within that slow-growing market.
Okay, another check for understanding. If a company's market share in a large market is consistently growing, even if the market itself is only growing slowly, what does that indicate about the company's competitive position? What's that telling you? Short pause.
It generally indicates that the company's value proposition is strong and effective.
Right.
It's allowing them to gain relevance and effectively take sales away from competitors or substitutes, even in what might be a mature or slow-growing industry overall.
It shows they're doing something right compared to others.
Definitely.
Yeah.
They're winning business.
Okay, let's quickly look at Aliso Marketplace again. Just a few specific questions about its revenue analysis to reinforce these ideas, especially for an e-commerce player.
Good idea. Apply the concepts.
For e-commerce platforms like Aliso, there's this metric called the take rate.
Right, we mentioned that.
It refers to the percentage they keep from the value of transactions they facilitate. For Aliso, how is their take rate calculated from third-party merchants in 2X19?
You'd divide their third-party merchant fees, which were $190 million, by the third-party gross merchandise value, GMV, which was $1,269 million.
So $190 million divided by $1,269 million.
Yes. That calculation gives you a 15.0% take rate.
And what does that 15% represent?
It's a direct reflection of Aliso's pricing power over its merchants. It shows how much commission or fees they're able to retain from each transaction happening on their platform through third-party sellers.
Okay, 15% take rate. Now let's do a market share top-down calculation for Aliso.
Right.
If Aliso's total GMV in 2X19 was $8,605 million, and the annual U.S. retail and food sales market was that $5,472 billion number, how do we find their market share?
You divide Aliso's total GMV, $8,605 million, by the total market size, $5,472,000 million. Make sure the units map.
Millions versus billions. So $8,605 divided by $5,472,000.
Yes, that gives you approximately 1.157%.
Still very small, like Warehouse Club.
Yes, in the context of total U.S. retail. And notice we use GMV here.
Why GMV?
Because it accurately reflects the total value of retail sales flowing through its platform, including both Aliso's own sales and those of the third-party merchants. It captures the platform's full retail impact.
Got it. Use GMV for platform market share. Finally, what would be an appropriate bottom-up driver for Aliso's revenues?
Thinking bottom-up for Aliso, a good one would be GMV per average active customer account.
Why that metric?
Because it's excellent for decomposing total sales. It tells you how much each active customer is spending on the platform, on average.
So you can track customer engagement and spending habits.
Exactly. It gives a more granular view of their growth drivers than just looking at total revenue or total customers alone.
Okay, that makes sense. Revenue analysis covered.
All right, students, let's now talk about costs. Every business has expenses.
Absolutely. No escaping costs.
From paying, say, the electricity bill for your home to a restaurant buying ingredients to prepare a dish, costs are everywhere. In finance, we categorize these costs in different ways to understand how a company generates its profits and where the money is going.
Okay, different types of costs.
First, we have operating costs. These are costs incurred directly in generating revenue in the current period or related to it.
Day-to-day running costs.
Yes. Includes all costs for acquiring, producing, selling, improving, delivering goods and services. Also managing the business activities, complying with laws. Think raw materials for a factory or salaries for sales staff.
Okay, operating costs. What else?
Second, investing costs. These are different. They relate to acquiring and producing long-term assets.
Things that last a while.
Exactly. These can be tangible assets like property, plant, equipment, a factory building, machinery, Or intangible assets like software licenses, patents, trademarks.
Investments for the future.
Right. Costs that benefit the company for many years, helping it grow.
Okay. Operating, investing. What's the third?
Third, financing costs. These are payments made to the people who provided the money, the debt, and equity investors,
Paying back the financiers.
as a return on their investment. The most common example is interest expense paid on loans or bonds, or dividends paid to shareholders.
The cost of capital, basically.
Exactly. The costs of securing the capital needed to run and grow the business.
Okay, three broad categories: operating, investing, financing. Now, you mentioned analysts classify operating costs differently sometimes.
Yes, a very useful way for analysts to classify operating costs, even if it's not shown this way on the official statements, is into fixed costs and variable costs.
Fixed versus variable. Heard of those.
This distinction is very insightful for understanding profitability and risk.
Okay, explain variable costs first.
Variable costs, VC, are those costs that vary directly with the level of output or sales, at least in the short run.
They go up when you sell more.
Exactly.
Yeah.
Let's use our sari shop example. If you run a small sari shop, the cost of buying each sari from the wholesaler is a variable cost.
Makes sense. More saris sold, more spent on buying them.
Right. Similarly, for a factory making shirts, the cost of the cloth for each shirt is a variable cost.
Okay, variable costs change with volume. What about fixed costs?
Fixed costs, FC, are those costs that do not change within a given range of output or sales in the short run. They stay the same regardless of how much you sell, up to a point.
Like the shop rent.
Perfect example. For our sari shop, the monthly rent for the shop space, or maybe the fixed salary of a permanent assistant, would be fixed costs.
Whether you sell 10 saris or 100, the rent is the same.
Usually, yes. Other examples include depreciation expenses on equipment, maybe software license fees, insurance premiums.
Okay, fixed costs stay constant in the short run. How does this help understand profit?
This classification helps us understand the fundamental equation for operating profit. It looks like this. Operating profit equals Q, PFs.
Okay, break that down. Q is?
Q is the quantity, the number of units sold. P is the price per unit. VC is the variable operating cost per unit. And FSC is the total fixed operating costs.
So price minus variable cost per unit times quantity?
Yeah.
Minus total fixed costs.
Exactly. And that term, PVC, is very important. It's called the contribution margin.
Contribution margin, what does it contribute to?
It's the amount of money each unit sold contributes towards covering the fixed costs,
Yeah.
FC, and then generating profit.
Ah, okay. Each sale helps pay the rent first, then adds to profit.
That's the idea.
Yeah.
Now, the amount of fixed costs, FC, in a company's operating cost structure is referred to as operating leverage.
Operating leverage. Heard that term too. High fixed costs mean high leverage.
Generally, yes. A company with high operating leverage means its operating profit can increase very rapidly with even small increases in sales volume.
Why?
Because once sales are high enough to cover those fixed costs, each additional unit sold adds its full contribution margin, PVC, directly to the operating profit.
Yeah.
The profit jumps up fast.
Sounds good.
It is when sales are rising. But the reverse is also true. If sales decline, operating profit can fall even faster.
Why? Because the fixed costs don't decline.
Exactly. Those fixed costs still need to be paid, even if sales drop. So losses can mount quickly, too.
So operating leverage is like a double-edged sword.
It is. It amplifies profits in good times, but exacerbates losses in downturns, magnifies the impact of sales changes on profit.
How do we measure this sensitivity?
We measure it using the degree of operating leverage, DOL.
DOL. How's it calculated?
It's the percentage change in operating profit divided by the percentage change in sales.
So how much profit changes for a given change in sales?
Exactly. A higher DOL means higher sensitivity. A firm can strategically increase its DOL, by the way,
How?
by increasing its fixed costs while decreasing its variable costs. For example, automating a factory might increase fixed costs, machinery depreciation, but reduce variable costs, labor per unit.
Trading variable for fixed costs to increase leverage.
Potentially, yes.
Let's see an example. You mentioned Ribbon Energy Ltd.
Yes, the fictional oil and gas company.
How does fixed versus variable apply there?
For Ribbon, their production costs, things like lease operating expense, production taxes, gathering and transportation costs, these are clearly variable costs. They are incurred per barrel of oil equivalent produced.
More oil, more cost.
Right. However, there are other operating expenses like depreciation, depletion, and accretion, DD&A, related to their oil fields and equipment, and their general and administrative, G&A overhead costs.
Right.
These are largely fixed costs. They don't change with every single barrel produced in the short term.
Okay, production costs variable, DD&A and G&A fixed.
So we can calculate the contribution margin per barrel. The data showed an average price P of $49.66 and production costs VC of $17.24.
So P minus VC.
$49.66 minus $17.24 equals $32.42 per barrel. That's the contribution margin.
Each barrel contributes $32.42 towards fixed costs and profit.
Correct. Now let's say management forecasts selling 167.197 million barrels.
Here.
And their fixed costs are DD&A $1,450 mils plus G&A $150 totaling $1,565 number of FC.
Okay.
The operating profit calculation would use that formula, Q, EP, fee, EP, UC. The key insight here is that once those fixed costs of $1,565 million are covered by the contribution margins from enough barrels, then every additional barrel sold adds its full $32.42 contribution margin directly to their operating profit. Profit can grow very quickly from that point, illustrating high operating leverage.
Because the fixed costs are already paid for.
Exactly.
Okay, let's try relating fixed and variable to something simple. Thinking about your home electricity bill. Which part behaves like a fixed cost and which part like a variable cost? Short pause.
Well, a fixed part might be a fixed monthly meter charge, or perhaps a minimum connection fee you pay regardless of how much electricity you use that month.
Right, a base charge.
And the variable part is the cost that changes directly based on how many units of electricity, how many kilowatt hours you actually consume. More usage, higher variable cost.
So both types of costs exist even in our daily bills.
They do. It helps to think about what changes with volume or usage and what stays the same.
Now, you said fixed and variable are useful for analysts, but not always how companies report costs.
That's right. While fixed and variable costs are incredibly useful for internal analysis, understanding risk, and forecasting, accounting standards like IFRS and US GAAP usually require companies to disclose operating costs in their official financial statements, either by their nature.
Nature, like what?
For example, compensation of employees, raw materials used, advertising costs. It describes what the money was spent on.
Okay. Or
By their function. This is more common.
function.
Like cost of goods sold or cost of sales, sales and marketing expenses, general and administrative G&A expenses, or research and development, R&D costs. It describes the business activity the cost relates to.
Grouping costs by department or activity.
Exactly. And most companies, including our case study Warehouse Club, choose to use this functional classification in their public reports.
Okay, so how do analysts measure profitability using these functional costs?
This functional classification leads directly to several key measures of operating profitability that analysts use constantly.
Like?
First, gross profit and gross margin. Gross profit is simply revenue minus cost of sales, or cost of goods sold.
Top line minus direct costs of goods.
Right, and gross margin is just gross profit divided by revenue, expressed as a percentage.
Okay.
Now, cost of sales generally captures a significant amount of the variable costs related to producing or acquiring the goods sold. So the gross margin is often a reasonable approximation of the contribution margin we discussed earlier.
A rough guide to PVC?
Kind of. A higher gross margin means more money left over after direct production costs to cover all the other operating expenses.
Okay, gross profit and margin. What's next?
Second, EBITDA, an EBITDA margin. EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
Quite a mouthful. How's it calculated?
You can think of it as gross profit minus the other operating expenses, like SG&A, R&D, but then you add back depreciation and amortization.
Add back D&A. What?
Because D&A are non-cash expenses. EBIT tries to measure the cash profitability from operations before considering financing, interest, taxes, and those non-cash charges. The EBITDA margin is just EBITDA divided by revenue.
A measure of cash operating profit, sort of?
It's often used as a proxy for that, yes.
Mm-hmm.
Useful for comparing companies with different capital structures or depreciation policies.
Okay, EBITDA. And third?
Third, EBIT, earnings before interest and taxes, which is often called operating profit, and the operating margin.
EBIT or operating profit, how do we get that?
It's simply EBITDA minus depreciation and amortization. Or you can think of it as revenue minus cost of sales minus all other operating expenses, like SG&A, R&D.
So profit from core operations before interest and taxes.
Exactly. The operating margin is operating profit, EBIT divided by revenue.
And those other operating expenses like sales, G&A, R&D, are they fixed or variable?
They tend to be largely fixed, although they might have some variable components. For instance, sales commissions within the sales and marketing expense would be variable, tied to sales volume. But overall, G&A and R&D are often mostly fixed in the short term.
So operating profit is a pretty comprehensive measure of profitability from the core business.
Yes, before you consider how the business is financed, interest, or taxed, it's a key metric.
Let's look at Warehouse Club Inc.'s operating profitability using these measures then.
Okay, what did Elaine's analysis show?
Well, first, their operating costs, which include merchandise costs, SG&A expenses, depreciation and amortization, and new store opening expenses, have naturally increased significantly in absolute dollar terms from 2x10 to 2x19.
Expected as the company grew much larger.
Right. But, and this is the important part, when you look at these costs on a relative to sales basis as a percentage of sales,
What happens?
they have remained remarkably stable over that same period.
Oh, that's interesting. Costs grew in line with sales.
Exactly. It strongly indicates that net sales growth is the primary driver of the increase in costs, meaning as sales went up, costs went up proportionally. That's a sign of good cost control and a scalable business model.
They managed their growth efficiently. Any exceptions?
One minor exception noted was store opening expenses per store opening. That actually quadrupled from 2x10 to 2x19.
Getting more expensive to open stores.
Seems so, but in the grand scheme of things, these remain a very small cost in aggregate compared to their merchandise costs, or SG&A.
Okay, small detail perhaps. What about SG&A? Fixed or variable?
Interestingly, their SG&A expenses do not appear to be purely fixed relative to net sales either. They remain roughly the same percentage of net sales over time.
So SG&A also grew proportionally with sales.
Largely, yes, suggesting they have a significant variable component, or perhaps they just needed to scale up overheads as the business volume grew.
Okay, now what about the overall profit margins? Gross margin, EBITDA margin, operating margin.
Here's the key insight. Warehouse Club's overall profit margins have remained mostly stable over the years, but they are consistently quite low.
Low margins, as expected from their strategy.
Right. For instance, their EBITDA margin was around 4% and their operating margin around 3% in 2x19. Very thin.
Okay.
But what's fascinating is when you compare the dollar amount of their operating profit each year to the dollar amount of membership fee revenues they collect.
What do you find?
They are very similar. The amount of operating profit is close to the amount of membership fee revenue.
Wow, so what does that imply?
It implies that the net sales from their stores, after deducting all the merchandise costs and other operating expenses, only account for a smaller portion, maybe roughly 30% of their total operating profit. The rest comes from the fees.
So the membership fees are generating the bulk of the operating profit.
It strongly suggests that. This observation aligns perfectly with what management asserts, that the membership fees are what truly allow the company to run profitably while earning only a very thin margin on their merchandise sales.
Which, in turn, attracts more members because of the low prices, the virtuous cycle again.
Exactly.
Okay, let's pause on that. If Warehouse Club has very low profit margins on its merchandise sales, but its total operating profit is very close to the membership fees it collects, what does that tell us about the importance of these membership fees for their overall business model? Short pause.
It tells us they are absolutely vital, fundamental.
Right.
They provide that significant, steady, recurring revenue stream that enables the company to operate profitably. It effectively allows them to offer those super low prices on merchandise.
Which attracts and retains members.
Precisely. Without those fees, their business model, with such low merchandise margins, likely wouldn't be sustainable.
The fees are the engine.
Absolutely. Okay, moving from operating costs and profit, let's talk about working capital.
Yes, working capital. Another crucial area. Think of it as the money needed to run your daily operations smoothly.
Like for our Kirana shop owner.
Exactly. He needs cash on hand to buy a new inventory, maybe collect money later from customers who bought on credit, kata, and importantly, pay his own suppliers for the goods they delivered.
The short-term cash flow cycle.
Right. It's the money tied up in the cycle, from buying inventory to selling it and collecting cash, while managing payments to suppliers.
How do we measure how well a company manages this?
There are two primary measures we use to assess working capital management.
Okay, first.
First, the cash conversion cycle, CCC.
CCC, what does it measure?
It measures, in days, how long it takes for a company to convert its investments in inventory, stuff waiting to be sold, and accounts receivable, money owed by customers, into actual cash,
Okay.
while also considering how long the company takes to pay its own suppliers, accounts payable.
So how long cash is tied up in operations?
Exactly. A shorter cycle is generally better, as it means less cash is tied up, more cash available for other things.
How is it calculated?
It's calculated as days of inventory on hand, DOH, plus days sales outstanding, DSO, minus days payables outstanding, DPO.
DOH plus DSO, DPO. Okay. What's the second measure?
Second, net working capital to sales. This ratio shows the level of investment required in working capital relative to the company's sales volume.
How much working capital needed per dollar of sales?
Kind of. Now, if a company has negative net working capital, it's often a very good sign.
Negative. How can it be negative?
It means that its suppliers are effectively providing a source of financing for the company. Their accounts payable, money owed to suppliers, are greater than their inventory plus accounts receivable.
Ah, so they hold supplier money longer than their cash is tied up in inventory and receivables.
Precisely. This can happen if the company collects cash from its customers very quickly, low DSO, and pays its suppliers relatively slowly, high DPO.
Okay, let's look at Warehouse Club again. How's their working capital management?
Excellent. Truly exceptional based on the data. They demonstrate remarkable efficiency.
How so? What's their CCC?
They boast a short cash conversion cycle. It was less than a week.
Less than 7 days. Wow. How?
Primarily a result of a very low days sales outstanding, DSO, just 4 days in 2X19.
Why so low?
Because Warehouse Club's customers pay either in cash or with credit debit cards that settle very quickly. They don't offer credit terms to customers.
Immediate payment, basically. Okay. What about inventory and payables?
What's more, their days of inventory on hand, DOH, at 20 days in 2X19 was nearly equal to their days payables outstanding, DPO, at 19 days in 2X19.
DOH and DPO almost match. What does that mean?
It's a brilliant arrangement. It indicates that their inventory is effectively financed by their suppliers.
How?
In simpler terms, they generally collect cash from their customers for items sold before they even have to pay their own suppliers for those items. They turn inventory into cash faster than they pay for it.
So they're using their suppliers' money to fund inventory? That's efficient.
Extremely efficient. As a result, their net working capital is negative.
We expected that.
It declined to negative 5.0% of net sales in 2X19. This is highly positive, indicating working capital is actually a significant source of financing for the company, not a drain on cash.
They're generating cash from operations and from managing working capital well.
Yes. And generally, all their activity ratios, DOH, DSO, DPO, have been quite stable since 2X10.
Consistent performance.
There was a temporary blip, a 1-year increase in 2X16 where their DPO declined slightly,
Why?
apparently due to an accounting information system change. They made accelerated payments to suppliers just before the system switch, probably to be safe and clear the books. But overall, it reflects a highly efficient operation that minimizes cash tied up.
Okay, quick check again. If a company consistently has negative net working capital, is that generally a good sign or a bad sign for its financial health? And why? Short pause.
It's generally a very good sign.
Right.
It means the company is exceptionally efficient at managing its inventory and payments. Its suppliers are effectively financing part of its operations.
Which frees up the company's own cash.
Exactly. Allowing the company to retain more of its own cash, which significantly improves its financial flexibility and liquidity. It shows they operate on very favorable terms.
Great sign of operational efficiency. Okay, let's quickly apply this to Aliso Marketplace Ltd again. Just some quick calculations and concepts.
Good practice.
First, looking at their operating margin again, it changed from 1.163% in 2X18 to 1.727% in 2X19. What was the increase?
Simple subtraction. 1.727% minus 1.163% equals 0.564%.
Okay, a small improvement. Now, their inventory days on hand, DOH,
Yes.
it improved significantly from 37 days back in 2X15 down to 30 days in 2X19. What's the most likely explanation for this improvement?
Think about Lisa's model. The most likely reason is the rising proportion of gross merchandise value, GMV, coming from their third-party merchant sales.
How does that reduce DOH?
Remember, with those third-party sales, Aliso acts as an agent. They don't own or take control of the inventory themselves.
Ah, so it's not their inventory sitting there.
Exactly. So as the proportion of these third-party sales grows relative to their own direct sales, the portion of their total revenues associated with their own inventories naturally falls. This leads to a lower calculated DOH for the company overall.
Makes sense. The mix shifted. Okay, next question. Among depreciation, costs of sales, and interest expense, which one is most likely to be a variable expense that varies with output?
Depreciation, costs of sales, interest expense, which varies with output.
Short pause.
Costs of sales are most likely to vary directly with output,
Why?
because costs of sales represent the inventory costs, like the purchase price of goods, recognized when a sale is actually made. So they fluctuate directly with the volume of goods sold.
And the others.
Depreciation varies with fixed assets, so it's generally fixed in the short run. And interest expense arises from the company's capital structure, how much debt it has, not directly from its sales volume.
Okay, cost of sales is the most variable there. Last one for Eliso, gross profit from merchant sales.
Yeah.
Let's say a competing marketplace makes an 85% gross profit margin on its third-party merchant sales. Eliso's merchant fees in 2X19 were $190 million. What was Eliso's gross profit from just those merchant sales, assuming a similar margin?
Okay, if the margin is 85%, then the gross profit would be 85% of the $190 million in fees.
Which is?
108.5 times $190 million equals $161.5 million, let's say $162 million.
Okay, $162 million gross profit from merchant fees. Now, Eliso's total gross profit was $7,526 million total revenues minus $5,414 million cost of revenues, which equals $2,112 million.
Right.
So what proportion of Eliso's total gross profit came from those merchant sales?
You divide the merchant gross profit, $162 million, by the total gross profit, $2,112 million.
$162 divided by $2,112.
Comes out to approximately 7.6%.
So merchant services contributed about 7.6% of their total gross profit in that year.
Gives you a sense of the profitability mix.
Okay, that wraps up operating profitability and working capital. One big section left.
Yes, our final important topic for today. It's about how companies invest their capital for growth and how they finance these investments, capital investments, and capital structure.
Right, how they spend money long-term and where that money comes from. Any analogies here?
Definitely. Think about planning for a big family wedding in India.
Ah, a wedding. Always expensive.
Exactly. You need a significant amount of money for many different things. Booking the venue, the elaborate decorations, the catering with delicious food, the music, maybe gifts. The list goes on.
It does.
Where does all this money come from? It could be from personal savings accumulated over years, maybe a loan from close relatives or a bank, or perhaps even by selling an old asset like a piece of ancestral jewelry that's not used anymore.
So money coming in from different places and going out for different expenses.
Precisely. Companies operate in a very similar fashion when it comes to long-term funds.
Okay, so companies have sources and uses of capital too.
Exactly. They have sources of capital, which is where the money comes from, and uses of capital, which is where the money goes, usually for longer-term purposes.
Let's list the sources first. Where does capital come from?
A primary source, hopefully, is cash flows generated from operations. The money the business makes day to day.
Internal funding.
Yes. And this can include positive effects if net working capital is negative, like we saw with Warehouse Club, where suppliers effectively provide financing.
Okay, what else?
Other sources include issuing new debt, borrowing money from banks or bond investors, issuing new equity, selling new shares of the company to investors, or asset disposals, selling off existing assets, perhaps divisions or equipment they no longer need.
Debt, equity, asset sales. Okay, now, uses of capital. Where does it go?
Common uses include simply increasing the cash and investments held on the balance sheet, investing in net working capital. If it's positive and growing, it requires cash. Making capital expenditures, CapEx.
Buying long-term assets.
Yes, buying property, plant, equipment, additions to intangible assets, like acquiring new patents or developing software. Making acquisitions of other companies.
Wine growth.
Could be. Also paying down existing debt. And finally, distributing cash back to shareholders through dividends or share repurchases.
Giving money back to owners. Okay, sources and uses. Let's look at Warehouse Club again over that 2X10 to 2X19 period. What did their sources and uses tell us?
Looking at their pattern revealed some interesting strategic choices.
Like what?
One key observation was that capital expenditures, CapEx, and returns to shareholders, dividends and share buybacks, were almost equal in proportion over that decade.
Really? Spending on growth versus giving back to owners was balanced?
Roughly, yes. CapEx and additions to intangibles were about 35% of total uses, while dividends and share repurchases were about 33%.
That is surprising, given how successful their new stores were. You might expect more focus on reinvesting in growth.
One might think so, but they chose to balance growth with shareholder returns quite evenly.
Interesting. What else?
Another important point, the company made no acquisitions during this entire period.
Zero M&A.
Zero. They focused purely on organic growth, building out their own stores and model, rather than buying other companies.
Stick to their knitting. Okay. What about financing? Debt or equity?
Regarding their financing preference, even after returning a substantial amount of capital to shareholders, the company consistently seemed to prefer equity financing, like retaining earnings, over debt financing.
Why would they do that given their steady business?
Well, it's quite logical given their relatively thin operating margins. Taking on a lot of debt means high fixed interest payments. That could significantly increase their financial risk, especially if the economy turned bad.
So playing it safe.
It seems so, although you could argue their sales risks are somewhat reduced because they sell necessities, and those membership fees provide predictable income.
They could probably support more debt, but they chose not to.
Conservative financing. Okay. Anything else from sources and uses?
Finally, we observed a declining financial leverage.
Less debt over time. Effectively, yes. The fact that their debt issuance, which was 16% of total sources, was smaller than the increase in cash and investments on their balance sheet. Also 16% of total uses, meaning cash was piling up.
What does that imply?
It implies that the company's net debt minus cash, actually decreased over time. Cash grew faster than debt. This suggests a deliberate reduction in their financial leverage, reinforcing that conservative approach.
Okay, very clear picture of a conservative organic growth company balancing shareholder returns. Quick check. Why might a company like Warehouse Club, with those relatively thin operating margins, choose to rely more on equity financing rather than debt? What's the main benefit for them? Short pause.
It's really a conservative and prudent choice for risk management.
Right.
If operating margins are thin, taking on a lot of debt brings high fixed interest payments. That's a heavy burden.
Especially in tough times.
Exactly. If sales decline, it could make it very difficult to pay back that debt, increasing the risk of financial distress significantly. Equity, which doesn't have mandatory fixed payments like debt interest, offers much greater financial flexibility and reduces that overall risk profile.
Safety first, given the thin margins.
Seems to be their philosophy.
Now, how do we evaluate how wisely management has used this capital and assess the risks related to their capital structure? Are there specific measures?
Yes, absolutely. We use several key measures for this evaluation.
Like what?
First, return on invested capital, ROIC.
ROIC. What is that?
This measures how efficiently a company uses the total capital invested in it, capital coming from both debt and equity holders to generate profits. How much profit do they make for every dollar invested in the business?
Okay, return on the total investment pot. What do we compare it to?
We compare ROIC to the weighted average cost of capital, WACC.
WACC. We calculated that for Eliso earlier.
Right. WACC is the average rate of return a company expects to pay to all its investors, both debt and equity holders, for the capital they provide. It's the blended cost of their financing.
So ROIC is the return generated, WACC is the cost of getting the funds. What's the key insight?
The key insight is this. If ROIC is consistently greater than WACC, WACC, it means the company is creating economic value for its investors.
Generating more return than the capital costs.
Exactly. It's earning above its hurdle rate. This is the ultimate goal, creating wealth for the owners.
Okay, ROIC versus WACC is crucial. What other measures?
We also use leverage and coverage ratios. These specifically assess the risks related to a company's debt level.
Like how much debt they have relative to equity, maybe.
Yes, that's leverage. And the coverage ratios look at their ability to service that debt. An example is the interest coverage ratio, which compares operating profit, EBIT, to interest expense.
Can they easily pay the interest?
Right. A high ratio means they can easily cover interest payments, indicating lower risk from debt.
Okay. Leverage and coverage. Anything else?
Third, the degree of financial leverage, DFL. We touched on DOL, operating leverage, earlier. Now this is DFL, financial leverage.
DFL, what does that measure?
It measures the sensitivity of a company's net income, bottom line profit after interest and taxes, to changes in its operating income, EBIT.
How much net income changes for a given change in operating income?
Precisely. It's calculated as the percentage change in net income divided by the percentage change in operating income.
What does a high DFL mean?
A higher DFL means that even small changes in operating income can lead to much bigger changes in net income. This is primarily due to the effect of fixed interest expenses.
Interest is fixed, so changes in operating profit flow through more dramatically to net income.
Exactly. A company increases its DFL by taking on more debt, which results in higher fixed interest payments relative to its operating income. It magnifies the impact of operating performance on the bottom line.
Okay, ROIC, WACC, leverage coverage ratios, DFL. Let's apply these to Warehouse Club. What did the analysis show?
The analysis revealed a very strong financial picture for them based on these metrics.
How so? Did they create value?
Yes, they clearly engaged in value creation for investors. Their return on invested capital, ROIC, consistently maintained a positive spread over their WACC.
ROIC was higher than WACC.
Consistently, yes, typically ranging from 200 to 700 basis points, that's 2% to 7% higher than WACC, every year since 2x10.
Wow. That's significant and consistent value creation.
It implies management used investors' capital very wisely. Their WACC also slightly declined over time, mostly as market interest rates fell.
Okay. What about their returns given the low margins?
What's particularly impressive is their ability to achieve high returns despite low margins. As we discussed, their operating and net margins are quite low, around 3% and 2% respectively in 2x19.
Right. Very thin.
However, the returns on capital, like ROIC and ROE, are significantly higher than these margins would suggest on their own.
How do they manage that?
It's largely due to two critical factors we've already discussed: their high asset turnover
Selling a lot for every dollar of assets.
and their negative net working capital.
Using supplier financing.
Right. The negative working capital acts as a very low-cost, almost free means of financing from suppliers. This means they require less actual capital from investors to run the business.
So high efficiency, turnover, and working capital boosts the low margins into strong returns.
Exactly. They amplify the low margins through operational excellence.
What about their capital structure risk? Leverage, DFL.
They have a very conservative capital structure. This is evident from their negative net debt, remember, more cash than debt.
Very safe.
And their degree of financial leverage, DFL, is remarkably close to 1.0. For example, 1.05 in 2x19.
DFL close to 1, what does that mean?
It means their net income and operating income move almost perfectly together, in lockstep. There's very little magnification effect from financial leverage.
Why is it so low?
Because their interest expense is largely offset or even exceeded by the interest income they earn on their substantial cash holdings. They have almost no net interest expense burden.
Okay, extremely low financial risk. What about ROE?
Looking at their ROE decomposition for 2x19 provides a nice summary. Remember, ROE can be broken down.
Net margin times asset turnover times equity multiplier.
Exactly. For Warehouse Club in 2x19, it was roughly net margin 2%, asset turnover 3x, equity multiplier 3x equals 18% return on equity, ROE.
18% ROE is quite good.
It is. And this decomposition clearly illustrates how your high asset turnover and moderate equity multiplier effectively augment those otherwise low net margins to produce strong returns for shareholders.
Shows how all the pieces fit together to drive shareholder return. Okay, final check on this section. If a company's return on invested capital, ROIC, is consistently higher than its weighted average cost of capital, WACC, what does this powerful combination tell us about its ability to create wealth for investors? Short pause.
It tells us that the company is effectively using the capital invested in it
Debt and equity.
to generate returns that are higher than what it costs to acquire that capital.
Making more than the cost.
In simple words, it is consistently creating economic value and adding wealth for its investors. It's a very strong indicator of good management and a sustainable, profitable business model.
The gold standard, really. Okay, finally, let's look at Elisa Marketplace Ltd's capital structure using some calculations just to compare and contrast with Warehouse Club.
Good idea. Let's run the numbers.
First, let's recalculate their WACC for 2x19. We need the inputs. Market value of equity was $1,178 million. Book value of debt, approximate market value, was $144 million. Cost of debt, 5.5%. Cost of equity, 12%. Tax rate, 24%.
Okay, got the inputs. First total capital.
Equity, 11,178 ARBs plus debt, 144 ARMR equals 5,322 ARBs total capital.
Right, now the weights. Weight of debt.
Debt, 144 ARM divided by total capital, 1,322 ARBs is about 10.89%.
Weight of debt equals 10.89%. So weight of equity.
1 minus 10.89% gives 89.11%.
Okay, weight of equity equals 89.11%. Now plug into the WACC formula. Weight of debt X, cost of debt X, 1 tax rate, plus weighted equity X, cost of equity.
So 10.89% by 5.5%, pi 124%, plus 89.11%, tight 12%. Let me calculate.
It comes out to approximately 11.15%.
Elisa's WACC is 11.15%. Now, why might Elisa's WACC be significantly higher than Warehouse Club's WACC, which we didn't calculate but implied was lower due to lower risk?
Well, a key driver is Elisa's higher cost of equity, 12%, versus maybe 9% implied for Warehouse Club.
Why is Aliso's cost of equity higher, more risky?
Yes, that reflects that Eliso's e-commerce business model is generally perceived by investors as riskier.
Why riskier?
Could be due to its shorter operating history compared to a mature retailer like Warehouse Club. Maybe its business model is still seen as relatively unproven in the long term, or simply higher competitive intensity in the e-commerce space.
Newer, less proven, more competition equals higher risk perception.
That's generally how it works. Warehouse Club has a much longer operating history and a very proven, stable business model, seen as less risky.
Also, Warehouse Club's capital structure was more conservative, right?
Yes, much more. Warehouse Club had negative net debt and a DFL close to 1.0, implying a very high effective equity weighting. Aliso has an 11% debt weighting, making its capital structure less conservative in comparison, which also contributes slightly to the WACC difference, though the cost of equity difference is the main driver here.
Okay. Now let's calculate Aliso's DFL in 2x19. Remember, DFL is percentage change in net income, percentage change in operating income. The numbers provided were net income grew from 52 barrels to $100 M's, and operating income grew from 72 barrels to $130.
Okay, percentage change in net income is 1,052, 1, which is about 92.3%. Percentage change in operating income is on 3072.1, which is about 80.6%.
So DFL is 92.3% divided by 80.6%.
Yes, that comes out to approximately 1.13.
Correct. Their net income is slightly more sensitive to changes in operating income because of their interest expense.
Finally, let's compare Aliso's ROE versus Warehouse Club's ROE. We know Warehouse Club's was 18% in 2x19. Aliso's net income was $100 and equity was 1177 basis in 2x19. What was Aliso's ROE? Aliso's ROE equals net income equity equals $100, level and 578 natures, so about 8.5%. Let's round it maybe based on the source data precision to 8.37%.
So 8.37% ROE for Aliso versus 18% for Warehouse Club. Big difference. Why is Aliso's ROE so much lower?
It's primarily due to Aliso's lower net margin, around 1.3% calculated from their data versus 2% for Warehouse Club, and also a lower equity multiplier. Aliso's total assets, total equity was about 1.84x versus 3x for Warehouse Club.
So lower profitability and less financial leverage.
Right. Well, Aliso does have a slightly higher asset turnover, around 3.5x versus 3x for Warehouse Club. It's not nearly enough to offset the negative impact of the lower net margin and lower equity multiplier on its overall ROE.
Shows again how all three components of the DuPont ROE decomposition matter.
Absolutely. You need to look at all three drivers, profitability, efficiency, and leverage, to understand ROE fully.
Excellent comparison. Okay, we've covered a lot of ground. Business models, revenue analysis, costs, working capital, capital structure.
A comprehensive overview. To reinforce our understanding, let's quickly run through some practice problems based on these concepts.
Good idea. Let's apply what we've learned.
Imagine some companies in the ocean freight shipping industry. We have Old Ships, a mature company with high fixed costs, Clean Yards, a technologically advanced shipyard, and New Ships, a web-based shipping technology platform.
Okay, old ships, clean yards, new ships. Got it.
First question, subsequent report elements. For analysts covering these companies, what would a subsequent company research report most likely include? Would it be in-depth info about industry size growth, details on ownership structure, or a summary of changes to the recommendation?
Subsequent report focused on updates. It would most likely include a summary of changes to the recommendation.
Correct. In-depth industry info or ownership structure belongs in the initial report. Subsequent reports highlight changes.
Okay. Next, capacity ramp-up. Which of these three companies has the most ability to ramp up capacity quickly if demand for shipping services suddenly increased? Old ships, clean yards, or new ships?
Ramping up quickly. Ships build ships. Clean Yards build shipyards. New Ships is a web platform. It has to be New Ships.
Why?
Because it has a capital-light business model. It just connects operators with customers. Unlike Old Ships needing time and money to build ships, or Clean Yards needing time and money to acquire new yards, New Ships can likely scale its platform operations much faster without huge capital investment.
Good reasoning. Asset-light models scale faster. Okay, calculation time. New Ships revenue in 2019. New Ships acts as a broker, earning a 6% commission. They brokered 900,000 20-foot equivalent unit TEU containers at an average gross freight rate of $3,848 per TEU. What was their revenue?
Okay, so they handled 900,000 containers. The value per container was $3,848. The commission is 6%. So revenue equals 900,000 on $3,848.06.
Let's calculate. 900,000 times 3,848 times 0.06 comes out to $207,792,000, or $207.8 million approximately.
Correct. Just multiply the volume by the average rate by the commission percentage.
Okay. Next, ROE comparison. Old ships versus clean yards. This one is tricky. Assume both companies have similar equity multipliers. Old ships has half the degree of clean yards' total leverage. DTL equals DOL, DFL. Old ship's asset turnover ratio, 0.84x, is double clean yards, 0.42x. Is old ship's ROE likely higher, lower, or similar to clean yards?
Similar equity multiplier. Old ships has lower total leverage, but double the asset turnover. Remember, ROETU, net margin as asset turnover equity multiplier. Lower leverage might imply lower net margin, but higher turnover might offset that. They might balance out. Old ships is most likely to have a similar ROE to clean yards.
That's correct, based on the typical interplay. The lower leverage impact on margin is likely offset by the higher asset turnover, leading to a similar ROE, assuming the equity multipliers are indeed the same. Good analysis.
Yo. Okay, next, business model relevance. When conducting company analysis, which of these is least relevant to determining a company's core business model? Comments by management about competing products and substitutes, the company's annual report, or industry white papers about pricing strategy.
It's least relevant to the business model itself. Management comments on competitors sounds more like industry analysis. The annual report and pricing strategy papers seem more direct. So I'd say comments by management about competing products and substitutes are least relevant to defining their own business model.
Exactly. That information is crucial for industry and competitive analysis, like Porter's 5 forces, but less so for defining the company's own fundamental plan of operation, which you'd get more directly from annual reports or papers on their strategy.
Okay. Now, cash conversion cycle, CCC calculations. Remember, CCC equal DOH plus DSO DPO
Right.
for old ships. DOH 12 days, DSO 27 days, DPO 55 days. What's their significance?
SCC 12 plus 27, 55 equals 39, 55 equals 40, 16 days.
Negative 16 days. Now, for clean yards, DOH is 46 days, DSO equals 98 days, DPO equals 40 days. Their CCC.
CCC plus 9840 equals 144 equals 104 days.
So old ship CCC, 16 days, is significantly lower and therefore better than clean yards 104 days. Old ships has that negative cycle benefiting from supplier terms.
Yeah. Big difference in working capital efficiency there. Okay, last practice question. First step in capital investments review. What is the very first step an analyst should take when reviewing a company's capital investment over time?
The very first step, before evaluating specific projects or cash flow drivers, you need to know where the money came from and where it went overall. So it must be to determine the major sources and uses of cash on a historical basis.
Absolutely correct. You need that foundational map of cash flows first. Evaluating the wisdom of management's investments or identifying specific operating cash flow drivers comes after you understand the big picture of sources and uses.
Excellent. Those examples really help solidify the concepts.
Good. Wow, students, we have really covered so much ground today.
We have, from the structure of research reports
To dissecting business models using those key creations.
analyzing revenues with bottom-up and top-down views.
Understanding operating costs, fixed, variable, functional, and profitability measures like EBITDA and operating margin.
Managing working capital and the cash conversion cycle.
And even delving into capital investments, sources and uses, ROIC, WACC, and leverage.
You've truly gained insight into how financial analysts dig deep into a company's financial story.
Uncovering its strengths, weaknesses, and potential. It's like being a financial detective.
Indeed. And remember, finance is very much like building a strong, sturdy house.
I like that analogy.
Each concept we discussed today, the business model, revenue drivers, cost structure, working capital, capital investments, is a crucial brick in that foundation.
Understanding these elements doesn't just help you answer exam questions, though that's important.
No, it helps you truly understand how real businesses operate, how they generate profits, and how they create value in the real world. It's about seeing the complete picture.
We really encourage you to revisit these concepts. Maybe pick a real company, a large Indian retailer, a bank, a technology firm. Look at their annual report online.
And try to identify these elements yourself. Where do they talk about their business model? What are their revenue drivers? How efficient is their working capital? Apply what you've learned.
Practice makes perfect.
So, for your provocative thought today, something to ponder until our next session.
Okay.
If a company has a highly conservative capital structure, like Warehouse Club, with its negative net debt and loads of cash, how might this very cautious approach, while clearly reducing financial risk, how might it potentially impact its future growth opportunities, even if it's consistently creating value for investors right now?
Is being too safe potentially limiting growth?
Something to think about. What are the trade-offs? Consider that for our next deep dive.
Thank you all for joining us today. Keep learning, keep questioning, and keep building that strong financial knowledge base.
Until next time, take care and Jai Hind.
Welcome, everyone, to the Deep Dive. We're so glad you joined us today for what we promise will be a truly insightful session.
Yes, welcome. Great to have you all here.
When we look at a company's financial health, it's often tempting, isn't it, to focus only on its own numbers, its sales, its profits, its growth.
Just the company itself.
Exactly. But that's really like trying to understand a cricket player's performance just by looking at their runs scored.
Without the context.
Yes, without knowing anything about the pitch conditions or the strength of the opposing team or even, the weather on the day.
A very good analogy. Context is everything.
Today, we're embarking on a deep dive into something absolutely fundamental, really essential for anyone aspiring to truly understand companies: industry and competitive analysis.
Foundational stuff.
Our mission today is simple, really. We're going to equip you with the essential tools to look beyond a company's individual scorecard.
Beyond just the boundaries and sixes.
Exactly. And see the entire game it's playing in. Why does this matter so much, you might ask?
Well, it matters because a company's success isn't just about what it does internally, is it?
Not at all. It's profoundly shaped by the industry it operates in, the rules of that particular game, you could say, and the strengths and weaknesses of its rivals.
Right. Is its growth because they're brilliant, or is the whole tide rising?
Precisely. Is its growth a result of something truly special it did, or is it simply riding the wave of an industry that's booming?
Yeah.
This deeper analysis allows us, it helps us make far more accurate predictions and valuations.
Much better forecasts.
So we'll cover what an industry is, how to kind of take its pulse, how to understand its competitive heart using powerful frameworks like Porter's 5 Forces and pestle analysis.
We'll unpack those.
And finally, how a company crafts its winning strategy within this complex environment.
Okay.
We'll take our time, don't worry, explain everything clearly, and connect it with examples you see every day right here in India.
Indeed, and welcome again, everyone. It's wonderful to have you with us. As our host rightly pointed out, this deep dive isn't about, rote memorization. Not at all.
No, definitely not.
It's about building a robust foundation for your financial understanding. Just as you learn your basic arithmetic, your tables, before tackling complex equations.
Or learning the rules of cricket before playing a match.
Exactly. Or understand the ground rules of a business before you decide to invest in it, we must first truly grasp the environment an industry creates.
That environment.
Yes. And one of the key reasons we undertake industry analysis is to understand something critical called economic profits. Now, what are economic profits?
Good question. Let's break that down.
Simply put, it's when a company earns a return on its invested capital. That's the money it has put into the business, you see.
The investment.
Right. When that return is more than its cost of capital. What it costs them to get that money. Think of it this way. If you invest money to buy a small shop, say a Kirana store.
A local grocery shop, yes.
And the income you generate from it, after all expenses, is significantly higher than what you could have earned by just putting that money in a fixed deposit. And it covers the cost of borrowing any money you needed for the shop.
So beating the bank and covering loan costs.
Precisely. Then you're making an economic profit. Real value creation.
Okay, I see.
Industry analysis helps us estimate a base rate for profitability. It tells us sort of how much profit companies in that sector generally earn. Why is this important?
Why indeed?
Because competition over time tends to pull company profitability back towards an industry average. It's like a gravitational pull.
Interesting. So outliers don't stay outliers forever.
Often not, unless they have very strong sustainable advantages. It's like how, in a long cricket tournament, an individual player's scores might fluctuate wildly in 1 or 2 matches.
A century one day, a duck the next.
Exactly. But the team's average score over many matches gives you a much better idea of its consistent performance, its underlying strength.
That makes sense. The average tells a story.
It does. So, are you ready to join us on this exciting learning adventure? We're here to guide you every step of the way.
All right, let's unpack this. Before we dive into the how of industry analysis, let's really cement the why. Why is this type of analysis so important for you as an aspiring finance professional?
Laying the groundwork.
Yes. The core purpose, you see, is to help analysts understand the fundamental structural factors that shape an industry. This includes identifying the competitive strengths and weaknesses of companies operating within it.
Their advantages and disadvantages.
Right. and ultimately how these factors contribute to a company's ability to generate those crucial economic profits. Remember, that's when a company's return on invested capital, or ROIC, is higher than its weighted average cost of capital, or WACC.
ROIC greater than WACC, that's the goal.
Exactly. Now imagine you're trying to assess the financial health of your local Kirana shop. You wouldn't just look at its daily sales figures, would you?
No, that would be too narrow.
You'd also consider, well, how many other Kirana shops are nearby? What's the population of the area? What's the purchasing power of the customers who live there?
The local competition, the customer base.
That's essentially what industry analysis allows us to do. But for much larger, often publicly traded companies, it helps us understand the wider context.
The whole ecosystem.
So here's a question for you to think about. If you're looking at a company that's currently making very high profits, seemingly doing extremely well.
Like hitting sixes every ball.
Right. Why might we need to look beyond just the company itself to understand if this level of profitability is actually sustainable in the long run?
That's a perfect question, really gets to the heart of it, because it touches on why we analyze an industry in the first place. Companies operating in the same industry typically share very similar business models, don't they?
Generally.
They
Yeah.
compete not just for customers, but also for raw materials, maybe skilled labor, even financing.
Competing on multiple fronts.
Absolutely. This means they generally face a common set of opportunities and risks. There was a landmark study, actually, by McGann and Porter back in 1997.
Oh, yes, I remember that one.
It highlighted that the industry itself is the most significant factor in determining the sustainability of a company's economic profits. Sustainability, that's the key word.
So the industry structure matters more than just a single company's actions, long term.
In many ways, yes. The real insight here is that while individual company brilliance, like having a great leader or a unique product, can certainly make a difference, especially perhaps for companies that are struggling.
It can lift them up.
It can, but the industry's fundamental structure can act like a ceiling on long-term returns.
Yeah.
It sets the upper limit, in a way.
A ceiling. Okay.
It's like that running race analogy again. The track condition, the weather, the altitude. These broader environmental factors affect everyone. While individual runners will still perform differently, their speeds will generally cluster around the average dictated by those conditions.
Got it. The environment limits the potential.
Exactly. And this brings us to the first major purpose of industry analysis: to improve our forecasts.
Better predictions.
Yes. Competitive forces, whether from existing rivals, potential new entrants, substitute products, suppliers, or even powerful customers, constantly exert pressure. They discipline prices, influence costs, determine market share, and ultimately impact profitability.
They shape the whole game.
They do. Understanding these drivers allows analysts to sharpen their predictions significantly. For instance, there was another study, Guan, Wang, and Zhang in 2014, found that analysts who covered both the company and its suppliers made more accurate earnings forecasts.
Interesting. Knowing the supply chain helps.
It does. Think about a street food vendor selling delicious samosas.
Samosas.
If they know the exact price of potatoes and spices from their supplier and how many other samosa vendors are on that same street,
The competition.
right, they can much better predict their daily profit. Without that broader market understanding, they might mistakenly believe they can charge any price they wish, leading to, well, inaccurate expectations.
Makes sense. Need to know your costs and your rivals.
And the second crucial purpose is to identify investment opportunities.
Finding good places to invest money.
Precisely. By deeply analyzing an industry, you can uncover attractive investment candidates that you might not have fully appreciated otherwise. It allows you to assess their strengths and weaknesses, not in isolation, but in direct comparison to their peers and competitors.
Relative performance.
Exactly. And sometimes investors want exposure to an entire industry sector because they believe in its overall growth story, rather than betting on the specific risks of just one single company.
Spreading the risk.
Yes, this leads to what we call basket approaches, where you invest in several companies within the same industry. For example, if you believe the Indian IT services sector has strong growth potential.
Which many people do.
Indeed. You might not just pick one large IT firm. You might choose to invest in 3 or 4 different IT companies to diversify your risk while still capitalizing on the sector's overall growth.
A bit like buying different sweets.
It's a bit like going to a sweet shop. You might pick different types of sweets, some jalebis, some gulab jamun, some barfi from various sections, but your primary intention is still to buy sweets because you enjoy the overall category.
That's an excellent way to put it. Knowing why we do this analysis really sets the stage nicely. So where do we even begin when we try to make sense of an industry? The very first step, right, after understanding its importance, is defining the industry itself.
Step 1. What is the industry?
Exactly. We commonly define industries as groups of companies that sell similar products or services. Crucially, from a customer's point of view.
Customer perspective is key.
It is. Sounds straightforward, doesn't it? But here's where it gets, well, really interesting and actually a bit tricky sometimes.
The nuances.
What happens if a company sells a wide variety of things, like a big conglomerate? Or what about products that aren't identical but fulfill the same basic need, what we call substitutes? And do geographical differences matter?
Good questions. It gets complex fast.
For example, think about a company selling both mobile phones and washing machines. They're both electronics, yes, but do they belong to the same industry when we're thinking about competition and strategy?
Probably not competing directly, are they?
Likely not. Or consider bottled water versus soft drinks. Both quench thirst, right? But are they in the exact same competitive space? Do they face the same pressures?
Similar need, but maybe different customer groups, different occasions.
Exactly. So if we consider these complexities, why isn't it always easy to neatly place a company into just one clear-cut industry category or box?
That's a fundamental challenge, you're right, and it highlights an important point. To assist analysts like yourselves with these very difficulties, various third-party organizations maintain what we call industry classification schemes.
Okay, systems to help categorize companies.
Precisely. These are essentially organized systems designed to group companies. Historically, older schemes like SE, Standard Industrial Classification in the US, or NACE in Europe, or the global ISIC.
I've heard of ESIC.
Yes, they were often developed by government agencies. They were typically country-specific and tended to group companies based on their production characteristics, how things were made or the raw materials used, a supply-side view.
Based on how they made things.
Right. But these became less effective as new technologies emerged and global business models became common. It was a bit like grouping students in a school purely by the kind of pen they used, rather than what subject they were actually studying.
Doesn't make much sense.
Not really. So today we rely more on modern commercial schemes, such as the Global Industry Classification Standard,
EICS.
EICS,
Yeah.
developed by MSCI and S&P Dow Jones Indices, the Industry Classification Benchmark, ICB, by FTSE Russell, and the Refinitiv Business Classification, TRBC.
GICS, RCB, TRBC. Got it.
These schemes are global, they're regularly updated, and crucially, they group companies based on the similarity of the products or services they sell from the customer's perspective.
Ah, the demand side.
Yeah.
What the customer sees.
Exactly. It's a demand-side approach, a shift from the old supply-side methods. It's more like how many schools now group students by their stream science, commerce, arts, which reflects their future career aspirations and what they demand from their education rather than just their classroom section.
A much more useful way to group them.
We think so. And these modern schemes are strictly hierarchical taxonomies. Think of it like a family tree in biology. You have species, then genus, family, order, and so on.
Yes, like levels.
Exactly. A company is classified into a single group at the lowest, most specific tier, and that automatically places it into all the broader, higher tiers as well. For example, GICS is structured into 11 broad sectors.
Like technology or financials.
Correct, which then break down into 25 industry groups, then 74 industries, and finally 163 very specific sub-industries. Every company gets assigned to just one of these 163 sub-industries.
One single slot at the bottom level.
Precisely. Now, a common question arises. How do they classify multi-segment companies, those companies with multiple, quite different business lines?
Like our phones and washing machines example.
Exactly. Typically, these schemes classify such a company by the business segment that generates more than 50% of its revenue. Or sometimes the rule might be 60% or more.
Majority rules, basically.
Usually, yes. If no single segment meets this threshold, they might use some discretion, or perhaps even classify it as a multi-industry company, though that's less common. The aim is to place the company into the single grouping that best describes the majority of its operations.
Okay, that makes sense. But you mentioned challenges.
Yes. However, these third-party schemes do have limitations, and understanding these is really crucial for you as an analyst. You can't just take them blindly.
Good to know. What are the main limitations?
Firstly, the groupings can be either too narrow or too broad for your specific analysis. For instance, according to GICS, Shopify, the e-commerce platform provider.
Yes, Helps people set up online shops.
right? And Checkpoint Software, a cybersecurity firm, they are both classified in the application software sub-industry.
Really? They seem completely different.
They are. They sell vastly different products and are certainly not direct competitors in any meaningful way. So that grouping might be too broad if you're analyzing cybersecurity. Conversely, many different types of retailers, even those selling similar consumer goods, might be classified into entirely different sub-industries or even sectors, making direct comparisons difficult if you want a broader view.
So, too broad or too narrow? Okay. What else?
Secondly, the strict rule of assigning multi-product companies to a single grouping can be problematic, sometimes very problematic.
The Amazon example comes to mind.
Exactly. A classic example is Amazon. It's classified primarily as a consumer discretionary retailer, but a significant portion, sometimes even the majority of its operating profits come from Amazon Web Services, AWS, its cloud computing segment.
Which is a totally different business.
Completely different industry. This is a critical insight. Rigid classification systems can sometimes mislead analysts about a company's true economic drivers. To truly deep dive, you absolutely must look beyond these official labels to where the real value and profit are being generated.
Otherwise, you misjudge the company.
You risk fundamentally misjudging it. Thirdly, geographical considerations often limit the usefulness of these global schemes. They tend to be less effective for service-oriented, localized industries like healthcare services.
Where rules and customers differ greatly by country.
Enormously.
Yeah.
The economics of hospitals in, say, the UAE often have very little direct relevance to those in France or India. The local context is paramount.
Okay, so global isn't always helpful locally.
Not for certain industries, no. And finally, changes to classifications over time can affect historical comparability. For example, the real estate sector was once just part of the financial sector in GICS, but it was later carved out into its own separate sector.
So comparing financials over time became tricky.
It did. You have to adjust for that change. Also, companies entering or exiting the market due to mergers, acquisitions, or bankruptcies can introduce what we call survivorship biases into historical data.
Survivorship bias.
Yeah.
That's that exactly.
Survivorship bias means that your analysis might only reflect companies that survived in an industry over a period. You're not seeing the data for the companies that failed or got acquired.
So it could paint too rosy a picture of the past.
It potentially could, yes. It might give you an overly optimistic view of past industry performance because you're missing the failures.
Right. That's important to remember.
Let's consider a practical case study. Warehouse Club Inc., a hypothetical example often used. For GICS, this company would likely be classified under consumer staples merchandise retail.
Okay.
However, our analyst, let's call her Elaine Nglayen, found this definition too narrow for her specific analysis. Why? Because it included companies operating outside Warehouse Club's domestic market competitors who weren't really relevant to its immediate competitive pressures. And, perhaps more importantly, it excluded many domestic companies that sold very similar products.
Like who?
Like grocery stores or drugstores, which are actually in different GICS sub-industries, and major e-commerce retailers, which are in a different GICS sector altogether. These are all direct competitors.
So the official classification missed key rivals.
It did, from her perspective. So Elaine made a judgment call. She defined Warehouse Club's industry more broadly for her analysis. She decided to include all retailers in its specific domestic geography, specifically excluding autos and auto parts. And importantly, she even considered restaurants as potential substitutes for some of their prepared food sales.
She customized the definition.
She did. You see, everyone, even with these structured classification systems, a skilled analyst often needs to use their own judgment, their own critical thinking, to define the industry in a way that makes the most sense for their specific analysis. It's not always black and white.
Like deciding if a movie is a comedy or a drama.
Exactly. Sometimes it's a mix, and you need to decide what's most important for your purpose.
That's a fantastic point about using judgment. It's not about just following rules blindly, is it? You have to think.
Absolutely. Critical thinking is paramount.
Now that we understand how to define our industry, using these schemes, but also our own judgment, the next crucial step is to survey it. This is where we start gathering numerical insights, the data, to understand its scale, its growth trajectory, its typical profitability, and, importantly, who the major players are.
Getting the facts and figures.
Yes. First, let's look at industry size and historical growth rate. Industry size is usually measured by the total annual sales generated from a product or customer perspective.
Remember, product or customer view, not necessarily total company sales.
Exactly. This means we're interested in the total revenue generated by that specific product or service across all companies selling it, rather than simply looking at the total sales of each individual company if they operate in multiple diverse businesses.
So for our conglomerate selling phones and washing machines, we'd look at total phone sales across all companies for the phone industry size.
Precisely. And the growth rate is typically measured year over year, or perhaps as a compounded annual growth rate, or CAGR, over several years to smooth out fluctuations. If possible, we try to differentiate if this growth is coming from selling more volume of products,
More units sold.
or from increasing prices, or maybe a shift in the mix of products being sold towards more expensive ones.
Volume versus price mix. Important distinction.
It is. Now, a practical challenge here, especially in countries like India with many small businesses, is that data for private companies, those not listed on stock exchanges, are often unavailable or very hard to find.
Very true. Lots of unorganized sector activity.
If you wanted to know the exact size of the chai tea selling industry across India, you wouldn't just count the sales of large public tea brands like Tata Tea or Brook Bond, would you?
No, that would miss a huge chunk.
You would also need to estimate the sales of countless small tea stalls, the chai wallas, on practically every street corner. That specific data can be incredibly difficult to get accurately.
Near impossible to get exact numbers.
So in such cases, you might have to rely on broader surveys from government agencies perhaps, or third-party market research consultancies. Or you might even look at related economic indicators, like how much tea is imported or produced nationally, or maybe how many tea vendors are registered with local authorities if that data exists.
Using proxies and estimates?
Exactly, making informed estimates. So here's a quick thought for you. If a company's total reported sales are, say, 40 crores, but 20 crores of that revenue comes from a completely different business segment. Let's say they mainly sell electronics, but also have a small real estate division.
Okay.
How much of that euro crores should we specifically count for the electronics industry size that we are studying?
That's a very practical question, and it drives home the need for precision, doesn't it?
It does.
You would count only the 80 crores that directly relate to the electronics industry you're studying. You'd completely exclude the 20 crores from the real estate segment. This ensures your industry scope remains clear and consistent.
Right. Only include what belongs. Makes perfect sense.
Now, let's talk about characterizing industry growth. We can think of it using a kind of style box, maybe, to classify an industry based on two dimensions. Its growth stage, is it a growth industry or a mature industry? And its sensitivity to the broader economy, is it defensive or cyclical?
Okay. Growth stage and cyclicality. Two dimensions.
Yes. Growth industries are typically those that haven't reached full market saturation yet. They often have unique demand drivers, maybe related to demographics or lifestyle changes, and are frequently linked to emerging technologies or new consumer trends.
Like electric vehicles in India now.
That's a perfect example. Still rapidly expanding, with new models, charging infrastructure growing, and increasing consumer adoption. It's clearly in a growth phase.
And mature industries.
Mature industries, on the other hand, have largely saturated their potential markets. Their growth rates tend to be much more in line with, or sometimes even slower than, the broader economy, like GDP growth. Or they might even be declining.
Like landline phones.
An excellent example. Think about the traditional landline phone service industry. Its growth has certainly slowed down significantly, and in many places, it's even declining due to the ubiquity of mobile phones.
Okay. Growth versus mature. Now, cyclicality.
Right. When we talk about sensitivity to the business cycle, we're looking at whether an industry's sales are heavily influenced by the overall economic conditions, booms, and recessions.
Does it swing wildly with the economy?
Exactly. This depends on factors like whether the products are discretionary things people want but don't necessarily need, like a fancy car or a foreign vacation.
Things you cut back on when money is tight.
Precisely. Versus necessary items, essentials like basic groceries, medicines, or utilities like electricity. It also depends on the industry's pricing power, its exposure to interest rate changes, and whether the product is a durable good, like a refrigerator or a car, which lasts years and is a big purchase, or a recurring purchase, like your monthly mobile phone plan or milk.
Ah, okay. So durable goods are more cyclical.
Generally, yes, because people can often postpone buying them. For instance, if you sell ice cream, your sales will likely be somewhat cyclical, maybe very high in summer, lower in winter, perhaps also dipping if people have less disposable income.
Correct.
But if you sell milk, your sales are much more defensive because people, especially families with children, generally need milk all year round, regardless of the overall economy or even the weather.
Essential versus non-essential. Defensive versus cyclical. Got it.
Next, we need to evaluate industry profitability measures. How profitable is this industry overall?
The bottom line for this sector.
Yes. Now, the most comprehensive way to do this, theoretically, is to look at the return on invested capital, ROIC, for companies within that industry over a period of time. ROIC tells you how much profit a company generates for every rupee of capital it has invested in its operations, its factories, its equipment, its working capital, regardless of how that capital was financed, debt or equity.
So a pure measure of operational profitability.
A very good measure, yes. However, gathering consistent ROIC data for an entire industry, especially one with many private companies where data is scarce, can be quite challenging.
Right. Back to the data problem.
So in practice, analysts often analyze the profitability metrics like gross margin, operating margin, or even ROIC, if possible, of the publicly traded companies in that industry. And they might make reasonable assumptions for the private companies, or perhaps use aggregated data from government reports or specialized consultancies if available.
Using public companies as a proxy.
Often, yes. But more important than any single profitability number, though, is the trend. Is industry profitability generally rising, falling, or remaining stable over time? That trend tells a very significant story about the competitive intensity and the long-term health of the industry.
The direction matters more than the exact number.
Very often, yes. Finally, in our survey, we analyze market share trends and major players. Who are the big fish in this pond?
Who dominates the market?
Exactly. A company's market share is simply its revenue from that specific industry as a percentage of the total estimated industry size. Now, it's important to remember that these market shares are often estimates, right? We discussed the difficulty in getting exact industry size. So they should be interpreted as a range, not a precise figure.
Ballpark figures.
Kind of. What's absolutely crucial here, though, is the trend over time. Is a particular company gaining or losing market share relative to its competitors? And importantly, is that growth organic, meaning they earned it by selling more products or attracting more customers themselves, or is it due to acquiring another company? Organic growth versus acquisition growth. Different implications. Very different implications for future performance. Now, an important tool for understanding the competitive intensity related to market share is industry concentration. This tells us how much of the market is controlled by just a few large players versus being spread out among many small ones.
How concentrated is the power?
Exactly. A common measure for this is the Herfindahl-Hirschman Index, often just called the HHI.
HHI, how does that work?
It's calculated quite simply. You take the market share of each competitor in the industry, express it as a whole number. So, for example, if a company has 50% market share, you use the number 50.
Okay, 50, not 0.5.
Correct. Then you square each of those market share numbers, and finally you add all those squared numbers up. So the formula is basically HHI equals sum of market share 2 for all competitors' I.
Square the shares and sum them up. Got it. Example.
Let's say you have an industry with 4 firms, and their market shares are 30%, 30%, 20%, and 20%. The HHI would be 30 squared plus 30 squared plus 20 squared plus 20 squared. That's 900 plus 900 plus 400 plus 400.
Which equals 2,600.
Exactly, 2,600. Now, the HHI gives us a quick gauge of the competitive landscape. Generally, an HHI below 1,500 suggests a relatively unconcentrated, highly competitive industry. An HHI between 1,500 and 2,500 is considered moderately concentrated, and an HHI above 2,500 indicates a highly concentrated industry.
So our example of 2,600 is highly concentrated.
Yes, it would be considered highly concentrated. Government bodies that ensure fair competition, often called antitrust regulators, pay close attention to this index, especially during proposed mergers or acquisitions.
To prevent monopolies?
Or excessive market power, yes. Generally speaking, a lower concentration, meaning many small competitors, usually suggests higher competitive intensity. Companies will compete fiercely, often on price. If the concentration is rising over time, perhaps due to mergers, it usually indicates that industry consolidation is happening, competitive intensity might be falling, which in turn can potentially lead to higher profitability for the remaining larger players.
Fewer players, potentially more pricing power.
Potentially. Think about the mobile network providers in India. A few years ago, there were many more players, right? Competition was incredibly fierce, especially on data prices.
Yes, prices came down dramatically.
Exactly. Now, after consolidation, there are only a few very large players. They still compete, of course, but perhaps they have a bit more control over pricing than when there were 10 players fighting for every customer. It's like having only two or three big auto rickshaw companies versus hundreds of individual drivers in a busy market. The competitive dynamic changes.
Fewer choices for the customer, potentially.
That can be a consequence, yes. Let's quickly apply some of these ideas to our case study. U.S. retail, excluding autos, for Warehouse Club Inc. Our analyst, Elaine, used data from the U.S. Census Bureau to size this vast industry, noting it includes hundreds of thousands of small businesses, highly fragmented overall.
Lots of small shops.
Yes. She characterized the industry's growth as mature. It's not growing explosively like a new tech sector and moderately cyclical. Retail sales are closely tied to GDP, but not as volatile as, say, the auto industry, which swings much more wildly.
Okay, mature and moderately cyclical. Profitability.
When she looked at profitability, she analyzed trends in gross and operating margins for all retailers, and also zoomed in specifically on the top 10 publicly traded ones to get a sense of the leaders.
And market share trends.
The most significant market share trend she observed was the massive, undeniable shift towards e-commerce. Amazon.com, for instance, captured a huge chunk, around 40% by some estimates, of the U.S. e-commerce market share. Even though the overall retail industry remains fragmented with many small players, the top 10 largest firms are steadily gaining market share from the smaller ones.
So concentration is increasing at the top.
Yes, driven largely by the scale advantages of the giants and the rise of e-commerce. This highlights a significant disruptive threat from online players to traditional brick-and-mortar retailers. The Amazon example is really a crucial lesson for everyone.
Why so crucial?
Because it vividly demonstrates how a new business model, leveraging technology and scale, can fundamentally transform an old, established industry. It's happening across many sectors, much like how digital payment apps like UPI have revolutionized cash transactions for countless small businesses and individuals across India. Old ways get disrupted.
That was a brilliant explanation of how numbers tell a story and how trends really matter. We've defined the industry, we've surveyed its landscape using numbers. Now let's turn our attention to its internal structure, its competitive engine, if you will.
The dynamics within the industry.
Exactly. This is where Michael Porter's Five Forces framework becomes an incredibly powerful lens. It helps us understand the fundamental pressures, the forces that collectively determine an industry's long-term profitability potential.
A cornerstone of strategic analysis.
It really is. Imagine the competitive struggle, the rivalry among existing companies right in the very center of a diagram.
The main battlefield.
Yes. Then picture four other powerful forces constantly pushing inwards, affecting that central rivalry. These four forces are the threat of new entrants coming into the industry.
No challenger.
The threat of substitutes, meaning different products or services that meet the same customer need.
Alternatives.
The bargaining power of customers, how much power the buyers have.
Can they demand lower prices?
And the bargaining power to suppliers, how much power the companies providing inputs have.
Can they charge higher prices?
Exactly. The core idea behind Porter's framework, and this is really key, is this. The structure of an industry often dictates its long-term profitability far more than the brilliance or struggles of any single company within it.
Structure drives profitability.
Fundamentally, yes. If some or all of these five industry forces are very intense, very strong.
Like strong headwinds.
Right. It's highly unlikely that any company in that industry will earn consistently attractive returns on its capital over the long run. But conversely, if these forces are benign, meaning they are relatively weak,
like gentle tailwinds,
then the industry as a whole can be highly profitable, offering opportunities for companies within it. This framework helps us characterize the drivers of profitability in a qualitative way, going beyond just looking at past numbers and understanding why those numbers are what they are.
Understanding the underlying causes.
So, here's a thought for you to consider. If all five forces in a particular industry are very, very strong, intensely competitive rivalry, very easy for new companies to enter, lots of good substitutes, powerful customers demanding low prices, and powerful suppliers charging high prices.
A tough neighborhood.
Extremely tough. What can we generally say about how profitable the companies in that industry are likely to be in the long run?
That's a critical question, and the answer, based on the framework, is quite clear. If all five forces are very strong, then the industry's average profitability will generally be quite low. Companies will really struggle to earn attractive returns consistently over time.
A challenging place to do business.
Very much so. Now, let's maybe explore each of these 5 forces with some key questions we might ask ourselves when analyzing an industry, and perhaps use some relevant examples, including our Indian context, to make them clearer.
Great idea. Let's start with the first one, threat of new entrants.
Okay, 1. Threat of new entrants. This force examines how easy or difficult it is for new companies, new competitors, to enter an industry and start competing, potentially stealing market share from the existing players. We ask questions like,
What kind of questions?
well, are there significant upfront capital requirements? Does it need massive investment in factories, equipment, or research just to even get started? Like setting up a new steel plant or a semiconductor fab. High capital needs create a huge hurdle for newcomers,
A big barrier to entry.
a very common one.
Yeah.
Also, are there strong network effects? This is really important in many digital industries.
Network effects, like social media.
Exactly. Think of a social media app like WhatsApp or Facebook here in India. Its value grows exponentially as more of your friends and family use it. A brand new messaging app finds it incredibly hard to gain traction because almost everyone you know is already on WhatsApp. This existing network is a powerful barrier, as new entrants start with zero network value.
Makes it hard to switch.
It does. Which brings us to another question. Are there high customer switching costs? This refers to the time, effort, or actual money it takes for a customer to switch from one product or service provider to another.
Like changing banks, maybe?
Changing banks can involve some hassle, yes. Or think about changing your electricity provider, if you had a choice, which isn't common everywhere in India, or your internet service provider. It can be a nuisance due to installation requirements, setting up new billing cycles, perhaps learning a new interface or service pattern. These switching costs, even if small, make it harder for new companies to lure away existing customers.
People stick with what they know if it's too much trouble to change.
Often, yes. Another factor. Do existing players have exclusive access to essential inputs or distribution channels? For example, if a specific rare earth mineral is absolutely crucial for manufacturing a high-tech product, and only a few established companies have long-term contracts or own the mining rights, that's a significant barrier for anyone else wanting to make that product. Or maybe they control the best retail shelf space.
Controlling key resources or routes to market.
Yeah.
What's the second force?
The second force is the 2, threat of substitutes. This force looks at how easily customers can switch to a different kind of product or service that fulfills the same basic need, even if it looks quite different from the industry's product.
So, not a direct competitor, but an alternative way to solve the problem.
Precisely, we ask. Is there another product or service that solves the same basic problem, but perhaps at a lower price or with better performance or convenience? For commuting within an Indian city, an auto rickshaw is a potential substitute for taking a city bus. They're different modes of transport, but they both get you from A to B. If autos become significantly cheaper, faster, or more convenient due to, say, ride-hailing apps, people might stop taking the bus as much for certain journeys.
Right. Or taking a train versus flying for long distance.
Another good example, we also ask, can customers simply go without the product altogether? If the product is not considered essential, customers might decide to cut it out entirely, especially during an economic downturn. Think about elective cosmetic procedures, definitely not essential, so demand can drop sharply if people feel less wealthy.
Things you can easily postpone or skip.
Exactly. And also, is the substitute product continuously improving in performance or becoming more attractive? Consider how digital advertising platforms like Google and Facebook have become increasingly sophisticated, targeted, and measurable, posing a significant and growing threat to traditional advertising channels like print newspapers or even television.
The substitute keeps getting better. Okay, force number 3.
Force number 3 is the 3, bargaining power of customers. This force assesses how much power the buyers, the customers of the industry, have to push down prices or demand higher quality, better service, or more favorable terms from the companies in the industry.
How strong are the buyers?
Right. Key questions include, are there only a few, very large, or highly concentrated customers for the industry's products? For example, if you are a small company supplying a specialized electronic component, and maybe 80% of your sales go to just 1 or 2 very large mobile device manufacturers like Apple or Samsung, those manufacturers will likely have significant bargaining power over your pricing and contract terms.
Because you depend so much on them.
Exactly. Another factor, are the industry's products largely standardized or undifferentiated? If one company's product is almost identical to another's in the eyes of the customer, then customers have much more power to simply choose the cheapest option. Think about buying basic commodities like rice or wheat or sugar. Often, one brand is very similar to another for the average consumer. So, as a customer, you have more power to compare prices and choose the cheaper one, which forces all the sellers to compete aggressively on price.
Price becomes the main factor.
It often does in commodity markets. Also, can customers potentially backward integrate? This sounds technical, but it simply means, can the customer start producing the product or service themselves instead of buying it from the industry?
Like making it in-house.
Exactly. For example, large streaming services like Netflix initially licensed a lot of content, movies, and TV shows from established studios. But then they started producing their own original content, their own shows and movies. This backward integration reduced their reliance on external content suppliers and gave them more control.
Became their own supplier, in a way. Okay, fourth force.
The fourth force is the mirror image. 4. Bargaining power of suppliers. This force analyzes how much power the companies providing essential inputs like raw materials, components, labor, or services to the industry have to raise their prices or limit the supply of those inputs.
How strong are the sellers to the industry?
Precisely, we ask. Are there only a few very large or highly concentrated suppliers for the industry's crucial inputs? For example, if there's only one or two global suppliers for a very specific, highly complex piece of machinery needed to operate a modern factory, that supplier likely has a lot of bargaining power over the factory owner. They can potentially charge higher prices or dictate terms.
Limited options for the buyer.
Right. Also, are there significant switching costs for the buyers, the companies in the industry, if they want to change suppliers? If it's very expensive, time-consuming, or technically disruptive for a company to switch from one supplier to another, then the current supplier has more leverage, more power.
Locked into the supplier.
To some extent, yes. Another factor. Are the supplier's products highly differentiated or specialized? Highly skilled labor, for example, can have significant bargaining power if there's a limited supply of people with that specific expertise and it's crucial for the industry's operations. Think about specialized software engineers or highly skilled surgeons.
Unique inputs give suppliers power. Got it. And the final force.
The fifth and final force, right at the center, is 5. Rivalry among existing competitors. This force examines the intensity of the competition, the struggle for position among the companies already operating within the industry. How fiercely do they compete against each other?
The head-to-head battle.
Exactly. Questions here include, is there a history of fierce price competition in the industry? Some industries, like airlines or maybe mobile phone plans in the past, are notorious for aggressive price wars that hurt everyone's profitability.
Cutting prices to gain share.
Yes. Also, are there numerous, roughly equal-sized competitors? If there are many players of similar size and strength, competition tends to be much more intense because everyone is fighting hard for market share and no single player dominates.
No clear leader, so everyone fights harder.
Often, yes. Are the products largely undifferentiated in the eyes of the customer? If products are very similar, competition often defaults primarily to price, which tends to be intense. Think about generic pharmaceuticals by law. They are required to be chemically identical to the original branded drug once the patent expires. This leads to very intense price competition among generic manufacturers.
Again, price becomes key if products are the same.
It does. And finally, are there high barriers to exiting the industry? This is an interesting one. If it's very difficult or extremely costly for companies to leave an industry, even if they are losing money.
Why would it be hard to leave?
Maybe they have huge investments in specialized factories or equipment that have no other use and cannot be easily sold off. Or perhaps there are high costs associated with closing down, like severance payments for workers or environmental cleanup obligations. If exit barriers are high, companies might continue operating even at a loss just to recover some of their fixed costs. This keeps excess capacity in the market and leads to sustained, intense competition for everyone remaining.
Trapped in an unprofitable industry.
It can happen. Imagine a large, old steel mill. It was very expensive to build, and maybe its equipment is too specialized to be repurposed easily. If the steel market becomes unprofitable, it's very hard for the owner to just shut it down because of the huge write-offs and potential closure costs involved. So it might keep operating even while losing money, which puts pressure on prices for all the other steel mills too.
Wow. Okay, so those are the 5 forces. Should we quickly apply them to our retail case study?
Yes, let's quickly revisit the case study. U.S. retail, excluding autos, using Porter's framework to get a clear picture of its structure.
Okay, threat of new entrants.
Very high. Why? because it's relatively easy, especially with e-commerce, to open a new retail business. Capital barriers are often low for many segments, and regulations aren't usually prohibitive for basic retail.
Easy to get in. Threat of substitutes.
Generally low. While people can buy services instead of goods, or maybe borrow or rent things, most physical goods sold in retail are not easily replaced by non-retail alternatives for fulfilling basic needs. Retail itself has evolved from physical stores to online, but the fundamental need for buying goods remains strong.
Okay. Bargaining power of customers.
Moderate, perhaps tending towards high in some segments. Customers are fragmented. Yes, there are millions of them. But the internet has made comparison shopping incredibly easy, almost frictionless. Customers are highly price sensitive, especially for identical or commodity-like products.
Easy to compare prices online. Power to the buyer.
A lot of power, yes. Bargaining power of suppliers. Generally low to moderate. Retailers usually have many options when choosing suppliers for generic goods. However, established manufacturers of strong branded goods, like a popular clothing brand or electronic gadget, can still impose some terms or command better prices from retailers due to customer demand for their specific brand.
So it depends on the supplier's brand strength.
It often does. And finally, rivalry among existing competitors. Very high, intensely high. The sheer number of retail firms, both large and small, online and offline, selling similar products, coupled with the easy price comparison and typically low switching costs for customers, leads to very intense price competition, frequent discounting, and constant pressure on margins.
A very tough competitive environment.
Extremely. So by breaking it down using Porter's framework like this, we get a much clearer qualitative picture of why the retail industry is generally so competitive and challenging for achieving sustained high profitability, even before we start looking at the specific financials of individual companies like Warehouse Club. It explains the underlying structure.
That was a fantastic walkthrough of Porter's 5 forces. It truly helps us peel back the layers and understand the internal competitive dynamics, the pressures inside an industry.
The internal game.
Now, while Porter's 5 forces helps us look inside the industry and its immediate competitive landscape, we also need to cast our gaze outside. We need to look at the larger, broader factors in the external environment that influence an industry's long-term growth prospects and how market shares might shift over time.
The bigger picture surrounding the industry.
Exactly. This is precisely where PESTLE analysis comes in. It's another framework, another helpful checklist.
PESTLE. What does that stand for again?
PESTLE is an acronym for 6 crucial types of external factors: political, economic, social, technological, legal, and environmental.
Political, economic, social, technological, legal, environmental.
Okay. Now, a key distinction to remember, and this is important, is this. Porter's 5 forces, as we just discussed, is primarily about understanding an industry's profitability and the intensity of competition within it. It's about the relative power dynamics. PESTLE analysis, on the other hand, is generally more concerned with the industry's overall growth rate and how market share might shift due to these larger, often uncontrollable external influences. It's about the broader currents, the macro trends that carry entire industries along, or sometimes disrupt them completely.
So Porter for profitability drivers, PESTLE for growth drivers, and big shifts.
That's a very good way to think about it, yes. Think of it like planning a big wedding here in India.
Okay, wedding planning.
Porter's 5 forces would help you understand the competition among caterers. How many choices do you have? How much power do they have to charge you? Or how much bargaining power you have with a specific marriage hall or decorator based on alternatives available.
The direct negotiations and choices.
Right. But PESTLE analysis is about the bigger forces at play that affect all weddings. For example, how might new government policies affect wedding venues? Maybe new taxes on large gatherings or noise regulations, political. How does the overall state of the economy impact people spending on weddings? Are they opting for grand, multi-day celebrations or smaller, more intimate affairs because of economic confidence? Or how are changing social trends influencing the size or style of weddings? Perhaps a growing preference for destination weddings or simpler ceremonies compared to traditional large family gatherings.
The broader context affecting the whole wedding industry.
Exactly. It's the external environment. So here's a quick question for everyone listening. If we are trying to understand why a particular industry, say renewable energy, is growing very, very fast right now, would Porter's 5 forces or PESTLE analysis likely be more helpful in giving us that broad understanding of the growth drivers?
That's a great question to clarify the distinction. If you're looking at why an industry is growing rapidly or perhaps shrinking, PESTLE analysis would generally be much more helpful. It specifically focuses on identifying those external forces like government policies, technological breakthroughs, or social trends that are driving those broader growth trends or declines.
Okay, PESTLE for the big growth picture. Let's explore those factors.
Absolutely. Now let's explore each of these PESTLE factors with a bit more detail and perhaps some relevant examples to make them more concrete.
Sounds good. Let's start with political.
First, political influences. These include things like changing government policies on taxation, fiscal measures, or interest rates, monetary policies, direct government involvement as a significant buyer or seller of goods and services, like in defense or healthcare, introduction of new regulations or deregulation, and of course, broader geopolitical conditions like international trade relations or political stability.
Government actions, basically.
Largely, yes. For example, if the Indian government decides to offer large subsidies and tax breaks for individuals and companies to install solar panels.
Like the rooftop solar scheme.
Exactly. This is a clear political influence that will significantly boost the growth and adoption within the solar energy industry. Similarly, in the healthcare sector, in many countries, the government is the largest single buyer of healthcare services. So any government reforms, changes in reimbursement rates, or price controls can drastically impact the profitability and growth dynamics of hospitals, pharmaceutical companies, and other healthcare providers.
Government as a big customer or rulemaker.
Okay.
Economic.
Next, we consider economic influences. These are the macroeconomic factors you often hear about. Changes in the gross domestic product, GDP growth rate, shifts in personal income levels and consumer spending, inflation rates, interest rates, and currency exchange rates. These influences can be cyclical, tied to the regular ups and downs of the business cycle.
Booms and recession.
Right, or they can be structural, reflecting longer-term changes like population growth, urbanization, or shifts in national wealth distribution. The auto industry, for instance, is typically highly sensitive to economic influences because cars are expensive, durable goods. People can easily delay buying a new car if consumer confidence is low, if interest rates for loans are high, or if their own income feels insecure.
Big purchases get postponed in bad times.
Very often. And think about something simple like petrol prices. When petrol prices go up significantly in India, it's a direct economic influence. It affects transport companies, makes logistics more expensive for almost every type of business, and directly impacts household budgets and daily commute expenses for millions.
Affects almost everyone. Okay, say social.
Then we have social influences. These encompass broad cultural trends, shifts in consumer preferences and values, demographic changes like an aging population or a growing youth segment, and changes in overall lifestyles and attitudes. Sometimes companies themselves can strategically try to influence these trends through their marketing, advertising, or even advocacy efforts. There's also a growing focus socially on reputational risk for companies related to issues like environmental sustainability, labor practices, and human rights.
How society's values and habits are changing.
Exactly. For example, the increasing preference for healthy, organic food, especially among younger urban populations in India, is a strong social influence. It's boosting the organic food industry, creating demand for specialized grocery stores, and shaping the menus of new restaurants and food delivery services.
The trend towards wellness.
That's another great example. The increasing consumer interest in fitness, wellness, and healthier lifestyles has significantly boosted industries like athletic apparel. Think brands like Nike or Decathlon becoming everyday wear. Fitness centers, health supplements, and wearable technology like fitness trackers. Social trends create new markets.
Very true. Next is technological. This seems huge today.
It is enormous. Technological influences. Technology is arguably one of inspired the most powerful PESTLE forces today. It can create entirely new products or services, dramatically improve existing ones, making them much better or cheaper, or sometimes it can even render currently successful products or entire industries obsolete over time.
Creative destruction sometimes.
Yes, that concept applies well here. We often talk about two important types of innovations when considering technological influence.
Two type.
Yes. First, sustaining innovations. These are generally incremental improvements to existing products or services that make them better, faster, or cheaper for existing customers, but without fundamentally changing the way they work or the market they serve. Think of successive generations of smartphones getting slightly better cameras or faster processors, or improvements to cable TV over the years, clearer picture quality and more channels, maybe on-demand features. These types of innovations are often led by the existing established companies in the industry.
Making the current thing better.
Right. But then you have disruptive innovations. These are the real game changers. They often create entirely new markets or enter existing markets with a fundamentally different value proposition, maybe simpler, cheaper, or more convenient, often initially appealing only to a niche segment of customers or non-customers that the incumbents were ignoring.
Starting small but changing the game.
Often, yes. Streaming video, for example, was initially seen as a niche service with lower quality and limited selection compared to cable TV, but it was cheaper and more convenient for a certain segment. Over time, it improved dramatically and fundamentally disrupted the entire entertainment industry, largely displacing traditional cable and satellite TV providers.
A classic disruption.
It is. And this leads to a major challenge for established companies, something often called the innovator's dilemma. Do they invest heavily in this new, potentially disruptive technology themselves, even though it might cannibalize or speed up the decline of their existing profitable business? Or do they ignore it, focus on their current customers, and risk losing market share completely, maybe even going out of business when the disruption takes hold?
A very tough choice for incumbents.
Extremely tough. Think about how UPI, Unified Payments Interface, completely disrupted traditional payment methods in India, cash, checks, even debit and credit cards to some extent. It offered a remarkably simple, fast, cheap, and easy way to pay using just your mobile phone. It started, and now almost everyone uses it. This poses a huge existential challenge for older payment systems and the companies reliant on them.
UPI is a fantastic example of disruption here. Okay, illegal.
Fifth is legal influences. These involve changes in actual laws and regulations that stem from legislative bodies, like Parliament or court decisions. These directly alter an industry's business practices. They are the formal rules of the road that all companies operating in that jurisdiction must follow.
Laws of the land.
Exactly. For example, new government regulations imposing stricter standards on vehicle emissions are a significant legal influence. They impact how car manufacturers must design their engines and vehicles, forcing them to invest heavily in new, cleaner technologies like electric vehicles or improved internal combustion engines. The tobacco industry globally is another example of being heavily impacted by constantly evolving laws regarding manufacturing standards, where and how products can be sold, advertising restrictions, mandatory health warnings, and heavy taxation.
Rules that change how you operate. Got it. And finally, environmental.
And finally, environmental influences. These encompass the growing range of risks and opportunities related to climate change, the global policy push towards a lower carbon economy, issues around waste management and pollution, land use policies, water scarcity, and broader environmental protection measures.
Climate change and sustainability focus.
Very much so. Sectors like energy production, coal, oil, gas, airlines, heavy industry, utilities, and automotive manufacturing are facing significant transition risks due, for instance, to increasing carbon emission regulations, carbon taxes, and the widespread push from governments, investors, and consumers for greener alternatives like renewable energy or electric vehicles. Conversely, these trends also create huge opportunities for companies involved in green technologies. For instance, the Indian government's increasing focus on improving air quality, especially in big cities, might lead to stricter rules for factories regarding their industrial emissions, which is a powerful environmental influence directly affecting manufacturing industries across the country.
Risks for some, opportunities for others.
That's often the case with these big external shifts. So, by systematically using this pestle checklist, political, economic, social, technological, legal, and environmental, we can identify important themes or narratives that are likely to shape an industry's future growth, its challenges, and its opportunities. It's like thoroughly checking the weather forecast and understanding the long-range climate trends before you plan not just a trip, but maybe building a house in a particular location.
That's such a vital framework to understand the bigger picture, the macro environment. Okay, we've covered a lot of ground. We've defined the industry, surveyed its landscape with numbers, understood the powerful internal competitive forces using Porter's 5 forces, and now we've looked at the broader external influences with PESTLE. What's left?
The final piece.
The final piece of our puzzle, and something absolutely critical for any business analysis, is understanding a company's specific competitive strategy and its positioning within that industry structure we've just analyzed. How does a particular company choose to compete?
How do they play the game?
Exactly. You see, every company has a strategy. Whether they consciously planned it out meticulously or simply stumbled into it, or inherited it over time.
Intentional versus unintentional strategy.
Right. There's a big difference between an intentional strategy and an unintentional one. An intentional strategy is usually the result of careful thought, analysis, planning, setting clear objectives, measuring performance against those objectives, and using feedback to adapt and improve over time. It's a deliberate choice about how to compete.
Proactive and planned.
Yes. An unintentional strategy, on the other hand, is often just reactive. Maybe just doing what the company has always done, following historical patterns, or simply imitating what competitors are doing without deep consideration of whether it's the right strategy for them, given their unique strengths and the industry context. An unintentional strategy is rarely optimal and can often lead to significant challenges or underperformance.
Just drifting along or copying others isn't a strategy.
Not a good one, anyway. So how do we, as analysts, evaluate a company's competitive strategy, especially on a forward-looking basis? We need to ask three crucial questions.
3 T-checks.
Yes. First, does this strategy create a strong defense against the 5 industry forces we discussed earlier?
Oh,
Can it
no.
effectively withstand intense rivalry, powerful customers, the threat of new entrants or substitutes, and powerful suppliers? Does it position the company favorably within that force field?
Does it fit the industry structure?
Second, does the strategy benefit from, or at least not directly contradict, the broader external influences identified in our PESTLE analysis? Is the strategy aligned with future trends in technology, society, regulation, etc., or is it fighting against them?
Is it aligned with the macro trends?
And third, perhaps most importantly, does the company possess the necessary resources and capabilities, its people, its financial strength, its technology, its brand reputation, its operational efficiency to actually execute this chosen strategy successfully? A great strategy on paper is useless if the company can't implement it effectively.
Can they actually do it? Resources and capabilities.
Exactly. So consider this scenario. If a company has a truly great product, maybe technologically superior, the best in its class, but the underlying industry forces like ferocious price competition due to low differentiation, as identified by Porter's analysis, are very strong against it, will its strategy, even focused on that great product, likely be successful and sustainable in the long run?
Not likely, unfortunately, even with a fantastic product. This really highlights a crucial point. Even the most brilliant product or innovation can struggle or even fail if the underlying industry structure is too harsh, or if the company's strategy isn't well suited to defend against those harsh forces.
So the product isn't enough on its own.
It's often necessary but rarely sufficient on its own. This is precisely why understanding the industry context through frameworks like Porter's and PESTLE is so fundamentally important before evaluating any specific company strategy.
Context first, then strategy evaluation.
Exactly. Now, let's delve into some generic competitive strategies, drawing again on the foundational research of Michael Porter. He identified 3 main game plans, or generic strategies, that companies often pursue to achieve a competitive advantage within their industry. These are cost leadership, differentiation, and focus.
Cost leadership, differentiation, focus. The big 3.
Yes. Think of these as the fundamental strategic approaches any team might take in a game, like deciding to play defensively, offensively, or focus on a specific tactic, although, of course, each company, like each team, will still have its unique plays, its specific execution, and its own style. Porter also famously warned against being stuck in the middle.
Stuck in the middle, what does that mean?
It means a company that tries to be both a low-cost producer and highly differentiated at the same time, or tries to appeal to all market segments simultaneously without a clear focus. Such companies often end up being mediocre at everything, not the cheapest, not the most unique, not the best at serving any particular niche. They lack clarity and often underperform.
Trying to be everything to everyone rarely works.
Very rarely. So let's look at the first generic strategy. 1. Cost leadership.
Aiming to be the cheapest.
Essentially, yes. Means of execution. A company pursuing this strategy aims to achieve the lowest production and distribution costs relative to its competitors in the industry. How do they achieve this? Often through achieving immense economies of scale, producing such large volumes that their cost per unit drops significantly lower than smaller rivals. They might also have favorable access to cheaper raw materials, cultivate a deeply ingrained organizational culture obsessed with strict cost control in every department, use aggressive pricing to gain high volume and market share, and develop highly efficient, low-cost distribution channels. Sometimes they also leverage economies of scope.
Scope. How is that different from scale?
Economies of scale come from producing more of the same thing. Economies of scope come from producing different but related products more cheaply together, perhaps by sharing production facilities, distribution networks, or marketing efforts. For example, a large food company might achieve economies of scope by producing and distributing many different types of snacks through the same network.
Ah, sharing resources across different products.
Yeah.
Okay. How does cost leadership defend against the five forces?
It provides quite a strong defense against five forces. Firstly, it acts as a strong deterrent to potential new entrants because it's incredibly difficult and expensive for newcomers to match the established low costs achieved through scale and experience by the leader. Secondly, existing customers can only push prices down so far, typically only down to the cost level of the next most efficient competitor. The cost leader can usually meet these prices and still earn a profit while rivals struggle. And thirdly, rivals simply can't compete effectively on price over the long term without damaging their own profitability.
Puts rivals in a tough spot. When does this strategy work best?
Industry appropriateness. Cost leadership strategy tends to work best in industries that are capital intensive, where scale matters a lot, where customers are very price conscious and primarily make decisions based on price, where customers don't perceive or particularly value significant differences between competing products, commoditized products, and where there's minimal rapid technological innovation that could quickly make existing processes obsolete.
Price-sensitive customers, commodity products, stable technology. What are the risks?
Risks. There are several key risks. One is cost inflation. If the cost leader's own input costs, like raw materials or labor, rise significantly, their advantage might erode. Another is losing internal discipline and cost control as the company grows larger or more complacent. A major risk is technological change. A new production process or technology might emerge that allows a competitor to achieve even lower costs, essentially leapfrogging the current cost leader. And finally, customer preferences might shift. They might start desiring more premium features, better quality, or higher levels of service, making the bare bones low-cost offering less attractive.
Need to stay vigilant, even if you're the cheapest. Any Indian example?
Sure. Think of a very large, highly efficient textile mill, perhaps in a place like Tirupur or Ludhiana, that produces basic garments like t-shirts or vests at the absolute lowest possible cost. They achieve this through massive production volumes, bulk purchasing of cotton yarn, incredibly streamlined processes, and maybe minimal spending on design or branding. They can then sell their garments much cheaper than smaller mills or brands, making it very hard for new players to enter that specific segment or for existing rivals to compete effectively on price for those basic items. This is a classic example of pursuing a cost leadership strategy in a specific product category.
Okay, clear example now.
Differentiation.
All right, the second generic strategy. 2, differentiation.
Making your product special or unique. Exactly. Means of execution. This strategy focuses on offering unique products or services that customers value highly, perceive as superior or distinct in some way, and are therefore willing to pay a premium price for. This uniqueness can come from many sources: superior product quality, innovative features, distinctive design, strong brand image and reputation, exceptional customer service, or perhaps a unique distribution method. Companies pursuing differentiation often make significant investments in research and development, R&D, advertising and brand building, customer service training, and sometimes seek legal protection for their unique features through trademarks or patents. The goal is to create loyalty and justify that premium pricing.
Building value beyond just price. How does this defend against the five forces?
It offers a different kind of defense. Defense against five forces. Strong customer loyalty built around the unique product or brand acts as a significant barrier to new entrants. Loyal customers are also less likely to switch to substitute products because they value the specific attributes of the differentiated offering. Furthermore, because customers value the uniqueness and are less price sensitive, differentiated companies often have a greater ability to pass on price increases from their suppliers to their customers. They have more pricing power.
Loyalty and pricing power. When does differentiation work best?
Industry appropriateness. This strategy tends to work well in industries where price is not the customer's primary concern, where customers genuinely value distinctiveness, unique features, quality, or brand image, and where there's enough scope for innovation or variation in the industry for products or services to actually be meaningfully different in features, form, quality, or service levels.
Customers willing to pay for better or different. What are the risks here?
Risks. A key risk is imitation. Competitors might eventually figure out how to copy the unique features or erode the brand image, reducing the differentiation advantage over time. Another risk is that buyers might become more sophisticated or their needs might change, and they might decide they no longer value or need the specific differentiating features or the high level of service offered, making them more price sensitive again. Or simply, the company might charge too high a pricing premium, pushing customers to seek out good enough, cheaper alternatives, even if they aren't identical.
Losing uniqueness or charging too much. Indian example.
Certainly. Consider a high-end luxury jewelry store, perhaps a well-known family brand with a long history. They don't compete primarily on the lowest price per gram of gold or per carat of diamond. Instead, they focus on exquisite, unique designs, perhaps handcrafted pieces, superior craftsmanship, certified quality of gems, and exceptional personalized customer service, maybe offering private viewing rooms, custom design consultations, lifetime maintenance. Customers are willing to pay a significant premium because they value these unique features, the perceived quality, the shopping experience, and the trustworthiness associated with the brand name. That's differentiation in action.
Great example. And the third strategy, focus.
Okay, the third generic strategy, 3, focus.
Targeting a specific niche.
Precisely. Means of execution. This strategy involves concentrating all the company's efforts and resources on serving a very specific, narrow segment of the market exceptionally well. This target segment could be defined by a particular group of customers, for example, young professionals, retired seniors, small businesses, a narrow product line, e.g., only high-performance bicycles, only organic baby food, or a specific geographic area, for example, serving only one city or region. The company aims to gain a deep understanding of the unique needs, preferences, and purchasing behaviors of this chosen niche segment and tailors its products, services, marketing, and delivery precisely to them. A focus strategy can sometimes incorporate elements of either cost leadership or differentiation, but its defining characteristic is its narrow scope. It can be a focus cross-leadership or a focus differentiation.
So being the best for a small group, either by cost or uniqueness.
Exactly. Defense against 5 forces. By serving a specific, often underserved niche very effectively, the company builds strong customer loyalty within that segment. Customers value the highly tailored offering and may find it difficult to find equally suitable alternatives from broader competitors, deterring switching. The specialized nature of the focus can also act as a barrier to entry for large players who might not find the niche attractive enough or lack the specialized knowledge to serve it well.
Deep expertise in a small area.
Yeah.
When is focus appropriate?
Industry appropriateness. This strategy is particularly suitable when the target niche segment has very distinct needs or preferences compared to the broader market, and when it's difficult or simply uneconomical for larger, broader-based competitors to serve this specific niche group as effectively. The big players might find the niche too small to be worth their focused effort, or they might lack the agility or specialized capabilities required to meet its unique demands satisfactorily.
When the big guys can't or won't serve the niche well. Risks.
Risks. The primary risk is that it naturally limits the company's potential overall market share, simply because it's a niche strategy. Also, larger competitors might eventually decide that the niche has grown large enough to become attractive and enter it, potentially using their greater resources or scale advantages to outcompete the focused player, perhaps on price. Another risk is that the specific needs or demands of the narrow focus group might change over time or perhaps converge with a broader market, eroding the basis for the focus strategy.
Niche might disappear or get invaded. Indian example for focus.
Sure. Imagine a small local restaurant, maybe in Chennai or Bengaluru, that specializes only in authentic traditional South Indian breakfast dishes. Idli, dosa, vada, pongal, maybe using only specific locally sourced ingredients and family recipes. They cater perhaps primarily to families living in that specific neighborhood who appreciate that authenticity. They know their regular customers' preferences, maybe even their names. They aren't trying to be a multi-cuisine restaurant serving North Indian, Chinese, and South Indian to everyone. Their narrow focus allows them to excel at what they do for their specific target audience. That's a classic focus strategy, building deep loyalty within a very specific culinary and geographic segment.
Perfect example. Focusing on doing one thing really well for a specific group.
Precisely. Now let's quickly look at some case study snippets that illustrate how these strategies apply in practice, based on the kind of questions you might see. Consider Manitou results. A hypothetical boutique hotel described as targeting young professional couples seeking wellness and relaxation experiences. This description clearly points towards a focus strategy, specifically focused differentiation. Any expansion plans for Manitou would need to carefully align with this specific customer segment and their desires, maybe adding spa facilities or yoga retreats rather than trying to attract families with children, which would dilute their focus.
Strategy needs to stay consistent with the focus.
Okay, or think about Warehouse Club Inc., our cost leader example, considering launching its own private label brand of non-perishable food products like canned goods or pasta. The most appropriate rationale for this move, given its existing cost leadership strategy, would be the assessment that customers in these categories generally do not notice significant product differences between brands and are primarily looking for value and lower prices. A private label allows the cost leader to offer even lower prices by cutting out national branding and advertising costs, reinforcing their core strategy.
Private label fits cost leadership if customers don't care about brand. Make sense?
One more. Eliso Marketplace Ltd. Imagine this company operates with a clear differentiation strategy, perhaps offering curated high-quality goods with exceptional customer service and therefore commanding premium pricing. If such a company were to suddenly adopt a price-matching guarantee promising to match any competitor's lower price, this tactic would likely decrease its overall profitability. Why? Because its value proposition is built on uniqueness and service, not on being the cheapest. Trying to be both highly differentiated and the cheapest often leads to confusion, erodes the premium image, and squeezes margins. A differentiation strategy should generally avoid adopting core cost leadership tactics like price matching.
Mixing strategies can be dangerous.
It can be very dangerous, leading to being stuck in the middle. Remember, everyone, a company's chosen strategy must always fit its specific industry environment, as analyzed by Porter and Pestle, and crucially, its own internal resources and capabilities. A small local chai vendor cannot suddenly decide to compete like a giant supermarket chain, and vice versa. Each has its own potential game plan, its own strengths, and its own unique set of challenges to navigate.
Wow, we've truly covered a tremendous amount today on this deep dive. It feels like we've built a really solid structure for understanding companies.
We've laid a strong foundation, I hope.
I think so.
Yeah.
We started by understanding why industry and competitive analysis is absolutely key, why it's so fundamental for any aspiring finance professional. We then learned how to carefully define an industry, using classifications but also our judgment, and how to survey its landscape by looking at its size, growth, profitability, and concentration.
Getting the basic facts right.
Then we delved into how Michael Porter's powerful Five Forces framework helps us understand the fundamental competitive dynamics and profitability pressures within an industry, the internal game. And we explored how Pestle analysis provides us with a crucial lens to look at the broader external forces: political, economic, social, technological, legal, and environmental that influence an industry's growth path and potential shifts in market share.
Understanding the context inside and out.
Exactly. And finally, we tied it all together by evaluating how companies choose and execute their specific competitive strategies within that context, whether they aim for cost leadership, differentiation, or a focused approach on a niche.
And the importance of choosing wisely and executing well.
This deep dive truly provides you, our listeners, with a powerful set of tools, a new lens, you could say, to look at any company. It helps you move beyond just the surface numbers to understand its past performance more deeply and, more importantly, to forecast its future potential with far greater insight and confidence.
A more informed perspective.
Building this strong foundation is incredibly important, especially if you're new to finance, and you've all taken a significant step forward today in understanding the complex yet absolutely fascinating world of finance and business.
Precisely. And maybe here's a final thought, something to perhaps mull over, think about until our next session.
Oh, a takeaway thought. Good.
In our rapidly changing world, with technology evolving at lightning speed, how might the continuous rise of technologies like advanced artificial intelligence and automation fundamentally impact all these forces and external influences we've discussed today?
AI's impact. That's a big one.
Think about how AI might change the threat of new entrants, maybe lowering barriers in some areas by automating tasks, but perhaps raising them in others by requiring huge data sets or specialized AI talent. How might it shift the bargaining power of customers through hyper-personalization or suppliers through optimized logistics? How might it even redefine what constitutes a social trend, like AI influencers, or an economic influence, like AI-driven productivity gains?
How could it change the game entirely?
Exactly. Consider how AI could force industries and companies from your local Kirana shops potentially using AI for inventory management to our beloved cricket teams using AI for player performance analysis, and even global IT giants developing the AI itself to completely rethink their competitive strategies and business models in the coming years.
Wow, that's a lot to think about. The frameworks might stay, but how they apply could change dramatically.
The forces might remain, but their intensity and interplay could be transformed. So keep thinking, keep exploring these ideas, apply them to companies you see around you, and we'll see you for our next deep dive.
Thank you all for joining us. We hope you found this helpful. See you next time.
Hello and welcome to the Deep Dive, your space for cutting through the noise and making complex finance topics clear and actionable. I'm James.
And I'm Jennifer. Together, we're here to help you build that really strong foundation in finance.
That's right. Whether you're, new to finance or maybe looking to deepen your understanding, our goal is simple.
Yes, to unpack these intricate concepts, make them truly understandable, and importantly, memorable. We know this journey can feel a bit, well, overwhelming sometimes.
It can, but we promise to guide you patiently, step by step.
Absolutely. So today, our mission is to explore one of the most vital skills for any finance professional.
Yes, the art and science, really, of forecasting a company's financial results and position.
Think of it like this. When you're planning for something big in your family, maybe a grand wedding next year for a cousin.
Oh, yes, those are big events.
Exactly. You don't just jump in. You carefully anticipate, how many guests might come, how much food you'll need, the cost of decorations, maybe even gifts.
Right, you forecast.
That's forecasting, but for a family event. In finance, we do something remarkably similar for a company.
We try to anticipate its future financial health, how much money it will likely make, spend, and what assets it will own down the line.
And the why behind this is just critical. Analysts meticulously craft these predictions to value companies to understand their true worth.
And this valuation, it then forms the bedrock for investment recommendations, whether to buy, sell, or maybe hold the company's shares.
It's truly a cornerstone of an analyst's daily work. It really is.
So let's embark on this deep dive. We'll start by clarifying precisely what financial elements we typically forecast.
Then we'll delve into the various approaches, the different ways we can make these predictions.
And we'll also consider how far into the future we should cast our gaze. That's important too.
Very much so. From there, we'll zoom in on forecasting specific financial items like revenues, operating expenses, and those big investments.
And finally, we'll tackle the crucial art of scenario analysis.
Ah, yes, which is all about preparing for different possible futures. Because, as we know, the real world, it rarely follows just one predictable path.
Definitely not. We'll navigate this together, thoughtfully and methodically.
Indeed. As we've hinted, accurate forecasts are, well, they're the backbone of sound company valuation and intelligent investment decisions.
Analysts dedicate significant effort, a lot of time, to refining these projections.
To truly master this, we'll explore three core pillars: identifying what to forecast, understanding various approaches to forecasting, and selecting an appropriate forecast horizon.
Let's begin with the what. When we talk about forecasting a company's financials, we're not just looking at one big number, are we?
Not at all. Analysts can focus on different objects, each serving a distinct purpose in building a comprehensive picture.
We generally categorize them into four common types. Let's take the first one.
Okay. First, we have drivers of financial statement lines.
These are the more granular specific elements that directly influence a larger line item on a financial statement.
It's not just about crunching numbers. It's about, unlocking the story behind the figures.
Think of a small neighborhood grocery store owner in India. We might call it a Kirana shop.
Right. To project their net sales for the month, they wouldn't just guess a number.
No, they'd be more careful. Instead, they might meticulously track their average number of customers per day.
And their average sales per customer. These are the drivers.
Exactly. By multiplying these, they get a far more insightful sales forecast.
And the analytical value here is just immense. Knowing these drivers allows you to pinpoint the levers affecting performance.
Is sales growth coming from more foot traffic, or is each customer buying, bigger baskets?
Exactly. This deep understanding improves accuracy and provides invaluable insights for strategic decisions.
For a company like Warehouse Club Inc., that our source material talks about, key net sales drivers included the average number of stores open.
And average net sales per store. Similarly, gross margin and SG&A, that's selling, general, and administrative expenses, as percentages of net sales were identified as crucial drivers for operating expenses.
It's really about breaking down the big picture into actionable components.
Then we move to individual financial statement lines,
Right. Sometimes you'll directly forecast a single line item.
especially if it's less material to the company's overall health or doesn't have clearly identifiable easy-to-track drivers.
Think about your monthly electricity bill. You probably don't meticulously track the usage of every single light bulb, fan, and appliance, do you?
No, probably not.
Instead, you might simply look at last month's bill and assume a small, predictable increase. It's a pragmatic approach.
Especially if the amount is relatively small or very stable.
For a company, this could apply to things like amortization expense, where management might even provide explicit guidance.
Or perhaps minor other non-current assets that don't fluctuate significantly. Things like that.
Our third category is summary measures.
Okay, these are aggregated figures like free cash flow, earnings per share, or EPS, or maybe total assets,
The primary benefit here is efficiency. You're dealing with fewer variables.
which can make the forecasting process much quicker, especially if you need a rapid, high-level overview.
But there's a trade-off. This efficiency comes with less transparency.
Right. It becomes harder to scrutinize the underlying details or, audit the forecast if you only have a broad summarized number.
It's like when you're watching a cricket match. Sometimes a commentator gives a quick forecast like, this team will likely score around 180 runs.
That's a summary measure. It's efficient for a quick understanding, yes.
But it doesn't tell you how many runs each batsman will score or how many boundaries will be hit. It conceals the specifics.
So if you're an analyst needing a quick, high-level view of a company's overall financial health, which of these forecast objects do you think offers the most efficiency, even if it means sacrificing some detail?
Good question for our students to think about.
I think you'd likely gravitate towards summary measures in that case.
Yes, they give you that broad stroke picture. But as you highlighted, it's always a trade-off. Speed versus granular understanding.
Now, the fourth type is ad hoc objects.
Okay, these are unexpected events or items that aren't typically found on a company's regular financial statements, but could have a very material, a significant impact.
Imagine your family is diligently saving for a down payment on a new home, a new flat.
Right, saving carefully.
Suddenly, an unforeseen, substantial legal dispute arises that requires a significant sum of money. This legal cost is an ad hoc object.
It wasn't a regular planned expense, but it critically needs to be factored into your financial planning for that home.
Exactly. For companies, examples could include a major legal proceeding, a sudden government regulatory action, a tax dispute.
Or even the profound impact of a natural disaster like a devastating flood.
These are unpredictable but potentially very impactful, requiring careful consideration.
What's truly insightful here, I think, is a crucial principle we advocate. Focus on forecast objects that are regularly disclosed by the company.
Or that can be directly calculated from information that is regularly made public.
Why is this so vital? Because it allows you, as an analyst, to confirm your forecasts in a timely manner.
Yes, verification is key. If you're forecasting a very specific product line gross margin, the profit from a single product after its direct costs.
But the company only publicly releases its consolidated gross margin for all products combined.
Then it becomes incredibly challenging to verify the accuracy of your highly detailed product line forecast.
Exactly. And it's also a caution against building overly complex models, isn't it?
Absolutely. Sometimes analysts can get caught up in forecasting every minute detail.
Our source mentions a large pharmaceutical company like Novartis AG, which manages over 35 individual drugs targeting various illnesses across different geographies.
An analyst could attempt to forecast sales for each drug by illness, by country.
But such a model would take months to construct and weeks to update every quarter.
And the irony is, most of these granular forecasts wouldn't even be verifiable with the company's public disclosures.
And often, this immense time and effort don't translate into significantly improved accuracy.
The lesson here is to prioritize. Focus on the most important drivers, and don't hesitate to use aggregations or simpler methods where extreme detail doesn't add proportional value.
Very wise advice. Now that we have a clearer picture of what we forecast, let's shift our attention to how we actually do it.
Okay, the how. There are 4 general approaches analysts employ, and in practice, you'll often find them used in combination.
Right, mixing them creates a more robust forecast. The first approach is using historical results.
This operates on the assumption that past is precedent, often the simplest and, frankly, the default starting point.
It involves using past observed values, like a historical average or a median, as your forecast for the future.
Imagine your local milk vendor, or dairy-wala, who has consistently sold, on average, 50 liters of milk every morning for the past year.
You might reasonably forecast that he will sell 50 liters tomorrow. You're assuming that past sales will repeat.
This approach is generally appropriate for companies operating in very stable industries with unchanging structures.
Or for those whose business is less sensitive to broader economic cycles, and also suitable for forecasting non-material items.
However, it's considerably less appropriate for cyclical industries, like automobile manufacturers.
Where future economic conditions will almost certainly differ significantly from the past. A boom versus a recession, for example.
Definitely. And it definitely falls short if a company is undergoing major strategic changes, such as a large acquisition or a significant restructuring.
Historical data alone won't accurately reflect the transformed future in those cases.
Building on that, the second approach is historical base rates and convergence.
Okay, this method involves using an industry average or a peer group's average or median computed over a long period as a base rate.
The core assumption is that the company you're analyzing will gradually converge or move towards this industry norm over time.
Think about a new small software company that has just launched. Its profit margins might be quite low initially.
But if you look at large, successful Indian IT companies like TCS or Infosys and observe their long-term average profit margins,
You might then forecast that the new company's margins will slowly grow towards that established industry average as it matures and achieves greater scale.
this approach is highly effective for companies within well-established industries with numerous publicly traded peers.
Like banking, airlines, or automotive sectors, particularly where the industry structure itself is stable.
It's also logical for smaller companies that are maturing into a profile similar to their larger, more established counterparts.
But this approach also has its limits.
Yes, it's less appropriate for companies in entirely new or rapidly evolving industries where a stable, definable base rate is hard to establish.
Also not ideal for highly cyclical industries, as a smooth convergence won't capture the inherent volatility.
And interestingly, it's often less suitable for industry leaders. Why? Because they're often the ones defining the industry average.
Right, like Alphabet and Meta significantly influencing the digital advertising industry averages.
So using that average to forecast their results might just reflect their own past performance without truly providing an independent benchmark for their future.
Makes sense. Our third powerful approach is leveraging management guidance.
Yes, public companies frequently provide public targets or ranges for future financial measures, like expected earnings, revenue, or capital expenditures. That's management guidance.
Its significance lies in its forward-looking nature, and the fact that company management possesses a wealth of internal company and industry information.
Information that isn't readily available to external investors like us.
It's worth noting that guidance is often presented as a range, say, sales growth of 2%, 4%.
And analysts should be aware management might sometimes pad the upper bound of their guidance.
Setting a slightly higher target to create an easily cleared hurdle, making it easier to beat expectations later.
Also, during periods of high uncertainty, like the early days of the COVID-19 pandemic, companies might even suspend guidance altogether.
So as an analyst, you must always critically scrutinize the assumptions embedded within management's guidance.
This approach is most appropriate when management has a proven track record of reliable estimates.
Conversely, it becomes less appropriate for companies that are highly sensitive to the broader business cycle.
Right. Management, despite their internal knowledge, typically doesn't have a significant informational advantage over investors when it comes to forecasting broad macroeconomic variables like GDP growth or commodity prices.
Management's insights are generally most valuable for forecasting elements under their direct control.
Such as their specific operating expenses or planned capital expenditures.
So if a company's management provides a sales forecast, what's one crucial step an analyst should take before fully relying on it? Any thoughts, students?
Well, before building your entire model on management's forecast, you absolutely must scrutinize the assumptions embedded in that guidance.
Are they plausible? Do they align with your own understanding of the market and industry? It's about critical thinking, not just blind acceptance.
Very good. And finally, we have the analyst's discretionary forecast.
This encompasses all other approaches where an analyst primarily relies on their own informed judgment.
It might involve incorporating data from surveys, constructing sophisticated quantitative models, utilizing probability distributions, or drawing unique analogies.
Crucially, it often involves inputs that aren't directly observable from publicly available financial statements.
Consider a pharmaceutical company developing a groundbreaking new medicine for a disease that currently has no effective treatment.
No history, no direct competitors.
Exactly. In such a unique scenario, an analyst must use their discretion. They might survey doctors to gauge interest, use medical data to estimate the potential patient pool.
And draw on their judgment from similar drug launches in related fields, even if not identical.
This approach demands significant judgment precisely because the situation is novel and unique.
It's most common for companies in highly cyclical industries, those with few or no comparable peers, companies that do not provide management guidance.
Or those undergoing fundamental transformative changes, perhaps a major shift in their competitive landscape or regulatory environment.
Right, so once we've determined what to forecast and the approaches we'll use, the next logical question is, how far into the future should we look?
The forecast time horizon. And it isn't one size fits all. It dynamically adjusts based on several critical factors.
Firstly, your investment strategy plays a significant role.
Long-term investors, like many institutional fund managers, might extend their outlook 3 to 5 years into the future.
While those focused on shorter-term opportunities might concentrate more on the next 1-2 quarters.
Secondly, industry cyclicality is a key consideration. If the industry is highly cyclical, experiencing pronounced ups and downs,
Your forecast period should be long enough to capture at least one full business cycle, to see the whole pattern.
exactly. This ensures your projections account for both periods of expansion and contraction.
Thirdly, company-specific factors are equally important. If a company has recently completed a significant acquisition or is embarking on a major restructuring,
You'll need a sufficiently long horizon to see the full benefits or impacts of that strategic activity materialize on their financial statements.
makes sense. And finally, sometimes the forecast period is simply a predefined standard set by your firm or employer.
Yes, that happens too, leaving less room for individual discretion.
Okay, so after deciding our time horizon, we delve into selecting our revenue forecast objects.
This is where we pinpoint exactly how we'll project those all-important sales figures. We primarily leverage two types of drivers, top-down and bottom-up.
Let's begin with top-down drivers. These approaches start with a broad macroeconomic perspective.
And then progressively narrow down to the company's specific situation. The first within this category is forecasting growth relative to GDP growth.
Here, you first project the overall nominal gross domestic product, GDP growth, for the economy.
Then, you assess how the company's revenue growth is expected to compare to that GDP growth, often expressed as a percentage point premium or discount.
For instance, if India's nominal GDP, the total output of our economy, is projected to grow by, say, 7% next year.
A very stable consumer goods company might forecast its revenue to grow at 1% below GDP, perhaps 6%, reflecting its mature business.
Or, conversely, a rapidly expanding e-commerce company might project its revenue to grow 3% above GDP at 10%.
Given its presence in a high-growth sector, if that makes sense.
Another key top-down driver involves forecasting market growth and market share.
In this approach, your initial step is to project the total market size for a particular product or service.
Following that, you estimate the company's current market share within that total market and anticipate how that share might evolve over time.
For example, if the overall market for electric vehicles in India is forecast to expand from, say, 1,000 crore rupees to 1,200 crore rupees annually,
And our company currently holds a 10% market share and expects to maintain it.
then our company's revenue from electric vehicles would proportionally increase from 100 crore to 120 crore rupees.
It's like precisely calculating your slice of a growing economic pie.
Now let's turn our attention to bottom-up drivers.
These approaches start with the smaller, more granular details of a company's operations.
And then aggregate them to construct the total revenue forecast. A very common bottom-up method involves using volumes and average selling prices.
Here, you project the number of units the company expects to sell, that's your volume, and the average price it expects to sell each unit for.
You then simply multiply these two figures to arrive at your revenue forecast.
For a company that manufactures beautiful saris, for example,
You would project how many saris you expect to sell and the average price per sari. Multiply these two numbers to get your total revenue forecast for saris.
this granular approach is commonly adopted for media and internet companies. Users times revenue per user.
Also airlines, asset managers, assets under management times management fee rates, and commodity producers where price and volume are key.
Building on that, another bottom-up method is to forecast product line or segment revenues,
This involves projecting revenue for individual products, distinct business lines, specific geographic areas, or separate reporting segments.
and then summing them up to arrive at the company's total revenue.
This approach is particularly valuable when these different segments have varied economic exposures or distinct growth trajectories, allowing for a more nuanced view.
We also utilize capacity-based measures.
Yes, for instance, in the retail sector, revenue forecasts are frequently based on the number of stores a company operates and the average sales generated per store.
Or often, the growth in same-store sales, that is, sales from stores that have been open for at least a year.
To use a local example, for a popular chain of quick service restaurants, like a fast food joint, you might forecast their revenue based on how many new outlets they plan to open.
And how much each existing and new outlet is expected to sell on average each day or month. It's a very direct link between physical presence and sales generation,
And finally, we have return or yield-based measures.
especially pertinent in the financial services industry, for banks, for example.
You would calculate their net interest income by forecasting their total loan balances and the average interest rates they're expected to earn on those loans.
This gives a direct projection of a major revenue stream.
Now, here's where it gets really interesting. Using both top-down and bottom-up approaches together is incredibly powerful.
Ah, yes, the cross-check.
Exactly. It provides a robust cross-check for your work, helping you uncover any hidden assumptions or potential errors that might arise from relying on just one approach.
For instance, if your bottom-up forecast suggests a dramatic increase in sales, but your top-down analysis of market share doesn't support it.
You know you need to re-examine your assumptions. Something isn't quite right.
It's like checking your cricket score from both the overall scoreboard and by meticulously counting each player's runs individually.
If they don't align, something needs a closer look. A very good analogy.
This brings us to a fundamental principle. Always separate one-time unusual items from your regular repeating revenue.
Yes, recurring versus non-recurring. Consider a school that consistently charges annual tuition fees that's recurring revenue.
The predictable backbone of its finances.
But if that same school receives a large, one-time donation from a benevolent alumnus, that's non-recurring.
You wouldn't expect that donation every year, so you'd forecast it separately, or maybe even exclude it from your core revenue forecast.
Because it doesn't represent the ongoing operational business. And the reason we do this separation is crucial.
Non-recurring items often have distinct drivers and can significantly distort the true underlying business performance.
Including a large one-time sale in your regular revenue growth calculation might artificially inflate the recurring growth, making the business appear healthier than it truly is.
There are generally two types of non-recurring items. The first are those clearly disclosed by management,
Such as the impact of changes in exchange rates, extra selling days in a fiscal period, or revenues stemming from acquisitions or divestitures.
These are usually straightforward to identify and isolate.
The second, more challenging type, consists of non-recurring items that are not quantified by management and demand your astute judgment as an analyst.
Our sources provide some compelling examples here.
Think about the massive surge in e-commerce sales during the COVID-19 pandemic. Many initially thought this was the new normal.
But later, e-commerce sales as a percentage of overall retail sales began to decline, revealing that a portion of that initial growth was, in fact, non-recurring or transient.
Another fascinating instance involved graphic processing unit, GPU sales, tied to cryptocurrency mining.
GPU manufacturers saw huge sales increases, but analysts had to carefully estimate and judge how much of that surge was attributable to mining.
Which they might then forecast separately as non-recurring due to factors like government restrictions on mining. This is precisely where your seasoned analyst judgment becomes invaluable.
Now let's revisit those four general forecast approaches we discussed earlier: historical results, historical base rates, management guidance, and analyst discretion.
All of them can be powerfully applied to revenue forecasting depending on the specific company and prevailing market conditions.
Let's consider how these might apply to a real-world scenario using insights from our sources on a company like Warehouse Club, Inc.
Okay. For top-down drivers, like market size and market share, applying historical results means projecting past trends into the future.
For Warehouse Club, if U.S. retail sales historically grew at, say, an average of 3.4% annually, and the company consistently gained 2 basis points of market share each year.
And analysts could simply forecast these same rates continuing.
If we use historical base rates and convergence, instead of assuming indefinite share gains, you might project Warehouse Club's sales growth rate to gradually converge to the overall market growth rate over several years.
Which implies that their market share gains would eventually decelerate to zero as the company reaches maturity.
When management guidance is available, such as annual or longer-term expectations for market size, market share, or direct sales figures,
An analyst can directly integrate these into their forecast, provided they first assessed management's credibility. Always check credibility.
and finally, with an analyst's discretionary forecast for a company like Warehouse Club, you might commission a detailed study to determine their market share in their most established regions.
You could then use your judgment to apply these insights, perhaps with careful adjustments, to new or expanding regions to estimate future sales. A deeper, more tailored approach.
Similarly, for bottom-up drivers like the number of stores, sales per store, or membership figures, the four approaches also apply.
Using historical results for Warehouse Club, if they have historically opened, say, 4 to 6 new stores annually, consistently grown net sales per store by 3.8%, and added around 450,000 members per year.
You could simply assume these same quantities continue.
With historical base rates and convergence, you might observe that other mature retailers eventually slow down and stop opening new stores.
So you could project Warehouse Club to gradually reduce their new store openings to zero as they mature, converging towards that norm.
Management guidance would involve using any specific targets management provides regarding new store openings or membership pricing, if they are credibly provided.
And an analyst's discretionary forecast could involve projecting stores and members based on ratios like stores per capita or members per store observed in their mature areas.
And then applying these ratios, or fractions thereof, to new regions where Warehouse Club is expanding, often needs detailed geographic analysis.
It's paramount that analysts consistently integrate their perspective on key risk factors into their revenue forecasts.
Whether explicitly stated or implicitly embedded. 4 crucial risk factors that universally impact companies, albeit to varying degrees, include competition,
Significant changes in the business cycle, recessions or booms.
the dynamics of inflation or deflation, and transformative technological developments.
For a company like Warehouse Club, for instance, 2 primary risk factors would be intense competition from other retailers.
And the ongoing technological developments, particularly the relentless rise of e-commerce, which has consistently captured market share in U.S. retail.
These risk factors are not isolated. They significantly influence not only revenue, but also other critical financial forecasts.
Like profitability, working capital, capital investments, and a company's capital structure. They are all interconnected.
Now, let's shift our focus to the money that flows out of a company, its operating expenses.
Right, the costs. Companies typically provide less granular detail about their expenses compared to their revenues.
Because of this, analysts often opt for more aggregated forecast objects, like combining all cost of sales or selling, general, and administrative SG&A expenses and modeling them as a percentage of sales.
A critical principle here is that forecasts for revenues and costs must maintain coherence. They need to logically align.
For instance, if you forecast a significant increase in sales of a low-margin product, perhaps a very inexpensive, high-volume item,
then the company's overall profit margin should naturally decline because that low-margin product now constitutes a larger proportion of the total sales mix. Makes sense.
let's specifically discuss cost of sales, COGS, and gross margins. COGS typically represents the single largest cost for companies that manufacture or sell physical products.
Given its direct relationship with sales, forecasting this item as a percentage of sales, or alternatively as its complement gross margin, is generally a highly effective approach.
Consider a local bakery. The cost of flour, sugar, and butter is a substantial portion of their cost of sales.
If the price of flour suddenly surges, but the bakery, due to competitive pressures, cannot quickly raise the price of its cakes,
Its gross margin, the profit remaining after deducting COGS, will inevitably shrink.
a smart bakery might employ a hedging strategy by buying flour in advance to lock in prices.
Much like you might pay for a year of broadband service up front to avoid future price hikes. Good comparison.
It's vital to recognize that even marginal changes in gross margin forecasts can profoundly impact a company's operating profit.
Think of airlines, and their jet fuel costs. A sudden, unhedged spike in fuel prices can dramatically erode their profits. It's a huge factor.
For short-term forecasts, especially for companies with volatile input costs, breaking down costs into their volume and price components becomes essential.
While comparing your company's gross margins to those of its competitors can offer a useful cross-check, exercise caution.
Different business models can lead to vastly different cost structures. A retailer owning stores versus a wholesaler with franchised operations.
They'll have different cost profiles. The wholesaler might have a lower gross margin, but also significantly lower operating costs overall.
Now we have SG&A expenses, which encompasses selling, general, and administrative costs.
These are the other major category of operating expenses. Unlike cost of sales, SG&A expenses generally have a less direct, immediate link to revenue fluctuations.
For a large IT company, the salaries of software engineers dedicated to developing new products, which typically fall under research and development, are largely fixed costs.
They are paid regardless of whether the company sells many new software licenses this month.
However, the commission paid to a salesperson would be a variable cost, as it increases directly with the sales they generate.
Selling and distribution expenses often contain a variable component and can be effectively modeled as a percentage of sales.
While general corporate costs tend to be more fixed and might be better projected using a steady growth rate, perhaps tied to anticipated wage inflation.
So a question for you students. If a company decided to launch a massive advertising campaign, would the cost of this campaign be more like a fixed cost or a variable cost in the short term, and why?
That's an interesting challenge. In the short term, the cost of that advertising campaign would largely behave as a fixed cost.
Why is that?
Well, the company typically commits to a certain amount of advertising spend up front, irrespective of the immediate sales generated from it. It's a predetermined expenditure, not something that fluctuates directly with each unit sold.
Ah, okay, a lump sum investment, got it.
Sometimes, when detailed cost breakdowns aren't publicly available, analysts might resort to using summary measures like operating or EBITDA margins broken down by business segment.
Our source provides a compelling example with a consumer goods company, similar to a Unilever.
This company operated with varying operating margins across its different segments, like beauty and personal care, foods and refreshments, and home care.
And the source illustrated that if the faster-growing home care segment, which notably had a lower operating margin, grew disproportionately,
It could actually pull down the company's overall operating margin, even if the individual segment margins remain stable.
that powerfully underscores the importance of forecasting by segment whenever possible. Shifts in the sales mix matter a lot.
Absolutely. Now let's turn our attention to working capital.
This is essentially the short-term money a company utilizes to manage its daily operations.
This crucial element includes funds that customers owe to the company, accounts receivable, the value of products held in inventory.
And the money the company owes to its suppliers, accounts payable.
For a small mobile phone shop in a bustling market, perhaps like Chore Bazaar.
Accounts receivable represents the money owed by customers who've purchased phones on credit.
Inventory encompasses all the phones and accessories stocked on the shelves, awaiting sale.
And accounts payable is the money the shop owner owes to the distributors for the mobile phone supplied to them.
It's the immediate financial pulse of the business.
The standard method for forecasting working capital relies on what we call efficiency ratios.
These ratios provide keen insights into how efficiently a company manages its short-term assets and liabilities. We then combine these ratios with our revenue and operating expense forecasts.
Let's look at 3 commonly used ratios. First, days sales outstanding, DSO.
This tells us, on average, how many days it takes for a company to collect money from its customers after a sale has been made.
The formula is accounts receivable divided by revenue divided by 365.
Second, inventory days on hand, DOH.
This shows us, on average, how many days inventory remains in the warehouse before it is sold.
The formula is inventory divided by cost of goods sold divided by 365.
And third, days payable outstanding, DPO.
This indicates, on average, how many days a company takes to pay its suppliers.
The formula is accounts payable divided by cost of goods sold divided by 365.
Let's consider a practical application from our source for a fictional company called YYLTD.
If we have their historical revenue, QGS, and their year-end balances for receivables, inventory, and payables, we can calculate these ratios.
For instance, if YYLTD had accounts receivable of a certain amount and revenue of another, we could divide the receivables by their average daily revenue to get their DSO, maybe 15 days.
Similarly, we could find their inventory days on hand and days payable outstanding.
Once we establish these historical ratios, we can then use them to project future balances.
If we assume these ratios remain consistent and we have our forecasted revenue in QGS,
We can simply rearrange the formulas. Future accounts receivable would be our calculated DSO multiplied by the forecasted average daily revenue.
A straightforward approach allows us to project future working capital needs.
Now let's circle back to Warehouse Club Inc. and apply our forecast approaches to their working capital ratios.
Using historical results, we'd observe that Warehouse Club's DSO and DPO have been quite stable.
While their inventory days on hand, DOH, has shown a consistent decrease, indicating improving inventory management efficiency, and analysts might forecast these trends to continue.
However, the historical base rates and convergence approach might not be suitable here. Why not?
Well, Warehouse Club's efficiency ratios are materially better than the industry average due to its unique business model, low margins, high membership revenues.
So assuming they'll converge to the industry average doesn't make logical sense unless their business model fundamentally changes.
If management guidance is provided on specific working capital ratios, we would incorporate it, but always after carefully evaluating its credibility.
And with an analyst's discretionary forecast, an analyst might delve deeper, estimating ratios by specific product category, distinguishing between fresh foods versus packaged foods, perhaps.
And then applying these nuanced estimates to sales forecasts broken down by category, providing a more precise view of working capital needs.
Thinking about this, why would a company selling perishable goods like fresh vegetables and fruits aim for a very low inventory days on hand, DOH? What do you think, students?
That's a critical point to grasp. Perishable goods, well, they spoil quickly.
So they need to be sold fast.
Exactly. To minimize losses and ensure freshness, they need to be moved out of inventory extremely fast. A very low DOH signals highly efficient, rapid turnover.
Which is absolutely essential for profitability in that kind of business. Good point.
Next, let's explore a company's significant long-term spending plans, its capital investments.
These represent expenses for acquiring or improving long-term assets, such as property, plant, and equipment, PP&E, and intangible assets.
These assets increase when a company makes capital expenditures, CapEx, and decrease over time due to depreciation and amortization expenses.
Consider a textile factory deciding to purchase a brand new, highly advanced weaving machine to significantly boost its production capacity.
That substantial outlay is a capital expenditure. It's a large, long-term investment intended for the factory's future growth and increased output.
We generally differentiate between two distinct types of capital expenditures. First, we have maintenance capital expenditures.
This is the money a company spends simply to keep its existing assets in good working condition and maintain their current operational capacity.
Think about the regular servicing and minor repairs you diligently perform on your family car to ensure it runs smoothly and extends its lifespan.
That's precisely analogous to maintenance capital expenditure for a company, often forecast based on historical depreciation and amortization, maybe with a small inflation adjustment.
Second, we have growth capital expenditures.
This represents money spent specifically to expand the business, directly tied to management's strategic plans and anticipated revenue growth.
If your family decides to purchase a second car because the family has grown and needs more vehicles for daily commutes.
That's akin to growth capital expenditure. It's an investment aimed at expanding capacity, not merely maintaining what you already possess.
These forecasts are generally more discretionary and are directly linked to a company's planned expansion initiatives and projected revenue growth targets.
For forecasting depreciation and amortization, these expenses are based on the existing net PP&E and intangible assets already on the balance sheet, as well as their estimated useful lives.
You can often find detailed information about this in the notes to the financial statements.
Our source provides an example with YY Ltd. If we have their historical CapEx as a percentage of revenue and their depreciation amortization as a percentage of beginning assets,
we can use these historical relationships to project future asset balances. For instance, if CapEx for PP&E was historically, say, 1.2% of revenue and depreciation was 7% of beginning PP&E.
You can use these percentages, along with your revenue forecast, to calculate future PP&E balances using a simple formula. Beginning PP&E plus CapEx minus depreciation gives you ending PP&E.
Similarly, for Eliso Marketplace Ltd., depreciation expense can often serve as a sound basis for estimating their maintenance capital expenditures.
And for Eliso, their historical capital expenditures consistently hovered around 4.1% of retail sales, making a historical results approach quite appropriate for forecasting their CapEx.
Okay, another question for the class. If a mobile network company is rapidly expanding its coverage by building many new mobile towers in new cities, which type of capital expenditure will be significantly higher? maintenance, or growth capex.
In that scenario, it would undoubtedly be growth capex.
Why?
Building new mobile towers in new cities represents a direct expansion of their operational capacity into new areas and markets. That's the very definition of growth capital expenditure.
Got it. Next, we delve into capital structure.
How a company finances its operations and its critical investments. This involves understanding the precise mix of debt money borrowed and equity money invested by owners or shareholders.
Imagine you're planning to fund your higher education. You have choices. You could take an education loan from a bank, which is much like debt for a company.
Or your parents might use their savings and contribute directly, which is comparable to equity for a company.
The strategic way you combine these different sources of funds to finance your education is, in essence, your capital structure.
Analysts frequently use leverage ratios as their primary forecast object to project future debt and equity levels.
These ratios effectively measure how much debt a company employs relative to its equity or its earnings. Common examples are debt to capital, debt to equity, or debt to EBITDA.
When making these projections, you need to thoughtfully consider several factors. The company's established historical financing practices.
Any explicit statements management has made regarding their financial strategy.
And critically, the capital requirements that are implicitly suggested by your own capital expenditure assumptions.
Importantly, management itself may provide guidance on target capital structure ratios, such as a specific debt to EBITDA ratio they aim to maintain, or even their desired credit rating.
Let's illustrate this with a YYLTD example from our source. If management has publicly stated a target gross debt to EBITDA ratio, say 2.0, by a particular year,
And you have already meticulously forecasted their EBITDA, which stems from your revenue and expense forecasts.
you can then easily calculate their target gross debt. You simply multiply the target ratio by your forecast EBITDA.
For instance, if YYLTD's EBITDA is forecast to be a certain amount, and their target debt to EBITDA is 2.0, then their forecast gross debt would simply be double that EBITDA figure, a direct link.
And if we apply this to Warehouse Club Inc., we can use the four forecast approaches to their capital structure as well, using historical results.
An analyst might simply project a stable historical debt to EBITDA ratio if it has been consistently maintained.
With historical base rates and convergence, an analyst might consider if Warehouse Club, as it matures, should strategically increase its debt levels to align more closely with larger, more mature competitors.
Competitors who typically utilize more debt and perhaps distribute more capital to shareholders.
If management guidance is explicitly available on a target debt to EBITDA ratio or a desired credit rating, that can be directly used.
Finally, with an analyst's discretionary forecast, an analyst might intricately link the capital structure forecast to their free cash flow projections.
Developing a specific debt to EBITDA ratio and determining how much free cash flow might realistically be returned to shareholders.
So why might a very established public utility company with steady, predictable earnings be comfortable with a higher debt to EBITDA ratio than a young, volatile technology startup? What's the reason there?
That's an excellent question, and it gets to the heart of risk and stability. A stable utility company benefits from highly predictable cash flows,
Making it much easier for them to service and repay their debt obligations consistently.
a young, volatile technology startup, on the other hand, faces uncertain and often fluctuating earnings, which makes carrying high levels of debt significantly riskier.
This inherent stability allows the utility to comfortably sustain a greater debt load. Makes perfect sense.
So we've covered a lot of ground on making detailed forecasts, but here's the most important truth. The future is never perfectly predictable, is it?
Not at all. That's precisely why we undertake scenario analysis.
Imagine planning a significant road trip, perhaps from Delhi to Mumbai, especially if it's during the unpredictable monsoon season.
You wouldn't just have one rigid plan, would you?
Definitely not. You'll likely have a base case plan, the most probable scenario, with normal weather and smooth driving.
But a truly prepared traveler also considers a best-case scenario. Maybe no rain, clear roads, leading to faster travel.
And crucially, they prepare for a worst-case scenario. Heavy rainfall, waterlogging, unexpected detours, possibly even a breakdown, leading to a much slower journey.
That's scenario analysis. It's about preparing for different possibilities, judging the likelihood of each, and understanding their potential impact.
Exactly. The core purpose of scenario analysis is to move beyond a single point estimate forecast.
Instead, Analysts develop several distinct forecast scenarios, each built upon different assumptions about key risk factors.
Then, they meticulously assess the likelihood of each scenario actually coming to fruition.
Generic risk factors that influence virtually all companies, though to varying degrees, include shifts in the broader business cycle.
The intensity of competition, the dynamics of inflation or deflation, and significant technological developments.
Okay, so if you're analyzing an airline company, why would it be particularly important to conduct scenario analysis to consider the impact of a potential economic recession?
That's a very practical question for an analyst. In a recession, people typically reduce non-essential travel, and businesses cut down on corporate travel expenses.
This directly translates to reduced demand for flights, leading to lower airline revenues and ultimately diminished profits.
Airlines are inherently highly sensitive to economic downturns, making scenario analysis a crucial tool for understanding potential financial vulnerabilities.
Let's examine a truly fascinating real-world example of how a new technology can dramatically create different scenarios for an existing industry, the case of tablets cannibalizing personal computers, or PCs.
And its profound impact on Microsoft. First, let's quickly define cannibalization.
This concept describes a situation where a new product, like tablets, captures sales from an existing product, such as personal computers.
It effectively shifts the demand away from the older product, eating into its market share.
The Microsoft's situation provides a perfect illustration. The introduction of the Apple iPad in April 2010 had immense implications for PC manufacturers.
And by extension for Microsoft, whose core business revolved around the Windows operating system and Office software, predominantly used on PCs.
These new tablets offered PC-like capabilities, often with a touchscreen interface.
And critically, they ran on non-Microsoft operating systems like Apple's iOS or Google's Android.
An analyst at that time would have faced the daunting challenge of quantifying how much demand for traditional PCs would be lost to these tablets.
And what the potential impact would be on Microsoft's sales and earnings. A huge challenge.
Let's walk through the analytical steps, drawing insights from our sources, like the data in Exhibit 13. First step.
1. Pre-cannibalization PC projections. You begin by forecasting global PC shipments, broken down by consumer and non-consumer segments, as if tablets didn't exist. Maybe 350 million units baseline.
2. Tablet shipment projections. Next, you forecast the sales of tablets themselves, again segmenting them into consumer and non-consumer categories.
3. Estimating cannibalization factor. This is the pivotal step. You need to estimate the proportion of PC sales that will be displaced by tablets.
And this cannibalization factor often differs between consumers and non-consumers. Let's assume 30% for consumers, 10% for non-consumers, for our example.
4. Quantifying units cannibalized. You then multiply your projected tablet shipments by your estimated cannibalization factor to determine the number of PCs effectively lost to tablets.
For example, if 80 million consumer tablets were projected and the factor was 30%, then 24 million consumer PCs would be cannibalized.
5. Revenue impact. Finally, you multiply these cannibalized PC units by Microsoft's estimated average selling price, ASP, for its software.
If, say, the ASP for consumer PCs was $85 and for non-consumer was $155.
Then the 24 million cannibalized consumer PCs would translate to a revenue loss of approximately $2.04 billion for Microsoft in that segment alone.
By summing the consumer and non-consumer impacts, you arrive at the total estimated revenue reduction. Our sources suggest this could have been around $4.2 billion by FY 2014.
What's truly fascinating here is how analysts then delve deeper to understand the impact on profits, not just revenue.
Because software companies like Microsoft typically have a unique cost structure.
Yes, they generally exhibit a high proportion of fixed costs, costs that don't change much with sales volume like R&D or general admin.
Conversely, they have very low variable costs, costs that change directly with sales, like making an extra copy of software.
Since companies rarely explicitly differentiate fixed and variable costs publicly, analysts often have to estimate them.
One method, as detailed in Exhibit 14 perhaps, involves calculating the percentage change in total operating expenses relative to the percentage change in revenue.
For Microsoft, this might suggest around 29% of costs were variable, implying a substantial 71% were fixed.
Another approach, maybe like Exhibit 15, is to assign estimated fixed to variable percentages to different expense categories. R&D is mostly fixed, sales and marketing has both.
This method also often converges on a similar conclusion, showing a significant portion of the cost structure as fixed.
A crucial operating assumption for analysts is that even fixed costs will grow over time, but typically at a slower rate than sales, maybe half the rate of sales growth.
while variable costs are projected to change at the same rate as sales.
Now, let's examine the profound impact on operating income and EPS, earnings per share. Our sources illustrate a pre-cannibalization scenario, like in Exhibit 16.
With typical annual revenue growth of, say, 7.0% and those inherent high fixed costs, Microsoft's operating income was projected to grow even faster, perhaps at 10.6% annually.
This phenomenon is what we call operating leverage. High fixed costs mean extra revenue drops straight to the bottom line.
Right. It creates a powerful amplifying effect on profits, leading to an expansion in their operating margin.
However, when we consider the post-cannibalization scenario, maybe like Exhibit 17, where revenue growth is significantly reduced due to tablets slowing to 5.2% perhaps.
The operating income growth also decelerated to 8.0%. Crucially, the operating margin was actually reduced by almost a full percentage point compared to the pre-cannibalization scenario.
The specific impact quantified in our source highlights a projected annual revenue reduction of $4.2 billion.
Leading to $2.6 billion less operating income and ultimately 0.25 cents less in earnings per share by FY 2014, compared to the optimistic scenario without cannibalization.
This clearly demonstrates the tangible financial impact of such a disruptive technological shift. A big difference.
This powerful example naturally leads us to an important question. What if our cannibalization factor estimates are slightly off?
Exactly. That's precisely why insightful analysts don't stop at just one forecast. They conduct sensitivity analysis.
This involves creating multiple scenarios, typically a bull case, optimistic, and a bear case, pessimistic, by adjusting those key underlying assumptions.
Like the cannibalization factors. An analyst might project a bull case with lower rates, 15% consumer, 5% non-consumer, and a bear case with higher rates, 40% consumer, 20% non-consumer.
Our exhibits 20 and 21 in the source material clearly illustrate how altering these percentages leads to a range of estimated EPS impacts.
In the bull case, the impact on EPS might be smaller, maybe a decrease of 13 cents.
While in the bear case, it could be a much larger decrease, like $0.35.
This provides investors with a crucial range of possible outcomes and helps them understand the sensitivity of the forecast to different assumptions.
Empowering them to make more informed decisions by understanding the potential upside and downside.
So we've had a truly deep dive today into the intricate world of company financial forecasting. A lot to cover.
We began by understanding precisely what to forecast, exploring essential forecast objects like underlying drivers, individual lines, summary measures, and even those ad hoc events.
We then meticulously moved through the different approaches analysts employ, from relying on historical results and industry averages,
to incorporating management guidance and leveraging an analyst's own expert judgment.
That's right. We then carefully broke down how to forecast revenues, moving from big-picture top-down methods to detailed bottom-up drivers.
And the key takeaway there was always remembering to meticulously separate recurring sales from those one-time, non-repeating revenues. Very important.
And I then guided us through forecasting operating expenses, exploring the crucial coherence between revenues and costs.
We also delved into the vital area of working capital, using those practical efficiency ratios like DSO, DOH, and DPO to project short-term operational needs.
Finally, we explored capital investments, those significant long-term expenditures, carefully differentiating between maintenance and growth CapEx.
We also demystified capital structure, analyzing how companies strategically finance themselves through debt and equity.
And we concluded with the absolute necessity of scenario analysis, underscoring how preparing for different possible futures, just like planning for that monsoon road trip, allows us to anticipate and manage uncertainty.
Remember, finance isn't merely about crunching numbers. At its heart, it's about understanding the compelling story those numbers narrate.
And forecasting is the invaluable skill that allows us to predict the unfolding chapters of that story.
Mastering this will transform you into a truly insightful analyst, far beyond being just a calculator.
That's the core idea. So what does this all mean for you as future CFA professionals navigating the complex financial landscape?
You will frequently encounter diverse and at times even conflicting forecasts from various analysts.
Armed with the comprehensive knowledge from today's deep dive, you are now equipped to do far more than just passively accept those numbers.
You can critically evaluate them, question their underpinnings, and form your own informed opinions.
Next time you encounter a company's financial projection, I encourage you to pause and thoughtfully ask yourself,
What fundamental assumptions are hidden within this forecast? And what specific scenario is this analyst truly betting on? Good questions to ask.
Keep practicing, keep questioning, and above all, keep learning. Until our next deep dive, take care and all the very best for your CFA journey.
Welcome, everyone, to the Deep Dive. I'm truly delighted to have you join us today. We're about to embark on an incredibly important and fascinating journey, understanding how to value a company's shares. For many of your aspiring CFA students, especially those of you perhaps new to the world of finance, this topic might seem a bit abstract at first. But don't you worry. Think of it like learning to appreciate a wonderfully brewed cup of Indian chai. First, you understand the basic ingredients: milk, water, tea leaves, maybe some spices. Then you learn the perfect technique to brew it, ensuring just the right balance. And finally, you develop the palate to truly spot the exceptional ones, the ones with that deep, satisfying flavor. Our mission today is similar: to help you understand the core ingredients of company valuation, learn the techniques, and ultimately gain the judgment to identify truly valuable companies.
That's a perfect analogy, and I'm equally thrilled to be your guide today. Our goal in this deep dive is to provide you with a very strong and clear foundation in equity valuation. We know some financial terms can sound complex, but we promise to break them down to simple, understandable pieces. We'll always be using examples that connect with our everyday Indian life. We believe in patience and encouragement, you see. Because building a strong foundation, step by step, is truly the key to mastering finance. We've done a lot of work, sifting through various sources, case studies, real-world scenarios, to bring you the most important nuggets of knowledge and insight. So are you ready to embark on this exciting journey with us, dear students?
Absolutely. Let's get right into it then. The very core idea, the foundational principle we need to grasp today is intrinsic value. You see, when we talk about valuation in finance, we're fundamentally trying to uncover the true worth, or the underlying value of a company's share. This is distinct from its market price, which is just what you see fluctuating on the stock exchange every single day. The market price reflects supply and demand, current sentiment, sometimes even temporary fads. But intrinsic value, that's about the deep fundamental economic reality of the business itself. In the world of finance, analysts primarily use two broad approaches to understand stocks. First, there's technical analysis. Imagine you're watching a cricket match, okay? And you're trying to guess the next run rate of a batsman by only looking at the scoreboard. You're seeing past scores, how many runs were made in the last few overs, how many wickets fell, the pattern of runs. Technical analysis is a bit like that. It focuses purely on past market prices and trading volumes, looking for patterns and trends to predict future price movements. It doesn't really look at the company itself, just its stock's behavior.
But our focus today, and the foundation of equity valuation, is fundamental analysis. This is like analyzing the cricket match, not just by the scoreboard, but by truly understanding the game. You're looking at the player's form, the pitch condition. Is it a batting pitch or a bowling pitch? The weather, the team's strategy, maybe even the opposition's weaknesses. In fundamental analysis, we scrutinize the company's financial health, its management, the industry it operates in, its competitors, and even the broader economic environment. Things like inflation, interest rates, GDP growth. It's about looking at the very essence of the business. We're trying to figure out if the market price truly reflects what the company is worth based on these underlying factors.
That's a crucial distinction. And you're right, fundamental analysis is where we truly dig deep. Intrinsic value, as we define it here, is the value derived from a thorough, careful analysis of a company's investment characteristics, its future prospects, and its financial strength. Analysts often take two primary routes for this. One is the top-down approach. Here you start by analyzing the overall economic environment. Is the economy growing or slowing down? Then you identify which industries are likely to thrive in that economic climate. Finally, you pick specific companies within those attractive industries that you believe are well-positioned for success. The other approach is bottom-up. In this case, you might be fascinated by a particular company or a specific industry right from the start. You then focus on deeply forecasting its fundamental performance, its earnings, its cash flows, its competitive position to determine its value. What's truly fascinating about an analyst estimating intrinsic value, regardless of the approach, is that they are implicitly questioning the market price. It's almost like double-checking your electricity bill. Even if the amount seems fine, just to be absolutely sure you're paying the right amount and not a single rupee more than what you owe. It's a healthy skepticism, always seeking the true underlying value. So, my dear aspiring financial analysts, if you were asked to evaluate a new startup, a company that has just begun its journey, still very young, would you prefer to rely on its share price chart, which shows how its price has moved in the past? Or would you want to scrutinize its detailed business plan, its potential future earnings, and its innovative ideas? And more importantly, why would you choose one over the other for a new venture like that? Think about the insights each approach offers.
That's a very thought-provoking question, and it really gets to the heart of why we do this fundamental analysis. Once an analyst completes their rigorous intrinsic value calculation, they then compare it to the current market price of the share. This comparison typically leads to one of three conclusions. Imagine, for a moment, that after all your careful analysis, you've estimated the intrinsic value for a particular share to be, let's say, 100. Now, if the market price for that share is also 100, we say it's fairly valued. The market price aligns with your estimate of its true worth. It's priced just right, you see. If the market price, however, is 150, meaning it's trading at a price significantly higher than your 100 estimate, then it's considered overvalued. In this scenario, people are paying more for the share than you believe it's fundamentally worth. And conversely, if the market price is 50, which is substantially lower than your 100 estimate, then it's undervalued. You've found a potential bargain, a good deal. To put it in a context we all understand, imagine you're at your local vegetable market, and you believe a kilo of fresh ripe tomatoes is truly worth about 30.
If the vendor is selling it for 50, you might instinctively feel, this is overpriced, it's overvalued. Its real worth is less. But if by some chance the vendor sells it to you for 20, you'd immediately think, wow, this is a fantastic undervalued deal. It's that same intuitive understanding of value applied to shares, isn't it?
That's an excellent way to simplify it. But in finance, it's rarely that simple in practice. Analysts must also consider their confidence in their valuation. This isn't just about whether the numbers add up, but how reliable their chosen model is, how robust their assumptions are, and how accurate their input data is. A very small difference between your estimated intrinsic value and the market price might be overlooked if your confidence in your model or inputs is not very high. For instance, if your estimated value is 100 and the market price is 100.50, you might simply conclude it's fairly valued. Acknowledging that a 50 pasa difference is well within your acceptable range of, let's say, estimation uncertainty. It's just like how you might ignore a 105 difference on a 100 grocery bill, right? But you would certainly investigate a 50 difference, wouldn't you? Furthermore, if an analyst finds that many securities they've meticulously examined all appear to be, say, overvalued, especially if these are stocks in a market segment that's widely followed by a multitude of other experienced analysts, they would typically pause. Before making any bold recommendations, they would definitely recheck their models, their assumptions, and their input data very, very carefully. Why? Because it's generally improbable that all of them are truly mispriced in the same direction by a significant margin in a highly efficient market. We've seen from various case studies that mispricing, where the market price differs substantially from the intrinsic value, might be more common in what we call neglected securities. These are companies that are not widely covered or actively followed by many analysts, often leading to less efficient pricing. So, dear aspiring analysts, here's a thought for you. If you calculate that your neighbor's house, which is quite popular and well known in the locality, should be worth 1 crore, but it is currently listed for sale at 1.05 crore, would you immediately conclude it is overvalued and advise against buying it? Or would you consider other factors? What might make you more or less confident in your conclusion about that 5 lakh difference?
That's a very practical dilemma, isn't it? And it forces us to think beyond just the raw numbers. Now that we understand what valuation is and why it's so important, let's explore the three main ways or categories of models that financial professionals use to value a company. Think of these as different specialized lenses, each offering a unique perspective on a company's worth. The first category is present value models, often referred to as discounted cash flow models, or DCF models for short. These models estimate the intrinsic value of a security by calculating the present value of all the future economic benefits you expect to receive from that security. These benefits are usually defined as either cash distributed directly to shareholders, like dividends, or cash flows that are available for distribution after the company covers its expenses and investments. The core idea is that a rupee received tomorrow is worth less than a rupee received today, so we discount future benefits back to today's value. The second category comprises multiplier models, also known as market multiple models. These models are based on ratios. For example, you might compare a company's share price to its earnings per share, giving you the price-to-earnings ratio, or PE. These are primarily used to compare the relative value of one company against its peers, or against the industry average, or even against its own historical valuation. They provide a quick snapshot, of how the market is valuing similar businesses. And the third category is asset-based valuation models. These models are quite straightforward conceptually. They estimate a company's intrinsic value by taking the sum of the market or fair value of all its individual assets, things like its buildings, machinery, inventory, and even intangible assets, and then subtracting the market or fair value of all its liabilities, like loans or accounts payable. It's like adding up what the company truly owns and then deducting what it owes to others. To use a simple analogy for these three categories, imagine you're trying to value a beloved family business. Let's say a well-established sweet shop that has been running successfully for generations in your locality. For a present value model, you might analyze its consistent future profits, and specifically, how much of that profit is distributed to the family members who own it over many years. For a multiplier model, you would look at similar popular sweet shops in other neighborhoods, see what they were recently sold for relative to their annual sales or their number of loyal customers, and then apply that average ratio to your family shop. And for an asset-based valuation model, you would simply add up the current market value of its physical assets, the shop building itself, the ovens, the display counters, the raw materials, and then subtract any outstanding loans on the shop. Each approach gives you a different yet valuable perspective on the shop's true worth.
Indeed, each model offers a unique lens, and it's rare for an analyst to rely on just one. Why do analysts often use multiple models? Well, because every model is a simplification of a very complex reality, and the inputs we feed into them always carry some level of uncertainty. For instance, if you're trying to value a brand new high-growth tech startup that has only 1 year of financial data, forecasting its earnings and dividends far into the future using a present value model would be highly speculative. In such a scenario, an asset-based model might be limited if its value lies mostly in intangible assets. So a multiplier model, comparing it to other similar young tech companies that have recently been acquired or funded, might be more practical and reliable. The choice of model, therefore, heavily depends on the available information, the stage of the company, and the analyst's confidence in the quality of their data and assumptions. Now, for our aspiring analysts, let's ponder this. If you were advising someone on buying a very new, high-growth tech startup, a company with a lot of potential but little historical data, which of these valuation model categories do you think might be the most challenging to use accurately, and why? Consider the inherent nature of such a rapidly evolving and future-oriented business.
That's a very insightful question, and it really highlights the practical challenges, doesn't it? Let's now take a true deep dive into the first category, present value models. The fundamental concept here is rooted in a core principle of finance. People invest their money today because they expect to receive greater benefits in the future. For shares, these benefits primarily manifest in two forms: the cash dividends you receive while you own the share, and the potential change in the market price when you eventually sell it. It's just like how many families in India save money in a bank or invest in a fixed deposit today. They do so with the hope of receiving a larger sum in the future, perhaps to fund a significant life event like a child's education, a wedding, or building a home. The future value of that saved money, when brought back to today's terms by accounting for the time value of money, is its present value. You are essentially discounting those future rupees back to their current worth. Makes sense.
Precisely. And the simplest form of a present value model for equity valuation is the dividend discount model, or DDM. This model posits that the intrinsic value of a stock is simply the present value of all its expected future dividends. The fundamental assumption here is that a company, as a corporate entity, is typically a going concern, meaning it's intended to operate indefinitely forever. Therefore, theoretically, the intrinsic value of a share is the present value of all expected future dividends from today into the infinite future. This idea captures the long-term, perpetual nature of equity ownership.
Now, when we talk about dividends, it's important to understand that they come in various forms. Firstly, we have regular cash dividends. These are predictable cash payments made by a company to its shareholders at regular intervals. In countries like the US and Canada, these are typically quarterly. In Europe and Japan, they might be semi-annual. And in many other countries, including India and China, they're often paid annually. Think of these as your consistent, expected income, much like the monthly rent you receive from a rental property you own, or the fixed income from a stable government bond. Then there are extra or special dividends. These are one-time payments that a company makes. They might occur if a company doesn't typically pay regular dividends but has a surplus of cash, or if it's supplementing its regular payments with an additional non-recurring amount. This is similar to receiving a one-time bonus at work during Diwali, which isn't part of your regular monthly salary. It's an unexpected additional payment because the company had an exceptional year or perhaps a large one-off gain.
Next, we have stock dividends, often called bonus issues in India.
Here, the company issues more shares to its existing shareholders instead of giving them cash. Imagine owning a share of a company as being equivalent to owning a slice of a large, delicious cake. A stock dividend is like taking that same cake and cutting it into more smaller slices. You now have more slices, more shares, but your total ownership percentage of the entire cake, and therefore the company's overall value, remains unchanged. Crucially, from an economic valuation perspective, stock dividends themselves do not directly affect the overall value of the company or the total wealth of the shareholder. You simply own more, smaller pieces of the same pie. In a similar vein, stock splits and reverse stock splits also do not have an economic effect on the company's total value or the shareholder's total wealth. In a stock split, say a 2-for-1 split, you receive 2 new shares for every one you currently own, and the price per share becomes approximately half. It's like exchanging €1 note for €2.50 notes. You have more notes, but the total value you hold is still €100. It simply makes the shares more divisible or accessible at a lower price point. A reverse stock split is the exact opposite. The number of shares outstanding is reduced, and the price per share increases proportionally, similar to exchanging €2.50 notes for a single or 100 note. Finally, we have share repurchases, or buybacks. In this scenario, a company uses its cash to buy back its own shares directly from the open market. Imagine a successful Kirana shop owner deciding to buy back some shares of his own shop from investors. He is distributing cash to shareholders, much like a dividend, but the crucial difference is that by reducing the number of shares outstanding, the remaining shares become more valuable. Each remaining share now represents a larger piece of the company's ownership and its future earnings. Companies engage in buybacks for several strategic reasons. It can signal that management believes their shares are undervalued. It offers greater flexibility in distributing cash compared to fixed dividends. It can be more tax efficient for shareholders in some regions. It can also help absorb shares issued from employee stock auctions without diluting existing shareholders.
That's a very clear breakdown of dividend types. Now let's understand the dividend payment chronology, the sequence of important dates that determine who receives the dividend. The first date is the declaration date. This is the day when the company's board of directors officially announces their intention to pay a dividend, specifying the amount per share and the other key dates. It's like the day your family elders officially declare the amount of money or gifts they will distribute for a major festival. Next comes the ex-dividend date, or often just the X date. This is a very critical date. It is the first date on which a share trades without the right to receive the upcoming declared dividend. If you purchase the share on or after this date, you are X, meaning without that specific dividend. It's akin to a cutoff date for receiving a special festival gift. If you join the family celebration after the specific date, you won't receive that particular gift. What's crucial for our understanding is that, all else being equal, the share price typically drops by roughly the amount of the dividend on this ex-dividend date, because new buyers are no longer entitled to that cash payment. This price adjustment clearly reflects the economic reality that cash is leaving the company and going to the previous shareholders. Following closely, usually 1 or 2 business days after the ex-dividend date, is the holder of record date. This is the date by which you must be officially listed on the company's books as a shareholder to be eligible to receive the dividend. It's like the date the company checks its official guest list for the festival party to verify everyone who is entitled to a gift. And finally, there's the payment date. This is the actual day when the dividend is dispersed to the eligible shareholders. This is the day you finally receive that festival money or gift in your bank account. Simple as that.
That's very precise, thank you. So aspiring analysts, based on what you've just learned about these dividend dates, if your primary goal is to receive a particular dividend, would you need to purchase the shares on the ex-dividend date, or would you need to buy them before it? Think carefully about the implications of each date.
A very good question to ensure you understand the practical application of these dates. Now, let's delve deeper into the dividend discount model, DDM itself. As we discussed, for a company considered a going concern, that is, one expected to operate indefinitely, the intrinsic value of share today, V0, is theoretically the present value of all expected future dividends, stretching out from today into the infinite future. The formula is V0 equals RT, 1 plus RT, where DT is the expected dividend in year T, and R is the required rate of return. This infinite sum represents the idea that the value comes from all the cash flows you expect to receive as a shareholder, potentially forever.
Now, some of you might be thinking, but what if I only plan to hold the stock for a relatively short period, say 1 year or even 5 years? That's a very valid and common question. If an investor intends to hold a share for just 1 year, the value of that share today, V0O, would be the present value of 2 cash flows they expect to receive.
the expected dividend at the end of year 1, D1, plus the expected selling price of the stock at the end of year 1, P1. So the formula would look like V0 equals D1 1 plus R plus P1 1 plus R. But here's the crucial insight. That expected selling price, P1 itself, is derived from the next investor's expectation of their future dividends, D2, D3, and so on, and their eventual selling price, P2, and so on, right into the infinite future. So ultimately, even for a short-term investor, the stock's value still fundamentally relies on the stream of all future dividends that the company is expected to pay. It's much like buying a rental property for just a year. You care about the rent you receive during that year, but you also care deeply about what you can sell it for. And that selling price, in turn, depends on how much rent the next owner can expect to receive from it.
Let's consider a practical example, similar to one from our detailed case studies. Imagine a stock where annual dividends are expected to be 2.0 in year 1, 2.10 in year 2, and 2.20 in year 3. The analyst also expects the stock price to be 20 at the end of year 3. If your required rate of return on these shares is 10%, how would you estimate the value of a share today? Well, we calculate the present value of each individual expected cash flow. For the year 1 dividend, 2 euro discounted 10% is 2.201, which equals approximately 1.811s. For the year 2 dividend, 2.21 euro discounted at 10% is 2.01, 1.9 at 2, which is about 1.736. For the year 3 dividend, 2.20 euro discounted at 10% is 2.05 euro at 3 is 1.1003, approximately 1.653. And the terminal stock price of 20 euro at the end of year 3, also discounted at 10%, is 20.01.03, which comes to roughly 15.26. When you sum up all these present values, 1.81 down plus 1.736 plus 1.653 plus 15.0203, you arrive at an estimated share value of approximately 20.2 on a CO. See how we systematically broke down the future cash flows and brought them back to today's value.
That's a clear demonstration of the DDM's application. Now, while the DDM is foundational, some analysts prefer using the free cash flow to equity FCFE model. Why this preference? Because the FCFE model focuses on a company's dividend-paying capacity. That is, the actual cash that a company could distribute to its shareholders even if it chooses not to pay dividends right now, or if its dividend payments are inconsistent. This makes the FCFE model particularly powerful and appropriate for valuing companies that currently pay no dividends, or for those whose dividend policies are erratic and unpredictable, or even for private companies where dividends may not be a formal concept. So what exactly is FCFE? It's generally calculated as cash flow from operations, CFO, minus fixed capital investment, FCINV, plus net borrowing. Let's break these down slightly. Cash flow from operations, CFO, is essentially the cash generated from a company's core business activities before any financing or investment considerations. It starts with net income and then adjusts for non-cash items like depreciation and amortization, and also for changes in the company's working capital. Think of this as how much cash is tied up or released from short-term assets and liabilities. Fixed capital investment, FCINV, is the money a company spends on new fixed assets like machinery, buildings, or technology to maintain or expand its operations. And net borrowing is the amount of new debt raised by the company minus any debt that it has repaid. You can think of FCFE as the leftover cash a successful Kirana shop owner has after paying for all their daily operational expenses, after buying new shelves or inventory for the shop to keep it running well, and also after considering any new loans they took or old loans they repaid. This final leftover cash is what is truly available to be given to the owners or shareholders without harming the business's future operations. The valuation using FCFE then mirrors the DDM structure. V0 equals the present value of all future expected FCFE, from today into perpetuity. It's about the cash generation potential you see, not just the payout.
So, my aspiring analysts, here's a critical question. If a company currently does not pay any dividends at all, and perhaps has no immediate plans to do so, can we still value it using a present value model? And if yes, which of the two models we just discussed, the DDM or the FCFE model, would be more appropriate for such a company, and why?
That's an excellent way to test your understanding of these models' applicability. Now, whether you employ the DDM or the FCFE model, a single, absolutely crucial input that determines the intrinsic value is the required rate of return. This R is simply the minimum return that investors expect to earn on a stock to compensate them adequately for the level of risk they are undertaking. Analysts frequently use the capital asset pricing model, or CAPM, to estimate this required rate of return. The CAPM formula states, required rate of return on a share, current expected risk-free rate plus beta market risk premium. Let's unpack each component. The risk-free rate is the theoretical return you'd expect from a completely risk-free investment, such as the yield on long-term government bonds from a stable economy. The beta of a stock is a measure of its systematic risk. That is, how volatile its returns are relative to the overall market's returns. You can think of beta as observing how much a particular cricket batsman swings his bat compared to the average player. A batsman with a high beta takes more risks, meaning his score can fluctuate wildly, leading to higher potential for big runs, but also higher potential for ducks. Getting out for zero. Estimating beta in the real world has its challenges. For publicly traded companies, it's often derived from historical stock returns through regression analysis. But for private companies or those with changing capital structures, analysts might need to unlever and relever betas from comparable public companies to account for different debt levels, which is a more advanced technique. And finally, the market risk premium is the additional return investors demand for investing in the overall stock market compared to a risk-free asset. It's their compensation for taking on the general market risk. Estimating this premium can also be complex, with various approaches ranging from historical averages to forward-looking implied premiums. It's important to remember that different analysts might use slightly different inputs or methods for CAPM, leading to different R values. There isn't one single correct answer for R. It's often a judgment call based on available data and assumptions.
That's absolutely right. Besides CAPM, analysts also use other complementary methods to estimate R. For instance, they might add a company-specific risk premium, based on their economic judgments, to the yield on a long-term government bond. Or, for a company with publicly traded debt, they might even add a risk premium to the yield on the company's own bonds. Ultimately, selecting the appropriate required rate of return boils down to good business judgment and a deep understanding of risk. Much like deciding how much extra interest you'd expect for lending money to a friend versus lending it to a large, stable bank. The greater the perceived risk, the higher the return you would logically expect.
Building on that discussion of required returns, it's worth a brief mention that for valuing the entire company, not just the equity, especially when using something called free cash flow to firm, analysts would often use the weighted average cost of capital, WACC. This is a blended cost of all sources of capital: debt, preferred stock, common equity, weighted by their respective market values in the company's capital structure. It represents the overall return a company must generate to satisfy all its investors, and it's a critical discount rate for many enterprise valuation models. Moving on now, let's explore valuing preferred shares. Preferred stock is a fascinating hybrid security, possessing characteristics of both equity and debt. Generally, preferred shareholders do not have voting rights in the company, but they hold a significant advantage over common stock when it comes to receiving dividends. They get paid first, and also in receiving payouts if the company goes into liquidation. Preferred shares can be perpetual, meaning they have no fixed maturity date, or they can have a stated maturity date, much like a bond. They can also have embedded options, such as being callable by the company or convertible into common shares.
For a non-callable, non-convertible, perpetual preferred share, that is, a preferred share that promises to pay a fixed dividend indefinitely and cannot be bought back by the company or converted into common shares, the valuation is remarkably simple. Its value, B0, is simply the annual dividend amount, D0, divided by your required rate of return, R. So V0 equals D0R. This is precisely like calculating the value of a permanent stream of income, say from a fixed rental property, where you know the rent will always be the same, and you know the annual return you expect from it. For example, if a $100 par value preferred stock consistently offers an annual dividend of $5.50, and your required rate of return for such an investment is 6%, its intrinsic value would be calculated as $5.50 divided by 0.06, which comes to approximately $91.67. It's a very straightforward application of present value for perpetuity.
Indeed, a very clean calculation. Now, for a non-callable, non-convertible preferred stock with a maturity date, the valuation becomes a bit more involved, but it parallels the process of valuing a straight bond. You calculate the present value of all the future expected fixed dividends up to the maturity date. And then you add the present value of the par value or face value that you expect to receive at maturity. So it's V0 equals the sum of D of T divided by 1 plus R to the power of T plus the par value F divided by 1 plus R to the power of N, where N is the number of periods until maturity. It's absolutely crucial here to ensure that your discount rate R and your dividend payment frequency are consistent. For example, if dividends are paid semi-annually, you must use a semi-annual discount rate and double the number of periods.
Very good. Now, as you mentioned, preferred shares can also come with embedded options, and these options significantly impact their value. For instance, they can be callable. This means the issuer, the company, has the option to redeem or buy back the shares at a certain pre-specified price before their stated maturity. This option is primarily beneficial for the company. They typically exercise this option when market interest rates fall, allowing them to issue new preferred shares at a lower dividend cost. Because this option benefits the company, it effectively reduces the value of the preferred share for the investor. The investor faces reinvestment risk if their preferred shares are called when rates are low. On the other hand, preferred shares can be retractable, sometimes called puttable. This grants the holder, the investor, the option to sell the shares back to the issuer at a pre-specified price before maturity. This is essentially a put option for the investor. It's like you, the investor, having the option to put back the shares to the company, perhaps when interest rates rise significantly, making your fixed dividend less attractive, or if the company's financial performance deteriorates. This option provides a safety net for the investor, ensuring they can recover their investment. Because this option is valuable to the investor, it increases the value of the preferred share compared to a non-retractable one. For instance, in our deeper case studies, we've observed that a retraction option can significantly increase the value for holders, especially when the put price is attractive compared to the current market value. So, my aspiring analysts, here's a quick thought to solidify your understanding. If a company's preferred shares are callable, meaning the company has the right to buy them back, would you expect their intrinsic value to be higher or lower than if they were not callable, assuming all other factors remain constant, and why?
That's a very practical question that tests your grasp of how these embedding options shift value between the issuer and the investor. Now, let's move to a particularly useful present value model that addresses the challenge of valuing an infinite stream of dividends. The Gordon growth model, also widely known as the constant growth DDM. This model simplifies the infinite sum by assuming that a company's dividends will grow indefinitely at a constant steady rate, G. The fundamental formula for the Gordon growth model is V0 is D01 plus G, RG, which is more commonly written as V0 equals D1 RG. Here, V0 is the intrinsic value of the stock today, D0 is the most recent dividend that was paid, D1 is the next expected dividend, so D0 multiplied by 1 plus the growth rate, R is the required rate of return, and G is the constant perpetual growth rate of dividends. A critical point for all aspiring analysts and a common mistake in examinations is to remember that the numerator must be D1, the next expected dividend, not D0, the current one. Always project that growth one period forward.
That distinction between D0 and D1 is absolutely crucial and a classic point to be careful about. To give you an everyday Indian example for this, imagine a very well-established small kirana shop in a stable residential neighborhood. This shop consistently distributes a share of its profits to its owners. If you expect its profits, and consequently its payouts, to grow steadily by, say, 5% every single year, year after year, indefinitely, then the Gordon growth model is perfectly suited to help you estimate its value today. This model is best applied to mature, stable, dividend-paying companies that are relatively insensitive to broader economic cycles. Think of an electric utility company serving a slowly growing area, or a company that produces essential staple food products like rice or flour. Businesses with a long and consistent history of stable dividend growth are also excellent candidates for this model.
That's right. To effectively apply this model, we need a reliable estimate for that long-term constant growth rate, G. One common and robust way to estimate the sustainable growth rate is to use the formula G equals BAROE, where B represents the earnings retention rate, which is the portion of earnings that the company retains and reinvests rather than paying out as dividends, and ROE is the return on equity. This formula essentially tells us how much the company can grow organically by reinvesting its own earnings, assuming its profitability, ROE, remains constant. Let's consider a quick real-world application similar to a case study we've analyzed for a large global company like Siemens AG. Suppose an analyst estimates Siemens' long-term dividend growth rate G to be 5.4% based on its historical performance. The required rate of return R is estimated at 7.5%. The most recent dividend D0 was 3.70. To estimate Siemens' intrinsic value using the Gordon growth model, we first calculate D1, the next expected dividend. D1 equals D01 plus G on a plus 0.054, 1 plus 0.054. Then we plug this into the formula. V0 D1, ROG yield 0.8998, 0.075, 0.054, 0.898, 0.21 euro, 185.70. So the estimated intrinsic value of Siemens shares would be approximately 185.70. Now, how much of this value is specifically attributable to the dividend growth assumption? If there were zero growth, G0, the value would simply be D0R all equals 70, 0.075. It was 49.33. This means the growth assumption of 5.4% adds a substantial 185.70 euros, 49.33 equals 136.37 to the value. This highlights just how sensitive the valuation is to that gross estimate. We've seen from various sensitivity analyses that even small changes in I or GAR can drastically alter the estimated value. For example, if G for Siemens were lowered by just 1 percentage point to 4.4%, the value drops significantly to 124.61. This level of sensitivity is like how tiny errors in a Cricut run rate calculation can lead to a surprisingly huge difference in the final predicted score. Analysts must be incredibly precise with their inputs and understand the potential impact of small changes.
That sensitivity is an incredibly important takeaway for your future analysis. Now, for the Gordon growth model to be mathematically sound and practically useful, there are some fundamental assumptions. First, it assumes that dividends are the most appropriate metric for valuing the company's equity, and that they accurately represent the cash flows available to shareholders. Second, it requires that the dividend growth rate, G, is truly constant and perpetual, stretching into infinity. Third, the required rate of return, R, is also assumed to be constant over time. And perhaps most critically, the dividend growth rate, G, must be strictly less than the required rate of return, R. Why is this GR assumption so crucial? Because if G were equal to, or even worse, greater than R, the denominator, RG, would become 0 or even a negative number. This would mathematically result in an infinitely large or negative value for the stock, which, as you can imagine, doesn't make any practical sense in the real world. So for the model to yield a finite, positive, and meaningful intrinsic value, the growth rate must always be less than the required rate of return.
It's a foundational requirement for using this specific model.
That's an excellent point for our aspiring analysts to firmly grasp. Now, what if you're trying to value a company that doesn't pay a dividend at all right now and might not for several years? Well, directly using the BDM in its simplest form becomes problematic. In such cases, an analyst might assume that dividends will commence at some point in the future, say in 5 years, and then apply the Gordon growth model from that future point onwards. Let's walk through an example. Imagine a company that currently pays no dividend but is expected to initiate its first dividend payment of $4 at the end of year 5. T5. This dividend is then expected to grow at a constant rate of 6% into perpetuity. If your required rate of return is 10%, how would you value this share today? We can first calculate the value of the share at T4, just one period before the first dividend payment at T5. Using the Gordon growth model, V4, value at year 4, would be D5, RGG, $4. 0.10.06 equals $4, 0.04 equals $100. This $100 represents the value of all dividends from year 5 onwards, discounted back to year 4. Now, we need to bring this $100 value back to today by discounting it for 4 years at your 10% required rate of return. So V0 equals $100, 1 plus 0.04 equals $100, 1.4641 equals $68.30. This adaptation shows you can still use the Gordon model for non-dividend paying companies, but it relies heavily on those future predictions, which can be quite challenging for young companies.
So, aspiring analysts, here's a critical question for your conceptual understanding. Why is it absolutely crucial that the dividend growth rate, G, is strictly less than the required rate of return, R, in the Gordon growth model? What would be the mathematical and practical implications if G were actually greater than R?
That's a fundamental concept to understand for your CFA studies, indeed. Moving beyond the simple constant growth assumption, we know that companies often have varying growth patterns throughout their life cycle. This brings us to multi-stage dividend discount models.
Exactly. The most commonly used one is the two-stage DDM. This model is designed for companies that are expected to experience an initial period of high growth, say for any years, followed by a transition to a lower, more stable, and constant sustainable growth rate thereafter, extending into perpetuity. Imagine a dynamic young entrepreneur whose small, innovative tech business is growing incredibly fast initially, perhaps expanding by 15–20% a year as it captures a new market. But after a few years, as more competitors enter and the market matures, that rapid growth will naturally slow down to a more sustainable, perhaps 5–7% rate. The two-stage DDM is perfectly suited to capture such a realistic growth trajectory, modeling both the initial rapid expansion and the eventual maturity.
Conceptually, the formula for a two-stage DDM involves 2 distinct parts. First, you calculate the present value of all the dividends expected during that initial finite high-growth period. Then, at the end of that high-growth period, you calculate a terminal value for the stock using the Gordon growth model based on the assumption of the lower sustainable growth rate that follows. Finally, you discount that terminal value back to today's value. It's essentially like valuing 2 separate streams of cash flow, one for the finite rapid growth phase and another for the perpetual stable growth phase. Let's quickly go through a numerical example. Suppose a company's current dividend, D0, is $5. Dividends are expected to grow at a high rate of 10% per year for the next 3 years and then settle into a constant lower growth rate of 5% thereafter. The required rate of return is 15%. First, calculate the dividends for the initial high growth period. D1 plus $5, 1 plus 0.90, $5, weighted 50. D2 is going to 2 plus 0.10, valued 1 plus 6.655. Next, we need the dividend for the first year of the stable growth period, which is D4. D4 was D3, 1 plus GL, 6.655, 1 plus 0.05, 1 plus 0.05, plus 6.98775.
Now, calculate the terminal value at the end of the high growth period, V3, since it's at the end of year 3 and based on D4. B3 is your D4, or GL. Use 6.98775, 0.75, 0 comes down, that's $0, 0 is 10, sum is 69.7775. Finally, we discount all these cash flows and the terminal value back to today. This is 0. V0 is equal to D1 plus 3, D1 plus 1, 2 plus D3, 1 plus 3, 1 plus 3, 1 plus 3. V0 is $5 for 50 grams, plus $6 is 5, 1 plus 6, plus 6 plus 6, 1 plus 6, 5, 2, 10, 3 plus 69.877, 1 plus 2 different 3 plus 69, plus 3 plus 69, 7, 1, 69, 6, 7, 1 plus 6. Calculating the present values of approximately $4.78 plus $4.57 plus $4.08 plus $46 almost 1 cent. Summing them up, the intrinsic value of V000 is $59.74. This model offers incredible flexibility and is very powerful for valuing companies with non-constant growth.
That's a comprehensive walkthrough. Very helpful for understanding the mechanics. Our deep dive into various cases also introduces the 3-stage DDM, which can be even more appropriate for very young companies, those just entering their initial rapid growth phase. It typically assumes a high initial growth, then a transition period where growth moderates, and finally a lower sustainable growth rate into maturity. Interestingly, a 2-stage DDM isn't just for young high-growth companies. It can also be effectively used for older, more mature companies that manage to restart growth, perhaps through significant innovation, a successful new product line, or aggressive expansion into new markets before eventually settling into a lower, mature growth phase again. We've seen examples of how a 2-stage DDM might be appropriate for a company like IBM, which has been strategically transitioning its core business over time. So, aspiring analyst, if you were asked to value a brand new tech startup that is expected to grow incredibly fast for its first 5 years, then moderate its growth for another 5 years as it faces competition, and finally settle into a steady, mature growth rate for the long term, which type of DDM single-stage, 2-stage, or 3-stage would be most appropriate for accurately capturing its value?
That's a great way to test their application skills for different company life cycles. Now, let's shift our focus to the second major category of valuation models. Multiplier models, often called market multiple models. These models are very intuitive and widely used because they offer a quick yet insightful way to assess a company's relative value. They work by comparing a company's share price to some key fundamental variable, thereby creating a ratio or a multiple. This allows for a fast evaluation of a company's worth, especially when you compare it against its direct peers or the overall industry. To give you an Indian example for this, think about how you might compare the price of different brands of mobile phones before making a purchase. You probably wouldn't do a detailed breakdown of every single internal component or manufacturing cost. Instead, you might compare their price relative to their battery life or their camera quality or their processor speed to quickly see which one offers better value for your money. Multiples do something very similar for stocks. They provide a simple basis for relative comparison and identifying potential bargains or overvalued situations.
Yes, they're like handy financial shortcuts that give you immediate context. Here are some of the most common and widely used price multiples. The most popular one is the price-to-earnings ratio, PE. This is simply the company's share price divided by its earnings per share, EPS. It tells you how many rupees are investors willing to pay for every single rupee of a company's earnings. Generally, a higher PE suggests that investors have higher expectations for the company's future growth and profitability. Then we have the price-to-book ratio, PB, which is the share price divided by the book value per share. This ratio compares the company's market value, as determined by investors, to its accounting book value, which is essentially the value of its assets minus liabilities on its balance sheet. This can be particularly useful for valuing financial companies or those with significant tangible assets. We also frequently use the price-to-sales ratio, PS, which is the share price divided by sales per share. This multiple is especially useful for companies that might be rapidly growing but are not yet profitable, meaning they have negative earnings. Since PE wouldn't work, PS provides a valuable alternative. And finally, the price-to-cash flow ratio, PCF, which is the share price divided by cash flow per share, often using operating cash flow. This can be more robust than PE because cash flow is generally less susceptible to accounting manipulations than earnings.
It's important for you to know the distinction between trailing multiples, which use past values for the divisor, like last year's earnings or sales, and forward multiples, which use forecasted future values, like next year's estimated earnings. When comparing companies, you must always use them consistently. Besides these general multiples, there are also highly effective industry-specific ratios. For example, for cable companies, analysts might look at revenue per subscriber, as the number of subscribers is a key driver of value. For oil and gas companies, they might analyze proved reserves per common share, as reserves are their fundamental asset. These specialized ratios help us understand the key value drivers in a specific sector.
What's truly fascinating is how these price multiples, while often used as standalone comparisons, actually connect back to the fundamental discounted cash flow models we discussed earlier. In fact, many multiples can be mathematically derived from models like the Gordon growth model. For instance, the justified forward PE ratio can be expressed as the company's payout ratio divided by RG. This formula is incredibly insightful for an analyst. It explicitly shows us that the PE ratio is not just a random number. It's directly linked to the company's payout ratio, which is the proportion of earnings paid out as dividends. The required rate of return R, and the expected growth rate G of its earnings and dividends. Specifically, the PE is inversely related to R, a higher required return from investors, generally means a lower justified PE, and it's positively related to G companies with higher expected growth rates, typically command higher justified PE ratios. The relationship with the payout ratio can be a bit more nuanced, though.
While a higher payout ratio could initially suggest a higher PE, it also means less earnings are retained by the company for reinvestment, which could potentially lead to a lower future growth rate. This is what we call the dividend displacement of earnings effect, where current dividends might displace future growth from reinvestment. Understanding this helps analysts appreciate the delicate balance in capital allocation decisions made by management and their impact on long-term shareholder value. We've seen in our case studies how a company like Petrobras, with a higher anticipated EPS growth rate, might justifiably have a higher PE compared to its industry average, even if its current earnings are similar. Similarly, when we apply this to a company like Nestlé, if its dividend payout ratio is 68%, required return is 9%, and sustainable growth rate is 6.9%, then its justified forward PE is calculated as 0.68, 0.090, 0.069, which is 0.68, 0.021, giving us approximately 32.38. This calculation also clearly demonstrates how sensitive the justified PE estimate is to even small changes in these input assumptions.
So, aspiring analysts, if you encounter two companies in the same industry with very similar earnings per share, but one has a significantly higher PE ratio than the other, what fundamental reasons, based on what we just discussed, might explain this difference in market valuation?
That's an excellent question for you to apply your knowledge. Let's now explore the method of comparables, a very widely used and intuitive approach. This method is founded on a fundamental economic principle known as the law of one price. In an efficient market, identical assets should theoretically sell for the same price. In the context of equity valuation, this involves comparing a company's chosen multiple, like PE or PS, to a benchmark. This benchmark could be the multiple of a closely matched individual competitor, or the average or median multiple for its entire industry. Some analysts also use time series analysis, comparing a company's current multiple to its own historical average values or trends over time to see if it's trading at an unusual level. To use an Indian example for this, imagine you are in the market to buy a second-hand car. You wouldn't just look at its original new price. Instead, you'd compare its price to similar models of the same age, with comparable mileage, condition, and features that are currently available in the market. You would naturally expect cars that are truly similar to have similar prices, wouldn't you? This is the core idea of the method of comparables. You're looking for relative value, identifying if something is priced fairly compared to its peers.
However, a significant challenge with the method of comparables lies in identifying truly similar companies. In the real world, large corporations are often complex, operating in multiple lines of business, and they can differ substantially in terms of their business models, geographic reach, growth prospects, capital structures, how much debt versus equity they use, and even their accounting policies. For example, we've seen cases where two car manufacturers might have different price-to-sales PS ratios. One might appear undervalued based on PS, but a deeper look might reveal it has lower profit margins, higher debt, or a less innovative product pipeline. Similarly, when comparing two aviation giants like Airbus and Boeing using PE ratios, Boeing's higher payout ratio might support a higher PE. But Airbus's higher revenue growth and larger order backlog could suggest it deserves a premium too. It's rarely as straightforward as just picking the lowest multiple. Analyzing a company's PE over time, as we've seen with companies like Canon, can also give valuable insights into how the market has historically valued its earnings and what current trends might imply. The art lies in understanding the differences that explain why multiples might vary.
So, aspiring analysts, when diligently using the method of comparables, why is it absolutely crucial to meticulously find companies that are truly similar to the one you are valuing? And what specific fundamental factors, beyond just being in the same industry, do you think make them genuinely comparable for valuation purposes?
That's an excellent question that pushes us to think critically about comparability. Now, let's turn our attention to another important and widely used concept in valuation: enterprise value, EV. Think of enterprise value as the total market value of the company, often viewed as the true economic cost you would have to pay if you wanted to take over or acquire the entire company, not just its equity shares. It's a comprehensive measure. It includes the company's market capitalization, which is the market value of its common equity, plus the market value of any preferred stock, plus the market value of its debt, and then importantly, minus its cash and short-term investments. To put it very simply, imagine you wanted to buy an entire Kirana shop, not just the owner's share of profits, but the whole business lock, stock, and barrel. You wouldn't just pay for the owner's equity portion, you'd also have to assume any outstanding loans or debt the shop has. But you would, of course, gain control of any cash the shop has in its cash register or bank account. That complete amount, encompassing all capital sources, debt, preferred, equity, and net of non-operated cash, is the enterprise value. This measure is incredibly useful, especially when you're comparing companies that have very different capital structures, meaning some might rely heavily on debt financing, while others use more equity. Enterprise value can also be computed even if a company has negative earnings, which, as we discussed, makes P/E ratios problematic.
That's a very clear explanation of EV. And just like with price multiples, we have EV multiples like EBITDA, earnings before interest, taxes, depreciation and amortization, or evaporating income. EBITDA is frequently used as a proxy for operating cash flow because it strips out non-cash expenses like depreciation and amortization, providing a cleaner view of the cash generated from the company's core operations before any payments to financial stakeholders or taxes. EV multiples are particularly insightful for comparing companies across different industries or with varying capital structures because they reflect the value of the entire business, not just the equity portion. The main challenge with EV multiples in practice is often accurately assessing the market value of debt, especially if a company's debt is not publicly traded. In such cases, using the book value of debt from the balance sheet is often just a rough estimate. For instance, in our practical case studies, we've analyzed companies like Kimiko Corporation, calculating its enterprise value and its EBITDA multiple. And when comparing various mining companies, using EVA operating income multiples can highlight how lower multiples might suggest potential undervaluation or differing operational efficiency compared to peers. It provides a more level playing field for comparison.
So, aspiring analysts, if you're comparing two companies and one has a very high level of debt compared to its equity, while the other is primarily equity financed, why might enterprise value multiples like EV/EBITDA be significantly more useful and reliable than price-to-earnings (PE) multiples for making a meaningful comparison between them?
That's a crucial insight for understanding these powerful tools and when to choose the right one. Finally, let's explore asset-based valuation models. This model is quite straightforward in its approach. It estimates a company's value by summing up the market or fair value of its individual assets and then subtracting the market or fair value of its liabilities.
Yes, think of it like this. Imagine you are considering selling an ancestral home, a property that has been in your family for generations. To determine its fair price, you would first get a professional estimation of the land value, then the building structure's value, perhaps even the value of any antique furniture or fixtures inside. After totaling all these assets, you would then subtract any outstanding loans or mortgages on the property to arrive at its net worth. This, conceptually, is asset-based valuation. It works particularly well for companies that possess primarily tangible assets, whose market values are relatively easy to determine. This includes real estate companies, financial institutions, natural resource companies whose value is tied to their reserves, or businesses that are being liquidated. It can also serve as a useful floor value, a minimum value below which the company's shares should theoretically not fall, as it represents the net realizable value of its assets. This model is also very commonly used for valuing private companies, where market multiples or future cash flows might be harder to ascertain.
While intuitive, this method comes with significant limitations. It is especially challenging, almost impossible, to use for companies with substantial intangible assets that aren't easily quantifiable on the books. Think of a company's brand reputation, proprietary secret recipes, patented technologies, valuable algorithms, or the synergy value created when companies merge. For instance, we've encountered scenarios where a highly popular restaurant might have very old depreciated equipment, but it's true, Immense value comes from the chef's unique, secret recipes, its loyal customer base built over decades, or its prime, irreplaceable location. An asset-based valuation would only give you a minimum baseline here, often dramatically missing the true economic worth derived from these intangibles. Another limitation is that the values stated on a company's balance sheet, its book values, are frequently very different from their actual market or fair values. Assets are often recorded at historical cost and depreciated, which can be far from their current resale value. And for large public companies, analyzing and valuing extensive assets piece by piece can be an incredibly time-consuming and almost insurmountable task. However, despite these limitations, it can be incredibly useful in specific situations. For instance, we've seen how an asset-based approach can provide critical insights even for an airline that might be currently losing money. Why? Because its underlying assets, like its valuable landing rights at busy airports, its established flight routes, its aircraft fleet, and its airport facility leases, might have substantial intrinsic value to a competitor who's considering acquiring it, even if the business itself is currently unprofitable. It gives a baseline for potential acquisition value.
So, aspiring analysts, why would an asset-based valuation model likely provide a very inaccurate or incomplete picture of a highly successful, innovative software company, whose primary value might stem from its unique algorithms, its vast and engaged customer base, and its skilled team of developers, rather than its physical assets like office buildings or servers? That's a crucial distinction for your future analysis, and a classic example of where models can fall short if misapplied. Now, we've systematically explored three major categories of valuation models: present value models, multiplier models, and asset-based models. You might naturally be wondering, which one of these is the single best model to use? And the simple yet profound answer is, no single model is perfect. Each has its own distinct strengths, its own inherent weaknesses, its own specific set of underlying assumptions, and its own ideal application scenario. This is precisely why, in the practical world of financial analysis, professional analysts almost universally employ multiple valuation models. They do this not because one model is always right, but to gain much greater confidence in their intrinsic value estimates, and perhaps more importantly, to deeply understand how sensitive their conclusions are to different assumptions and various input parameters. Think of it like a highly skilled doctor who uses multiple diagnostic tests, a blood test, an X-ray, an MRI scan to get a complete and holistic picture of a patient's health. Similarly, using different valuation models allows you to cross-check your findings, gain a more robust and comprehensive view of a company's financial health, and ultimately arrive at a more defensible estimate of its true worth. It's about triangulation, confirming your insights from different angles.
That's an excellent analogy. Valuation is truly both a science, with its rigorous formulas and quantitative analysis, and a sophisticated art, which requires sound judgment, astute intuition, and a willingness to continually question your assumptions. The numbers and formulas provide the essential framework, but your critical thinking and discerning judgment are what will truly make you an exceptional financial analyst. We also adhere to what we call the law of parsimony in modeling, which suggests keeping models as simple as possible given the available inputs rather than making them overly complicated just for the sake of it. The ultimate goal is always to minimize the inaccuracy of the forecast, to get as close to the truth as possible. We've seen in various comprehensive case studies how using multiple models can highlight different aspects. For instance, one scenario involved a company valued using all three methods. A Gordon growth model might indicate the stock is fairly priced, while a multiplier model, like PE, suggests it's undervalued, and an asset-based approach might give a very conservative lower value. This scenario beautifully illustrates why checking assumptions across all models is absolutely vital. It forces the analyst to think deeply about why different models are yielding different answers. Perhaps the PE model is picking up on future growth potential that the Gordon growth model, with its stable growth assumption, isn't fully capturing. Or maybe the asset-based model is too conservative because of unrecorded intangible assets.
So, aspiring analysts, remember this core principle. An analyst who estimates intrinsic value is, by their very act, implicitly questioning the market's current estimate. And because of the inherent complexities and uncertainties in any valuation process, an analyst often needs a substantial divergence, a meaningful difference between their estimated intrinsic value and the current market price, before they confidently conclude that a significant misvaluation truly exists, and therefore, before they recommend taking any action. This avoids acting on mere noise or small estimation errors. This will be a key skill you develop for your CFA exams and beyond.
Precisely. Mastering these valuation tools will truly empower you to make more informed and confident decisions. Whether you're analyzing a large global corporation, advising on an acquisition, or simply making astute investment decisions for your own family's financial future, the fundamental principles we discussed today remain consistent across all these applications.
Well, everyone, that brings us to the end of our deep dive today. We've covered a substantial amount of ground, haven't we? From understanding the crucial concept of intrinsic value and differentiating between technical and fundamental analysis, to exploring the three major categories of valuation models: present value models, including the dividend discount model, the FCFE model, and the Gordon growth model, multiplier models like PE and EBITDA, and asset-based valuation. We've also highlighted the paramount importance of using multiple models to gain conviction in your estimates and to thoroughly understand the sensitivity of your assumptions. We hope this deep dive has provided you with clarity and a robust foundation.
Thank you so much for joining us on this enlightening journey. As we've seen today, valuation is truly both a rigorous science relying on formulas and data and a subtle art demanding your astute judgment, your intuitive understanding of businesses, and your unwavering willingness to critically question all assumptions. The numbers provide the indispensable framework, but it is your insightful judgment and your ability to connect the dots that will truly make you an exceptional financial analyst. So as you go forward, how will you apply this newfound knowledge and critical thinking to look beyond the superficial surface of everyday prices and truly uncover intrinsic value in the world around you? I strongly encourage all of you to review these concepts, practice with the examples, and most importantly, keep that spirit of curiosity alive.
Until next time, keep learning, keep questioning, and keep growing. Namaste. And we look forward to having you join us for our next deep dive.